congratulate on the successful flight. So I think this is more like a national milestone, and there's no stopping from here.
No stopping from here. The third rocket, the timeline for that, and it's going to be much larger than Vikram 1 as well. So you're moving up that trajectory also.
Yeah, that's right. So the next launch we're targeting this year, and we're going to build bigger vehicles from next year onwards, and also like down the line, large reusable vehicles as well. So it's a very interesting pipeline, So we want to become literally meet our dream of opening space for all.
Reusable. You use that word. When is that going to be a reality? Are you fast tracking that plan?
Yeah, of course. I mean, it'll be a few years. We'll probably.
Good morning. Friday is here. You're watching Power Breakfast right here on CNBC TV 18 in the Mumbai News Center. I'm Hormas Fatakia. With me is Vinny Motiwala, who's going to tell you whether it's going to be a Fab Friday or a Freaky Friday.
It has to be a fabulous Friday. I am hoping for that. I just want a Friday, though, a lot of earnings. But let's get to the top headlines then, Hormas. And starting with the top headlines coming in on the West Asia front, we have Donald Trump, who defends the war on Iran and says it's going very well. And overall, the talks with Iran's war and is going very well. The war will end pretty soon. Meanwhile, Iran publishes a restrictive draft plan for Strait of Hormuz operations, which proposes to block US as well as Israeli ships with penalties up to 20% of the value of the cargo if violated.
Wall Street ends lower, pausing this week's record-setting rally amidst renewed uncertainties in West Asia. The Dow slips over 450 points, breaking a 5-day winning streak, while weakness in the tech stocks dented S&P 500 and the Nasdaq, both of which ended below the flat line. The Asian markets have started the day mixed, while the GIFT Nifty is indicating a gap down start for our markets.
Oil climbs higher as renewed tensions in the Strait of Hormuz cast a fresh doubt over efforts to fully reopen the shipping route. Gold steadies while copper futures hit record high amid tight supply concerns.
On the earnings front today, State Bank of India is expected to see steady growth and asset quality, while margins will remain the key watch point. Titan is expected to shine with a strong set of results, while robust India operations and firm LME prices could power Hindalco's performance.
Tata Sun continues to face listing uncertainties after the RBI retained it in upper layer NBFC list and is yet to take a decision on the company's request for deregistration. The central bank added PSUs like REC, PFC, IRFC and HUDCO into the category, subjecting them to enhanced regulatory oversight.
It's a mixed picture to what the Asian markets are projecting this morning, but the action, of course, lies in South Korea and in Japan. The Taiwanese index and the Hang Seng are below the flat line, but take a look at the Kospi. When I walked into office earlier this morning, the Kospi was up around 0.75% or so, but right now the index has slipped into the red. And the Nikkei too is trading with some bit of pressure after what happened on Wall Street overnight. So as of now, the Asian markets are projecting a slightly negative picture. The Kospi is now down 1.5%. So it was up around 0.75%, now down 1.5%. The GIFT Nifty too is showing a similar sort of move as of now. Around about 95 points lower is what the implied open is suggesting. But there you can see the divergence between the spot and the futures prices, of course, at 24,739. The spot yesterday ended at 24,636. So still a 100-point divergence, Winnie.
Okay, that divergence is what we'll keep an eye out on. As of now, the Nifty implied open indicating a bit of a red start for the Indian markets. But on to our top updates and story for today, that's going to be West Asia. US President Donald Trump expects the war on Iran to end pretty soon, telling reporters during the questions on the global and domestic energy prices that he does not think that they can go much longer. Let's in fact listen in to his comments.
We had oil down to less than $2 in many places like Iowa. Oil was down to, gasoline was down at numbers that people hadn't seen in years. $1.85, $1.95. So it passed Tuesday. I was in Iowa at a stop, and we had $1.95, another one, $1.85 a gallon. And we'll see those days pretty soon again, based on everything I see. as soon as the war ends. And I think it's going to end pretty soon. I don't think they can go much longer. I think we're doing very well. I just, I'm involved in the negotiation. I think we're doing fine.
Meanwhile, Iran's president states that the US has applied maximum economic pressure, noting that Iran loses roughly 230 million cubic meter of gas daily as a result of US-Israeli attacks. Elsewhere, Yemeni forces reported that Houthi strikes using suicide drones and ballistic missiles left at least 18 troops dead.
Let's now set you up for today's trading session. Our research team is here with the trade setup, the stocks that should be on your radar, and of course the setup on the FNO side of things as well. Sonal is here to tell you all the market cues that you need to watch out for. Sonal, good morning. A happy Friday to you.
Happy Friday to you guys as well, but we did not get a happy handover from the US markets. Dow snapped its 5-day winning streak, was down around 400 points. We saw cuts in S&P and Nasdaq as well, led by tech stocks. The jobs report is something that investors are awaiting today, but shrugging off any concerns around West Asia crisis for now. Stocks are headed for second week of gains. However, it was snapped yesterday for Dow at least. Nasdaq could post its best weekly performance since May. Of course, we'll need Friday's data to confirm that as well. For crude oil prices, they continue to focus on what's happening with West Asia war, and we did hear the comments coming in from Donald Trump as well. For now, they are higher. Asian markets quite mixed, largely lower, and they are also focusing on earnings and some of the news updates which are coming in there. GIFT Nifty is indicating the start for our own markets could be in the red for today. For our own markets, the focus continues to remain on cash. Yesterday, Nifty Sensex and Nifty Bank closed higher, with heavyweights like financials and Reliance Industries lifting the market. After 3 days of big differences, markets saw minor adjustment after cash in comparison to previous 3 sessions. Mid-cap underperformance was something that kept the market breadth in favor of declines. However, small-cap index did well in yesterday's trading session. DIs bought around 4,000 crore rupees in cash market, while FIs sold around 18 crore rupees. Of course, Sudarshan will speak about it as well. There was some improvement in the longs data. 24,770 to 25,000 is the resistance, but 24,430 to 23,380 is the zone where there could be some support. So watching out for these levels on the Nifty.
Okay. Thank you so much for that, Sonal. But let's move on and get you the list of stocks to watch out for in the trading session. We have Upasana here to take us through that. Good morning, Upasana.
Good morning. Well, it looks like a result-heavy day today as well. Now, first up, let me start with Hero MotoCorp. It's been a healthy Q1 for the company. Margins better than the expectations. Volume saw an uptick of 23% on year-on-year basis. Revenue growth also stood strong at 36%, and margins stood at 13.3% versus 14.4%. And net profit overall has seen a jump of about 29%. Moving on to LIC, it's been a beat in terms of the VNB margins of the company, which was mainly aided by the favorable product mix. Now, total APE saw an uptick of 8%, and VNB margins saw an uptick of nearly 750 basis points at 22.9% versus the poll of 17.8%. So certainly a big beat on that one. Britannia revenue was largely in line. Volume stood higher than expectation, certainly a beat on that one. So volume stood at 9% versus the poll range of nearly 5 to 7%. Now revenue saw an uptick of 8% at 5,000 crores. Margins also stood at 16.8% versus the poll expectation of 17.4%, and PAT overall saw an uptick of 14%. Now coming to Lupin, the numbers were better than expectations. Revenue saw a growth of 32%. EBITDA margins also saw an uptick of 200 basis points at 29.6% on year-on-year basis. Now Siemens Energy, it's a beat on all front. Revenue growth was led by strong execution. Revenue has seen an uptick of 40%, and margins also exceeded by 400 basis points at 23%. Now moving on to Crompton, largely it's been an inline set of numbers. If I compare to the poll, there is a slight revenue miss. This is because of the 200 crore loss of sales due to the supply chain disruption is what the company has indicated. Revenue saw a growth of 12% versus the poll of nearly about 15% that we were estimating. EBITDA margin stood at 10%, largely in line with the poll. Now moving on to PG Electro Plus, the revenue growth stood higher, much stronger here at 35% on year-on-year basis. EBITDA margin and PAT largely in line. Company's RAC business, which is nearly 70% of the total sales, has performed strongly this time around with a growth of 38% on year-on-year basis. Now moving on to Apollo Tyres, revenue growth lower than expectations here. Revenue has seen an uptick of 13% and margin stood at 11.7% versus 13.2%. So all in all, these are the counters that we'll be certainly keeping an eye on in today's trading session.
Boy, that's a long list to pass. Now, thank you for that update. Lastly, to the one who people tune in to listen to, Sudarshan is here with cues from the FNO space. Sudarshan, good morning.
Good morning, Harma. So hope we end the week the way we had started on Monday. It was a very strong day we had seen. Hope we end the week on a similar note. As far as the cues are concerned, global cues are looking largely on a negative side. But if you ask me, it's looking FNO data. If you look, it's looking more through a positive biased rather than negative bias, because we have seen aggressive put writing, and that has taken Nifty PCR back to the levels above 1. And also another positive part is rupee continues to hold the levels below 95.50, and FIs, after adding short positions for 2 consecutive days, yesterday they have reduced short positions by more than 11,000 contracts. Not only that, they also have added long positions. Now, GIFT Nifty might be indicating you a downtick of almost 90 to 100 points, but over the last few days, you would have seen how GIFT Nifty has been indicating and how our market has been behaving. So, FIs in the index futures, they were buyers. They bought more than rupees 2,200 crore. In the stock futures, they bought more than rupees 200 crore. And longs position, I have told you, they have added more than 2,000 contracts. Short position, they have reduced by 11,000 contracts. Now, longs exposure has increased to 14%. It's the highest that we have seen in last 3 to 4 months. Now, coming to the options data, the reason I was telling you that aggressive put writing that we had seen, which put writing options were active? 24,600 and 24,700. Nifty at this point might be below 24,700, but again, we are seeing major open interest change even at 24,700 levels. On the call side, 2 active options, 24,700 and 24,750. So it looks like in very near term, we might hit the levels of around 24,800 to 24,850. That's the support I have taken, 24,515, and resistance would be 24,850. Which all stocks will be in focus? Blue Star, it was a weak set of Q1 earnings, had seeing addition on the short side. Kalyan has started seeing addition on the long side, and today Jefferies initiated coverage. Reliance Industries has been seeing addition on the long side. Yesterday was up almost 4%, and surprisingly SBI ahead of the Q1 earnings is today, and started seeing addition on the long side.
Sudarshan, thank you for that. Of course, we'll be watching out for SBI's results during the course of the day. Take a short break. All the action from Wall Street on the other side.
Welcome back to Power Breakfast on CNBC TV 18, and let's take a look at what happened in the US market. Wall Street's 5-day winning streak came to an end yesterday. The Dow fell almost 464 points as investors kept an eye out on what's happening in West Asia with the deal to open the Strait of Hormuz. All of that is still in the works. Now, S&P 500 as well as the Nasdaq also closed near the flat line, more on the red side versus the green. That is what happened in terms of the US market, and we're seeing a negative handover that's coming for the Indian market as well, Hormuz.
Indeed, and traders will also be awaiting the July jobs report later this evening, which isn't expected to show much improvement. CNBC's Steve Leesman is here to share the outlook and the likelihood of a rate hike by the Fed in September based on the oncoming data.
Fed Governor Lisa Cook joining the ranks of Fed officials who have said they would hike rates if inflation doesn't cool. And that's now a larger group if you count those three dissenters who already wanted to hike at the last meeting. The probability of a Fed rate hike in September remains high, but down from where it was a few days ago at 58% now. Despite higher bond yields on the day, part of that could reflect a general belief that I'm reading from forecasters in the market that inflation is expected to cool and hopes for a benign employment report tomorrow morning at 8:30. Here are the numbers we're looking for. Payrolls forecast to have grown by 83,000 in August, up from 57,000 in July. That's an okay number. The unemployment rate seen unchanged at 4.2%, and average hourly wages, they're estimated to have grown by 3.5%, also unchanged. So far, many Fed officials have suggested the labor market not pushing inflation higher, with wage growth relatively consistent at that 3.5% level. But the FT reporting that sources close to Fed Chairman Kevin Warsh say he, like Cook, would be prepared to raise rates in September if the next two inflation reports end up being hot and inflation expectations do not remain under control. And separately, the White House confirming that the president and Warsh have been speaking once in a while, they said. A story first broken in the Wall Street Journal last night said that Warsh has spoken with the president, quote, repeatedly.
Okay, thanks so much for that. But on that note, we're going to slip into a very short break. After the break, we'll get you details on RBI's upper layer NBFC classification. Stay tuned in.
Welcome back. Now, the Reserve Bank of India has released a fresh list of 17 upper layer non-banking financial companies. Tata Sons, which had applied for a deregistration as an NBFC, continues to feature on that list. Let's go across to Ritu to know which bank qualifies as an upper layer NBFC.
Well, a But status quo for Tata Sons, the Reserve Bank of India has once again classified them as an upper layer NBFC and again repeated that Tata Sons inclusion is without prejudice to the outcome of their deregistration application, which continues to remain under examination. Remember, Tata Sons was first classified as an upper layer NBFC in 2022, and then it applied to surrender that license in 2024 after repaying all of its debt. So essentially, the fate of Tata Sons still rests with the RBI and what RBI decides to do with the application. So absolutely no change as far as Tata Sons is concerned. Now, beyond that, this new revised list includes 17 names under the revised identification framework. The biggest change is the addition of 4 government-owned NBFCs. So REC, PFC, IRFC and HUDCO, they've all entered the upper layer list and therefore they're now going to be subject to more regulatory oversight. This of course comes on the back of the revised guidelines now saying that government-owned NBFCs can be included in the list, which was previously not the case. At the same time, PNB Housing Finance and Sammaan Capital, they no longer qualify as upper layer NBFCs under the revised methodology. But importantly, both of them will continue to remain under enhanced regulatory framework, because once you're classified as an upper layer NBFC, you remain under stricter RBI rules for at least 5 years, even if you no longer qualify as an upper layer NBFC. Now, apart from the 4 new entrants, the list continues to include the other names that were previously there, like Bajaj Finance, Shriram Finance, LIC Housing, Tata Capital, and others.
Thank you so much for that, Ritu. But on that note, let's move on and talk about SBI. It's expected to report its numbers, Q1 FY27 numbers. What is the expectation? Ananya is here to take us through all of that. Ananya?
Now, the street expects SBI to deliver another steady quarter, with NII likely to grow around 11 to 12% range, while PAT is expected to remain broadly stable or decline marginally due to lower treasury gains and a higher base here. Now, on the loan growth expectation front, it is the expectations are quite high from SBI. It's around 15 to 18% range, while asset quality is expected to remain stable with benign credit cost here. Now, margins will be the key monitorable for this quarter and going forward, because NIMs are expected to stay steady around 3% here. Now, in the previous con call, the management guided for FY27 credit growth of around 13 to 15%, domestic NIM above 3%, credit cost of around 50 basis point, ROA above 1% and a minimum 15% ROE, while reiterating confidence in asset quality. So investors will watch out if the management revise this guidance, especially on the margin front.
Getting you the latest now from the world of tech. Ananya, by the way, thank you for that. The big result of the day, SBI. But the AI Pulse is here and Rachna is here to decode all of that. Rachna.
Well, first up is Microsoft, that has opened its largest data center in India in the Hyderabad region. This is its 4th in the country. Adani Group and HDFC Bank are among the first users. This is a part of the $20.5 billion India commitment that Microsoft had made. Staying with India, then, the government has restarted its deepfake framework under the amended IT rules in force since February. Platforms get 3 hours now to act on a valid takedown notice. This is down from 36 hours. AI-generated content must be clearly labeled. Then, a New Mexico court has ordered Meta to pay $567 million into a child mental health fund. That is on top of the $375 million March jury verdict. Meta must also delete accounts of users under 13 and says it remains confident in its record. To chips then, SpaceX and Tesla have picked Grimes County, Texas for a terafab with an initial investment of $16.8 billion. At least 3,000 jobs are planned with this one. Then there's AMD that's buying Talas, a Toronto startup building specialized inference silicon. Terms were not disclosed of this deal, but it follows NVIDIA's $20 billion Grok acquisition that we saw earlier. In China, ByteDance founder Zhang Yimin has told staff not to distill rival models. This is as per the information and state-backed outlet The Paper. ByteDance has not been accused of distillation so far, so we'll have to see how that one goes. Then there's Google security team that says hackers are phoning staff at US financial firms, posing as IT help desk to steal credentials and extort them. Ransom demands run from $750,000 to $3 million. Then there's OpenAI that's removing text limits for free users. GPT 5.6 Luna now next week. And finally, OpenAI's first device. Bloomberg has reported that a donut-shaped smart speaker would be the first piece of hardware, roughly a size of a hockey puck, likely priced between $300 and $400. That's all that we have from the world of AI for now, but we'll get you more updates through the day.
Absolutely, Rachna. Thank you so much for that. But with that, we're absolutely out of time on this edition of Power Breakfast. Thank you so much for tuning in. Up next, your Pasa Morning Call.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC TV 18, Motilal Oswal.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you from the CNBC TV 18 Motilal Oswal studios. I am Prashant. With me, my colleagues Rima and Nigel. Guys, good morning.
Hi, good morning. Finally, it's a Friday. It's been a hectic last 4 trading sessions. We had to deal with CAS in the last half an hour or so with the extended trading, lots of earnings. But by the end of it, the Nifty and the Sensex are up 1%, while the Midcap index is down 0.65%, week to date so far. Let's see what Friday holds for us.
Well, that's right. Always good feeling, right, on a Friday.
Always.
Almost there at the weekend. It's almost towards the end of the earnings season as well. So looking forward to the weekend. But we've got a trading session to get through. So let's get straight to that.
Higher oil prices.
Higher oil prices, but maybe a little bit, but up and down. And it's to be expected, isn't it? And we were talking about this right at the beginning of the week when this entire MOU, once again, the talk started, etc., that fundamental issues about the Strait of Hormuz, how are you going to resolve that? Iran is saying, well, it's ours. And US is saying, well, it's everyone's. It's free passage through the strait, waterways or whatever. So, that's a fundamental sticking point. So oil jumped 5%. We are back above $83 as we go into this weekend. And Iran, and this is a report, by the way, which said that Iran is seeking to bar US and Israeli ships from the Strait of Hormuz. Remember, yesterday, same time, we were talking about how there was a pact between, Iran essentially was saying that they're reaching a pact with Oman. And I was saying, well, that is fine. Iran and Oman, they are on both sides of the strait. But what about the main thing is the Iran-US MOU? Because this is about the Strait of Hormuz, and the sticking point in that is the Strait of Hormuz. So how are both compatible in that sense? So we will see. Money, sanctions, etc., are easier to solve, but this has been the really a big sticking point in that sense. Now, there were actually 3 threads pulling on the market yesterday. One, of course, is oil. The second was Google Alphabet essentially launching a 10-part bond offering to raise up to $25 billion. So, the basic point is, capex spending is through the roof, right? Some $700 billion by the 7 companies in the US this year, 800 next year, whatever, big numbers. And increasingly reliance on, the bond market to finance it. So I think it got a great response, prima facie. But the point is that more and more of these companies are going to the bond market to fund some of this capital expenditure they're talking about. And the third thread pulling at the market was this FT article, which essentially said that Kevin Walsh is looking to stick with the Fed messaging despite the market backlash. What was the backlash and what was the issue? Issue was, Kevin Walsh saying, well, inflation is running hot. We've not met 2% for a long time, etc., 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 but refusing to commit to doing anything. Essentially saying that, well, we will see once the task force comes back with reports on what's the right way to measure inflation, whether we need to stick with PCE, etc. And that is the reason why bond markets on the long end, the short end, everything moved higher. The 30-year particularly got a fair bit of attention. And the FT article essentially saying that Walsh is sticking with the, with his plan. Whatever he's not changing course. That essentially was the message of the article. There was also another item there that Walsh is prepared to hike interest rates in September. So maybe, I don't know, that is what the market wanted to hear last time. We didn't hear, but the article threw that in for good measure. 2-year, the frontier naturally on the rate hike, because that's the most sensitive. The 2-year yields ended 6.5 basis points at about 4.25%. US equities 6.5 basis points higher on the 2-year, not lower. The S&P was down about 0.18%, and they were down small. So nothing very much in that sense. So actually the price change on the rates market, look at the equity market has been small. Actually, NASDAQ was absolutely flat. So little change on S&P, but nothing on the NASDAQ. And of course, today we get the NFP number, the US jobs number. The consensus is expecting an addition of 80,000 jobs, and we'll see what really comes through. I'll just quickly refer to, and I must refer to what happened yesterday was Sensex expiry, weekly options expiry, and that's why we finally ended. Between the 315 price and the final discovered price at 330. And the difference was about 160 odd points or so between 315 and 330. Actually, if you look at it on the Sensex, yesterday was the 4th day and the first expiry on the Sensex. It's been small. It's been much smaller on the Sensex. The difference has been much smaller as compared to the Nifty. But yesterday, compared to the last 4 days, prior 3 days on the Sensex, the gap was a little high, a little more, a little larger. I just want to. And those are the stats basically, right? Average difference over the last 4 days is 0.1%. on the Sensex. And the turnover was about 127 odd crores, which actually is not, there was just go back to that last plate. So 127 crores and a lot of, hand-wringing about how volumes perhaps are lower, and volumes generally are, as we've been talking about, down by 5-6 odd % overall at broker terminals, etc. But the turnover of the BSE in the last 10 minutes, 127, they were running at, whatever, 1.5, 2, 5, 10. And yesterday that number was 127. And even if you look at the volume WAP average turnover, typically in the last 30 minutes on the BSE used to be about, from what I remember, 200, 250 odd crores. So this is not a bad number in that sense. And of course, it needs to pick up, and as participation picks up, that's another talking point. Just one more thing, right? And this is the from day one what we've been talking about, which is the options market, the futures and options market becoming a bit of a blind bet on expiry days. And just take this example. I just wanted to put this up. The 79,300 call at 2:55 p.m. was at $60. It got sold at 120 at 3:25 p.m. How is that possible, right? It's just, the only explanation is fear psychosis. The buyer of the call was essentially betting that the discovered price is going to be substantially higher. Actually, the final closing price was below the strike price. So that call was so out of the money by the time that the expiry happened that, it just doesn't make sense. And this is the problem that we've been talking about with regards to, cash. The idea is great and all that is fine, but especially on expiry days, both the NSE and the BSE, and we highlighted the same example with the Nifty strikes on Tuesday, but that is the basic problem. You need to, find a way so that, you're not expiring contracts at the discovered price on a Tuesday or a Thursday, because then it's a bit of a blind bet in that sense. So just wanted to put that up quickly. That's the Nifty. I just wanted to just for equal measure, put up the Nifty changes as well. On your screen right now, the difference has come down quite substantially. We started on Monday with a 200-point difference between the 315 and the 330 price. Yesterday, the difference was just about 8 points or so. So we've come, already it's looking much more, much better in that sense. Okay, let me just quickly wrap up the levels then. And these are support and resistance levels. Nifty support at 24,600 and then 24,500. These are round, broad numbers that we will watch out for. And on the upside, 24,870, as we've been putting out for some time, the 24,900 odd mark is the resistance as far as the index is concerned. GIFT Nifty gives you a quick sense of where we start, and then we'll pick it up from there. 100 points lower, and you don't have to adjust too much because the 315, 330 price was only about 8 points change. So that's the price that you're seeing, and you can go with it. Nigel has walked across to the wall with the FNOQs and the positioning. Nigel, take it away.
Well, yesterday in the cash session, there wasn't too much of a difference. Well, I'll tell you what, for the day itself, the difference between the high and the low on the Nifty was only around 73 points. I looked at it through the data, and I don't think in multiple months we've seen such a narrow trading session. So for the day itself, the Nifty didn't move too much. We were in a very, very tight band. And also it seems that things are at least easing out or stabilizing in the cash session. So that's good news, because otherwise that volatility doesn't help anyone. So as you can see on the screen, that difference between 315 as well as the close wasn't too much. In terms of flows, in yesterday's trade, the DIs were biased. The FI number was more or less flattish, which is par for the course. But there were clearly signs of shorts getting covered out for the markets on the whole, because you had the Nifty as well as the Nifty Bank. The open interest on both those two was a little bit lower. Now, if you look at the positioning, well, for the FIs, it perfectly tallies in, because in trade yesterday, you had the short positioning that was done by close to 12,000 contracts. And there was long addition to the tune of close to 2,000 contracts. The swing factor was close to around 14,000 contracts. And the short positioning is holding at around 86%, which is sharply lower from around the 92% that we saw in the last 1 month or so. Well, in terms of options, you had more number of puts getting written in comparison to calls. So clearly, most of market participants are not factoring in a big premium at roughly around 86 rupees, 24,700 put, premium at roughly around 130 rupees. And both those two, between them, they added close to around 63 lakh shares, which brings you to the levels. The recent high, that continues to be a bit of a resistance, which is ballpark around 24,770. 200 DMA comes in there. The recent high as well is around there. Well, support going by the options data, the first reference point comes in at around the 24,450. So that's going to be important. Well, in terms of results, I think the all-important result is going to be SBI. That's going to move the needle today for the markets, in trade today. And normally we see quite a big reaction on that one. So I think that's going to be probably the result of the day. Yesterday, there was some bidding up of the stock getting into the result day. So I'll keep an eye out on this set of numbers. That could actually change sentiment as well as move the market. So important to see. In terms of stocks that are moving in and out of the F&O ban, well, you have LIC that's still in the F&O ban. But going by the data that we saw yesterday, probably it's on the verge of getting out of the F&O ban. It could happen today itself. So we'll keep an eye out on LIC. And the stock that's moved into the ban is Bandhan Bank at around 160, 170 rupees. There was good amount of interest in a lot of delivery-based buying out there. So let's see how this one goes. But that's the new entrant in the F&O ban.
Thank you very much for that. SBI numbers typically come out between 1:45 to 2, and then following that, you've got the press conference. So in market hours will be crucially tracked. And on LIC, we'll also react to the numbers, and numbers looked pretty okay. But let's get you the latest updates from West Asia. So even as the Iranian Parliamentary Committee is reviewing a proposal to ban US and other hostile vehicles from using the Strait of Hormuz, and the Houthis have launched fresh attacks on Saudi deployments, US President Donald Trump expects the war on Iran to end pretty soon, telling reporters during questions on global and domestic energy prices that he does not think they can go on much longer. Listen in.
We had oil down to less than 2 in many places like Iowa. Oil was down to, gasoline was down at numbers that people hadn't seen in years. $1.85, $1.95. So it passed Tuesday. I was in Iowa at a stop, and we had $1.95, another one, $1.85 a gallon. And we'll see those days pretty soon again, based on everything I see, as soon as the war ends. And I think it's going to end pretty soon. I don't think they can go much longer. I think we're doing very well. I just, I'm involved in the negotiation. I think we're doing fine.
All right, let's get in our first guest in the show, Neeraj Seth, Founder, Chief Investment Officer at 3R Investment Management. Thank you very much, Neeraj, for joining in. So what's top of mind for you? We've got the conflict simmering on now for the last more than 6 months. There is worry about inflation. Crude prices have gone up. Yields went up last week. There is circularity of AI deals. There is AI debt funding. We had Alphabet raise. So what is top of mind for you now?
So I think I'm still very focused on the US rates market and the steepening of the curve there. And you've seen some big moves over the last few weeks. And you touched on the US Treasury market. You continue to see that. And you can see the reaction function where the US Treasury last week or over the weekend intervened in the Japanese yen. But it was not just a currency focus. It was also the focus on Japan intervening and obviously leading to the curve steepening further. So I think the US rates will matter a lot. If you see more sell-off in the 10 to 30-year part of the curve, that's not good news for the risk assets.
What's the rate that you expect on the US 10-year yield? And what do you expect the Fed to go ahead and raise rates?
So I still believe in my base case, the Fed is going to be on the hold for next 1 to 2 quarters. You have 5 different task force actually now put in place by Chair Walsh. So he's going to wait for that. But there is obviously a risk building up. If the inflation prints come hot, it'll be hard to hold the ground from the Fed chair perspective. So base case, I don't think a hike, but there is a risk of September meeting being live if the next 2 inflation prints are hot.
But the markets will keep worrying because so far, I mean, a lot of economists were questioning the Fed's credibility because he's not giving a path to bring down inflation to 2%, which has anyway not been achieved for the last 5 years or so. So if there is, and he's not even communicating that he's not going to hike, not going to hike. So that's kept everyone in, just a little uncertain. Is that going to keep the markets raising rates at the same time?
So I think to some extent, it's actually what you're seeing in the market is the lack of forward guidance is leading to higher volatility. And to some extent, the markets are trying to now second guess. But one thing is very clear. Chair Walsh has been absolutely crystal clear about reducing the forward guidance and letting the market do its work, which is how it used to be 25 years ago. Most people have forgotten. They have not lived through the era of the no forward guidance, and you obviously watch the data. So I think it will, in the short term, introduce more volatility and the risk of further spiking in terms of the curve. But longer term, I do think markets actually will not be as worried as they are today on the lack of communication from the Fed standpoint.
Okay, Neeraj, we'll leave the conversation here. Thank you very much for joining in.
Thank you.
All right, let me tell you the interactions lined up on the show today. First up, 8:35, the management of Nazara Tech will talk about the company's planned fundraise. There is a CEO transition succession. 9 a.m., Equirus Securities' Manoj Gori will talk about the consumer durable earnings. 9:20, Atul Mehra of Motilal Oswal AMC will be our market master for the day. 9:30, the management of Tenneco Clean Air joins in to talk about the June quarter numbers. Following that, Crompton will chat with us at 9:40. 9:50, another earnings conversation. The management of Samvardhan Madison joins in. Towards the end of the show, Lata will speak to Goldman Sachs, Santanu Sen Gupta and CLSA's Nikhil Gupta on the dovish RBI policy. Stay tuned.
The time to slip into a short break, but on the other side, we go full tilt on the stocks in focus. Hero MotoCorp, Britannia, LIC, Siemens, Lupin, all of them will be reacting to positive news flow. Add to the list a couple of more stocks, Fortis, Prima Energies, Crompton, PG Electroplast. So a lot of stocks reacting to positive news flow, while Apollo Tyres could be the one that reacts to its earnings on the downside. Take that break, come back, we'll tell you why.
Welcome back. You're watching Bazaar Morning Call. It's a Friday morning. It's time to talk stocks. Our research team is standing by with CNBC TV 18's list of top stocks for the day. Hi guys, good morning. Sudarshan, Hero MotoCorp.
Good set of earnings. Company has reported margins that were better than expectations. Healthy volumes have supported revenue growth, and realization too has come better than expectations on the back of price increase that company had undertaken. So talk about the headline numbers. Profit has increased by 29%, revenue has jumped by 36%, and EBITDA too has seen an increase of 25%, and in resultant margin has come at 13.3%, higher than expectations, but around 100 basis points lower if you compare YOY. Volumes, as we know, were higher 23% YOY. and that led to realization increase of more than 10% YOY and more than 4% on a sequential basis. Earnings call is at 10:30 a.m. We'll look out for what exactly company talks about new launches and the domestic outlook. But on the back of earnings, going with green.
Thank you. Manglam, what about Britannia? 50-50 or it's packed in a crunch?
Well, the results may look like they're 50-50, but I believe that investors may have a good day in trade today. Why do I say that? Because the revenue is in line. Volumes are a beat as compared to expectations. The EBITDA and PAT, if you look at the numbers, they may have looked like they're missing estimates, but the commentary is fairly strong. So revenues are around 5,000 crores. Volume, that's the massive beat. Closer to 9% versus expectations of 5 to 7%. The EBITDA is slightly shy of expectations, and that's largely because despite the gross margins expanding by 120 basis points, the company stepped up its expenses on advertisements and sales promotion, and as a result of which the margins came off. So that's not necessarily a bad strategy. You are stepping up promotions to step up volumes, and that's something that is working in favor of the company. They said that they delivered healthy growth while gaining ground against competition, exited the quarter with mid-teens revenue growth, and rapid scaling in e-commerce and robust growth in general trade led by higher ads and promotion spends are things that maybe the street would like the sound of. So going with green on Britannia. The call starts at 9:30. Let's see what the management says.
Okay, all right. Thanks a lot for that, Manglam. Good day, and probably we're going to have a good evening as well, Manglam. Look forward to some fun times this evening.
Nigel.
Well, let's hop across to Vinny. She's here to tell us about Siemens Energy. Vinny.
Hi, good morning. So good numbers coming in from this company. Overall beat on all fronts. Revenue growth led by strong execution. So revenue growth coming in at 39%, which is a 10% beat versus what the street was expecting, what we were expecting at CNBC TV 18 as well in terms of revenue. Margins of the company, good improvement there. 23%, 23.5% versus 19%. So strong expansion in terms of margins. Profits of the company also seeing a very strong growth. And obviously margins was led by operating leverage. That is surely working out. Higher export contribution as well as order execution overall is leading to the good performance. Power transmission business, that's interesting there because 42% growth in terms of revenue, but their margins were lagging. And now we've seen a strong performance coming in on the power transmission margin front as well. EBIT margins at 21.5% versus 18.7%. Power generation business, good and strong growth in terms of revenue. Margins over there also have seen an improvement. So all in all, good numbers coming in. Your order backlog is also very strong. 19,331 crores is what the order backlog stands at, which is an uptick of around 17% from last year. So green expected here today.
Thank you very much for that. LIC in focus. Yash joins in to detail out the numbers for us. Morning, Yash.
Morning. So, of course, as far as LIC is concerned, very, very strong set of numbers. The numbers on the value front are stronger than what they've delivered on the top line. As far as the top line is concerned, new business premium, that has seen a growth of 10%, total AP growing at 8%, retail AP growing at 7%. This is one part of the story. But look at the value which they've been able to derive. The value of new business, that has seen a growth of 61% in the first quarter. Margin is up by 750 basis points on a year-on-year basis. The margins have come in at about 22.9% versus 15.4%. And this time there is no economic assumption which has worked in the favor. It's pure product mix, pure business which has contributed to this strong value which the company has been able to derive. On VNB and margin, the numbers beat every estimate on the street. Also the CNBC TV 18 poll, and that has happened by quite a margin. VNB has come in at 3136 crore. The poll which CNBC had was 2638 crore rupees, hence there's a big beat there. VNB margins at 22.9% versus poll of 17.8%. So of course I expect the stock to be in green. It's beaten down 0.65 times price to embedded value and very, very good numbers.
All right, Yash, and can't take my eye off that look that you're sporting now. Al Pacino with the mustache, it seems. Wow, I think I'll have to try it sometime. Looking good, Yash. Thanks a lot for joining in and detailing those numbers. Well, let's hop across to Ekta. She's here to tell us about Lupin and Fortis. Ekta?
Well, I'll start with Lupin because the stock has, it's a good set of numbers that they've reported. A revenue growth of around 32%, margins of around 29%, better than our estimates, and a profit of around 1,416 crores. US-wise, it did well, so $366 million versus $282 million year on year. India was in a double digits, up around 14%. Other developed markets and emerging markets did show strong growth. So I expect the stock to see some green. But remember, the stock has run up quite significantly. For example, it's up around 10% in the past 6 months. Now for Fortis also, it's a good quarter. Revenue was up around 17%. Margins were a little subdued this time, so 21.1 versus 22% Q-on-Q and year-on-year. And the profit just about came in higher by around 2.3%. But hospitals revenue was up 19%, margins were 21.5%, diagnostic business revenue was up around 10%, and the margins showed a slight improvement. So overall, it's a working quarter for Fortis, you'd have to say.
Thank you very much for that, Ekta. Vivek now joins in to tell us more about Premier Energies.
Well, that's right. Good morning. Quite a healthy set coming in from Premier Energies. There were worries that this could be a muted quarter, especially given the muted performance of Wari, but driven by higher sell and driven by the fact that the company produces and sells entirely in the Indian market. You've actually seen very good growth coming across. Our revenues higher by over 35%, above the street expectations. EBITDA up 30% on a year-on-year basis. Margins quite healthy at 29%, and profitability higher by 50% on a year-on-year basis. The order book again is quite strong at almost 15,000 crore worth at with total module capacity of close to 9,867 megawatt, with cells now comprising a higher proportion of the order book at 58%. What led to the growth this particular quarter? Number one, higher cell production leading to better spreads, and also higher module production as well. Along with that, the transformer capacity that the company has built also has been ramping up. Now, along with that, one thing that could weigh a little bit on the stock performance today is the fact that the company has taken an enabling provision to go ahead and raise close to 5,000 crore rupees via the QIP route.
Got that. Thanks very much for that. Vivek, let's talk about Apollo Tyres next, and Sudarshan's got details on this one. So take it away.
So Apollo Tyres' performance is like the recent performance of Indian cricket team, somewhere doing good, somewhere doing not that great. So overall headline numbers, revenue has increased by 13%, but it's below than expectations. EBITDA was down 0.1%, almost flat, and margin has fallen to 11.7% versus 13.2%. Where exactly it's doing good? That's the Asia Pacific, Middle East and Africa market, where revenue has seen an increase of 15%, EBITDA has jumped by 14%, and margin was flat at 8.7%. Where it's not doing good is Europe business, because demand has remained soft, and that's the reason revenue, while it was up 10.3%, EBITDA has fallen by almost 70%, and margin has come in at just 0.7% versus almost 3% in the same quarter last year. So I'm going with mild red.
Thank you very much for that. Upasana now joins in to tell us about Crompton and PG Electroplast.
Good morning. First up, let me start with Crompton. Well, largely in-line set of numbers, but the revenue is slightly lower than what we were estimating, because the company has reported that there's a 200 crore loss of sale due to supply chain disruption, which is why the revenue saw a slight downtick out there. So if I talk about the overall revenue growth, it stood at 12% versus the poll of 15%. Now I talk about the revenue growth across the key segments. ECD it stood at 11%, lighting stood at 15%, and butterfly stood at 18%, much better than what the street was estimating. So certainly double-digit growth across the segments. EBITDA margin saw an uptick of just about 20 bips at 10%, which is largely in line with our poll. Now, company took calibrated price hikes and cost control measures to offset the inflationary cost pressures, and commodity inflation also resulted in cost escalation across categories. Now, if I talk about the gross margins, they saw a downtick of 90 bips at 31.2%, and PAT overall saw an uptick of 15%. Now, moving on to PG Electroplast, the revenue growth here stood quite strong at 35% year-on-year, much higher than what the street was estimating. That is around 28% growth is what the street was working with. Gross margin saw a downtick of 140 bips. This is due to the elevated commodity prices, is what the company has indicated. EBITDA margin and PAT largely in line. Now, EBITDA margin stood at 7.3% versus the estimates of 7.7% that we were working with, and PAT saw an uptick of 12% overall. Now, mind you, the key highlight here is also the cash and bank balance, which came in the positive category this time around. So, company is now net cash positive at 491 crore. Now, if I talk about the overall segment performance, the product business is the main highlight, which contributed nearly 80% of the total revenue. Here, the growth came in at 41%, and the key highlight of this one is the RAC business within the product business, which saw a sharp uptick of nearly about 38%. So overall, certainly a good set of numbers for both Crompton and PG Electro Plus, going with green on both.
Thank you very much for that. So many numbers to parse through, and there are more which you can see on the ticker line. A quick recap then of the top stocks. Stocks with positive news flow are Hero MotoCorp, Britannia, LIC, Siemens, Lupin, Fortis Health, Premier Energies, Crompton and PG Electro Plus, while Apollo Hospitals could be the only stock that's on our radar right now that's likely to, Apollo Tyres, sorry, that's likely to open in the red. Get into a break. On the other side, Siddharth Khemka, Motilal Oswal Financial Services joins in for some fundamental stock talk. We'll also connect with the management of Nazara Tech to discuss the company's planned fundraise and the road ahead. Welcome back. Let's invite the first management on the show. Nazara Technologies is looking to raise 733 crore via a preferential issue to fund growth. The entire issue will be subscribed by Blue Tile, Best Play founders and the leadership team. To discuss this on the road ahead, we have Nitish Sen, founder and CEO and managing director of Nazara Technology. Nitish, before we get to the numbers, the revenue, the margins, if you could tell us your decision to step down from active management. What prompted that, and what are you going to be involved with? Are you going to be involved in the capital allocation decisions, M&A, because Nazara has grown with a lot of acquisitions. So what's your role going to be? And what's the new leadership what will Nazara look like under the new leadership?
Sure. So Nazara already had a CEO in place for 7 years from 2015 to 22. And when that CEO departed, I took a decision to come back as CEO. Time flies and it's been 3.5 years. But I think at the stage Nazara is to take this to the next level, especially in the ever-changing world of AI, which is throwing up huge opportunities. We thought bringing in a global CEO would be really useful for us to plug into the global gaming industry. And I think that is what has led to this. I continue as managing director of the company, and I will be focusing on the long-term vision, looking closely at the way the world of technology is changing in gaming, because that's been a passion for me, M&A, strategy. So I think those are the areas I will be focused going forward.
The other aspect in the numbers is your decision to move from an earnout structure for Blue Tile and Best Play to a fixed $303 million. So what changed? What prompted this change in how you're going to be acquiring this company? Because in a way, it does remove the, with the earnout structure, the earlier structure, it gave you that downside protection in case the acquisition didn't do so well with the earnout. And how are you planning to fund it? Tell us a little bit more about the 733 crore of preferential issue.
Yes. So I think one is certainty of valuations was something we wanted to achieve in the revised structure. At the pace Blue Tile is currently growing, 54% up year on year, we felt that there's a high chance that they would earn, the earlier structure capped it at 180% of earnouts, and we thought they could potentially hit the upside. So I think capping this and fixing the valuation made sense. Also, now from day one, the company, the Blue Tile and West is 100% owned by Nazara, which means all the economics, including the cash flows, directly accrue to us. I think there are multiple benefits. And the last thing is because we decided that Raymond could be a great CEO for Nazara, we wanted to ensure that his and his team's incentives are not directly correlated to one subsidiary of ours, but kind of, relevant across the board. I think multiple things in play leading for us to take this decision. In terms of how we will fund it, one is, of course, there is some cash at Nazara books and also in Blue Tile. Blue Tile is about $18 to $20 million of free cash lying over there at the point of acquisition. Addition to that, the Nazara existing businesses as well as the Blue Tile businesses are generating meaningful cash. And by April 27th, by the time this entire payout is due, more cash will be accumulated. Some debt, because Nazara has largely been a debt-free company, but now with growing cash flows, I think a conservative approach to debt is helpful, and we are open to that.
Okay. All right.
Yeah. Okay. So there are many plans right now on how we're going to fund it.
Yeah, Nitesh, just wanted that math again. As you said, both the entities put together, there's some cash in the book. So both together, how much is the cash that they have? Then this preference issue will fill part of the gap. So just lay that out for us, the total size, how much has already been covered, and then we'll get a sense about the debt that you are...
Between Nazara and Blue Tile, we would have about $30 million.
$30 million, okay.
And like I said, there will be cash accruing till April in both the entities. So that will add to this. Let's say, give or take, maybe we would need another $50-60 million to bridge the entire gap of what we need to cover for this entire transaction.
Okay, all right. So around 500 crores, 600 crores of debt is what you could be looking at in this. Got it. All right. So we got that out of the way. A couple of sell-side analysts were saying, why doesn't Nitish continue at the top? Bringing Raymond in is okay, but they would like you to be part of the day-to-day functions. But we get that on board, and we've spoken about that in the past as well. Let's talk about the IPO that you're looking at, Nodwin. What's the plan out there? What is the current stake first that you'll have in that entity? When is the IPO? And will you all be offering some shares in that particular IPO?
So Nazara owns 46% in Nodwin.
Right.
We had deconsolidated the business last year, but continue to work closely with the management. Company's grown well, come back to profitability, and we're seeing a lot of growth potential going forward. So I think they are definitely exploring an IPO. Early days still, but perhaps 2028 is when this could happen. Nazara will have a flexible approach. Our core gaming business is growing very well. That's where we are focused now. We've grown 14% year on year with our core IPs, and I think that will accelerate. Much higher margins. If you look at our Q1 results, we had 20% margins of the gaming business, and that can increase. So we could potentially sell a stake, but there's no fixed mandate at this point.
What is the targeted holding you would like to maintain?
I would say at least half of it.
Half of it. So approximately 23%.
Yeah.
Nitish, hi, good morning, and good speaking with you. I think Manish was the last CEO, right? And then
Manish was there in 22, just after our IPO.
So many, the thing is, Nitish, and we've spoken about this before, right? So many acquisitions, lots of, fundraise, restructuring. So there's a lot going on, right?
Yeah, I think what we are trying to achieve is really create a global gaming platform out of India, and that's not easy, right? Nobody believed that could be done, and I think to do that you will have to hustle, you will have to take big jumps. Look at this acquisition that we've done of Blue Tile, right? It's a 3,000 crore acquisition done out of India for a global business. So I think that's what we are trying to achieve, and that's why we are busy executing what we think is the right thing to do.
Could you just leave us with some way to think about? I mean, the aspiration is big, as you say. What will that translate to? Can you just quantify? I mean, it helps focus and fixes the mind to a number. So tell us, FY26, what was the how much did you do? And I'm not saying this is going to next quarter or the 2 quarters down, but say say 28, right? I mean, what should we expect?
So Nazara did about 1,850 crores of revenue in FY26 with 255 crores of EBITDA and 213 crores of operating cash flow. If you just compare that, if you look at a Q1 number, if I look at a pro forma, we haven't consolidated Blue Tile, but I'll just give you apple to apple pro forma number. Combining with Blue Tile, our Q1 would look like 947 crores. We reported 429 crores, but it would look like 947 crores. And Nazara did 46 crores of EBITDA, but the combined would look at 101 crores of EBITDA. So you can see the company already in FY27 time, in FY27 is going to be a multiple of what it was in FY26. And Blue Tile is growing at a very rapid pace. Year on year, Q1 growth is 54%. I think that growth plus our core gaming business growth coming back, you should see a large organic boost going into FY28. I think we're already at a pretty large base of about 3,500 to 4,000 crores of revenue in FY27, and you can extrapolate that into FY28.
Sorry, 4,000 crores of revenues in?
At a pro forma level, because Blue Tile will get consolidated from Q2, but at a pro forma level, if you're comparing to FY26, we were 1,850 crores in FY26. It'll be between 3,500 to 4,000 crores in FY27.
Okay, and what is the growth estimate you think on a total basis, 28 over 27?
I think blended rate organic, we are going to aim for at least a 25-30% growth.
No, this is included. This is all inclusive. Blue Tile included. X any other acquisitions you may do.
Yes.
Okay. All right. We'll leave it there. Thank you very much, Nitish. So appreciate you joining us, and we wish you all the best of luck with the new CEO and of course the acquisition and everything else is you're doing. As you said, there's a lot happening in the company. Well, I think 24,636 is where we left off yesterday, about 11 points higher. Let's just put up the GIFT Nifty. I think we're still down about 100. I mean, I think 8 o'clock we were down 100, and it's not very much different. This okay, 75 down now, so a little better, but not wildly different in that sense. Guys, we have I think Siddharth Khemka with us.
Siddharth Khemka is now joining in from Motilal Oswal Financial Services. He's here with us on the show. Siddharth, thank you very much for joining in. The one number from yesterday's entire track which stood out for you, which could be the stock of the day to your mind?
Hi, good morning. So I think Samadhana Motherson, that came out during the fag end of the market hours, but pretty strong Q1 performance, significantly ahead of our estimate because net profit was up 70%. Y on Y, EBITDA margins expanded 65 basis points at 8.8% compared to our estimate of about 8.3%. This was driven by better than expected profitability in the wiring business, the integrated assembly segments that also showed sharp improvement in overall margins. Going forward, we expect Samadhana Motherson to continue outperforming the global automobile production supported by increasing vehicle premiumization, the ongoing EV transition, as well as the company also boosts of a healthy order book across both automotive as well as the non-automotive segments. And hence, we believe that's a key stock that has consistently done well. And within the auto ancillary space, it is one of our preferred picks ideas, which continues to deliver quarter after quarter. So we recommend a buy with a target price of 178 on Samadhana Motherson.
Okay, all right. Got that. Hi, Sid. Good morning. Good to see you in, Sid. What about LIC? A lot of new shareholders as well will be tracking these results very, very closely. And Yash is telling us that the government doesn't plan on selling more stake for the next 2 years. So no fresh supply. Numbers look pretty good, actually. Your take?
So, yeah, good morning, Nigel. Glad to be on the show. I think, yes, after the OFS, there were certain market overhangs that there is more stake from the government that could come in and if that overhang is removed, I think in terms of purely in terms of numbers, very strong Q1 numbers. VNB margin saw sharp expansion of 730 basis points. So overall, we believe that the Q1 definitely pays a strong foundation for the growth over FY27, FY28. And given that this continues to remain a market leader, we are seeing the major concern on the margins now being delivered with strong margin expansion, the increasing contribution from the non-participating business, as well as improving the product level margins. I think that is a key positive from the results. Also, going forward, what is expected to improve is that the ULIP would likely to regain momentum along with high ticket sizes. So overall, we believe that with these strong numbers and the strong growth expectation going ahead, we have revised our estimates, specifically the margins front, and raised our target to 480, giving almost 24% upside from current level.
Okay, all right. Sid, request you to stay with us. For the time being, we'll slip into a short break. We come back. Sid will continue to be with us, so he'll be answering all our queries. We'll also be joined by technical experts. Mitesh and Sudeep are waiting for us on the other side. Stay tuned. Welcome back. Well, let's hop across to Hormuz. He's going to refresh our memory and tell us about all those big movers yesterday and some of them that were backed by delivery. Hey, Hormuz, what's up?
Morning, Nigel. And the gas stocks, the usual suspects continue to dominate the list. But unlike the first 3 days, the only change that you see is the fact that their closing price and their reference prices are nearly the same. There's no major divergence in yesterday's trading session. You look at ICICI Bank as well, almost the same as its reference price, turnovers of close to 90 crore rupees. Reliance as well, 1320 was the reference price, closed at 1325, turnover of just over 80 crore. HDFC Bank as well, almost almost the same as its reference price there, as a turnover of around 65 crore. Yesterday's turnover too was around about 1500 crore rupees. There was not no other stock that touched 100 crore in turnover yesterday. Bharti Airtel too, that was the one that was seeing a significant divergence over the first 3 days. That too did not see any major moves yesterday. 60 crore worth of turnover, and HCL Tech made an entry yesterday in the top 5 with turnover of close to 53 crore, and that one ended lower than its reference price in yesterday's session. Beyond the cash names, of course, there were lots of buzzing stocks that moved yesterday in reaction to earnings. Navin Fluorine was one of them, ended 13% higher at record highs. And the volumes as well yesterday, 38.5 lakh shares that were traded. The 20-day average is just over a lakh, and 15% of those shares were marked for delivery, so just under 6 lakh shares, and the 20-day average is less than 75,000 shares on the 20-day average front. Tata Technologies was another stock that did well yesterday. The stock was up 7%, close to 85 lakh shares were traded. The 20-day average is less than 10 lakh shares. And on the delivery front, 22% of those were marked for delivery. So less than 20 lakh shares for delivery. The 20-day average is 3.5 lakh shares. So significant delivery volumes on Tata Technologies as well. And lastly, Hindustan Aeronautics, of course, after that big brokerage note that came in from Goldman Sachs yesterday, the stock was up 6%. Almost 48 lakh shares were traded. The 6.5 lakh shares was the 20-day average, and for almost 46% of those shares were marked for delivery. So 22 lakh shares marked for delivery. The 20-day average is less than 3 lakh shares for HAL.
Got it. All right. Thanks a lot for that, Hormuz. Well, let's get back to our conversation with Sid. Sid, I think you all were positive, if I'm not mistaken, at lower levels as well. You were positive on Kalyan Jewellers. You could correct me on that one. I'm looking at a Jefferies note that's come in. They are initiated coverage with a target price, I think, of more than 800 rupees, if I remember correctly. And they're valuing the company at a 35% discount to Titan, which has been the case. Remember, the stock has already seen a big run. What's your view on the name from here on? It's around 600, was 650 last week.
So Nigel, if you look at company, this has been consistently delivering strong performance quarter after quarter. And however, the stock had underperformed last 1 year. From the lows, it has sharply recovered. And what we see is that Q4 numbers are pretty strong. Q1 also is expected to be pretty strong. And consistently, what we're seeing is the nationalized players gaining market share. So the unorganized to organized story continues within the jewelry segment in India. Titan being the market leader, consistently delivering numbers, and Titan remains our preferred pick within the jewelry segment. But nonetheless, Kalyan, we have been positive, and I think from the lower levels, we had a target price, which is now the stock is closer to our target price. We believe Kalyan continues to remain well positioned to deliver a sustained growth, supported by strong customer acquisition, the franchisee-led expansion that would also add to the overall growth, as well as improving profitability. Our expectation is about 20-22% kind of a CAGR earnings growth over the next 2 years. And with the discount to the market leader narrowing, I think the stock can deliver a 25% CAGR returns over the next 2 years.
Okay, all right. Got that. Sid, what about the auto ancillary space? Plenty of stocks, right? Came out from there. We had Hero. We had a couple of ancillary names as well. You had Apollo Tires. Anything that stood out for you?
So Nigel, I think first one was Samadhana Motherson that we spoke about. I think if you look at the Hero Moto numbers, that was the overall numbers were in line, but I think margins were something that needs to be looked at. And so margin performance has been pretty strong. So that was pretty good from Hero Moto side. Despite the sharp GM contraction, EBITDA margins fell only by 110 basis points to around 13.3%, which was higher than our expectation of 12.8%. So overall, I think Hero Moto EBITDA grew 25%, and due to the strong margin performance, net profit came in at a growth at about 30%. So I think that is something pretty positive about Hero MotoCorp, where we continue to have a positive view. In the auto space, I think in the two-wheeler space, our preferred pick continues to remain TVS Motors, where the company has been delivering strong growth in the EV two-wheeler space, market leader, consistently delivering growth, and even in terms of margins, pretty strong margins there. The other one was Apollo Tyres. Again, net profit was largely fueled by higher other income. If you look at segmental performance, decent inline numbers. But clearly, from the auto pack in the two-wheeler space, we like TVS Motors. In the auto ancillary space, Samadana Motherson remains our preferred pick.
Okay, Siddharth, we leave the conversation here. Thank you very much for joining in. Get into a break on the other side, pre-opening rates. We'll also be joined by Equirus Securities' Manoj Gori to talk about the key consumer durable earnings.
Okay, welcome back. Mitesh and Sudarshan are with us. Sudeep is with us today. Sudeep Shah, Head of Technical Derivative Research at SBI Securities. Mitesh and Sudeep, thank you very much, both of you, for joining us. It's another weekend. I'm not sure how much oil is going to make a difference, but I mean, if it opens up 5-6% this way, that way on Monday morning, then it'll make a difference. At least if you're trading, and it's one more weekend and anything can happen. Markets are shut, but social media is on. So what do you think, Mitesh? What's the thing to do here?
Prashant, I think, there's always this risk of a geopolitical event, and especially last few months we have seen that. Having said that, I think, traders should focus on the fact that the market looks like uptrending because most of the moving averages, the indicators are in rising mode. And while last 3-4 days we are seeing really contracting kind of an equation, I think as long as we are not breaking 24,400 in the short term, the immediate trend is on the upside, and therefore any declines to those levels will be buying opportunities. And as I've said this before, I think, once we start moving up, assuming we don't break the lower level, then I think there's a good chance that we might head towards 25,050, 25,100. So that's the way I approach it. Use declines to buy into it. Otherwise, the index is not giving you much joy. The other thing could be Bank Nifty, moving above 58,450, 500. Yesterday, we saw a lot of good movement happening in the PSU banks, Canara Bank, Indian bank sector. So Bank Nifty, I'd keep a close watch upon, but the level is 58,450, 58,500.
Sudeep, morning. What would your trading approach be?
Morning, Rima. Rima, what I feel is that
markets would enter into a period of consolidation as we've been witnessing in the last 2-3 days. Because the previous 2 weeks there have been a strong rally into the markets, and hence 24,750, which is the 200-day moving average, which is a kind of getting difficult in the last 2-3 days to clear. So overall, I feel 24,400, 24,450 is that dip which needs to be bought into. I feel we need to have a buy on dip approach, and there would be a gradual move beyond 24,700, 24,750 would lead to that level of 25,000 that we all are eyeing for. So 24,400, 24,450, one needs to be a buyer on the dip. For the bank Nifty, I agree with Mitesh that yes, since yesterday PSU banks have started to come back, and overall the structure of bank Nifty seems more stronger than Nifty. So here I feel that 57 300, 57 500 zone positionally will now become an important support. Any dip towards that zone should be used as a buying opportunity. Overall, 58 800, 59 300 are the levels that I am eyeing for on the upside.
Okay, and what about stocks, Sudeep?
Two of them, one from the PSU banking space, Union Bank of India. Yesterday, there was a strong breakout. Last 3-4 weeks of consolidation taken out. What I feel is here the stock is headed up to 190, 192 levels. This can be bought at current levels or on dips closer to 180. The stop loss will be 178. The second stock that is there on my radar is Polycab. We've seen wires and cables industry, the lot of stocks making a move in the last several days, and Polycab is strongly creating that kind of intermediate short-term bottom. And yesterday we saw decent action here. So this can be bought with a stop loss at 91.80. The targets would be 94.80, 95.30.
And Mitesh?
I have two buys and two sells. On the buying side is AU Bank, which is a buy with a stop below 1,069. Look for targets of 1125. And apart from banks, the defense stocks also gave a good breakout. So Cochin Shipyard, that's the one which I have put down the recommendation list. If you get it mildly lower, say 10, 12 rupees lower, around 1480, 1475, buy with a stop at 1445 for targets of 1540. And on the selling side is Dabur with a stop at 417.5. Here, look for targets of 398 on the downside. And NHPC is a sell with a stop just about 79 for a target of around 74.
Okay, all right. Got it. Thanks a lot, Mitesh, for giving us all of those calls. We'll revisit them at around 9:10 a.m. Well, let's focus on the earnings of consumer durable companies then. You had Crompton, PG Electro Plus, I think IFB, Bajaj Electricals, all of them reported a lot of numbers. Now, to help us out with which is the pick of the pack, we are joined by Manoj Gori, Director Equities at Equirus Securities. Hi, Manoj. Good morning. Always good to see you win. A host of results came in, right? Last 24 hours. A couple of lesser known names as well, like an IFB Industries that you track rather closely. Which is the pick of the pack for you? I think Whirlpool as well came out, which IFB, the growth has been much better out there. So run us through that one stock actually that was the best among all of them.
Yeah, good morning, everyone. Thank you for having me on the show. See, if you look at from the set of results that have been registered during yesterday and in the week, we believe like probably if you look at electrical names have reported relatively better numbers, whether we talk about Crompton, whether we talk about Orient Electric. So there, and also if you look at V-Guard, these three names have reported far better numbers as compared to what expectations were. Even Crompton, if you look at, they lost close to around 200 crores of revenues during Q1. And despite that, they reported double-digit top-line growth and they have maintained their margins very efficiently. So if you look at electrical names, relatively have posted better set of numbers as compared to expectation. And especially if you look at on the profitability side, they have managed well. I think the pain more was visible on the large appliances. So if you look at players like Whirlpool, IFB, and Blue Star, they were able to report that double-digit growth, where we have seen larger portion of the growth coming because of the price increases. But despite that, if you look at, there has been significant impact on gross margins and EBITDA margins that we have seen for both Whirlpool and for Blue Star. IFB versus expectation, I believe like they have reported better set of numbers because it is expected like IFB margin should have been impacted more. But despite having lower gross margins and higher operating expenses, IFB has relatively delivered a better performance considering the macro environment. So at least from the last 2 days, I think this is the set of numbers that we believe like probably this is the highlight. Otherwise, if you look at from wires and cable space, brands like RR Cable, Polycare have been significantly outperformer. And these two names have consistently outperformed for many quarters now. And yeah.
Yeah, sorry. Mano, just a quick point. You mentioned Crompton in there. It's been a big underperformer over the years. Is there a turn in sight? There's been, by the way, we have the management coming on a little later, but is there? I mean, there's been all kinds of talks, right, with regards to whether is a change afoot. What do you think? Are there, betting on this one here, at this moment, this point in time, how is the risk reward?
See, for Crompton, if you look at risk reward remains favorable. The company over last 4 quarters to 6 quarters, if you look at, they have been able to deliver operating performance which is better than the industry average. Plus, if you look at the way they have managed their margin profile, I think that has been far superior as compared to many of its peers. So if you look at Orient, Crompton and V-Guard, in these uncertain times have been delivering better. Plus, if you look at going forward, there will be significant revenue contribution coming from your solar rooftops also for Crompton. So accordingly, your outlook for Q2 and Q3 seems much better than what we were expecting probably. Yeah.
Do you track Bosch Home Comfort?
We don't have it in official coverage, but yesterday they posted their numbers. The growth was relatively better in this uncertain environment. If you look at the market,
Manu, sorry, this is not. We're not talking about Bosch. Bosch Home Comfort. Is the air conditioning? Yeah, we'll just have that up. I think stock ended about. At least yesterday was up some 7% post numbers. Go on, Manoj. Finish that point.
Yeah. So if you look at overall, if you look at we continue to take names into electrical space, there the margin comfort has been better. Plus, if you look at the top line, has been relatively better in the current context.
What about PG Electroplast? Turned cash positive, good revenue growth, maintaining operating discipline in terms of costs and margins. What are your FY27 growth estimates? Have you revised it higher?
We will be revisiting the numbers for PG Electroplast. But if you look at considering the overall environment, plus if you look at the overall numbers that brands have been reporting at the primary level, we believe like the growth that PG has reported, which is close to 39% into their RAC business, has been extremely strong. There has been some pressure on the gross margins even for PG, and that was clearly visible in the numbers, and accordingly they were short of expectation. But that is bound to happen, we believe, and probably how we are going to manage the margin, especially for the large appliances, whether it's a brand or a third-party manufacturer. I think the roadmap to reviving the margin, I think, will be the key commentary that we need to look at from brands like PG or Blue Star. Probably both are having their calls today. Blue Star at 11:30 today. Yeah.
Okay, and just one quick word on room air conditionings. Blue Star numbers were a bit subdued. Would you bet on any RAC company for this year? Quickly.
Q2 again is likely to be relatively softer. It's a seasonally weak quarter. But somewhere we believe like a company like Blue Star probably should be evaluated from a 1 year's time frame. Margins have taken a dip. This is the first margin disappointment probably in last 20-24 quarters. So I won't be structurally negative on the space. In fact, we will evaluate the name from a 1 year point of view. So Blue Star, Voltas would be the names that we'll keep on the radar.
Got that, Manoj. Great conversation. Thank you very much for joining in and sharing your insights on all the various subsegments. The Reserve Bank of India has released a fresh list of 17 upper-layer non-banking financial companies. Tata Sons, which is filed for deregistration as an NBFC, continues to feature on that list. Ritu now joins in to tell us which banks qualify now as the upper-layer NBFCs which get added.
While it's status quo for Tata Sons, the Reserve Bank of India has once again classified them as an upper-layer NBFC and again repeated that Tata Sons' inclusion is without prejudice to the outcome of their deregistration application, which continues to remain under examination. Remember, Tata Sons was first classified as an upper-layer NBFC in 2022, and then it applied to surrender that license in 2024 after repaying all of its debt. So essentially, the fate of Tata Sons still rests with the RBI and what RBI decides to do with the application. So absolutely no change as far as Tata Sons is concerned. Now, beyond that, this new revised list includes 17 names under the revised identification framework. The biggest change is the addition of 4 government-owned NBFCs. So REC, PFC, IRFC and HUDCO, they've all entered the upper layer list and therefore they're now going to be subject to more regulatory oversight. This of course comes on the back of the revised guidelines now saying that government-owned NBFCs can be included in the list, which was previously not the case. At the same time, PNB Housing Finance and Sammaan Capital, they no longer qualify as upper layer NBFCs under the revised methodology. But importantly, both of them will continue to remain under enhanced regulatory framework, because once you're classified as an upper layer NBFC, you remain under stricter RBI rules for at least 5 years, even if you no longer qualify as an upper layer NBFC. Now, apart from the 4 new entrants, the list continues to include the other names that were previously there, like Bajaj Finance, Shriram Finance, LIC Housing, Tata Capital, and others.
Okay, thanks, Ritu, for that. Going across to Mitesh. Mitesh, 9-10 call, please.
Yeah, I'll go with a buy on AU Bank. Look to buy for targets of around 11.25.
AU Small Finance Bank. Got that. We'll watch that very closely. Ekta now joins in to tell us more about Lupin's numbers. Ekta, look good?
Well, yes, definitely a good quarter which came in for Lupin this time. So we had the revenue, which was up around 30% on a year-on-year basis. The margins expanded to around 29.6% versus around 27.6% on a year-on-year basis. And the profit was higher than estimates as well. Now, in terms of the geographies, the key geographies, US came in at around $366 million. This is versus $282 million on a year-on-year basis. India was strong. It showed a double-digit growth, strong growth of around 14%, and the other developed markets and the emerging markets did well for Lupin as well. Remember that the stock has run up quite significantly. For example, it's up around 10% in the past 6 months. So maybe a large part of the good news is probably factored in, but nonetheless, good performance coming in for Lupin, led by the US business.
Thank you very much for that. And now Mangalam is here just quickly to tell us about Britannia's numbers as we await the opening rates.
Well, we are also awaiting the Britannia conference call, which begins at around 9:30. We have the presentation and the internals out there look fairly strong as well. General trade growing 1.5 times, e-commerce growing over 2.5 times. The growth coming in material states as well. Overall revenues were slightly in line with expectations, with a big beat coming in on volumes at around 9% versus street expectations of 5 to 7%. The EBITDA largely lower than expectations because the company stepped up ads and promotion spends, and the net profit as a result of which a mild miss on expectations. But commentary is fairly strong, going with the green on Britannia.
Got it. All right, Mangalam, thanks a lot for that. Well, here's a quick recap of all the top stocks we covered earlier this morning. Hero MotoCorp, well, that one will be reacting to its numbers. Britannia, Mangalam believed it was crunchy enough, and it is. It's up close to 2%. Yash told us LIC was good. Siemens Energy as well, I think the numbers are pretty good, as what Vinny said. And it's a thumbs up out there, 6% higher. Going with what Vinny said. Lupin in the green as well. Fortis more or less flattish. Premier Energies, I think, was mildly higher. Crompton as well was more or less flattish. And PG Electroplast should come up for you on the screen. Apollo Tyres, I think the stock had opened up more or less flattish with a bit of a negative bias. So bang on. That was the lone stock that was expected to open up in the red, guys.
Well, I think, we've got market open coming up in just a bit from now.
But I think we could highlight a couple of more stocks. Prashant, I'm just looking at a JM Financial note and they're talking about Kirloskar Oil. Out there's a miss on the margins and the gross margins as well have compressed. So the top line is very, very good. But Kirloskar Oil, the volume's not very high. But, at the start of the trading session, it's showing a downtick. Volume not high. So just keep that in mind. But it's showing closer around a 10% downtick on that name as well. So.
And Firstsource, a stock which fell 10-12% yesterday, could be down in pre-open, 3% lower. Kotak has downgraded Firstsource to a sell today. Their target price is 225, so much lower than the current market price. They say we expect the termination of a large contract to be a drag on near-term growth, which is only partly offset by the deal pipeline and the recent wins. So Firstsource also on your radar, and Vikram Solar in pre-open is down 6.5%, and here the numbers look a bit disappointing. So that's another one.
Yeah, absolutely. All these names and more as we start in the morning in just a bit from now, and we'll have that up. These names up on your screens. I think the Nifty is down 100 points, 24,540 in the pre-open, and we'll have the first rates come up, the heat map, and then all these individual movers and shakers. So lots of, it's been about individual names all through, and I guess today is no different as well, despite the slightly risk-off kind of sentiment that pervades. What do we have on your, should come up on your screens? Maybe an eye on BSE as well after yesterday's expiry. What do we, it's coming up on your screen. So about 1/3% lower on the Nifty Bank should be there. That's the opening bell. So 24,540. So about 1/3% down. Yeah, Nifty Bank is down about 1/3%. The Sensex is down, and the Midcap index is starting about 0.3% lower as well. So that's the start for you. 70 points. So it's not a big gash or anything. The indicative start at 8 o'clock was 100. Is down. We're down about 60 to begin this day. Market breadth is more. Stocks are opening, so maybe just get to it in just a bit from now. Nifty heat map, let's just go straight to it. Take a look at what's happening there. How are the 50 stocks opening? You've got Tech Mahindra, Bharat Electronics, Mahindra & Mahindra, ONGC, which is the top gainers. On the other side, you've got Bajaj Finance, Bajaj Finserv, Maruti, Hindalco, which are down. So that's the market start. About 8 odd names are higher, a few yet to open, and the rest are lower this morning. Prima.
Well, LIC is moving well, so that's up 2.5%. Macquarie says valuations remain attractive at 0.5 times FY27 price to EV, and a negative VNB multiple. Their target price is 550. And even another one, you've got a bullish note coming in from Jefferies on LIC. They've put the target price at 530, so that's moving well. Britannia is another one opening strong. Manglam was telling us about the numbers, 3.5% higher on Britannia. Well, a couple of other mid-caps deserve mention on the way up. It's Muthoot Micro. These are all earnings reactions, not getting into the numbers, but Muthoot Micro is up 8.5%. GR Infrastructure, Wakefit Innovations 4.5%, Vijaya Diagnostics 4%, SCI higher. In the large cap space, it's Hero MotoCorp, which deserves mention. That's up 2%. On the way down, Kirloskar Oil, a stock that Nigel highlighted, is down 8%. Sula margins have compressed. Vikram Solar weak. Finolex Industries and Crompton have opened with a cut of 3-4%.
Well, that's right, Rima. A few other stocks in the broader markets. You have Lloyd Engineering Works. Just take a look at that stock. It's up 6.5%. That's the play on the bigger player, which is Lloyd Metal. Some of their business will be coming from there. They're talking about defense, shipbuilding as well. So that's why that stock is up and about in today's trading session. Samartha Motherson is now bursting away. It's up close to around 5%. So good move is what you're seeing on that particular name. And Siemens, just take a look at the move you're seeing in that stock. It's building onto the gains. It's now up close to around 9%. As Vinny told us, those numbers look quite good. Explains why that stock has popped up in trade. Indraprastha Medicals as well. That one, in fact, is seeing a decent up move in today's trading session. So big move is what you're seeing on that name. Another couple of stocks that are moving around. Gala Precision Engineering. That one's down close to around 8.5%. Volume's not very, very large, so we can ignore that. MTAR, for the time being at least, either the recent circuit-to-circuit move has reversed, and the stock actually is probably at lower circuit with a cut of close to 5% after opening gap up. Sula, the last few days, has been dancing away post some wine. However, that stock has come back actually. I recall the stock moved from around 140 very swiftly to around 170, but that's cooled off today down close to around 5%. And Carraro India, that's the other newly listed company I recall, that one as well is softer to kickstart trade. Net 50 points down, the bulls will say, okay, that's fine. Let's get on from here on.
Okay, let's just look at BSE. I don't know if there's a move or anything of that sort, but it's up 2.25%. Yeah. So 35.18 is where BSE is starting this morning. MCX is the other one, which should come up on your screen as well. As I was saying in the morning, I mean, if you look at the overall volumes, turnover traded yesterday, for example, it picked up to a pretty respectable number on the BSE. About 129 odd crores was the turnover as far as the cash segment is concerned. Feedback from brokers is that there is a slight dip in volumes turnover across the board, not BSE, but NSE, BSE, everything. But that after any big change, market structure change, there is a bit of a dip which gets which should normalize. We'll see. But just wanted to put that up right now. Atul Mehra is with us. He's fund manager, Motiros for Asset Management Company. Atul, good morning. Great to have you with us here. Thanks for joining in. I mean, it's a busy market, and if you've got some of these stocks right and you've held on, I mean, you tended to make a lot of money. Single stocks, all the rage with, there are themes, but more and more it's getting a little dispersed, right? Because themes like, for example, electrification, it's I'm not saying it's overdone, but in a way it's just so maxed out that now to buy those names is hard. So people are looking for other ideas, right? I mean, underperformers, stocks which have not done anything for a long time, turnaround stories. So it's become a lot more broad-based, isn't it?
Yes, that's definitely the case. I think more importantly, like you mentioned, within the theme itself, there is a wide dispersion. Like you will have one electric vehicle company doing extremely well while the other doing very poorly. Similarly, like in quick commerce, like one company doing extremely well while others are kind of not being able to catch up to their potential. So it is not just like themes, but it is within the themes being company specific. That is really what is really making a difference, and not just the theme by itself. So I think that has been the key story. Additionally, I think other than the secondary market, like we've spoken, there's such a large pipeline on the primary markets, whether it in terms of IPOs, in terms of QIPs, in terms of blocks. So most of the street is, I think, kind of busy with the deal street to a larger extent than even the secondary markets by itself, because the quantum of the deal sizes, the liquidity that that is available for many of these names, it's easier to kind of participate and deploy money through deals than in the secondary markets by itself. So a lot of street is also busy on deal after deal per se. So that is the other key theme that is really playing out right now.
Atul, you just said that even in quick commerce, one company seems to be doing well while the others are sort of catching up. But as a house, you all have been very bullish on quick commerce. You believe that this could be the next wealth generation idea. And in a way, you all bet on all the three horses, all the three companies present in that. Have you all changed your view on quick commerce? Is this going to be dominated by one player, eternal, and the others sort of struggle? Or, what we're seeing right now, the underperformance of Swiggy or the news with Zepto and the IPO getting delayed is just noise?
Yes, Rima. So clearly the execution, like we've seen by Blinkit, is far superior than peers. And end of the day, it is like not just top line growth, it is bottom line, cash flow, etc. All that together comprise in terms of the valuation of a business. So in that sense, as a house, if you look at it, although we've had participation in various names at various points of time, but if you look at the size of allocation that we would have in, say, a Zomato or a Eternal, is disproportionately higher than any other name that we have. So I think what really matters is what is the allocation size that you have in a name. And from that perspective, I would say more than 90% of all our money would be in Eternal, while others would be much smaller or very marginal at best. So I think that is the key story here. And within quick commerce, like maybe in the near term, what is happening is it's not just the 3 or 4 guys that we know of. It is also in terms of the incumbent e-commerce guys like Flipkart and Amazon, which are now going all in terms of going for quick commerce. So now obviously they have global balance sheets, they have US balance sheets, and for them it is if they are not able to pivot to quick commerce, then they risk even losing what they've built over the last 15 years in e-commerce. So in that sense, given the size of the opportunity is so large, we believe that more and more people will contest for this market, and hence in the near term you might have a little bit of in terms of ceiling on profitability, but in the long term, the better execution companies will win in a big way. So that's the key story as far as quick commerce goes.
So for now, persist with 90% of your portfolio in one company, the one which is executing well, that's Eternal, right? That's the broad strategy. What's the other theme, Atul, that you all are very bullish on as a house, which can do well from here on in the next 2 years?
So in terms of themes, so we've had participation in terms of electric vehicles, like per se. That has been a theme that we participated in. A lot of it, I would say, has kind of played out. So that has been, again, one high value migration story from ICE to EV. So that has been a key winner for us as a house. Other than that, if we look at it in terms of themes, the classic, I would say, consumer discretionary plays, and which is more stock specific, bottom up names. So consumer discretionary is one key theme that we have as a house. Other than that, in terms of financials, again, it is very selective. Like some of the new age financials have kind of done well, and that part continues to do well. And in terms of broadly, other than that, I would say that private banks, although it remains promising, but as a space, it has not done well. So even now, lately, like some of the names like HDFC, etc., have kind of been again on the lackluster side more recently. So although medium to long term, that theme is promising, but near term, the stocks have not done well, while the valuations remain very attractive. So one other theme is telecom, which is, I think, a structural theme. So that continues to be a continuous overweight for us in terms of allocation. And there again, you have an IPO in Jio, which should kind of trigger valuation re-rating for the space. So that remains to be a very long-term structural buy and hold theme. So those are the key plays as of now in the portfolio that we have.
And even on this ICE to EV theme, are you disproportionately in Ather Energy, or do you also have holdings in an Ola Electric or some auto ancillaries like a Samvardhan, Uno Minda to play the EV theme? What's the best approach, since this is becoming such a stock-specific market and one stock is cornering all the gains in capital?
Yes, so we've had allocations to Ather and many of the names you spoke about. But again, like I was mentioning earlier, like while we might have in terms of multiple names, in terms of where the allocations are, in terms of proportion of the funds, etc., that really kind of matters. So yeah, obviously Ather has done well as a house for us. And other than that, we also have like substantial holdings in Samvardhana, etc., where there again, it's more than EV. It's in kind of a play on manufacturing to a large extent. They're getting into newer spaces like defense, aerospace, etc. So in that sense, it is a much more broader play than EV per se. But again, it's an allocation that we have across many of our funds.
LIC and NSE, all the excitement. Sorry, not LIC. Sorry. We're talking about NSE and Jio. These are the two big IPOs headed before Diwali. We could have a Diwali bonanza with both these. What has been the investor perception? I'm sure a lot of conversations are taking place as we head to these IPOs. Give us the feedback and the talk.
So NSE, yes, we've already met them along the way in terms of their IPO roadshows, etc. So NSE is obviously very promising as an asset. We've held NSE across many of our portfolios since many years now. It's been a multi-bagger for us in many of our portfolios, which are able to invest in unlisted securities. So in that sense, we've owned the name for quite some time, and we believe it is again a very promising play. In terms of Jio, I think it is yet to hit the roads in terms of company management meetings, etc. But again, here the thought process is that in terms of the biggest lever is on the tariff side, which is, we all know, significantly underpriced as compared to the value it delivers to consumers. So as there is repricing on the way up in terms of tariffs, you will see that in terms of that, most of it gets translated into bottom line, 80-90% gets translated to bottom line. So there is a massive operating leverage story that is available in telecom as a space. And we believe that as the Jio IPO comes about, even the existing listed company Bharti will kind of re-rate in terms of higher valuations, because as you have Jio coming in at a fairly high valuation, existing Bharti also should get re-rated. So along the way, as you will see tariff increases come about in the next 12, 24 months time, that again should lead to earnings re-rating as well for them. So long term, it is, I would say, a no-brainer kind of space to be in, because because of the kind of underpricing and tariffs that we have, and the monopoly duopoly between the two companies that we've seen. So so in that sense, it's a long-term structural allocation in telecom, and obviously we'll get to hear from Jio as they hit the roads in terms of company meetings.
We'll leave it there. Atul, thank you very much for joining us. Good speaking with you. Appreciate your time here on CNBC TV 18. Well, let's talk about the company on the radar. Tenneco Clean Air is what I'm talking about. Now, Tenneco is an auto components company, and it designs, engineers, and they're into critical vehicle components. They're clean air emission systems, powertrain parts, ride performance, suspension solutions. So, mobility, commercial vehicles, off-highway equipment, etc., etc. Just a bit of a background for those who are, in a way, the company's new to many, I guess. Well, they've reported a steady set of first quarter numbers, double-digit growth continuing, although margins have softened. Management, however, remains confident and has reiterated its mid-teen growth guidance. Arvind Chandra is CEO at Tenneco Clean Air. He's with us. Arvind, good morning. Great to have you with us here. Thanks for joining in. I have a question on margins that I wanted to start with, but maybe very quickly, Arvind, if you can just preface that with a qualitative comment on what your specific sort of end user companies, etc. What was the business environment for Tenneco in last quarter? How was it different from last year? How was this quarter panning out? And then maybe address the margin decline issue. Go on.
Yeah, sure. Thanks for having me, Prashant. Nice to talk to you again. So as you know, we are a tier 1 auto component supplier. We supply to over 100 customers. So we are pretty well known in the auto industry as a supplier of engine, component systems, as well as chassis component systems like suspension technologies. We have very high market shares in India. We are a technology company. When you think of Tenneco, you have to think R&D. We had a very successful IPO last November, if you remember. And since then, we've performed quite well. So and we are a high margin company, as you can see, compared to the rest of the component makers. And the reason for that is we have a very unique culture, a unique operating model, et cetera, et cetera. Again, things that I've talked about in prior quarters as well. In terms of how we've done last year versus this year, look, this year is just a start. The Mideast war has, affected everybody. So we also have suffered, some cost-related issues with commodities, not the ones that we index, like steel, which is pretty well indexed with our customers back to back, but things like crude oil, LPG, CNG, plastics, rubber. These are things that we have to go, request the customers for recovery. But other than that, and of course, the cost of going from a private to a public company. Remember, Q1 of last year, two things happened. We were a private company, so we didn't have a lot of the structure and the governance put together for a public company like we do now. And also, we sold a business called Motorcare Aftermarket, for which we received a profit gain last quarter. So if you remove that one-timer, if you look at that, and then if you look at what's happened because of the Mideast war, we're actually doing very stable. I think our EBITDA growth, 8%. Our PAT growth is also similar to our EBITDA growth if you take off the one-time effect of the Motorcare business sale. And other than that, double-digit growth. We are shaping the market in suspension technologies. You might have, I think the last time I came on and talked about Da Vinci DCX, which is what we think
just sorry, if I can just come in there, Arvind. You said you mentioned a few items, and you said these are items for which we have to go to customers for escalation. That's what you said, right?
Yeah, well, again, these are negotiated settlements. We're also, again, working on productivity improvements internally, and again, that's part of our culture. Cost cutting is what we do.
So, how much of the costs are kind of linked to inflation? I mean, you said some of it is indexed. How much of it is? I'm assuming it's in terms of fixed price contracts versus variable, frequent pass-throughs. Just give us a sense of that.
So, look. the raw material like steel that's indexed, you don't have to worry about it because there's a back-to-back agreement, so we do get price corrections. These things that are like crude oil, LPG, rubber, plastics. Again, these are one-time, and I'm hoping that the Mideast war doesn't continue. So for us, these amount to just recoveries from the customer. Now we have been successful in recovering. Customers are also very understanding, and of course they also understand they have to raise prices at the end consumer level. But they've been very kind. So net of recoveries, I think we still have about 50 basis points of a hit from a Mideast war standpoint, and the recoveries and commodities put together, that's about a 60 basis points. So what I'm saying is, if it wasn't for the recoveries and our productivity improvements, our EBITDA would have been worse by 60 basis points. That's the best way I can describe it.
Okay. Just some more questions, Arvind, on this. So what percentage of your commodity is indexed, which means a direct pass-through? And what percentage of it, which is your crude, plastic, rubber, LPG, LNG, etc., is not indexed and therefore not passed through, and you have to go to your customers? Can you give us a broad percentage rate?
So if you look at, if 100 were our revenues, about 60% of that is raw material, right? And about 60 to 70% of that is steel, right? So you could say that 60 to 70% of that 60% is roughly indexed, and the remaining is not indexed. But look, we're not suffering commodity increases across the board. It's only the ones that are Mideast war related, things that are like, directly impacting us, like CNG. We use CNG for argon gas, for ammonia gas for our furnaces, etc. We use lube oil for our shock absorbers, etc. So some of those things are the ones that are the sticky ones, difficult ones that we have to go back and renegotiate with customers. And again, keep working on our factory transformation and productivity improvements, which we have done over the last 3-4 years very successfully.
Okay. What would FY27 margins look like, given everything that we're talking about?
Well, of course, nobody can predict what's going to happen with macroeconomic conditions. There are a couple of things, right? One is macroeconomic conditions in Europe and the US, Americas, could have an effect on our exports. Also, tariffs could have an effect because the tariffs from the US are somewhere around 43%. For us, the good news is the OEM demand in India is still very strong. We are hoping that will continue, which means that will continue double-digit performance in terms of top line. In terms of costs, if the Mideast war continues, of course, all of us, the entire supplier community, not just our sector, but other sectors also will be affected. And that could also have an effect on demand. So it remains to be seen, but things are still optimistic in India. India is one of the few places where growth is still kind of coming in, and it's not the same in other regions. So we're quite lucky to be sitting on India Inc. And Tenneco has always outperformed the market because we are disrupting the business of shock absorbers. We're also growing a lot of business with clean air and powertrain, including export. So you've got multiple levers. You've got content per vehicle, you've got exports, and you've got all the white space where we're growing market share. Our market shares have grown in suspension to about 55%, which means more than 1 in 2 vehicles in India have a Tenneco shock absorber. And in the commercial truck clean air side, we are like at about 58%. That's huge. That's very strong market share. And off-highway, we're at 68%. So very high market shares, very solid position, and we are a technology company, and that's our main differentiator.
All right. Hi, Arvind. Good to see you, Ben. Let's talk about both your verticals, the emission control system, which is the advanced ride tech, as well as, the clean air and powertrain. How do you see this mix pan out? Because if we look at it in the past quarter, the emission side of the business, well, there was a good revenue growth of more than 25%. While, you had the clean air and powertrain that grew, I think, in double digits. The guidance on both these two in terms of revenue growth from year on, and how does the mix evolve?
Yeah, nice talking to you, Nigel. Yes, look, the suspension business, we are the disruptors in the market, right? And by default, that business is taking off. It's growing. Just the last quarter, it grew nearly 28% year over year. And that thing is going to keep disrupting the market. And hopefully with that disruption, because it's technology disruption, we're providing more comfort to the end consumer in terms of ride quality. Those margins hopefully will also improve over time. And we can prove that our Da Vinci technology or the semi-active suspension technology are coming in at better margins. So yes, there will be an inflection point where there will be a bigger effect on the ART margins over the overall margin. Clean Air and Powertrain are obviously slightly more profitable because they're legacy commodity businesses. But don't forget, Clean Air and Powertrain is also growing quite well. I mean, if you look at the next 3 years, we've booked a lot of business across the board from Indian OEMs, passenger vehicle OEMs, truck OEMs, as well as export, right? Including exports to third-party OEMs and also exports back to Tenneco entities. So we are very cost competitive. We have that labor cost advantage, and plus we have the technology equalization. It's not like 10 years ago where there was always, India was always behind in terms of technology, but we've caught up, right? We are BS 6.2. In fact, last quarter we announced that we had a prototype for a Euro 7 from a European truck customer, OEM. So we're on par on technology. We have the best cost position. So from the standpoint of growth, I think both our verticals, Clean Air, Powertrain, and suspension will grow. Obviously, suspension is disrupting in a very big way, so that will go a little bit faster. And in terms of margins, I think overall they will balance each other out simply because ART, the technology differentiator is...
Arvind, 10-second answer to this. Sorry, we're just on the clock. You said you will enter passenger EV segment and the discussion is on. You're debating to enter new products, right? And you're also discussing M&A. Is something afoot?
Yeah, so we always say that EV for us is a good or a great story, right? Because EVs often require more advanced shock absorbers, right? So by default, you get into more electronics and software-enabled suspension systems. So that's great for us. So we always say no matter how the pendulum swings, whether if it goes full EV or full ICE or somewhere in the middle in terms of alternate powertrain, as we're seeing in China, those things will also come to India.
This is a capital allocation decision that you're considering? You'll have to set up...
We will obviously look. We are exploring all options, including investing in traditional ICE, but also the middle ground, the compromise solution of hybrid vehicles is also very exciting for us. As is EV. Like I said, EV also we are heavily invested because of our shock absorber technology. And as we move to more electronics and software-enabled suspension, that content per vehicle will grow like 5x.
And M&A actively under consideration.
Yeah, it is. We cannot. We're exploring a lot of different options, and again, they're very exciting times for us. We generate a lot of cash, right? So nearly 60% of our EBITDA gets converted to cash, and that helps us. And we are a zero debt company. I must emphasize that the high margin zero debt company with an ROCE of over 80%. There are not that many companies you can find that are performing at this level, and so because of that, we are able to tap the debt markets as well as equity markets. In terms of inorganic.
Thanks very much, Arvind. We'll leave it there. Sorry, just rushing you. We have two other managements waiting. Appreciate you joining in here on CNBC TV 18. So that's Tenneco there. We'll take a quick break and we'll come back with the management of Crompton on the other side. Stay tuned. Welcome back. Let's focus on our next management, Crompton. The stock is a little under pressure. The numbers are more or less in line, but seems that the street wanted something more from the numbers. Let's go across to Mr. Arunachalam, the Group CFO and the Head of Strategy on the show. Hi, good morning, sir. Good to have you on the show. Well, a couple of quick details before we get to the fine print. Is there a management change that is in the offing? Should we be looking at some kind of a takeover? Because the street has been in a buzz about the speculation. Could you clarify?
No, not at all. I think we did clarify this last time itself. None of these things are under discussion or discussed.
We'll take your word for it for now at least, and we'll continue to probe and keep our ear on the ground. Let's get to business then. There is some growth that I can see on the top line, but let's take it segment by segment. First on the fans business. Could you tell us what kind of market share you have? I believe that you're saying that the more value-added products as a percentage of the mix has moved up. So how do you see that evolve? And the growth that you're seeing on the fans business, is it volumes as well, or is it price-led?
See, fans as such, if you look at it, there are a few initiatives that we called out. It's going to be critical for us to drive growth, led by premiumization, BLDC, and a category where penetration is still an opportunity, which is TPW. I'm glad to state that we reported one of the robust quarters on BLDC, grew at almost at 45% quarter on quarter. And our core fan SKUs, which is like high speed or TPW, grew in double digits. We continue to be world leader in ceiling fans in terms of market share is concerned. And overall also fan as a portfolio, we are the #1 player in the country. So pretty much moving in the right direction. Quarter one saw a mix of volume and value. A large part of the growth was driven by impact on price increases that we have taken to offset the commodity costs.
Okay. And can you give us the volume versus the price growth in Q1?
See, we don't give a specific segment-wise data, but if I have to give you a range, I think our price increases have been around 6% in Q1 for fans, and almost low to high double-digit or early double digits in categories like geysers, kitchen appliances, etc.
Okay, all right. And the point you mentioned with regard to market share, you have gained market share, right? Do you want to put an updated number to that?
Yeah, ceiling fans, we have gained market share.
Do you want to give us an updated number?
We don't give specifics, but yes, we continue to be the leader and we continue to move in the right direction on market share.
Let's focus on profitability then. How do you see the ECD margin business move up? And for the consolidated entity as well, how should it look?
See, this has been a quarter where challenges have been there on commodity cost and material availability issues also. In spite of that, we have been running a tight ship. Timely price increases coupled with our cost program, which is Unnati, helped us to bring in overall EBITDA margin ahead. Actually, we expanded EBITDA margin around 30 to 40 bips, both in Crompton and in Butterfly, which also states that unit economics is something that we hold tightly. And that's something we would continue to drive. And as we talked about our long-term guidance, the plan is to, in about, say, 4 to 5 years' time, how do we expand the EBITDA margin from current levels by up another 200 bips.
And 200 bips margin expansion over what time horizon? 3 years, 5 years? What's medium term?
It's about 4 years.
4 years from now. Okay. And for this year, do you think double-digit EBITDA margins are sustainable? And is there another price hike on the anvil in Q2?
Yeah, this year we are moving towards a double-digit EBITDA margin, and which is recently delivered in Q1 also. We expect that to be sustained. In terms of price increase is concerned, I think we have seen one round of increase in Q1. We are watchful on how the commodities are moving. And if you think that would warrant another price increase over and ahead of the cost programs that we are running in, we would go ahead and do that.
And you also said that 200 crores of sales were lost on account of supply chain disruptions in Q1. Are you likely to recover it in Q2, or is it permanently lost? Or will there be a similar such loss even in the current quarter?
See, these are numbers that we talked about in terms of what could have happened if the stock was available. And as we talked in, stock levels have been restored by end of June. And in July itself, we have seen very, very positive, strong growth momentum continuing. So we do believe that a little bit of lag in terms of growth that was there in Q1 is catching up in Q2. And in terms of supply restoration, it has been fully completed now.
Okay. All right. Mr. Arunachalam, a couple of more questions. The wires business has entered, if I got that number correct, 14, 15 towns. And you're looking at further penetrating in, right? What's the longer term goal out here? How do you see this business scale up? What kind of contribution can it give to your total revenue mix?
See, it's a very large TAM. It's a 40,000 crore TAM that we're operating with. And we do believe that Crompton as a brand has got a reasonable right to win here. The brand is trusted and reliable. We have got a go-to-market, probably one of the largest touch points in the country, with about 270,000 outlets that we reach to. Coupled with this, and we have also come out with a value proposition of adding more copper to the product, which ensures that reliability of power conductivity is much more higher. Right now, it's in a pilot stage. We have just taken few cities in. We are trying to see what has been the consumer response to it and what are the course corrections that we need to make towards that. In the long run, in the categories that we have entered, we have always been a market leader. Whether you start with fans, today I'm happy to say that water heaters, for example, in volume terms, in general trade, we have become a number one in Q1. We always have been a number one in e-commerce. We have now become number one in general trade also. Similar to that, wires also, the idea is that how do we become a top tier player as we move in the coming years.
But you want to put a number to that. 40,000 crore market is what it is. You have just entered. 3 years down the line, Mr. Arunachalam, what should it look like?
See, priority one is get it to 1,500 crore business, and then we'll take it forward from there.
Got it. Final question then. What about Butterfly? That business has been growing quite well. In the past, you have attempted to fold it into the core business. That's a merger. It didn't go through. Is there going to be a reattempt?
See, the synergies that we need to attain for Butterfly with Crompton is already in place. It's not that merger is going to add any further synergies to us. Whether it is back-end or front-end, wherever relevant, we have already got that into place. Glad news is that Butterfly continues to grow pretty well. It has been growing in double-digit mid-teens for the last 3 to 5 quarters now. Profits have come back. Profit growth is ahead of revenue growth. And we do expect Butterfly business to double its revenue in the next 4 years. So the trajectory is good. We don't think a merger will augment anything other than the regulatory requirements.
Just one last question. If I look at Crompton, right, since the time it came out of the consolidated entity, it's been 10 years now, right? If you look at the profit growth, profits have over the 10-year period, profits have doubled. And with the name like Crompton, I mean, some would say the performance has been underwhelming, Mr. Arunachalam, right? About some 8% odd CAGR growth. What is the inflection? Do you see things changing materially? And what should investors expect, really?
See, pretty difficult to comment the journey that I've not been part of. When we started Crompton 2.0 about 3 to 4 years back, there are a few promises that we made, and probably we're ahead on that. The first one was to turn around Butterfly. We have not only turned around, we have created a robust kitchen business that's growing ahead of the category. The second promise was lighting business, which was lagging behind the curve. We wanted to bring it back as a mid-teens, high-growth, high-profit business. I'm glad to say we have delivered that. Third is continue leadership in fans and other categories of ECD. Pretty much we have been delivering on that. And I do believe fans as a category itself is well poised for a double-digit growth as we move forward. Similarly, we have also expanded our TAM by getting into wires, rooftop, solar pumps, etc. So pretty much, if I look at from Crompton 2.0, what has been committed has been delivered, and you will still see the things only moving further on the positive side when we look at the outer years.
Okay, work in progress. We leave it there. We wish you all the best of luck, Mr. Arunachalam. Thank you very much for joining us. Rima Samvardhana Motherson next.
Absolutely. That's the next management on the show. The company has reported an in-line set of numbers, margins hovering around 9%. Joining in to talk about the way ahead, we have Pankaj Mittal, Whole-Time Director, President of the company. Thank you very much for joining in. Let me begin with margins. Your margins came in at 8.8%, and this is despite you absorbing very high copper, not absorbing, but despite high copper and aluminium inflation that we've seen. How should investors think about the margin trajectory going ahead? 9% sustainable for the full year, sir?
Good morning, and thank you for having me on the show. For us, you're right that we had the delays in the sense that the copper and other expenses which we have on the commodities, there is a lag. And definitely this lag comes in. But at the moment, the commodities are on a high. It's not just copper, but also polymer prices because of the high crude index. And we expect that during the year, these should get normalized. As they get normalized, definitely our margin trajectory should improve. And also new businesses are growing very well. Our aerospace business, our consumer electronics businesses, they're all growing very well. So our building up of Temal capabilities are playing out very well, I would say.
So broadly 9% doable, right, for the full year, sir?
Well, we do not give you a projection on a year because we are an OEM supplier. And a lot depends on as to how the markets play out. Our endeavor has been always to have a 5-year vision. And in that 5-year vision, we look up to our top line of about $108 billion. and being a ROCE-focused company to keep improving our return on capital employed.
Okay. So as a part of that 5-year plan, you also recently completed Nexen Auto Electric and Yutaka Giken acquisitions, and together they will add $2 billion to your annual revenue. What is the integration timeline, and will these acquisitions be EPS accretive from year one, or will there be any margin pressure in the near term because of integration issues?
We are very pleased that both these acquisitions have been brought in, and from July onwards, they will be consolidated in our results. These acquisitions are EPS accretive, and there is a lot more which we can do in both these acquisitions. The idea is that in the coming years, you will see a lot of growth, both in Yutaka as well as in Auto Electric.
So even Chinese OEMs are getting a lot of, gaining share in Europe. Is that putting pricing pressure, or are you seeing your European OEMs come under pressure? And are you catering to the Chinese OEMs? And if yes, what percentage?
So we cater to all the customers. We are in China also. We are in Europe. We cater in Europe mainly to our European customers, and also in China we support them. We are definitely supporting the Chinese OEMs as well. Because of our presence in China and our relationships, if the Chinese OEMs are setting up plants outside China, there is a big chance they would want global players to support them. And that's the play where we will come in. However, when we say that there is a pressure in Europe, there are multiple model lines, and it's a debatable question as to how the market is evolving there. But we are a powertrain agnostic company. We are very clearly working with all our customers on their new model lineup. And we believe Europe, with the new lines of cars which are to be launched in this quarter and the coming quarter, will also see a better result. We have also restructured over the last 1.5 years our European footprint and also our facilities in line with the customers' new plans. And that has resulted in the resilience which you see in our results today.
Fair enough. I mean, it's just that, Chinese OEMs are in China, of course, but they're also taking over Europe. I mean, the broader industry numbers perhaps point to it. So anyway, I mean, that's. I just want to ask about these new areas, right? Robotics, industrial automation, AI, semiconductors. You said you're evaluating opportunities here, Mr. Mittal?
Yes, we in all areas which are emerging, because a lot of our customers are also in these areas and they want us to be suppliers with them. So, but these are very new areas. We are very proud that we are associated with our customers in a very small way in these very new areas, like being a supplier to these industries, but it's very small at the moment. And as time goes, then these industries will also, possibly you will see that we will be a big supplier to the makers, or whether it's humanoids or data centers and things like that. We don't know, but we continue to strive to support our customers, and the trust which we have built with our QCDD MSCS performance.
You will not build a product. You will continue to be suppliers into these companies, basically, right? You won't build a robot, or a humanoid robot, whatever. I mean, but you will supply to a company which is into that field. So that's the idea.
Yes, and I would say we are a not yet company. So I won't say no to anything, because there could be a partner who asks us to assemble together with them. So why not?
Have you spoken to someone?
Well, there are lots of discussions which continues, but till something becomes really effective. So there are always discussions in many different areas.
And all these areas emerging, and they're all high growth areas, right? I mean, physical AI is a big one. So, is something top of mind? I mean, they're all high growth, but what are you really focused on? Is it robotics essentially?
See, we are focused definitely on our core businesses. And then on the emerging side, we are also there because this is an area where...
I'm saying in emerging, what is top of mind? That was my question.
All what you mentioned. So all the emerging areas, customers are also looking for stable partners who can support them over periods of time. And we are also into integrated assemblies. So that's a very strong division and a vertical within our group, which looks at assembling anything and everything and be of support to the OEMs.
For semiconductors, right? India is also, we got the semicon mission, etc. And where do you come in? Where does a company like Samvardhana Motherson come in that value chain?
So as of now, what we are doing is we are supporting the semicon machine makers. So we are supporting them with their needs. So we are a tier one supplier to a, let's say, a machine maker.
Okay.
Sir, this 2030 target of $108 billion of revenue, what percentage or what part of it will come outside of autos? Say from semiconductors, robotics, industrial automation. I mean, in your roadmap, give us some broad idea of what we should expect.
See, it's anybody's guess. When we make our plans, there are certain things which we imagine because it's a vision. But sometimes things turn out differently. So it's all about imagining. So we would say it's maybe about 45% comes from new things. And rest of it is coming from the core industries where we are in or related industries where we keep growing. So this is how it evolves. And then
45% from non-auto.
Yeah, because auto, I would say the whole transportation industry, because autos include just a piece, but let's say the whole transportation industry and beyond that.
Okay. So when you mean autos, you also include aerospace as a part of transportation. So we're talking about robotics, semiconductors, industrial automation in that balance 40%. You've also said that 60% of your capital from here on will be earmarked for these new emerging opportunities. Is that correct?
What we said is that if we have a capex of 6,000 crores, then 50% is a growth capex. And out of that 50%, 60% is for these new businesses.
Okay, Rima briefly mentioned about aerospace. I believe that you're expecting that business to grow at 20-25% every year?
It could be even more. What 20-25% is, we said it has grown now, but the order books are pretty strong. We had mentioned it was about 1.6 billion last time, and now hovering maybe more, 17-18% more. We have a very strong traction in this industry, and our customers are very happy. We are adding new customers. So this industry, this segment is supposed to grow much faster also.
Okay, all right. And aerospace is a percentage of the mix. What could it get to since it's going to be growing at a faster clip?
Well, as of now, you would see that these are incubated businesses which are now taking off. We can't put a number to these new businesses where we are in at the moment, because it'll take us a little bit more time when we start putting a number to it. But you'll see that all these incubated businesses, as they grow bigger and bigger, they will all be standing on their own and growing even more. So that's the whole idea which we had enunciated during our investor conference when we launched our 5-year plan. And we intend to do that in this 5-year period.
Okay, Mr. Mittal, we'll leave it there. Thank you very much for joining us. We wish you all the best of luck and hope you meet your ambitions. And I think I like what you said. We are a not yet company.
So we are always open to what our customers require us to do, and if we can do it together with them, then why not?
Will you do this? Not yet. Will you will you do that? Not yet. But so it's optionality which you want to keep with you. Thank you very much for joining us.
Thank you so much.
Okay, well, I think it's 10 o'clock and we are down 18 points on the Nifty. So it's kind of flat, 24,617. Motherson is jumped about 6% right now. So that's, I think, at the day's highest point. We'll take a break. We're back. And Somil Mehta from Mirae Asset Sharekhan is going to be with us with some technical trading ideas. Comes up in just a bit.
Welcome back. Another sideways session for our markets. Very quiet. The Nifty is hovering around 24,600, down about 25 odd points. Midcaps are doing better, but they had underperformed in the run-up to Friday. Somal Mehta is now joining in from Mirae Asset Sher Khan. Somal, what's the trade that you're recommending at this hour?
Good morning. Good morning to everyone. See, the view definitely remains positive. Been consolidating. Nifty has been consolidating above 200 daily moving average for last 4 to 5 days now, creating a triangular pattern. I'll be expecting this pattern to break on the upside. I'll be positive. My targets for Nifty would be around 25,000 in the short term. And the support would be around 200 daily exponential moving average, which is 24,380. So that is a very crucial level in the very short term. So buy on decline should be the strategy, more focused towards the sectors which are performing well, like defense, metals, banks as well. And IT has started moving up again today. So these are some sectors which I like. The two stocks which I have chosen from here is first one is Emphasis. Emphasis has just broken out of a small consolidation, cut above 200 daily moving average, already trading above 20 and 40 daily moving average. Great stock to be in. Stop loss would be 2,400 and target would be 2,700. The second stocks which I've chosen is Canara Bank. Canara Bank is, has just moved about 200 daily moving average, already making high top, high bottom formations. PSU banks are already looking good, like PNB, Bank of India. A few other stocks have also started moving up in the PSU space. My targets for Canara Bank is 145 and my stop loss is 127.
Okay. Ixigo is a stock, late revenues tech, that's down nearly 7-8% on the back of numbers, while the top line grew 13%. Margins for the company have come down. So EBITDA margins at 6.8%, lower than Motilal Oswal estimates of 9.4%, impacted by higher advertising and branding expenses. And Motilal Oswal, on the back of that, has downgraded the stock to a neutral from a buy. Stock is under pressure. Samal, thank you very much for joining in. Moving on to the other important story, RBI has proposed to bar NBFCs from offering revolving credit facilities. Ananya joins in to tell us the details and the impact on stocks.
Well, yes, the RBI draft guidelines on revolving credit could be an important negative for selected NBFCs, particularly Bajaj Finance and Tata Capital. So simply put, RBI is proposing that once a borrower repays part of a loan, that limit cannot automatically become available for borrowing again, effectively impacting flexi loan structures. Now, IIFL here estimates the exposure at around 20% of Bajaj Finance's standalone AUM and 50% on a consolidated basis, while Tata Capital could have a high single-digit to low double-digit exposure here. So that's why these stocks are reacting today. Now, the first impact will be on growth. Without the redraw facility, loans run down faster, customers become less sticky, and lenders need fresh sanctions and disbursements to replace that AUM. Now, fee income and yields could also take a hit here, as flexi products are generally more lucrative. Now, but Bernstein highlights an even bigger potential risk here. Asset quality. Some borrowers may have been repeatedly using these available limits to manage cash flows. Removing that liquidity could expose underlying borrower stress. So that's why you are seeing that these stocks are under pressure today.
Ananya, do we know for existing running loans, right?
Yes,
which
yes.
are on right now, is there all of this comes into effect immediately, or those tenures run out?
I need to get more clarity on that. I'll get back to you on that. Yeah.
Okay, fair enough. We'll check
There's
up on
no more
that.
clarity on this. Yeah.
But it's a very, very significant one. I mean, highly lucrative for companies like Bajaj Finance and NBFCs. So typically think about this. Think about it like this. There's you take out a 50 lakh rupee loan, and you kind of structure it in a flexi way. So, the tenure is whatever, 5 years, 10 years. I mean, it's almost like in a home loan situation, you have OD accounts, overdraft sort of loan accounts. You are able to repay, borrow again, repay, borrow again. without very much by way of charges all the way till the term, till the tenure of the loan. So that's the reason why it's called a flexi loan. And there was a bit of a ambiguity. I mean, this product was operating perhaps in a bit of an ambiguous kind of a zone, and I think now the Reserve Bank of India stepped in. And I think the second point which Bernstein makes, which is that these loans perhaps were being used to tide over cash flow issues by a lot of people, because because of technology, because of apps, etc., you're able to draw the funds, you're able to put the funds back quickly. Operationally, they were very, very easy. And as you heard Ananya lay out the numbers, I think that this is could be pretty significant in that sense. From a lender perspective, I mean, rates of interest from 12% all the way to 18, 19%, depending on your CIBIL score. So I think was pretty significant. I think Lata is here for the 10-15 discussion, but why don't you come in, Lata? This is important.
No, it is very important, and revolving credit is the lifeblood for both the borrower and for the lender. But you have to note that these are draft guidelines. Yeah. So, it's not as if immediately anything is going to happen. And I think they'll keep a very patient ear to what the NBFCs have to say, whether it is prospective. So, or any of the banks, every one of them has reported a better asset quality, lower credit cost. So maybe this is the right time to set tightened rules. But I think it will be done prospectively. In any case, it's a draft. So let's wait and see.
Yeah, we'll see. And eventually what comes out of it. But important. We'll take a quick commercial break here. And, the discussion with Santanu Sen Gupta of Goldman Sachs, Nikhil Gupta of CLSA on the RBI policy coming up in just a bit.
Welcome to It's the Economy. Well, we are discussing inflation growth dynamics today because the Reserve Bank policy has put up some unexpected question. It has been widely seen as more dovish than expected policy. So what does that mean for policy rates going forward, both for inflation and for growth? Will growth be higher than the 6.7% forecast by RBI because of the low rates and because of easy liquidity going ahead, given the FCNR flows. Also, what is in store for the rupee? Time permitting, we'll discuss that also. But more importantly, this is an inflation growth discussion, and I'm joined by two top economists, Santanu Sengupta of Goldman Sachs and Nikhil Gupta of CLSA. Gentlemen, good morning, and thank you very much for joining me. Santanu, first the easy question. Because of the policy and the way it sounded, where are you seeing the next rate hike? Will there be one at all in 26?
Yeah, thanks, Tata, for having me. Look, it was a dovish policy. I mean, it was noticeably dovish in terms of the governor's policy statement. We thought that the press conference was slightly more balanced. And by the end of the day, you saw a VRRR option to suck out liquidity. So I think all put together, we think that October is out now. So we've pushed our rate hike call back to December. From December onwards, we think becomes live. But it really depends on where inflation ultimately shows up in the actual prints rather than the forecast, because the forecast is already saying 5.5% by the RBI's forecast, which is actually higher than ours. And between December and February is when it is live for us.
Okay, but the governors also said that the inflation is high because of supply side issues, and the underlying inflation, by which they mean core, I would assume, is going to be 4.3. So is there a 50% chance that there is no hike at all?
I mean, our sense is that with the way growth is surprising on the upside, companies still okay to price to pass on the input cost pressures at some point, and the El Nino risks on the horizon. All combined together, we think that core goes above 4%, even ex precious metals by the end of the year. And at that point of time, we think that the rate hike is on the table. I mean, of course, if there's a situation where, let's say, oil prices fall into the late 60s or maybe the early 70s, the growth momentum is not as strong as what we are seeing now. That is the situation in which the RBI can think of a hold. It's not in our base case. We think there's 50 basis points hike in this cycle, maybe 75 if inflation gets higher.
Okay, well, I would be in that camp, but I'm deferring to the economists. Nikhil, what's your sense? From what the governor is saying, he seems to be saying that the headline inflation is going to come down, but that is because it's going to go up, up to 5.9, but that's only because of supply side. The underlying inflation is 4.3. That's not a big distance from 4. So is there a chance that he doesn't move at all?
Hi, Lata. Good morning. So, Lata, we have maintained since March, since we have seen the war escalation, that rate hikes may not come. Initially, the reasoning for rate hikes was the currency depreciation, and we have always maintained that interest rate tools are not the best tools to defend the currency. And we are totally in agreement with what the RBI is saying in terms of the headline inflation inching up, primarily because of supply side issues. Oil prices have been very volatile. We have seen them moving 5% in a day, moving towards 70 and then 90 within a matter of weeks. And I don't think it would be wise to decide your policy rates based on something so volatile and something so difficult to predict at this point in time. You're absolutely right. Although headline inflation is expected to peak at around 6%, we also believe that in the December quarter, same as the RBI's projections. But we also know, and the broad consensus is that it is going to come down from March quarter towards 5.25% by June 27 quarter. So if this rise in headline inflation is going to be temporary, if the core inflation has actually been revised down by the RBI from 4.7 in the previous meeting to 4.3% now, and I think the broad consensus along with us is also around 4.5%, then I do not see the need for the RBI to hike interest rates. And in any case, we know that 1 to 2 hikes, 25 to 50 bip rate hikes is not going to have any serious real impact on the economy. So probably, our base case
You're going with no hikes at all?
This year, yes.
Okay. Shantanu, there was another interpretation I heard when, we all of us wrote pieces saying that the RBI is dovish. The interpretation was RBI is saying, I am not dovish. The situation is like that. The situation is that the underlying inflation has not shown any increase for some time now. And that's why that sentence, that para 12th, where they say, especially the normalization of the underlying inflation from its benign levels seen hitherto. Are you buying that? That, there is an underlying either lack of aggregate demand or whatever reason, that there is a very, very benign inflation. And unless that normalizes, why should we, hike?
No, you're right. And the RBI is also right in saying that core inflation has been extremely benign through this whole period. I think we have seen the initial signals of core inflation rising from the previous month's print. I think it was a couple of months back when the processed food or prepared meals, packaged food has started increasing. This will slowly pass on into textiles, clothing, footwear, and so on. So our call for the last 3 months has been predicated on core goods inflation rising. And you'll also see things like car prices increasing and so forth, right? So this is the first oil shock which increases petchem prices, which will translate into core goods over time. And then if growth is indeed this strong, at some point of time, it shows up in services inflation as well. And if you're the central bank, you might want to, that's what the RBI is indicating, that you want to wait out until you get to see core really getting towards 4.5%. But core X precious metals, if it gets towards 4.5%, then we think that 75 basis points of a real rate at that point of time is not going to be enough. Our sense always is on the 12-month forward is when the RBI calculates the real rate, and that is already at zero or negative currently. So our sense is that you'll have to go as core picks up by the end of the year.
Oh, yes, that's exactly what I asked the governor also. Are you comfortable with negative real rates, which already seems on the cards, going by your inflation forecast and your and the T-bill rates in the market? Okay, Nikhil, you sound very bearish. I'm coming to the growth question now. You're sounding a little bearish on growth. But what is the situation in front of us? The Reserve Bank doesn't seem to be very tight on the quantity or the price of money. If what you say is right, they're not going to increase rates, and there is this FCNR flow coming in, and they're committing that they're going to keep the call rate, overnight rate, at best at 5 quarter, then is there not a very good chance that growth is going to be better than the 6.7 they are saying?
So, Lata, I think this year we are going to see two halves story in terms of growth. So first quarter, the RBI has already said that they expect it to be 7%. We also revised our first quarter growth forecast from 6.7% earlier to 7% before the RBI monetary policy meeting earlier this week. For the second quarter also, we expect it to be around 6.25%. Where we differ from the RBI is totally in the second half. Now, we expect second half growth to be about 5.5%, which is much, much weaker than 6.5% or so RBI's projections and market consensus. And there are 4 reasons I would like to highlight why we believe that growth could see a serious slowdown. First, we all know that there is a very favorable base effect till about September. We will see that base effect going away. Second, I still believe that El Nino is not factored into any of these forecasts. RBI is expecting second half growth to be as good as in the first half with El Nino, without base effect going away. So I'm a little confused, and I think it is still not factored into. Third, we know that fiscal spending, I still believe that the government would like to keep their fiscal deficit as much close to the budget estimates as possible, which means it is possible that we may see fiscal spending slowing in the second half. And lastly, I still believe there would be some adverse impact on private consumption. We have not seen the worst of inflation, be it because of the base effect, because of the supply side issues, whatever. But inflation, as all of us expect to increase, we believe that consumption growth may also come off in the second half. If I combine all of them, this is what makes us believe that second half could be much lower, which means that full year growth could be about 6%, more than 6.5% or about 6.5% in first half, but significant slowdown in the second half.
I think
and
I'm
this is
finding
one of the
myself.
key reasons why we do not expect RBI to hike rates anytime soon.
No, I find myself in exactly the opposite camp, not 5.5, but much better. Shantanu, you come in on the growth issue. Asia itself is seeing a very, an 18-month high in capex, I'm told, 18-month high in credit growth. And likewise, India is in a two-year high credit growth, which can actually increase going by the liquidity and rate promise that we see ahead of us. So would you say that there is an upward bias to your growth forecast? Are you at 6.9 for the full year? And would you say that there could be an upward bias?
Yes, I would say upward bias to the growth numbers. We have been surprised on the upside, especially in the previous quarter, on how resilient the economy has been. It was a very deep oil shock. I think it was managed very well between the quasi-fiscal and the fiscal policies, and also sourcing of crude, etc. There was some tailwind that India and the rest of Asia got from China not importing during that period, which is why barrels still flowed. The limited barrels that were there still flowed, but clearly, there's something underlying in this economy which we did not anticipate is surprising us on the upside. I would agree with Nikhil that there are some headwinds in terms of the strong base from GST and a little bit of front loading that you've seen in the fiscal, especially on the capex front. That will sort of act as a headwind now in the second half. But even then, we are at around the RBI's forecast for the second half. But I would say with a slight upside bias, because for the current quarter, I'm at for the quarter gone by, I'm at 6.9, and there's an upside bias to that number, probably going towards 7 or a little above 7 once all the data comes in on the earnings. So yeah, I would say in a nutshell, upside bias on growth.
Okay, upside bias on growth, and according to you, upside bias also possible on inflation, right?
Well, I think the risks are sort of evenly balanced. There is a slight bit of upside from the El Nino shock. We don't think it is as bad as what we were anticipating a month and a half back, but a little bit of downside maybe from core goods, because oil prices are lower now, and the second round effects of that will be slightly lower.
Okay. Well, I'm not done with my questions, unfortunately, done with time. So let me just ask you all one question which I couldn't, bring to the fore at all. What is your rupee forecast? I know it'll remain unargued, but what is the range, Nikhil?
We are seeing rupee probably strengthening 1.5%, so closer to 94 by the end of September till we have the FCNR scheme running.
Okay. Shantanu, what's your range?
We are also at 94 in the near month by about September, and then back towards 96. We just think that these flows are buying the RBI time, and there's something underlying on the balance of payments that still needs to get sorted out.
Okay. Well, I think that can't be argued against at all, especially if the policy continues to be loose. Then perhaps the 94 gets to 96 a bit quickly. But let's wait and see. There is a policy in between, and the Reserve Bank can always talk differently in the minutes, for all you know. Thank you very much, Shantanu and Nikhil, for joining in and giving us more nuances to understand the Reserve Bank policy and the evolving growth inflation dynamics. We have to wrap up on Bazaar on that note. After a break, Chartbusters.
Britannia leads the FMCG pack higher as volume surprise on the upside. The management also issues a strong outlook and says it's exited the quarter with mid-teens revenue growth. The stock up 4.5%.
Hero MotoCorp's first quarter numbers beat estimates. The margins look good. Strong volumes aid the revenue growth. The stock is up close to around 3%.
Siemens Energy delivers an all-round beat in the quarter that went by. March ending strong execution with revenue growth. Margins also improved on a strong operating performance. The stock surging 12% as we speak.
Samvardhana Motherson surges close on 7% after reporting a solid set of numbers. Yesterday, the company reports a healthy revenue growth, maintains margin despite the higher input costs. The management tells CNBC TV 18 that their restructuring of the European business is showing results and the company is now evaluating the new growth verticals.
Crompton slumps 6% following a quarter where supply chain disruptions led to a 200 crore rupee hit on the revenue. The management tells CNBC TV 18 that growth momentum remains strong. Supply chain issue has normalized in June. The stock still lower by 7%.
Hello and welcome to Chartbusters. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Nigel, with me is Mangalam. We're looking forward to Friday evening, but before that, we've got an entire trading session to go through. And Mangalam, we have a new kid on the block, an IPO. Let's get straight to it.
We do. And before we leapfrog to the evening, Nigel, let's talk about Leap. That's the IPO where the issue has opened, a logistics player where, the company is raising about 2,500 crore rupees, of which 2,000 crores is an offer for sale, for nearly 480 crores or 500 crores fresh issue. Joining us now to discuss the IPO are Sunu Matthew, who's the founder and MD, and Rajesham Ale, who is obviously the CFO of the company. Thanks a lot, Rajesham and Mr. Matthew, for joining in. Now, I was looking at what the company does. Provides pallets, container, material handling equipment on a rental pooling model. It's an interesting business, but at the same time, sounds like a very niche play as well. So if you could explain to us what the industry size is. You basically make pallets and then you rent it out to other people, who the other players are, and at what rate is this industry growing?
So thank you for calling us into the studio, me and Rajesham. See, this business is all about asset pooling. So we are not a logistics company. We don't do transportation. We don't do warehousing. So before any final products come to your hand, any product, bulb, blade, biscuit, battery, that has to flow through supplier, manufacturer, 3PL and retailer. So this is a kind of a pallet. This is the miniature of a pallet. The size is 1200 mm by 1000 mm. You can see this. And this is the fulcrum of the supply chain. So what happens is, if this is not there, the entire supply chain is not there.
So products are placed on this.
On top of it, stretch wrap, then it is moved from distance to distance.
So you're essentially making just this?
We are making pallets for...
You're not even manufacturing this?
No, we are not manufacturing this. We get it sourced from outside and we rent it to different customers at different point in time. So 38 sectors we cover with these pallets. We have foldable large containers and crates for automotive. We have utility boxes for quick commerce. And we have forklifts for big business houses.
So all of this is essentially rented?
Absolutely rental model. We absolutely do not sell anything. We tell customers, please work on OPEX. You focus on your core business and don't spend CAPEX.
So if I get that right, you are buying these products from somewhere else, you are renting it to someone else, and of which you are just making a bit of a spread, right?
Yeah, when a supplier sends it to a manufacturer, PDR is paid by everybody, per day rental. He gives us a movement charge. When the manufacturer moves it to a 3PL, he gives us a movement charge. Then 3PL moves it to a retailer, they also pay it.
And you monitor this entire thing. So what is typically the cost of something like this?
This is 1700 rupees to 1750 rupees on the basis of the fluctuation of the wood price.
And the rent that you charge on it is?
It depends upon various sectors. It varies from 1 rupee to 4 rupees per day rental.
Okay, all right. Hi, welcome, gentlemen. Interesting business, but give us a few more details. The size of the industry. If you could tell us what is the size of the industry?
Okay, the size of the industry is today we can say that worldwide it is an anecdote is equal to 1% is equal to 1 pallet, 1 human being, or you can say 1 ton is equal to one pallet. In India, we are nowhere as compared to both these anecdotes. So all developed countries absolutely palletize everything. We are still at a very nascent stage. But still, we have got 9 million of these assets wherein we move it, and the market is somewhere around about 100 million.
Okay, so it's 9 million. The market is about 100 million. Are there other players in this market? Because
it's a monopoly business.
So you're the only largest player
We are the only player. This business is done in 56 countries. Either it is a monopoly business or max it can be a duopoly business. You need to understand that when there are 4 pillars in supply chain, you cannot have a red, blue, green, yellow pallet into the system. The entire supply chain will collapse. You know, it has to be one pallet that is flowing across all 4 players. For example, in Australia, there is CHEP and there is Loscam. But they also then split the industry. Somebody will do which is less than 200 kgs and somebody will do which is about 200 kgs.
What is so special about this? I mean, it looks like a regular wooden,
this is,
plate that we call it. And anyone can do it, right?
Yeah.
So what's your moat in this?
See, moat is our network. The network is that we have 10,000 location network in this country. You know, you can take this pallet from Baddi, you can leave it in Chennai. From there, you can take it to Siliguri to Vizag. Everywhere we collect it and give it back. So you look at it that the supply chain cost, say, is 2 rupees for a company, you know, out of 100 rupee. 70% is transportation. If you have to take this and get it back, this business becomes unviable. So if I take it to Chennai, I have 100 customers in Chennai, I will give it there.
And what's the shrinkage on something like this? You have 9 million. So if someone puts it in Baddi, someone leaves it at Siliguri, for instance, and 2 or 3 of them get lost, or some client keeps one or 2
to the customers. Everything has to flow through our docket, through MyLeap. There is a system that we have created. If somebody is moving a crankshaft from Chakan to Chennai, they have to punch it into our system. If it is not there, we go and count it. If it is lost, they pay us MPC, which is missing pallet charge.
Interesting. Very passionate about your business, and my man Mangalam also is quite interested about it. But, you know, shareholders, they want to know, you're raising money.
Yeah.
What will it be used for? Will it be used to repay some debt? Will it be used for expansion? So the street likes numbers, sir. You know, they appreciate this. It's beautiful. But they want to know, in these numbers, how is the profit and loss account going to look? You know, what is going to come on the revenue side? Can your revenue continue at this 35-40% growth odd? What kind of profitability are you looking at? And most importantly, 500 crore, I think you're raising from the market, right? What are you going to use it for? Come on, let's get to that.
Fantastic. We are a profitable company, PAT profit company since last 6 years. We are an EBITDA profit company since last 10 years. So it's a very, very profitable company. Our EBITDA margins has varied from 47% to 56% in last 8 years. So it is a very high generating operating margin business. Now, you may think that the PAT is a bit subdued. It is because we have got 1,650 crore worth of assets. So our depreciation sits somewhere around about 200 crores. So our PAT is currently subdued. Now, what happens is, whatever assets that we have to make every year, around about 300 to 400 crore, our EBITDA actually takes care of it. So whatever growth we have to get, we will absolutely get that. So there is only one company which is listed in the world, which is Brambles, which is listed in Australian Stock Exchange. And this business is always a EV EBITDA business.
Right. So, you know, I'll ask this to Rajesham as well,
please.
because since you're passionate about the business, let's ask him about the numbers as well. Rajesham, you know, you have a debt of almost 1,000 odd crores. You get about 480 crores from the IPO issue. So take that off, it's a net debt of 500 crores right now. And alongside that, you are seeking a post-issue market cap of 7,000 crores. So 7,500 crores on an EBITDA of close to 350 crores same time last year. How do you justify that sort of valuation? Because the pace at which the EBITDA has been growing, you are still, for a logistics company, trading at high teens, if not 20s, EV to EBITDA. How do you justify that sort of valuation? And what's the growth that you guys can do on both your revenue and EBITDA over the next 3 to 4 years?
Yes. Thank you. This question is a very important question to answer to all the investors. Okay. After we extensive roadshows in India and abroad, okay, so we took the feedback from all the bankers. So that's how they arrived at this valuation where we can come to the market. And we are not comparable business in India. We are a unique business model, and worldwide also, out of 5 companies, only 1 company is listed in Australian Stock Exchange, that is a Bramble, CHIP India. So we are not comparing with any of the business. We just focus on our business model. You must have seen what Sunu Bose told. Last 10 years, we are a EBITDA positive company. Last 6 years, we are a PAT positive company. If you look at our PAT from last year to current year, where PAT is grown by 66% from 36 crore to 62 crores. And revenues also were grown from 55%. So that's how we are focusing on a business. This will take care of the valuation and growth. Yeah. You can add.
I would like to elaborate on this. What happens is that the listed entity, if you see, it is working on a multiple of 12. We are asking a multiple of 20, wherein we have done 379 crores of EBITDA last year. So, if you look at any category leader in India also, the EBITDA multiple that they are trading is at 30, 50, 70, 110.
Correct.
You know, so, and this business is, the more you scale, your cost dramatically comes down.
Correct.
Because if your warehouse is handling 50,000 pallet, same amount of people will be able to manage 5 lakh.
Got it. Got it. You know, and I think the banker has really trained you all well as well, right? Talk about the multiple, you know, and they would be keeping an eye. They would be like, make sure don't give these guys any forward guidance. So we'll keep that for the listing day. But what about the other expense?
For the other stuff.
Other expenditure, banker also will be on board.
Yes.
You know, now that they've given the multiple and etc. Beautiful that was. But tell me, why the other expenditure gone double in the last year?
Which is the other expenditure?
There is overall other expenses in your P&L, which has increased from 110 crores last year to 210 crores. And this pace of growth is actually most only in last year, FY26.
See, if you see, last year we made one large acquisition, CHEP India operations.
Okay.
And we got a revenues as well. Around 180 to 200 crore revenue has been added to my revenue. The same scale will be added to expenses.
Okay.
So that's how our EBITDA margins are around 50%. Yeah.
No, it's 49%, 56% has come down to 50%. So that additional 5% is what I wanted to know.
Yeah.
Now, basis the growth that is happening and the multiple that you're speaking about, can the street work with 500 crore EBITDA in FY27? And closer to 650 crores in FY28. Is that a fair assumption?
So we are not supposed to talk about.
No, but I'm just generally, we are talking about it. You're not talking about it.
Okay. So
is that a fair estimate?
It is a fair estimate, but looking at a lot of geopolitical situation which is going on, because the price of the plastic has increased to 100%, same 30% increase in the cost of the timber also. That can subdue a little bit, but you can always say that a 35 to 40% growth in EBITDA is always on the card. And always, as our depreciation value is coming down and down, PAT will have a multifold growth.
Super. All right, gentlemen, I think your phones are buzzing because the bankers called and said you'll have given too much. But thanks a lot for joining in. We come back and we'll chat more on the listing day.
Thank you.
For the time being, we shift focus to our special segment. We get a few ideas for profit, as always, from Money Control Pro. Anand joins us to tell us about a stock that is tracking closely. Anand?
Today's stock pick is a leading electrical consumer goods company, Bajaj Industries Limited, which posted a very strong top-line growth of 24% in Q1. There was a healthy demand across stabilizers, UPS systems, inverters, and batteries. Improving RAC demand, an expanding solar portfolio, and premiumization that could sustain this growth in the electronics segment. The electrical business also witnessed a robust demand in wires, switchgears, and pumps, while in consumer durables, summer demand aided growth of fans, air coolers, and seasonal products. Kitchen appliances have witnessed improving demand over the past 5 to 6 months, supported by V-Guard Industries and Sunflame integration. While upcoming product launches, that could also provide an additional growth lever. Management retains its medium-term aspiration of 15% revenue growth, while indicating FY27 growth to exceed this due to price hikes implemented over 80% of the portfolio. The company continues to target 9 to 10% EBITDA margins over the medium term, despite the volatile cost environment. We believe that sustained execution and an improving product mix that could continue to drive earnings growth over the medium term. Stock currently trades at 30 times on FY28 earnings, well below its long-term average multiples, which gives a decent margin of safety to investors.
Right. With that, we'll take a short break. Don't go anywhere. Primary, listing done. Let's speak about some numbers that come by. We have E-Clerk Services joins in to discuss their first quarter numbers. Srinivasan Nadadur joins in from the company.
Welcome back. We've got the management of eClerx who joins us on the show. Mr. Srinivasan, the Chief Financial Officer, joins in. Hi, Mr. Srinivasan. Thanks a lot for joining in. Well, the numbers look pretty interesting. You know, the margin's a little lower than what we discussed the last time around. I think we were talking about 24-25%. So the quarters to come, we expect it to improve. And what kind of growth trajectory are you looking at for this year?
So I think Q1 has been good, and we expect to build on this momentum. We don't usually give guidance, as I'm sure you're aware, but we expect that we'll be in top quartile of the peer group that we usually benchmark ourselves against, which is typically mid-cap ITES companies.
Okay. All right. So, and margins improve to that 24-28% that we spoke about?
Margins will improve because this quarter is where we actually pay out the wage increments. And usually every year Q1 is the lowest among the 4 quarters. So from now on, as growth improves and as we are able to refill or maintain the pyramid, margins are expected to improve.
All right. So for this quarter, employees were happy because they got higher wages. And in the coming quarter, shareholders will be happy because the margins come back. Fairly put?
Well put.
All right. The new deal, ACV, that came in at around $41 million odd. The previous quarter, I think it was $46 million odd. I think last full year, you did around $160 million odd. This year, will it be more than last year?
See, certainly we are operating on a higher revenue base, right? So we've grown 16% over the previous year. And our aim is definitely that ACV is a leading indicator into what eventually happens with the crude revenue. So ACV has to grow if a crude revenue has to grow. Otherwise, growth will slow down. So our aim definitely is to ensure that the ACV number continues to increase.
Okay, got it. And, at what point do you expect this AI-related deals to meaningfully contribute, say, to the revenue number?
So there is AI is already contributing to part of the revenue that we have, and we have wins in both standalone AI engagements, which means the work that we are not doing today, and also AI is embedded in our products compliance manager and market intelligence product, because of which we are seeing a lot of traction in AI. It's hard to call out AI itself because AI is one part of the service. Like any technology, it is one aspect which helps you be more productive, add more value to the client. So we are tracking what kind of engagements our clients are interested in and how that is, and whether they have AI or not. But looking at a number, I think it means different things to different people. So we don't look at it in a number perspective. I hope I'm able to convey my perspective.
Okay, all right, Mr. Srinivasan, a short but effective chat. Thanks a lot for joining in and giving us some color in terms of how things panned out in the past quarter and how do you see things pan out from here on. Appreciate you joining in. Well, for the time being, all right, we have an important flash actually at the bottom of your screen. Hero MotoCorp, I believe the margin guidance has been raised. And, my colleague Sudarshan is on this particular call. And he's putting that out, and it's very, very important with regard to the profitability perspective because that's a big increase. Yep. Just imagine the upper end has now become the lower end, in the refresh guidance. So the medium-term guidance has been up. Hero MotoCorp should be revving up the engine, and I think it's spiking up as we speak to the high point of the day. As it is, it was only holding with a gain of closer around 3% or thereabouts, but it's perked up because of this margin guidance. Tell you what, we'll slip into a short break, come back, we'll focus on a couple of other names. Stay tuned. Well, a lot of con calls are ongoing, and Hero MotoCorp is one such stock that is now spurted away. It's up more than 4% post that margin guidance has been up. And the other one I think that's seen a bit of an up move is PG Electroplus. You know, that's the stock you should be putting on your radar because the con call's ongoing. My colleague Upasana is on it. And the commentary is very positive. They're saying they don't see any reason for not attaining the 25 to 30% revenue growth in FY27 as well as FY28. And they don't think that growth will be a challenge for the next 2 to around 3 years. Remember, this was a management that was sounding a little bit cautious earlier. So because of this sort of commentary, the street likes it, and that's why they're bidding up that stock. We'll get the management later on in the day as well, but just thought we'll highlight that because the con call is ongoing, and the big takeaway is at the bottom of your screen, which is send the stock higher.
Yes, a bunch of stocks buzzing around right now. As we speak, Nigel, we have Bharat Forge as well, which has spiked right now. But what we'll do is, our director tells us it is time. It's time for us to wrap up on this edition of Chartbusters. Stay tuned. We have Trading Hour coming up next.
Good morning. It's time for Trading Hour on this final trading day of the week. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I am Hormus Fatakia. With me, as always, Ritu Singh. Ritu, good morning to you. Well, the markets are taking a bit of a break to what has been a relatively positive week for the indices. But of course, today being a big day for results, in fact, and SBI coming out with results anytime now.
That's right. SBI is a big one to watch out for. But, what a week it's been, especially with gas It's now the 5th day, and hopefully things ease out as we go further ahead. But it's very cautious on the market today. When you look at the frontline index as well, trading now with cuts of about 66 points or so. It's down from the day's high. The Bank Nifty also at about 57,800 odd levels is trading with cuts of 0.4%. The broader markets are holding up a bit though compared to the rest of the markets. The Midcap index is trading with gains of almost 0.3%, and the small cap index just about flattish but still in the green. The market breadth though shows you there are still more stocks that are advancing than the ones that are declining. So about 1580 stocks in the green versus about 1411 stocks that are in the red as we speak. For the crude prices as well, there's a bit of an inch up. We're above $83 a barrel mark today compared to the under $80 prices that we were seeing yesterday. And as a result, there's some pressure on the rupee as well, 95.27 against the dollar. That's how we're stacked up in the market. The IT, auto sector, media, FMCG, seeing some buying. But on the flip side, banks, pharma, metals packs, they're seeing some pressure. But as always, let's put the spotlight on the top movers in the market. Harmas has walked over to the wall with that list.
The index is taking a break, yes, but the bulls will be happy for the fact that they are still managing to hold on to the 24,500 mark on the downside. And that is something that the analysts are also finding a lot of comfort in. You're still at 24,570. So every dip that is going towards that 24,550, 24,500 level is getting bought into. Take a look at the futures right now. The futures are at 24,650. So there is still an 80-point divergence between the spot and the futures price as we speak for the Nifty. And same has been the story for the Nifty Bank as well. For now, the index has been trading around that 57,700 mark. Again, finding some supply at 58,000. And the futures are trading at 57,900. So again, another 150, 170 point divergence that you can see on the Nifty Bank futures as well when it compares to the spot price. Take a look at the positive result reactions. We are counting down to the end of the earnings season for this quarter. Take a look at Siemens Energy, 12.5% higher after an all-round beat for the quarter. Hero MotoCorp delivered some strong commentary in its earnings call. That's up 3% as well. And LIC, after its results, up around about 1.5%. But the negative reactions are a lot more pronounced today. Now look at Revenues Tech, which is Ixigo, 9% lower after its results. Carraro India, we'll hear from the management on the show as well. So 6.5% lower here. Crompton's down 7%, and Sonata Software too. Midcap IT over the last couple of days has not had some very good result reactions. We saw one from First Source yesterday and Sonata Software today as well. So 4% lower on that stock. Look at the newsmakers today. Bajaj Finance and Tata Capital are down 4% each after the latest RBI norms on NBFCs. We'll let Ritu talk more on that. PNC Infratech, of course, was down around 6-7% yesterday, down another 6% today as well. So extending its losses is PNC Infratech after the NHAI notices that it has been served. Look at the Tata Group stocks today. Tata Sons is still an upper layer NBFC. Tata Investment and Tata Chemicals, the two names that always have a reaction whenever some news about Tata Sons comes in, seeing a positive reaction today. Tata Tech was up 7% yesterday after that Bloomberg report on the deal with Honda. Is up another 2.5% today, and TCS too is ensuring that the Nifty downside is protected today, up around over 2%. And lastly, stocks at record highs. Samvardhana Motherson's analyst commentary was very positive as well. The stock is now up 8.5% at record high levels. Avalon Tech is up 6%. Look at Shivalik Biometals, that's up 20% in a circuit now at record highs. And Lloyd's Engineering too having a good day at the office at a record high, 3.5% high here as well, Ritu.
Harmas, thanks very much for running us through that exhaustive list. Time to get in the first management on the show. Carraro India, their domestic revenues have grown 26% this quarter, even though margins contracted in exports. That stayed subdued. So let's bring in the management. Balaji Gopalan joins us now to talk about the first quarter numbers. Thanks very much, Balaji Gopalan, for being here with us. Just segmentally, if you break down your performance in the first quarter, domestic revenues are up 26%, yes, but exports are down 14%. Even your agri-equipment revenue, that's up 25%, but construction revenue is up only 4%. I mean, what's the dichotomy there? What's going on? And when do you see a recovery, especially in the export segment?
Yeah. See, export, I would always say it is a momentary thing. It is something which is temporary because we always have a long-term plan. There is a pipeline that builds up when you are exporting. So it's very important to understand that the current disruptions in the Western Asia is contributing to a lot of export-related issues. Container availability is a problem. Sometimes the ports are congested. So these kind of logistical issues are affecting our export. Largely, the book order exists, but due to logistical issue, we are not able to execute the orders. Having said that, we are very sure that in the coming months, because we are already seeing green shoots, we are seeing normalcy coming up. What is more important is the industry has learned to adapt to any of these disruptions. Now it is a question of management by anticipation. And people are no longer looking at just in time. JIT has moved to just in case. So we are looking at all the possible disruptions, and there is an element of I would say a tranquility that is coming in, a rhythm that is coming in. So I'm very confident in the coming quarters, we will recover whatever we lost. We have always had an average of 33 to 35% in our export versus domestic market. And we are confident that we will reach the 33-35% that existed in our portfolio.
Would that happen at the end of this year itself, Balaji, or do you envisage that this might have a spillover into FY28 as well? That's part one. And part two, since you highlighted that there were execution issues that you are facing, what is the current scenario on the ground right now? Because we are almost a month and a half into the second quarter as well. Has the situation improved on ground, which is then therefore driving this conviction from you that you will eventually manage to recover whatever you have lost?
Absolutely. I would give full credit to the Indian supplier base that are quickly gearing up. So there are issues, there were manpower constraints, there were commodity price concerns, but we have been addressing all that, and industry has been responding very well to this disruption. So to answer your question, yes, I am seeing normalcy coming up. That is where I said there is a rhythm that is coming. There is order in this disorder that has been existing. So I'm very sure that within this financial year, we will be able to recoup whatever we have lost, because I still have a runway of more than 2 quarters in front of me. And I'm hopeful that the kind of trend that normalcy is coming back, if it continues, I'm sure we are all out to reap the benefits in the next 2 quarters.
Would that be true of your margin story as well? I mean, you started the year guiding for about 12%. This quarter, you've been lower. In the second half, is there enough leverage for you to pull back to that 12% kind of a target you had set?
This is it's a very tricky question to answer, looking at the uncertainty that prevails. Now, my only issue is if this normalcy takes longer to come, then my runway left to recover is reduced. But in any case, if I don't recover it by March 31st, I will recover it subsequently, because now the issue is of the inflationary cost and recovering from the price. It is a throughput, it is a pass-through, and it is a matter of timing, because once we give the increases to the suppliers, we have to recover it from customers. And it has been agreed in principle with all customers that it will be a pass-through. But there is a time gap, 2 to 3 months before the OEMs recognize it and pass it on to us. So I will always be with a gap towards the end of the year that I will still be recoverable, but it will not be probably reflecting in my books. So to answer your question, most of it will be recovered. That will help in building back my EBITDA. What is also pulling my EBITDA down is my localization content has dropped by 4%, not because of any structural issue, but mainly because of this inflation and my need to import components which are not available in my local supply chain in India. So this reverse has happened a little bit in localization. Again, we will get back to it. And my forecast is, yes, I will not look at 11.8 because last year we closed 10.8 and 100 bips is what we have always been guiding. That 11.8, today we are sure between 10.8 to 11.8, we will cross 11 for sure. That becomes my new base. Now, looking at the runway available for me to recover, whether I close at 11.3 or 11.6, this is the range we will be working at. And in the next 1 or 2 quarters, I will have clarity to come closer to where we will close. But
And
in
we'll
any case, 11.3, 11.6, above 11 is my EBITDA.
And we will hold you to those numbers, Balaji, when you speak to us the next time around. Thank you for sparing time and joining us. Lots of questions, but running out of time. Wish you good luck for the rest of the year as well. Take a short break. On the other side, focus on bonds. Ritu earlier caught up with Kaustubh Gupta of Aditya Birla Sun Life Mutual Fund. Stay tuned to that conversation.
Welcome to Bond Street. Our guest today is Kaustubh Gupta, who's the CIO Fixed Income at Aditya Birla Sun Life Mutual Fund. Kaustubh, thanks very much for being here with us. Let's start with the big macro news recently with the RBI holding the repo rate at 5.25%. What's your read? Is the rate cutting cycle, you think, firmly behind us now?
So before this policy, we were of the view as fund house that RBI will be on a prolonged pause, and which is why our take on the policy is that it is decisively neutral. Now, neutral means they can move up and down depending on evolving macro variable. The general policy fabric at central banker globally has been over last 18 months is being non-committable or don't give any preset course, and which is where RBI is prudent given that the variety of data is moving and it's difficult to look through and decide actions. So unless the inflation become more generalized, as RBI pointed out, or I would say the headwinds to external stability increases, we think we are in a prolonged pause, at least for next 6-9 months. Clearly, we are at a lower bound of rates, so probability of rate going higher is more than probability of rates going lower. but we do think that the risk to growth on downside is higher than risk to inflation on upside, and which is why RBI is in a prolonged pause.
Investors can own fixed income two ways, through debt funds or by buying bonds directly. Just briefly explain, when does each route make more sense?
So I think the choice is not now either or. It has to be both, and actually dependent upon the investor's ability to understand the risk around it, because it's very easy to take exposure, but you need to understand the variety of the risk which comes with each exposure. For example, someone who understands the credit risk, someone who understands the liquidity risk part of it, who doesn't need liquidity while the tenor of the bond is concerned, or who is okay for a concentrated portfolio, for him probably taking direct bond route takes or make a lot more sense. But someone who is looking for flexibility, someone who is looking to invest in fixed income for regular income, for asset allocation, or you can say the optionality part of it, that he can change the asset allocation part, for him probably coming through direct or coming through debt fund house make a lot more sense. So it entirely depends on the investors who is taking that risk. To put it simplicity, just like in equity, as you say, that the call on individual stock selection has to be best left to the professional. Similarly, the call to go to direct or you come through debt mutual funds, it has to be dependent on individual risk appetite.
Well, for an investor who's ridden the equity wave, what case would you make for why does fixed income deserve a real place in a portfolio today, and how much of it?
No, this is the most, I would say, frequent question which is being asked post-taxation change, and I would say most difficult question to answer. Beyond taxation, what fixed income gives you is flexibility in terms of, or that optionality part of it, that in times you can increase your asset allocation toward the risk asset when there are drawdowns for it. Clearly, it gives you clarity in terms of consistent cash flows. In terms of asset allocation principle, especially when the times are bad on the risk assets, they act as a portfolio stabilizer. And which is why in our assessment, fixed income should be looked as a partner to overall asset allocation rather than competition to other asset classes when you talk about asset allocation for these investors.
Briefly, this 10-year GSEC yield, it's been pretty sticky, 6.7, 6.8, even with that rate cut that had happened. Of course, there's a whole bunch of reasons, including supply-side concerns. But to your mind, why hasn't the long end fallen in step? And where do you see yields headed from here?
Look, these long end yield curves, they are just not get influenced only because with what's happening on the repo rate. They take into account what is expected inflation, growth, fiscal dynamics, which is going to play out over next 5 to 10 years, and which is where they can move indifferent to what's happening on the repo rate. Now, in our assessment, there are 3 or 4 reasons why these yields are refusing to fall. The first of all, clearly, market since last 1 year has been on the consensus that rate easing cycle is over, and now market is betting that probably the probability of next move is rate hike rather than rate cut, and hence investors are demanding for higher term premium. Second, as far as inflation are concerned, given the geopolitical setup, uncertainty risk have gone up, and which is why higher term premium is demanded by these investors. Third, post-COVID, clearly demand supply dynamics has changed, and a significant amount of duration is being supplied by state and central government, which is why investors are asking for more risk premium and term premium while investing in these long end of the bonds, and which is why these term premiums remains elevated. Lastly, I would say we are not working in isolation. If you look around the world, everywhere the term premiums are increasing, whether it's US, Japan, or any of the developed markets. And in wake of thing, across the globe, investors are asking term premium because of uncertainty, and which is why these long end of the curve are refusing to settle down.
Welcome back. For the markets, they're trending a bit lower, 24,574 on the Nifty, and those crisscross lines seem to be coming closer, although you still have more stocks that are advancing than declining. But let's focus on Deepak Nitrite. Now, they have reported a strong set of first quarter earnings. The revenue saw an uptick of 36%. Margins have doubled on a year-on-year basis. But let's get in their management to discuss more, on these first quarter numbers. We're now joined by Deputy Managing Director, Maulik Mehta. Mr. Mehta, thanks very much for being here on CNBC TV 18. Your first quarter numbers look very good, but is a lot of this performance thanks to the higher prices on account of the disruptions in West Asia? And once that situation normalizes, can you sustain this kind of a performance for the rest of the year as well?
First of all, thank you for having me. And I think this is a question that is relevant to the entire sector. So one thing I can say is that the entire sector had the same kind of weather. The question is who was able to build a roof beforehand. Now, in any eventuality, the companies that are able to secure both their raw materials as well as their customers are able to do well. And they are generally able to do well against companies which have not been able to secure the same. So across the group, we have had a strong focus over several quarters on ensuring that our raw material security is able to help us grow as we place more and more product in the market. Now, in Q1, we had an unusual situation where several of our suppliers declared force majeures. Now, in this period of time, we also preponed our annual shutdown and for repairs and maintenance. So by the time we were able to get the supply of raw materials, we were ready and able to run our assets at and exceeding the design capacity as we normally do. So this looks like a strong quarter. It is not by accident, and we're looking forward to a strong year moving forward as well.
So, Maulik, you are saying that you managed to build a roof before the weather turned bad compared to your competitors. And what steps are you taking to ensure that there are no further leakages during the year from that very roof? Is that performance sustainable going forward, especially since you mentioned that you have had a strong quarter and you're expecting it to remain so?
So what we're expecting moving forward is that the consumption pattern is normalized. What we've seen in the last 6 weeks or so is that the consumption pattern is normalizing. So the volume will drive both the top line as well as the bottom line. The top line on a per kilo basis, even if it does get moderated, we're already seeing a moderation of the raw materials pricing as well. And as we've secured availability, we're able to escape these short-term volatility situations where suddenly the Middle East heats up again, cools down again. Our supplies are secured and our customer bases are increasing their volume offtake as compared to Q1. Our assets, as usual, stand ready.
All right. You're fairly confident there'll be no leakages through the year, come what may, in West Asia. But, Maulik, multiple large projects under execution for you at the moment, bisphenol A, polycarbonate, all of that. What is the total capex that you've planned and what will that do to your debt? And when do some of these projects start contributing more meaningfully to your revenue flows?
Okay, so we've already announced the total capex outlay over the next 3 years. This was about 11,000 crore. We've already spent, I think, about 2,500 plus about 1,000 odd crores. The first tranche of it was for upstream integrations such as nitric acid, MIBK and MIBC, nitration and hydrogenation. These assets are up and running as we speak. The downstream, which includes polycarbonate asset, the bisphenol A asset, other specialty chemicals. The spend over this year will be more regarding construction as well as licensing fees. So we're reasonably confident that over the next 3 years, and we've secured our debt funding to have a good 60-40 ratio. And I think we're reasonably confident about the way that we are establishing our gearing, so that we don't have this concern. the focus continues to remain on good operational excellence as well as good project execution.
Right. Maulik, when does this entire capex program complete? One, and two, I'll club in another one. What happens to ROS in this time? Because your return on capital employed from 44% in FY22 is down to 11. You're in the middle of a heavy capex cycle. But once everything comes on stream, which we would want to know when, does that come back to those FY22 levels eventually going forward?
So that's a good question. And, the ROCE that you're seeing now, as you rightly mentioned, it is taking into account spending that is taking place without revenue that is concurrently being earned because this is a construction phase. Large part of the investment that we're making is on an integrated basis. All of this will be online by the second half of FY29. And so at that time, we will see that with asset build out as well as commissioning ramp up, we should be easily able to cross the threshold of at least 20% ROCE on a regular basis and then build up as we move forward. I'll highlight also that the 40% ROCE was at a point where we were not executing a capex.
Right.
Now, ROCE is a right number to look at, but not so much for a growth-oriented organization. We should be able to maintain a certain minimum ROCE, which we're targeting. As I clarified, that should be in excess of 20%. And as we get opportunities for growth, we will take them. We've established ourselves very firmly with regards to the ammonia chain as well as the propylene chain. We see ourselves moving from an intermediate chemical manufacturer to a materials manufacturer, and from an intermediate chemical supplier to an application chemistry.
All right, Maulik, thanks very much for joining us here with that. And we hope to have you back as you have more updates on some of those projects that you're speaking about. Time for a short break, but when we return, we'll get you excerpts of our chat with former whole-time member of SEBI, Anand Narayan, to get you a sense of what India's newly launched closing auction session could mean.
Welcome back. Still holding around that 24,570 levels on the index. But the big talking point all through the week has been SEBI's latest closing auction session. And that, of course, has been the big attention driver all through this week. The market regulator in its annual report, in fact, highlighted that the new mechanism is a significant step in enhancing the robustness of price discovery. But why introduce such a mechanism now when the old system appeared to work? A former whole-time member of SEBI, Anant Narayan, believes that it was the tracking errors that triggered the introduction of the closing auction session. Here's an excerpt of that chat we had with him.
The starting point was we did see representations coming in from many passive funds, the global passive funds, saying that this is a ubiquitous feature in most global markets and India is the outlier in terms of not having a CAS. And obviously they were worried about the errors that they saw in their execution on rebalancing days, etc. So the tracking error. So that was one of the starting points to start with. There were other issues as well. By the way, just for reference, we checked the numbers. The passive players in the FPI community are quite large. In fact, if I remember the numbers, they were about 30% of overall FPI equity inflows, total assets under management as well. And of course, they tend to be very stable long-term flows because people who invest in ETFs typically are there for, as a part of their asset allocation, etc. Also, what we realized is that a lot of the active funds as well, because they are benchmarked to these indices, are also very closely tracking things like tracking error. So it was not just passives, it was also the actives who were interested from a global perspective. Related to that, what we noticed is that index providers, they tend to kind of evaluate markets on various market parameters and microstructure parameters. One of the parameters, amongst many, happens to be the presence of CAS. And in that, India was not ticking the box. We were seen as a restricted country. So that was impacting, in a small way, the overall way in which index providers saw us and the weightage they gave to us.
Well, in fact, Anant also believes that critical information may not be reaching the street for participants to be able to make informed bids. Listen in as he details the significance of the indicative price and the imbalances there.
During the course of the CAS, at every instant, there should be an indicative price available to all market participants to see. Which means if you're seeing a particular stock quoting at, let's say, 1% higher, given the volumes of bids and offers, the market bids and the limit offers and everything put together, if it shows 1% higher, that should be visible to people so that a normal trader or an investor can come in and say, you know what, I'm getting a significantly high price.
Why would that be not visible? I mean...
So you have to make those system changes to make sure that first there's a calculation being done in real time of what the indicative price would be at that point of time.
So would this be similar to what we have in the morning, the pre-open?
In fact, we changed the nature of what happens in the pre-open based on what we learned for the CAS. But let's take the principles.
That simple point of the indicative price being available and being visible to everyone clearly, we have that in the morning.
That's right. But it should be visible throughout all the stocks. And remember, the closing auction is likely to be a lot more activity-based than the opening auctions are. So,
yeah, absolutely.
So you have to have the indicative price and you also have to get a sense of what the imbalance looks like. What is the nature of the bids and offers? And therefore, what can tilt this equation going forward? This is complete information which does two things. One, it provides information to the derivative market on where things stand as of now, knowing full well this is not the final number. But at least as things stand, where are they? So that it becomes an anchor or at least an indicator for the derivative market. The second part is this information is extremely important to draw in people. The moment you see the prices deviating from where it ought to be or where the market thinks it ought to be, you bring in offers and bids.
Fair enough. Are you saying that's not happening, Anand?
So my understanding, and I'm sure there is information available among stakeholders, I'm given to understand that in certain broking front ends, that is still not available in full as yet. Now, the first thing I would think about if I had been in SEBI right now, and I'm sure SEBI is doing this, is correct that. Make sure that anybody who's actually interested in the markets can see where the indicative prices are during the course of the CAS. And what the imbalance is like so that I can jump in whenever required. I'm told in some broker front ends, unless you do a nudge, which means I place an order, only then I can see the indicative price. That should not be the case. I should be able to see the indicative price and the imbalance at all points in time.
Take a short break then. Continue our conversation on the markets with Seshadri Sen of MK Global on the other side.
right, let's get in Seshadri Sen from MK Global, who joins us now to discuss market fundamentals and his top sectoral picks. Seshadri, thanks very much for joining us here. Since we have the big SBI numbers coming in anytime now, quick thoughts on how the PSU space you think stacks up versus some of the private peers. The performance continues to be better, and whether you find in the NBFC pack, are you going to be a little more cautious giving this new rules that have come out from RBI on the revolving credit that could impact players with large flexible loans like Bajaj Finance?
Yeah, so let me answer the question in sequence. Thank you for hosting me on the show. First, as far as the PSUs are concerned, if you take a slightly longer term view, say 2 to 3 years, there is the case that the valuation gap between the PSUs and the private banks should narrow a little bit from here. Performance metrics for the PSU banks have vastly improved over the last 4 or 5 years. The gap between them and their private counterparts are not as big as they used to be, and a lot of that is not yet captured in valuations. However, we have said in the past that FY27 is a bit of a tough year for the PSU banks. There is the bond side where in the base there are high treasury profits, so that will affect the overall PAT growth. Moreover, on the cost side and the credit cost side, there could be some upward normalization, especially with the wage agreements coming up. For the next 2 to 3 quarters, I'd be a little cautious. The only positive that has emerged in the last few days is that the largest PSU bank is seeing probably cornering a large share of the FCNRB flows. So that could be a short-term positive for the sector. But by and large, I'd be a little cautious on PSUs in FY27, but a little more constructive if you take a 2 to 3 year view. As far as NBFCs are concerned, we have said that in an upward credit cycle, NBFCs offer a bigger growth beta. They are in a better position to capture the upswing in credit growth than the private sector banks, which are hamstrung by a few issues in terms of their growth. Yes, the draft guidelines could be a temporary setback, but these are fairly innovative companies, and they have a lot of frontline sales capabilities to be able to pivot their products and overcome whatever setback these guidelines come. So short term, there may be a bit of a blip, but I wouldn't change my investment thesis based on these draft guidelines.
Seshadri, the other part of the talking conversations has been IT, where large cap IT has been fairly, on expected lines, disappointing this time around. Mid cap IT, barring the 2 large names, even actually barring one of the 2 large names, the rest of the companies have been fairly disappointing too this time around, whereas while it has been the mid cap IT space that was outperforming its larger peers. You still stay away from that sector because with all the AI meltdown that you've seen in the month of July, suddenly people have started to find some affinity towards that sector.
Yeah, so IT is a trading sector. For us, IT in the next 2 to 3 years will be a trading sector. You have to keep a sharp eye on valuations. When valuations do drop and implied growth in dollar terms goes down to 2 to 3% as they did at the bottom, that is when you should enter the sector, because I'm not in the camp which is, talking about doomsday and the sector will be wiped out. AI does provide some challenges, but the sector will retain relevance. Once implied growth goes up to say 6-7% in dollar terms, that is when you should start exiting the sector, because AI does provide some growth headwinds. And even before this AI factor, you had seen that the large cap companies were delivering only low single digit dollar growth in terms of revenue. So it's a trading sector. You got to keep an eye out on valuations, buy it at the right valuations and go underweight at higher valuations. I think we are in the middle of this re-rating run. There is still some momentum to go. But you can't just buy at any price and hope for a long-term compounding story in IT anymore.
Seshadri, what about the auto pack? I mean, the sales numbers have been fantastic so far. What do you particularly like in the space? Passengers, commercial, two-wheeler, tractors? Where would you place your money?
We've been bullish on autos for some time, and we continue to be very bullish. The numbers that are coming in are very strong. Yes, as you get into October, November, there is a very strong base effect which will kick in, but that doesn't matter. Auto growth cycles don't peter out in 12 months. This is a 2 to 3 year cycle in my view. At the moment, tactically, we are looking at CVs as one sector where they hit a little bit of a growth bump and are starting to recover. So probably a bit more delta, but we are bullish on the entire space. Autos, especially in the small car segment, I think has the scope to surprise the market over the next 3-4 years, because that's where the GST cut and the price impact is the maximum. Two-wheelers also continues to be strong despite the increasing share of EVs. ICE two-wheeler growth is also fairly strong. So most of the players are delivering very robust numbers and will continue to do so. Valuations are still not completely out of hand. So we remain constructive on the entire auto space. But at the moment, tactically, we are looking at CVs as one area which could give a little extra momentum to the portfolio.
Never out of questions, but out of time. Seshadri, thank you for sparing time and joining us. Looking forward to the next conversation. Take a short break. The key takeaways from the latest RBI survey on the other side. Stay tuned. Welcome back. The RBI has released results of its latest forward-looking surveys, and it clearly points to consumer confidence softening from the previous one, even though people remain optimistic about the year ahead. Ritu, what are the key takeaways from that survey?
Well, RBI's July forward-looking surveys show that consumer sentiment has weakened more across both urban and rural India. Let's start with urban consumers, where the current situation index, which RBI measures, that has slipped from 88.3 to 88.3 from 90.7, and that shows that households today feel economic conditions are weaker than they did 2 months ago. Even the future expectations index has eased, although it remains well above 100, which indicates that optimism is intact. Now, for the index that is showing on your screen, anything above 100 means consumers are optimistic about the outlook, and a reading below 100 means they are pessimistic. Now, the biggest concerns continue to be the economy, jobs, and prices, while households remain fairly confident about their income and spending outlook. It's a similar story in rural India as well. Rural consumer confidence has slipped, with both the current and future confident indices moving lower. People are also less positive than before about jobs, income, and the economy, but they still expect conditions to improve in the next year. The third survey on your screen, that tracks inflation expectations. Here, urban households continue to expect inflation to remain higher. Their one-year ahead inflation expectation has actually moved up to 9.4%, and the 3-month inflation expectation has eased a bit to about 9.2%. Current inflation remains unchanged at 7.8%. So that's as far as the sentiments are concerned. Hormaz.
Right. So that is, of course, the latest RBI survey. A couple of flashes at the bottom of your screens. One was from Swiggy, block deal that took place just a few minutes ago, 0.8% equity changing hands in the stock. That's now down to the lowest point of the day. And some commentary coming in from Blue Star as well. So keep that on your radar. The stock was down yesterday after the results miss, and continues to grind lower today as well. So 4.5% lower on Blue Star. And just pull up PG Electroplast before we sign off. Well, some commentary on the positive side coming in from the management this time around, as they see no reason why they could not have 25 to 30% growth this time around. And the stock is doing well for itself in today's session. Mind you, from the lows of June, which were around 450 rupees, the stock has now gone up to 630. Take your leave on this edition of Trading Hour. From Ritu and me, thank you for watching. Halftime report on the other side.
Stocks see small two-way moves with heavyweights coming under some pressure even as mid-caps perk up ahead of the weekend amid Gulf risks. IT as well as autos notch some gains while financials and chemicals drag.
RBI's draft rules and proposed barring NBFCs from offering revolving credit. A stop to these lucrative products offered by lenders like Bajaj Finance and Tata Capital can dent their business significantly. Stocks of NBFCs at risk dip.
Hero MotoCorp sees growth momentum continue in the second quarter and expects margin pressure due to higher input costs being mitigated by price increases. The two-wheeler major also expects to triple EV capacity by fiscal end.
Britannia surprises with 9% volume growth in Q1 FY27 as against expected 5 to 7%. Higher ad spends help push sales even as there is some dent on margins. The management says that it has gained ground against competition.
Siemens Energy jumps after posting revenue and profit well above estimates. Strong execution of the order book coupled with operating leverage and high exports contribute to the stellar show.
Hello and welcome to Halftime Report live from the CNBC TV 18 Motilal Oswal studio. I'm Ekta Batra and with me Sonal Putra and Vinny Motiwala. Well, it's turning out to be a mixed day for the markets at this point in time. So the Nifty is just about lower by around 77 odd points and we have the mid-caps which are just about managing to hold their head above the water at this point in time. If you look at it on a week-to-date basis as well, the Nifty is just about higher by around 0.7% and the mid-caps are step in step with the Nifty up around 0.7% on a week-to-date basis at current reckoning. So it has been quite a volatile week with regards to CAS. So let's see what today pans out like and whether or not there's any kind of stability going into next week on a sustainable basis. For the advanced decline ratio, positive as we speak.
Hey girls, good afternoon. It's Friday. Finally, it's been a long week. There were too many earnings, a lot of developments with West Asia crisis as well. And of course, gas. That is something that kept all of us on our toes as well. For now, the markets, as Ekta mentioned, they've been somewhere in the middle. For now, the mid-cap index is in favor of advances. IT is batting it for the bulls, followed by energy, oil and gas, CPSE, all of them doing really well. But what is under a lot of pressure is some of these financials. The private banking index is the top loser. Earnings coming in thick and fast. Godrej Consumer reacting to its numbers. So the action continues in the broader markets and earnings doesn't look like we are done yet, Vinny.
Not done yet. We still have a week to go, but hoping not as many as we saw this week. But just look at Godrej Consumers. They just reported their numbers as well. At the bottom of your screens, when you're looking at it, 504 crores, the net profit versus the poll at 530 crores. So we're seeing a bit of a miss coming in on that front. Revenue also largely in line, just a slight miss. Not much of a pressure on the revenue front, but the stock has seen a sharp fall coming in. Obviously, we'll come out with more internals on that later on as well. But for the week also, what we've seen gone by is PSU banks and IT as well as metal shine. Like Sonal was also saying, we've seen them buzz and trade. So that is what we'll keep an eye out on, and a whole host of earnings reaction coming in through the day as well. We'll watch out for that. But on the show, what is lined up for y'all? We'll connect with the management of Life Insurance Corporation and PG Electropras to discuss their Q1 earnings as well as the road ahead for the companies. Vivek will be putting the spotlight on the stocks that are moving around in the trading session this afternoon. So stay tuned in for that. Sonal is going to take us through the Q1 performance of chemical companies, a sector that has delivered a strong set of earnings. So what are we keeping an eye out on now, as well as a roundup will be key to watch out for. But first up, let's go across to Vivek, who's here to take us through the stocks that are moving around in the trading session. Afternoon, Vivek.
Well, good afternoon. Again, quite a volatile trading session. Sharp moves seen, especially with companies that are delivering results, and the reactions there are quite sharp. In terms of individual stocks and sectors that we're tracking, have a look at Britannia. Very good volume growth coming in, much above what the street was anticipating. That particular stock has seen a little over 2% uptick, market share gains seen as well. Hero MotoCorp, again over here, the management has alluded to the fact that margins will remain quite healthy. There was significant, almost 230 basis points of market share improvement in the ICE segment, and the outlook is quite positive. Stock higher by another 2%. PG Electroplas, extremely volatile stock, but good set of numbers. Steady Q1, and along with that, the management has guided for a 25 to 30% uptick in revenue revenues as far as FY27 is concerned. The entire auto ancillary pack are doing quite well. Motherson, one particular stock up almost 10%, along with that RK Forging too, that particular stock doing quite well, and Varroc Engineering up on very good volumes as well. And lastly, to round off the list of gainers, Kalyan Jewellers, initiating coverage note coming in today. Jefferies has come out with a buy rating almost 4% higher. So Kalyan continues its stellar performance, especially post this particular quarter results. On the other hand, quite a few drags as well. Crompton Consumer, steady Q1, but the main ECD segment has seen some pressure come across, down over 6%. NBFCs, especially Bajaj Finance and Bajaj Finserv, the RBI circular is something that the street has not liked. They're proposing a ban as far as revolving credit facilities are concerned. Midcap IT stocks, quite a bit of few seeing selling pressure today. Sonata Software, First Source, guidance downgrade coming in over there. Vikram Solar, pure play module company seeing significant pressure as far as realizations are concerned, down over 5.5%. And PNC Infra stock we highlighted yesterday, after a while we're seeing some action taken by NHI on contractors that have not delivered quality. That particular stock down over 5% after tolling has been suspended on its key project.
Okay, all right, Vivek, a lot of stocks buzzing in today's trading session. Thanks very much for taking us through that list. Let's get micro and talk about one particular company. PG Electroplast has posted what is a strong quarter, with revenue up around 35%. The profit after tax has risen around 12%. The growth was led by room ACs and washing machine sales, though margins did see some pressure on the back of lower other income as well. To discuss the quarter in more details, we have with us Vikas Gupta, who's joining in to talk about the growth outlook. Mr. Gupta, thank you very much for taking the time out. Well, revenue growth of around 35%. Has it beaten your own estimates, considering that, post Q4, you had indicated that you all were keeping your fingers crossed for FY27, and now it seems as though demand has panned out maybe better than your expectations?
So, good afternoon. First of all, thank you for having me on your show. If you look at the quarter one, internally, we were planning as per the growth which has come to us. So we were hopeful that the AC season should do well, and we were able to achieve almost around 38% growth in our AC business in this quarter. Washing machines has been an outlier. It has performed exceedingly well, and the washing machine business grew 67%. So what we feel, the quarter, this FY27 has started on a good note, and still we are cautiously optimistic, and we hope that it remains the same way going forward also.
Okay, so you're cautiously optimistic on FY27. Vikas, in the conference call, you also indicated that demand has been in line with what you were expecting, or maybe better. Next 2 to 3 years are looking good. I'm just trying to understand, if you do take price hikes, because commodity inflation has hit all the industries, will that not dent demand? What is your take on that, and how are you, seeing things 2 to 3 years down the line when things could be volatile on the supply side as well?
So please understand, our understanding of the situation is like that, that the demand still is holding up based on the current price inflation. Also, we are seeing that the demand is holding up. If you look at the other sectors also, other industries also, like the two-wheelers and everything, they are doing exceedingly well in the current volatility of the pricing. So we are hoping that the demand should hold up to the current pricing challenges. If you look at the long-term horizon of 2 to 3 years, definitely I think there will be a lot more stability and a lot more consistency in the pricing going forward. So once this geopolitical situation is resolved, I think we should have a more predictable pricing environment where we can predict demand in a better way.
Vikas, just want to understand a bit more in terms of pricing. Will you take more price hikes? To what extent you may take more price hikes as well? Q1 you have taken some. Maybe Q2, could we expect some, given this volatility is not going anywhere yet?
So please understand, ideally speaking, all the cost price hikes related to the raw material or the foreign exchange are passed through to our customers. But please understand, there is always a challenge. There is always a lag in negotiations with the clients to pass on the complete impact to the customers. So that's a kind of a constant discussion, constant struggle, I would say, that we do with our clients. And we are hopeful that we should be able to pass on the complete impact to our clients. At the same time, we are working with the clients to see how to mitigate this by working on the value engineering and some BOM optimization. So that is a work in progress.
Okay. Well, Vikas, you know, your inventory levels at the end of FY26 was around 1,600 odd crores. And that went to around 1,100 crores, I think, by the end of May. What exactly was it and is it at this point in time? And what are you guiding for in terms of inventory levels?
So please understand, we were hoping to bring our inventory levels down further, but we were not able to achieve that due to certain challenges. Currently, based on the volatility and the unpredictable nature of the supply chains in the current situation, we are preferring to hold on to some inventory with us. So there are certain QCO related challenges which are coming up in the next 2-3 quarters. So we are just trying to review the situation. But currently, the inventory level that we are holding on should get further normalized in next 1 or 2 quarters.
The value of it?
What is the current inventory levels is what my colleague asked Mr. Gupta.
Sorry. So the inventory level today is almost around 1,200 crores.
Okay.
So that should get further. We are hoping to bring it down further.
So in such situations, Mr. Gupta, no worries at all. In such situations where you are seeing supply side issues and, you know, while demand is strong, there could be an impact on balance sheet because there's inventory, then you have your creditors, there are receivables as well. What is the working capital cycle looking like going forward? You've turned cash positive as well. How does the balance sheet pan out going forward?
So please understand, now the AC season is almost over and we are seeing that the inventory is coming down. But again, once we start entering into a peak season of AC, we will have to again do the complete analysis of the situation, how the supply chain is looking at. Based on that, we might have to take some calls on the inventory. We might have to build on some inventory for compressors or some copper tubes and all that. So that is something that we will review and take decision on that maybe by October or November.
And what happens to the working capital? What is it currently, the days, number of days?
So currently the working capital is almost around 65 to 70 days.
And that continues to be the target?
So it should be, it will be in the range of same.
Okay, thank you so much, Vikas, for joining us this afternoon on the show and giving us an insight in terms of what we should expect from the company going forward. Speak with you more often. Thanks so much for that. On that note, we're going to sip into a very short break. After the break, we'll come back and talk to you all more in terms of markets. We'll focus on Hero MotoCorp, which is a stock that is buzzing around in the trading session as well. Stay tuned in.
Welcome back. Well, there's some more pressure on the Nifty as we speak. It is down 100 points right now. A lot of pressure coming in from the financials. HDFC Bank, which is at the day's low. We do have ICICI Bank also, which is putting some pressure. And Jio Financials is the other one, which is at the day's low as we speak. So the financials pressure continues on the Nifty right now. But from the Nifty pack, we also have Hero MotoCorp, which saw growth momentum continue in the second quarter, and they expect margin pressure to continue as well. Sudarshan is joining us now with all the conference call takeaways that he has. Sudarshan.
So Hero Moto had come out with a healthy set of earnings where it had seen healthy volume growth. Even margin has come in better than expectations. Today around 10:30 a.m. company has held the analyst call in which it has talked about first market share gain, then volume growth outlook, and also how exactly the EV thing panning out. So first talk about the growth outlook. In Q1, industry growth was 14% if you combine both ICE plus EV. Now for H2, it's saying that we're considering the high base of FY26, H2 growth might be lower, but overall in FY27, it's looking at industry growth combined EV plus ICE around 10%. Now what exactly is aiding the revenue? So some of the factors that it's talked about, first one is premiumization, second shift in mix towards scooter, EV, and also more selling of premium and bike. Now coming to the market share and margin front. So while it's saying that input cost had seen a sharp increase in Q1, in Q2 it's seeing a marginal increase, but the price increase that company has been undertaking will offset the pressure that's seeing from input cost. As the market share is gained, it had seen market share gain of almost 230 basis points in the scooter segment. Lastly, about EV and flex bikes. Recently, it had launched a flex bike where ethanol mix is up to 85%. Within 2 weeks of launch, it has sold around 5,000 flex bike. Now, EV capacity at the end of 2025 was around 15,000 units per month. Now it's been increased to 30,000 units, and by the end of 2026, it believes that it might be triple and can increase to 45,000 units per month. And also, currently 60% of its entire EV portfolio is PLI certified. And by the end of 2026, its entire 100% EV portfolio will be PLI certified. So after a strong set of earnings, outlook is looking largely positive.
Okay, all right, Sudarshan, thanks very much for that. So that's on Hero Motors, stock up around 2.5%. We had a couple of numbers go by for you. That Cera Sanitary, that stock is down around 4% reacting to its performance. Revenue is up around 19%, but maybe the EBITDA and the profit performance should come up for you as well. The EBITDA down around 7% for that particular company. We'll take a short break, but a lot more on the markets. A lot of stocks lined up on the other side. Stay tuned for that.
Welcome back to Halftime Report on CNBC TV 18. Nifty as of now 24,535 levels. Seen a bit of a dip coming in from when we started the show, so keep an eye out on that. As of now, the Nifty is trading at the day's lowest point. But let's move on and talk about the newly introduced gas mechanism, which lays a solid foundation for surveillance as well as against spoofs and manipulation. That's the word coming in from a former whole-time member of the SEBI, Anant Narayan. Listen in to his rationale.
Checking for things like spoofing, manipulation of any kind, trying to mark the close, etc., is far easier in a CAS environment than it is in a VWAP environment, because the exchange or the regulator only has to look at that particular window. We can see everything there. We can see who's placing the orders, who's modifying the orders, who's withdrawing the orders. All of that is visible at one go at one particular window, right? So rest assured that actually the CAS lays the ground for very, very solid, surveillance to be in place, which the exchanges and SEBI anyway are very, very good at. So if at all somebody plans to do funny business using the CAS, good luck to them, okay? And for the ecosystem as a whole, this is an ecosystem which is under the spotlight and very easy to check in terms of volume. Now, the issue, therefore, is not really about manipulation. I think that can be taken care of by the exchanges and by SEBI, and they're good at that. The issue is that the volumes remain low.
All right, that's the explainer on CAS. Of course, we'll keep getting excerpts of that conversation that we had through the course of the day. It's time for a break now. Before that, can we take a look at Godrej Consumer Products Limited? Reported numbers just a while back. There's been a sharp fall. The numbers were below estimates, and that's the reason why we're seeing that cut on the stock price as well. It's down around 4.5%. Look at that go. There's a further fall, 3.5% now on Godrej Consumer. Slip into a short break. When we come back, we'll connect with the management of LIC to discuss the company's first quarter performance and the growth roadmap going ahead. Stay tuned.
Welcome back. Well, it is a mixed day like we've been talking about for the markets. So the Nifty is just about lower by around 80 odd points. And we have the Bank Nifty, which is sulking a little more, so down around 0.5%. A couple of stocks which do stand out, however, on the upside is Newland Labs, which is going from strength to strength. It's up another 4% today. Remember, it's up around 17% this month and rallied around 47% this year. So fantastic move on that particular counter. And the other one is Aurobindo Pharma, where the likes of HSBC, in fact, have raised the target price post the numbers yesterday and conference call. So new target price for Aurobindo is 1,900 rupees from the likes of HSBC. But let's talk about another particular company. It was a steady Q1 for LIC. The insurer reported strong VNB growth, while margins also witnessed a healthy expansion. Our colleague Yash Jain spoke to the CEO and MD and started by asking about the verticals which performed well and which lagged. Listen in to a slice of that conversation.
We have been trying to improve the contribution from the non-par segment, and that has been the focus area for some time now. In the first quarter, we had a good growth in terms of non-par savings, which is our area of strength, and non-par protection, where we started focusing in the current year. Both have done very well. We had some strain in the non-par ULIPs as well as annuities. These are the two areas which normally we are doing well in the last 2 years, but this year we saw a strain on those two in terms of growth because of the uncertainty that the market faced. When you have this kind of a market situation, the interest rate becomes an area of doubt or question. So we had some kind of a headwind in terms of the annuity sales, as well as ULIPs. ULIPs, because of the market uncertainty, we could not show kind of growth that we wanted. So overall, we could show an 8 plus growth thanks to the good growth in non-par savings and non-par protection.
Okay, ULIP did not do well. I mean, naturally, because of how markets have performed. What I want to understand from you is, for the year, from Q2, Q3 onwards, do you expect ULIPs to come back performing stronger than what they did in the first quarter? Keeping that in mind, the revival that you see there, what is the kind of AP growth target or an understanding that you have for FY27?
See, we are a legacy player and we have a large base. So naturally, we are not looking at a very big growth over a long period of time, but we would like to continue to grow on a sustainable basis, on a profitable basis. These are the focus areas. So I would expect my growth to be in the double digits. That's what we will be certainly focusing on.
Early double digits?
We can think of early double digits to start with, but it can go up over a period of time. We need to work towards that.
Okay. You spoke about, ULIPs, which will help you because those are chunky premiums, will take you towards that double-digit mark. I want to understand, if ULIP does come back, do you think you will have to trade off a little bit of the margin performance to that growth in ULIPs?
See, we get the margins from different portfolios. In fact, in the first quarter, we had seen an appreciation of margins in all the parts of business. The PAR has also improved its margins. The group has also improved its margins, and the non-PAR has been, as usual, giving a good margin. So all the three have been contributing, and we are focusing on improvement in margins. The margins improve because of multiple components. One is the product mix itself. Two is the operational efficiency.
Correct.
Where we improve our the expense ratio, we optimize on the expenses and see that we have a higher top line growth compared to the expenses growth. The growth in margin is also possible. The third factor, which is the interest rates in this market, which is not within the control of anybody. It is a market-driven kind of a situation. If that also continues to be hovering around what it is today, we should be able to get a growth in the margins from here onwards also.
Okay. Just because you're speaking about margins, FY26 is when you did 21.2% in terms of margin. First quarter has been higher than that at about 22.4%. For the full financial year, where do you see yourself? How much of an improvement over previous year, that is about 21.2%, do you see for yourself as far as current financial year is concerned?
No, as I told you, we cannot predict what is going to be the interest rate scenario. Once the given uncertainty in the market goes, or if the geopolitical situations ease, the interest rates can also undergo a change.
Correct.
If that is the case, there can be an impact on margins of the entire industry as such. So The component from that is not predictable, but otherwise the component that arise out of our product mix and operational efficiency will continue to be improved. If the other situations remain the same, we can look at an increase of over the previous year or over the first quarter also to a small extent. Yes.
Okay.
We would like to reach closer to the industry average.
Which is the number that if you
we can look at 100 basis points increase or something like that, but I do not want to give an exact guidance, but we would like to improve further on this.
Okay, understood. I want to understand a little in terms of the product level margins that you've been deriving. Would you be able to share some numbers in terms of what is the kind of margins that you've been able to derive as far as the ULIP segment is concerned, the protection book is concerned, the annuity book is concerned? Some understanding on that?
No, ULIPs has got a limitation in terms of capping of the RIY.
Correct.
So we cannot, you can't expect ULIPs to give you much increased margins.
But with riders, attachment of riders?
We don't have compulsory riders attachment on ULIPs. So we give the options to the customers, and whatever riders are being opted by the customer, that is what is what we get. Yes, there can be a small increase in margin by two factors, as you say, if riders adoption is increasing, 1, and 2 if the ticket size improves. Both are going to be areas of focus for us. Plus, we have good margin contribution from savings and protection. Of course, annuities also are rate sensitive.
Yes.
So we cannot look at much big margins in annuities also, but they can give numbers. They can give both top line numbers as well as VNB numbers.
VNB numbers. One question as far as the non-par segment itself is concerned, we've been seeing a continuous improvement in the share of non-par as a part of the individual APE. It's gone to about 32.5% from 30.5%, so about 200 basis points improvement there as well. For the year, where do you see the share? Do you see further improvement where you can take the share of non-par book as of your individual APE even higher, and till where can you take it?
It will improve a bit more because the products that we have launched in the recent past, right from April 22, have all been non-par, and there is a good flair for guaranteed products in the market as well. There is no ambiguity. Customers are very comfortable knowing what exactly is going to be paid to them based on what they pay and other things. So there is a liking for non-par, which is going up. I have been mentioning that we will try to be around 1/3, 2/3 kind of a ratio.
Okay.
It can be plus or minus on both sides. So it can go up to 35, 36% also, or it can be around 30, 33 or so, or something.
All right, that's the word coming in from LIC. The stock is high by 1.5%. With that, we'll slip into a short break now. Up next, Manisha Gupta will connect with GP Sharma, President SkyMet Weather Services. Stay tuned for that conversation.
Welcome back, and joining on the show now is GP Sharma. He's the President, Skymet Weather Services. Mr. Sharma, hi, thank you so much for joining. And we do understand that July is ended 1% on the positive, but August 1 has been called below normal as a month to begin with as an estimate. How are you looking at what we've done in the first week of August?
Yeah, thank you, Manisha. Yes, right. July, quite good. Not without hiccups, but then still, overall, it was good. Normal rainfall, maybe a percent higher than the normal. First week of August, it is not bad. But then every day the rainfall has been a little below the normal, maybe a millimeter or so. Still, the normal is 8.5 to 9 millimeters per day rainfall pan India. It's a higher, quite high. But then actual rainfall has been, as I said, about a millimeter or even at times 0.5 millimeter less than that. As of now, as of today, first 7 days of the month, they are just okay. And rainfall is just about 2 millimeter to 2.5 millimeter less than the normal. Not a question of any worry as such. But then, big thing is the upcoming days. As it is in the last few days, you see the pattern of rainfall has changed. It is mostly confined along the Indo-Gangetic plains and eastern parts. One good thing, these are the parts which were rather deficient. Bihar had a large deficiency. East Uttar Pradesh had a large deficiency, which has covered better. It has over the last about 4, 5, 6 days. It has improved by about 10%, which is a very good number. Okay, but then the gray area is the central parts of the country, which had become very good. Maybe parts of Vidarbha, Marathwada earlier. There are hardly any rains, very little rains, and there the deficiencies are growing again. Vidarbha had dropped to just about 5% below the normal. Now, as of today, as of yesterday, gone to 13. So is the case with even Marathwada. It is also 12%, and it's going to grow further. Okay. There will not be much of rains in the western parts, central parts, southern parts of the country. You give a time of another 3 days, it's going to shrink significantly over these parts.
So how would you look at, Mr. Sharma, how would you look at the month of August end for some of these states then? Maharashtra, of course, is a concern. So is the case with Karnataka. Gujarat has seen that very strong rain over a period of a very less time. And then again, we're looking at not much rain there. So where do you see concerns coming in by the time we close this month?
All these pockets which you mentioned, month of August is going to be a dampener. Okay. More so the second half of the month. I see possibly a break in monsoon situation is coming. It should be anytime around 12th or later, wherein, as we know, the monsoon belt, rainfall belt that shifts along the foothills predominantly, foothills of Nepal, foothills of adjoining Uttar Pradesh, Bihar, and going up to Northeast India. Yes, those are the pockets which do have very heavy rainfall, which doesn't suffice, which is actually not needed from agriculture point of view, but that is what the pattern becomes. Parts of some Tamil Nadu and South Coastal Andhra Pradesh do get some moderate showers around that time, but most parts of the country, they go dry. Particularly western, central, and southern part. Yes.
How would you look at August end then? Because we saw July end just about a percentage point higher, even with so much rain. How do you see August trending? Below normal, yes, but are you putting out a percentage yet?
Yeah. See, what I find is there is a pattern during El Nino years. I studied for 2002, 4, 9, 15, 23, all these 5 years. There is a pattern in the core monsoon months. Both the months have failed only once. Otherwise, 2002, 2004, July fared better. And other 2 months, it is August fared better. How logic? I cannot explain as to why. But there is a pattern which you have to give some weightage, and it happens. July has performed better. The chances are more that the month of August is going to slow down. To me, it appears as if the deficiency of 10%, I will take it as such. Okay. In the month of August as such. As of today, as I said, it's okay, but still 255 millimeter of monthly rainfall is not a small figure. And the second half of the month, possibly it is with a long break. How long the break is going to last, as of now, it is difficult to say. But then even if it is for about a week or so, week, 10 days, it drops the averages and the rainfall is going to be less than the normal in the month of August, as I first read it at this time. Okay, to start with, I will say about 10%. How September is going to pan out thereafter, it's a big question. But then August is going to be a little below normal. To start with, I will say about 10%. Yeah.
All right. Mr. Sharma, one final question then. And how are you also looking at the El Nino developing right now? Because the statements or the projections from various international agencies still are putting it to a severe El Nino by the time we are in the month of October, November and going forward from there. And how are you looking at this positive Indian Ocean dipole? Is that changing things?
El Nino is growing. It's already reached maybe the borderline of strong category. As far as the Climate Prediction Center is concerned, that is American, that is the US, NOAA. Whereas the Australians, Bureau of Australia, they follow different standards. As per Bureau, it has already reached, because the last figure they had given, temperature anomaly, it was 2 degree plus, 2.02 rather. Whereas as far as the CPC is concerned, it is 1.5, just the threshold of strong El Nino. But then notwithstanding, okay, as I keep saying, irrespective of the El Nino, whether strong or very strong or moderate, it doesn't modify the monsoon to that extent. Yes, for academic purposes, it is going to be a strong El Nino in the month of August itself, by all means, and possibly maybe by second half of September, it will grow to very strong also. But then, even the dampener in the month of August, which I'm saying about less than normal by 10%, I will not associate it with the El Nino condition. Okay. As such, month of August is prone to break. Break is coming, and that break will bring the monthly rainfall down. As far as IOD is concerned, it's showing positive signs. But then to counter the ill effects of El Nino, we need a very strong IOD. You see, historically, traditionally, whenever there is El Nino, IOD is positive. You take the 50 years of data, there's nothing great about it. That IOD is turning positive now. Yes, it is plus 0.6 now. For the last 2 weeks, it is above the threshold of 0.4, but it always is positive. Okay, we need, like what it happened in 2019 or so, we need anything about 1.5, at least I will say, to be on the safe side, 2 degrees Celsius higher temperature. That only will be able to counter El Nino. Not these 0.5 and 1 degree, that will not suffice at all. Okay, that's that's my view.
That is what the numbers are looking like. So clearly, August second half is going to be a stronger El Nino, and by September we could be looking at very strong El Nino. So clearly, the monsoon concerns just about continue.
Absolutely, just about continues. But Mr. Sharma, thank you so much for joining us on the show, and Manisha, thank you so much for taking us through that conversation as well. That's all about El Nino as well as monsoons. Keep an eye out on that. But with that, we're going to step into a very short break. After the break, Sonal is going to take us through the Q1 performances of all the chemical companies this time. Stay tuned in for that. Welcome back to Halftime Report on CNBC TV 18. While the markets are seeing a few point uptick from 12:30, we are coming in at around 24,560. That's the level for the Nifty. But let's keep an eye out and switch gears and talk about the chemical space and the sector that has delivered a strong Q1 FY27 performance. Sonal is at the wall to take us through the numbers, the trends that she saw coming in as well. Sonal, over to you.
Let's talk about the profit growth that these companies saw. Before I talk to you about why did these companies do well in the quarter gone by, look at that performance. Lakshmi Organic seeing gains of 216%. There's Deepak Nitrite with gains of 207%. This is profits on a YY basis. Naveen Fluorine, Balaji Amides, Alkyne Amines. You have SRF, Ecuras Chem, Aether Industries, and 27.5% growth was one of the lowest actually in the industry. Of course, not all of them did well, but this was a strong performance in an otherwise weak quarter, which was expected. What were the key factors that led to it? Of course, inventory gains, because we did see the impact of West Asia crisis. There were forex gains as well. Spreads and cracks were higher because there were supply chain issues in some of these products, and demand continued to be strong. There were no demand side concerns that these companies saw this time around. So what did they indicate? What would the coming quarters look like? Naveen Fluorine continued to maintain its guidance, $100 million in terms of revenues in CDMO, EBITDA margins between 30 to 33%. Acuras Chemicals said that they will see revenue growth of 25% and EBITDA growth of 36% in FY27. We had Aether Industries, which spoke about how margins could be between 28 to 30%, and new product launches are expected in some of their important segments as well. Himadri Specialty maintained its FY28 profit after tax guidance of 1,100 crore rupees. SRF also had a decent guidance. They spoke about 15 to 20% growth in their chemicals business, which is a bunch of their earnings. They said it's firm refrigerant gas pricing, volumes, improvement in specialty portfolio, which will lead to growth going forward. The stocks have also done well, not all of them, but most of them. Acuras Chemicals is up 93%, Aether Industries is up 86% this year so far. Good gains from Balaji Amines, Naveen Fluorine, Alkyl Amines, Lakshmi Organic, Deepak Nitrite. It's SRF which has not done so well because there were concerns and headwinds as well. However, the sector as a whole has done really well this year so far. Let's talk about the valuation picture as well. Start with Aether Industries. Trades at hefty valuations of 86 times. Now, do remember with chemical companies, not all of them are peers for each other because all of them have different product profiles. So you can compare something like Alkyl Amines with Balaji Amines. There is a big differential here. Naveen Fluorine and SRF, where SRF is trading at a weaker value, at a cheaper valuation because it does have other segments as well. But largely, it's not a cheap valuation for the sector as a whole. And yes, the stocks have run up as well. But the main test is in quarter two, where we'll not have big forex gains, no inventory gains. So demand is something that we'll be tracking very closely, and the pricing scenario for all these companies.
Okay, demand pricing scenario will be key to watch out for in Q2. Sonal, thank you so much for taking us through the highlights of Q1 and valuations as well as what to watch out for in Q2. Thanks so much for that. But on that note, quick check in terms of what the market is doing. While I said, yes, we've seen a recovery coming in of 30-odd basis point from the lows in the last 1 hour. So, yes, that's a recovery there. Nifty IT managing to still hold on to gains in the trading session. So, keep an eye out on that as well. Nifty IT has managed to do well for the whole week this time as well. We're holding on to gains of 2% for the Nifty IT. PSU banks continue to shine for the week as well. And a lot of individual names that are moving around in the trading session. Do not forget Siemens Energy. Good set of numbers that came in from the company, and the top Nifty 500 gainer today is Siemens Energy. 13-14% uptick for that stock as well. We have Samvardhana Motherson that's holding on to strong gains, as well as Tata Technologies. So keep an eye out on all these names. But with that, we are absolutely out of time with this edition of Halftime Report. Thank you so much for tuning in. Up next, your Business Lunch.
stocks see small two-way moves with heavyweights coming under some pressure even as mid-caps perk up ahead of the weekend amidst Gulf risks. IT and auto notch gains while financials and chemical stocks drag.
RBI's draft rules on proposed barring NBFCs from offering revolving credit, a stop to these lucrative products offered by lenders like Bajaj Finance and Tata Capital can dent their business significantly. Stocks of NBFCs at risk dip.
Hero MotoCorp sees growth momentum continue in the second quarter and expects margin pressure due to higher input costs being mitigated by price increases. The two-wheeler major also expects to triple its EV capacity by the end of this fiscal.
Britannia surpasses with 9% volume growth in Q1 against the expected 5 to 7%. Higher ad spends help push sales even as there's some dent on margins. The management says it has gained ground against competition.
And Siemens Energy jumps in double digits after posting revenue and profit well above expectations. Strong execution of the order book coupled with operating leverage and higher exports contribute to the stellar show. Good afternoon, you're with us here on Business Lunch. We are coming to you live from the CNBC TV 18 Motilal Oswal studios on the final 150 minutes of this week. I'm Hormuz Fatakia. With me as always, Arundhati Ramanan. Arundhati, good afternoon.
Hi Hormuz, good afternoon. You know, the market's in the red, the mid-cap index bucking the trend, but what a week it's been with the new CAS rules and everybody trying to navigate the markets with those rules, plus these West Asia tensions and higher oil prices all weighing on the market.
Indeed, it's not over until it's over, right? We are still 80 points down for all you know. After the final tick, we might be in the green. Who knows? But that's been the kind of week that we have had for the markets. We are going to end the week on a positive note, that's for sure. Around about the 24,550 mark, the bulls will take comfort from the fact that the index is constantly taking support at that 24,500 mark, and that is something that even a lot of chartists were also alluding to, that if 24,500 holds, it might just end up forming a base for now, and then we start moving higher again towards the 24,800 level on the upside. But the big news event of this hour is going to be results from SBI. It should be out anytime now, and that's what the street is awaiting, because results from SBI will have an impact on the entire PSU bank basket, albeit all of them have already come out with numbers, but still it does have an impact for sure. The stock is off the highs of the day, is SBI, still away from its 52-week highs though, which is around 1230 and still around about 1086. So we're awaiting results from SBI. A lot of other results have already come in though, from GCPL, from Cera Sanitary, from BEML. Then there are a lot of other results expected as well from Hindalco, from Titan. So it's a big second half that's lined up for sure.
Absolutely, and SBI will be key to watch out for. And on the sectoral front, IT stocks are helping curb some of those losses. We've got TCS, Tech Mahindra, HCL Tech, all of those stocks gaining in trade. The Nifty IT up over 1%. And, you know, TCS 2.7% in the green. Tech Mahindra, HCL Tech managing to hold 0.5% higher. Auto stocks also doing well today. Tata Motors PV, that index 1.5% in the green is the top gaining index. We've got Tata Motors PV. It's come off the highs of the day, now in the red. But Bharat Forge, Hero MotoCorp doing very well in trade today. Hero MotoCorp higher by over 3%, nearly 4% in the green. On the downside, we've got those private bank names. Financials across the board are under pressure today. That index 0.7% lower. We've got Kotak Mahindra Bank, we've got Axis Bank, HDFC Bank, all of them feeling the pressure today in trade.
The other big announcement that has come in from the RBI is that it has proposed to bar NBFCs from offering revolving credit facilities. Ananya is joining in with more details on this. Ananya, tell us more.
Well, yes, the RBI's draft guidelines on revolving credit could be an important negative for these NBFCs, especially for Bajaj Finance and Tata Capital. Now, I'll tell you why. Simply put, RBI is proposing that once a borrower repays part of a loan, that limit cannot automatically become available for borrowing again, effectively impacting flexi loan structures here. Now, here IIFL estimates that the exposure at around 20% of Bajaj Finance's standalone AUM and 15% on a consolidated basis, while Tata Capital could have a high single-digit to low double-digit exposure here. Now, the first impact will be on growth. Without the redraw facility, loans run down faster, customers become less sticky, and lenders need fresh sanctions and disbursements to replace the AUM. Now, fee income and yields could also take a hit here, as flexi products are generally more lucrative. Now, but Bernstein here highlights an even bigger potential risk, that is asset quality. Some borrowers may have been repeatedly using these available limits to manage cash flows. Removing that liquidity would expose underlying borrower stress here. So that's why you can see these stocks particularly are under pressure. And we should remember that this is just a draft and we'll wait for the final guidelines by RBI.
All right, Ananya, many thanks for those details. Now, the Reserve Bank of India has released a fresh list of 17 upper-layer non-banking financial companies. Tata Sons, which has applied for deregistration as an NBFC, continues to feature on that list. Let's go across to Ritu Singh to understand what qualifies as upper-layer NBFCs. Ritu?
Well, let's start with Tata Sons. That's been the one making headlines, and it's status quo as far as they are concerned, because RBI has once again classified them as an upper layer NBFC. But again, it comes with the same caveat that the inclusion is without prejudice to their application to deregister themselves as an NBFC, which continues to remain under examination by RBI. If you recall, Tata Sons was first classified as an upper layer NBFC back in 2022, and thereafter they had applied to surrender the NBFC license in 2024 after repaying all of their debt. But since then, there's been no decision on their application. So whether they need to list or they get to remain private, all of that will depend on what RBI finally decides to do with their applications. But look, beyond Tata Sons and the latest upper layer NBFC list, it comprises of 17 names. The biggest change is the addition of 4 government-owned NBFCs. So REC, PFC, IRFC and HUDCO, they've all entered the upper layer list, which means they're now going to be subject to tighter regulatory oversight. Of course, this is only made possible when the guidelines were revised, and now it allows for the inclusion of government-owned NBFCs, which was previously not the case. At the same time, you have PNB Housing Finance and Sammaan Capital that were earlier on the list, but now they no longer qualify as upper layer NBFCs. But there's a very important caveat here. Both of them will continue to remain under the upper layer regulatory framework. That means they'll still have to, go through tighter regulatory guidelines, because once, according to the rules, you're classified as an upper layer NBFC, you remain under stricter RBI rules for at least 5 years, even if you no longer qualify on the list.
Ritu, thank you for that update there. Explains the reason, of course, the upper layer NBFCs. Tata Group stocks have been reacting to, but 2 of them in particular, Tata Investment and Tata Chemicals, both of them always have a reaction whenever there is something with regards to Tata Sons and its potential listing. Now, Hero MotoCorp has seen a growth momentum continue in the second quarter and expects margin pressures going forward as well. Sudarshan is joining in with some of the key highlights from the earnings call. Sudarshan.
It has been a strong quarter for Hero MotoCorp. Given the volume growth, given the strong revenue growth, even margin has come in better than expectations. And now going forward, so I'll be talking about 3 topics. First, growth outlook for FY27. Second, margin. How exactly companies looking at the margin going forward, if there is any change in the medium-term guidance. And lastly, what's the strategy on EV front? So first, talk about the FY27 outlook. So in Q1, EV plus ICE volume growth for the industry was 14%. Company believes that in Q2 the growth is expected to be the same. Now in H2 there would be a higher base of H2 FY26, but despite that, industry growth of combined EV plus ICE can be in the double digit, and that's very positive. Now what exactly is going to aid revenue growth for the company? So it's the mix in the shift in the mix. So premiumization, shift in the mix to a scooter, EV and premium variants. These are some of the factors that will be aiding revenue growth going forward. Now coming to the margin and market share. On the margin front, company has reported margin that was higher than expectation. It was above 13%. We were expecting around 12.5 to 12.6%. How about the margin in Q2? Input cost will remain elevated, but it's going to be offset by the price action that company has been undertaking. So there won't be any major impact because of input cost. Now, medium-term margin guidance company maintains in the range of 14 to 16%. As far as the market share is concerned, especially on the scooter front, it has gained market share of more than 230 basis points in Q1 FY27. Now coming to EV and flex vehicle. Company recently launched flex vehicle in which ethanol mix can be as high as 85%. 5%. Now, on that front, within 2 weeks of launch, company has sold almost 5,000 vehicles. Now, coming to EV. EV capacity as of FY25 or 2025 end was 15,000 units per month. Now, it's been increased to 30,000 units. Now, by the end of 2026 end, company believes that it will increase to 45,000 units because of the sharp increase in the demand. We are looking at the EV. And lastly, about the PLI. So, currently 60% of its EV portfolio is PLI certificate. By the end of 2026, it believes the entire portfolio will be PLI certificate. So, strong earnings, and even for FY27 outlook, company has got very strong outlook, and margin pressure from input cost is going to be very minimal.
So strong earnings, strong outlook, and the stock also reflecting that 3.5% higher in trade. Thank you so much for those details, Sudarshan. SBI is all set to report its Q1 earnings today. Let's go across to Ananya to tell us what the street is expecting.
Well, the street expects SBI to deliver another steady quarter, we can say, with NII likely to grow around in the range of 11 to 12% on a year-on-year basis. But PAT here is likely to be flat or marginally lower because of, the lower treasury gains and a higher base here. But the loan growth expectations here are quite high from SBI. It's a 15 to 18% loan growth is expected here. Now, margins will be the key monitorable, with NIMs expected to stay broadly stable around the 3% mark. So we'll watch out for that. Now, in the previous earnings call, if you see, management guided for FY27 credit growth of around 13 to 15%. Domestic NIM above 3%, credit cost of around 50 basis points, ROA above 1% and a minimum 15% ROE, while reiterating confidence in asset quality. So we'll see, the investors will watch out for the guidance that if SBI reiterates the guidance again, and on the margin front. So we'll watch out. The results will be out soon.
Yes, and we are counting down to those numbers from SBI. Ananya, thank you for that update there. Hovering around the flat line is SBI. It has done well over the last few days now in anticipation of its results. Take a short break. More news and updates on the other side. Stay tuned.
On to our top story, updates from West Asia. US President Donald Trump expects the war on Iran to end pretty soon, telling reporters during questions on global and domestic energy prices that he does not think they can go much longer. Listen in to his comments.
We had oil down to less than $2 in many places like Iowa. Oil was down to, gasoline was down at numbers that people hadn't seen in years. $1.85, $1.95. So it passed Tuesday. I was in Iowa at a stop, and we had $1.95, another one, $1.85 a gallon. And we'll see those days pretty soon again, based on everything I see, as soon as the war ends. And I think it's going to end pretty soon. I don't think they can go much longer. I think we're doing very well. I just, I'm involved in the negotiation. I think we're doing fine.
Meanwhile, Iran's president has stated that the US has applied maximum economic pressure, noting that Iran loses roughly 230 million cubic meters of gas daily as a result of the US-Israeli attacks. Elsewhere, Yemeni forces reported that Houthi strikes using suicide drones and ballistic missiles left at least 18 troops dead.
In the US, traders will be awaiting data from the July jobs numbers due later today, which isn't expected to show much improvement. CNBC's Steve Leisman joins in to share the outlook and the likelihood of a rate hike by the Fed in September based on the oncoming data.
Fed Governor Lisa Cook joining the ranks of Fed officials who have said they would hike rates if inflation doesn't cool. And that's now a larger group if you count those three dissenters who already wanted to hike at the last meeting. The probability of a Fed rate hike in September remains high, but down from where it was a few days ago at 58% now. Despite higher bond yields on the day, part of that could reflect a general belief that I'm reading from forecasters in the market that inflation is expected to cool, and hopes for a benign employment report tomorrow morning at 8:30. Here are the numbers we're looking for. Payrolls forecast to have grown by 83,000 in August, up from 57,000 in July. That's an okay number. The unemployment rate seen unchanged at 4.2%, and average hourly wages, they're estimated to have grown by 3.5%, also unchanged. So far, many Fed officials have suggested the labor market not pushing inflation higher, with wage growth relatively consistent at that 3.5% level. But the FT reporting that sources close to Fed Chairman Kevin Warsh say he, like Cook, would be prepared to raise rates in September if the next two inflation reports end up being hot and inflation expectations do not remain under control. And separately, the White House confirming that the president and Warsh have been speaking once in a while, they said. A story first broken in the Wall Street Journal last night said that Warsh has spoken with the president, quote, repeatedly.
All eyes at 6 o'clock this evening with the US jobs report. Take a short break, back with more on the other side. Welcome back. Now, the debate around delinking FNO settlement from the CAS is picking up. Of course, the closing auction session is what I mean, is picking up momentum. But largely, the discourse stems from the wild price swings the market has witnessed on the first day of that special closing auction session. Now, a former whole-time member of the SEBI, Anant Narayan, also believes that critical information may not be reaching the street for participants to make informed bids. Listening to what he said, and he details the significance of the indicative price and the imbalances.
During the course of the CAS, at every instant, there should be an indicative price available to all market participants to see. Which means if you're seeing a particular stock quoting at, let's say, 1% higher, given the volumes of bids and offers, the market bids and the limit offers and everything put together, if it shows 1% higher, that should be visible to people so that a normal, trader or an investor can come in and say, you know what, I'm getting a significantly higher price.
Why would that be not visible? I mean...
So you have to make those system changes to make sure that first there's a calculation being done in real time of what the indicative price would be at that point of time.
So would this be similar to what we have in the morning, the pre-open?
In fact, we changed the nature of what happens in the pre-open based on what we learned for the CAS. But let's take the principles.
That simple point of the indicative price being available and being visible to everyone clearly, we have that in the morning.
That's right. But it should be visible throughout all the stocks. And remember, the closing auction is likely to be a lot more activity-based than the opening auctions are. So,
yeah, absolutely.
So you have to have the indicative price, and you also have to get a sense of what the imbalance looks like. What is the nature of the bids and offers, and therefore what can tilt this equation going forward. This is complete information which does two things. One, it provides information to the derivative market on where things stand as of now, knowing full well this is not the final number, but at least as things stand, where are they, so that it becomes an anchor or at least an indicator for the derivative market. The second part is this information is extremely important to draw in people. The moment you see the prices deviating from where it ought to be or where the market thinks it ought to be, you bring in offers and bids.
Fair enough. Are you saying that's not happening, Anand?
So my understanding, and I'm sure there is information available among stakeholders, I'm given to understand that in certain broking front ends, that is still not available in full as yet. Now, the first thing I would think about if I had been in SEBI right now, and I'm sure SEBI is doing this, is correct that. Make sure that anybody who's actually interested in the markets can see where the indicative prices are during the course of the CAS and what the imbalance is like so that I can jump in whenever required. I'm told in some broker front ends, unless you do a nudge, which means I place an order, only then I can see the indicative price. That should not be the case. I should be able to see the indicative price and the imbalance at all points in time.
And with that, it is a wrap on this edition of Business Lunch. Midcap Radar will take all the market action forward. From Hormaz and me, goodbye and many thanks for watching.
Good afternoon. Welcome to Midcap Radar. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra. With me is Vivek Iyer. Vivek, good afternoon. We are below that 24,600 mark for now. We were lower, but yes, it's somewhere in the middle today for the markets. But it's a Friday, and midcaps are rejoicing that fact.
Absolutely right. Good afternoon, Sonal. And one particular sector that has taken quite a bit of a pounding today has been the entire NBFC pack. The RBI circular is something that has ensured that a lot of these names actually are under quite a bit of pressure. But remember, Lupin has reported a good set of Q1 numbers. The revenue surged more than 32% and US sales jumped 43% to $366 million. Our colleague Ekta Batra caught up with the company's top management and began by asking about the quarter gone by and the growth outlook for the US business. Let's listen in.
Yeah, so it was a very strong contribution this quarter, with both products, with, tolvaptan as well as mirabegron, but already started to see pressures on mirabegron. We had an additional launch within the quarter, Amneal with the MSN product. Launched their generic, and so that has an impact on pricing in particular, although we've been able to maintain our share with both the growing generic penetration of the product as well as incremental channels, customers that we've acquired.
Okay. Are you sticking, Vinita, to that $1 billion guidance for the US in FY27?
Well, with the upside that we've seen in Q1, we should be ahead of that, between 1.1 to 1.2 billion, hopefully.
Okay, so you are increasing your US guidance. So what would that mean on a quarterly basis? What can one assume would be a base run rate for the company going forward? You did around $366 million this quarter. You did around $370 million in the previous quarter. Tell us what we can expect.
Well, so, quarter on quarter, there might be impact of erosion on a few products as well as, addition of new products. But as we have mentioned in the past, we will hopefully be at the 250 million plus every quarter.
Okay. Price erosion, is that a concern in the US in terms of the base portfolio?
Not in the base portfolio other than mirabegron and tolvaptan. I mean, the base portfolio has been fairly stable. Both the respiratory products have been fairly stable and a strong contributor to the baseline, as well as other legacy products. But with the additional competition that we see in tolvaptan from Q2 onwards, plus the mirabegron competition that we've already seen, obviously there's an erosion from those two products.
Okay. Well, Ramesh, the margins were definitely better than the guided 25% for FY27. Are you hiking the margin guidance based on Q1?
No, whilst we have done extremely well in the first quarter, we're also conscious of the fact that there could be reduction in mirabegron on tolvaptan because of the intensity of competition being higher. And we are also conscious of the geopolitical tensions and concomitant price increases. So as you would know, freight costs have increased, both air and ocean freighting. There have been increases in terms of raw material prices and the like. So clearly, the first quarter doesn't capture it all because you're carrying some inventory from the past, but there could be some impact in the quarters to come. So we would rather be a little prudent about it and err on the side of caution. So I would stay the guidance of between 24-25%.
Okay, so you're sticking with 24-25% in terms of guidance for FY27. But just give us a sense in terms of, what exactly the street can expect on a quarterly basis when it comes to margins.
Whilst, if we talk about the medium term, I would say that there is going to be secular growth in margins and the like. There will be some volatility amongst quarters. As Vinita also pointed out, there could be volatility in terms of a turnover. A top-line variancy would be maintained in the long term, but there could be, again, some volatility amongst quarters. So that would potentially flow through to the bottom as well, and I'm conscious of that.
All right, Dinesh, the India business was strong with around a 14% growth. Your diabetes franchise led this time round. What was the contribution of GLP-1s or weight loss drugs in terms of the diabetes franchise growth? And what can we expect in terms of the India growth as a whole?
Sure. We actually grew 14.8%. Diabetes, like you said, grew stronger, 31.8%, 60% ahead of the market. Even without GLP, that growth was 27%. So there's a solid growth in the inline diabetes portfolio, also driven by the insulin portfolio. Now we're the second largest insulin company in India. Very proud of getting to that position. Obviously, we'll grow that further as well. So I think diabetes is going strong for us, for the market as well. We obviously will continue that through the year. Cardiac going pretty strong as well. Respiratory has been a little slow to start, but hopefully from Q2 it will pick up as well.
All right. And India as a whole, are we expecting this 14-15% growth to continue? And what would your exit rate be for FY27?
Yes, we would expect it to continue. I think 30% ahead of the market. The market's growing very strong as well. I think even IQVIA raised its estimate for the market to double-digit growth. We're growing 30% ahead of the market. We would intend to continue doing that.
All right. Before we wrap up this conversation, Vinita, President Trump's tweet with regards to generic drugs, how exactly are you approaching it as a company? How should the industry think about this?
Yeah, so, we've been through this path before with the 232 investigations and just methodically went through what the implications are and educating all of the stakeholders in the administration to what the implications would be on tariffs, whether it's 100%, 100% plus 200% could really lead to significant inflation on the generic front, given 70% of the drugs, on the generic side of the business are imported into the U.S., 50% out of India. We believe that no one wants to see exacerbation on the drug shortage front, and the conversations that we are having with the administration, we believe that they seem to appreciate it. And while they still have a desire to bring more onshoring of essential medicines, no one would like to see drug shortages. So as an industry, we're adopting a very similar approach as we took to 232 investigations, maybe a step ahead in terms of highlighting the implications of both inflation as well as bringing manufacturing of high volume essential medicines into the U.S., what it would mean in terms of cost of manufacturing and investment in the U.S., and what it would take in terms of incentives and offsets from the administration to get the industry to consider any incremental manufacturing in the U.S.
Well, that was the management of Lupin. Seeing a bit of profit booking, while the U.S. guidance seems quite positive, the EBITDA margin guidance has not been increased, contrary to what the market was expecting. Well, we'll now slip into a short break. Up next, we will connect with the management of Interaj Building Products to discuss their Q1 numbers and the road ahead. Stay tuned.
Welcome back. You're still tuned into Midcap Radar on CNBC TV 18. Important flashes at the bottom of your screen. There's an interim relief which is coming for Dabur, where there is a Delhi High Court issuing notice to FSSAI to seek response. The next hearing is on August 24. This is with respect to Dabur's claims, where FSSAI had barred the company to display claims that said 100% pure, 100% organic, or in that direction. So now Delhi High Court has held that prima facie this could not have been passed without an order from the High Court, and the next hearing is on August 24th. Of course, we'll get in our colleague Ashmit in just a bit. So that is the update as far as Dabur is concerned for now. Let's move on and talk about our important special segment, Midcap Movers. We have Ria to take us through the midcaps that are moving around in trade. Ria.
Well, yes, a whole host of stocks are in focus today. Let's look at the gainers first. We have Travel Food Services as well as Samvardhana Motherson, both reacting to their Q1 results and seeing good gains in today's trading session. There's also Techno Electric, Physicswala as well as Kalyan Jewelers, all seeing gains anywhere between 3.5% to 7% today. On the flip side, looking at some of the losers today, we have First Source Solutions, EIH, Sonata Software as well as eClerk Services. All of these stocks reacting to weak Q1 numbers, all down anywhere between 3.5% to 6% today. And in fact, the consumer durables pack is also in focus today, all on the back of their Q1 numbers. We have Crompton as well as Blue Star reacting to weak numbers and weak commentary in the earnings calls as well. And PG Electro, on the other hand, is reacting to its strong numbers, up nearly 2% today.
Well, thank you so much, Ria, for joining in with all the top movers and shakers as far as the broader end of the markets are concerned. Well, it's now time to bring on and invite a management on our show. Arvind Nanda, Managing Director at Interaj Building Solutions, joins us to discuss the quarter gone by as well as the outlook for FY27. Well, Mr. Nanda, thank you so much for joining us. We had you recently, and in fact, you had gone ahead and hiked your FY27 guidance on our show. What is the current guidance that you're working with, especially in terms of the top line? Give us the guidance also for EBITDA margins as well as profitability.
Thank you. Well, FY27 remains between 2150 and 2200 currently. We've got a new Gujarat plant started last month, and our heavy structure plant in Andhra will also go on stream end of this month, early next month. So I think the capacity is coming into place. The order book is good. Our order book has improved in the last 3 months. It is now over 1860 crores from 1700. So we keep increasing our order book depending on our capacity. We are hoping to do about 600 a quarter, plus minus, depending on which quarter for next 3 quarters, to achieve our aim of 2150 at least, and achieve our target that we have already given, projection we have given.
Okay, this is about FY27 guidance and the numbers therein. You have an enabling provision for QIP. Are you anticipating a bigger capex because you already had capacity expansion that came by? Are you looking at an acquisition? What is the reason for this enabling provision now?
See, we are looking at next 2 years as a very fast growth period era coming up, especially for pre-engineered buildings. Steel buildings are getting more and more used in data centers and high-rise buildings. So these require a different kind of plant. The first phase, which we are now setting up in Andhra, so we are going ahead with phase 2 and phase 3 also, and also a new plant in Gujarat. So all this is planned for next 18 to 24 months. And I think we have some land, we have some we have to buy. We have decided that the QIP should fund all these capex requirements. Last time we raised capex was in the IPO, 180 crores. Since then, we've already spent about 240 crores on just capex itself. We also have MOU signed with a Canadian company for North America to set up a 100% export unit here for an open web joist system. So that also requires 70 to 80 crores of funding. So we decided to raise the IP requirement.
Mr. Nanda, we would have liked a longer conversation, but we have to wrap it up here. State Bank of India's numbers are flashing for you at the bottom of your screen. The net profit has come in better than estimates at 21,125 crore rupees. The expectation was of around 19,000 crore rupees. The NII also is higher by 1,000 crore rupees, almost a 2,000 crore beat on the NII. The net profit, as I said, is a beat of around 2,000 crore rupees on the bottom line. Even on the NII bit, there is a beat that has come by. Gross NPA has has improved on a quarter-on-quarter basis to come at 1.47%. It's the NII beat that the street clearly likes, and the stock has spiked to the day's high. In fact, we do have Ritu who's joining us now with her analysis on these numbers. Ritu, the first tick looks good, better than what the street was working with. Take it away with your analysis.
Absolutely, Sonal. I think the numbers, prima facie, and we're just looking at the headline numbers, not internals yet, look much better than what the street was estimating. Pull up the stock as well to see if that is reacting as well. The asset quality, there was some expectation that because of the seasonal factors, primarily on account of what's happening in the agriculture book, and that's very seasonal. It's across the banks. We might see a bit of an uptick as far as asset quality is concerned, but even that has come in, flat or not, or even improved sequentially. The pre-provisioning operating profit is also higher than what our poll had indicated by more than 3,000 crores. The net profit coming in a good 2,000 odd crores better than what our poll had thrown up at more than 21,000 crores, and the core income is also growing well, 46,992. That's almost 47,000 crores of net interest income. Gross NPAs at 1.47%. Like I said, it is actually an improvement by about 2 basis points, but an improvement over the previous quarter. Margins is one thing that the street will keenly be eyeing out for. There was an expectation that there could be a 8 to 10 basis point decline in the margins, but we'll have to see if the bank has been able to protect that or even see an improvement. So the margin number is still awaited, as is the slippage number. But overall, the headline looks like it has performed much better than what the street had factored in. Look at the sharp spike in the stock as well, now up by about 2.2% as we speak, but it's going up, reacting to those numbers. The street clearly likes what it is seeing there. Let's try and see if we have some of our guests joining in as well to help us analyze these numbers. We have Gurmeet who's joining in, from Complete Circle. Gurmeet, quick thoughts on the headline numbers that have come in, both the top line and the bottom line, better than expected. Asset quality is held up. There is no sequential decline there either. Of course, we're waiting by for some of the internals, but quick reaction on these headline numbers that you're seeing.
I think numbers look very strong, and I think over 21,000 crore PAT, NII growing more than 12%, asset quality first cut looking good, sub 1.5%. I mean, these are numbers you usually associate with leading private banks. So I think first cut looks.
Gurmeet?
I think it's a scratchy line, Ritu. We'll try and connect with Gurmeet in just a bit. But as Gurmeet said, the numbers look better than what the street was working with. The asset quality has improved. And he said the numbers look like of any private bank which would have reported numbers at this level. So NII, a definite beat. And that is something that the street likes. In fact, we also have Devin Choksi, Managing Director at DR Choksi FinServ, joining us on the phone line. Devin, what did you make of the initial numbers? Of course, we are still parsing through more details and the internals as well. But on the NII number, the gross NPA and the profits, what's your take for SBI?
Yeah, sure, Sonal. Well, I think the numbers definitely look impressive. And I think good part of these numbers, I think 1, 2, 3 points. First point, definitely the NPAs, like in many other banks' cases, I think they are far under control. And as a result of which, I think they are showing up better as far as the bottom line performance is concerned. Second part, subject to details coming out, I would think that the corporate lending book for SBI would probably show relatively higher amount of performance in this quarter, because this quarter has been a typical quarter where significantly large amount of working capital related borrowings have happened by the corporates, and that has possibly given them, along with I think many other banks, a good amount of interest income from this side of the lending. The third part, of course, I think the consumption trend has remained extremely strong. So certainly the retail consumption has also given the kind of a growth, which I would like to see the number first before making any comment on it. But in our estimate, these three areas are the areas where probably I think we always thought that I think the business of the company is shaping up far better now in the current environment. Last, which is the treasury part of the area, where I think the mark-to-market gain on the bonds is something which we'll have to see the numbers. But in my viewpoint, I think these numbers are likely to be steady to little firm. And that's where probably you should be seeing the confirmation of the analysis as far as I think the numbers are concerned.
Okay, let me also point out that the provisions are actually higher year on year and sequentially as well. They've almost doubled, but still you're seeing that kind of a growth in profit, which should be taken positively. The Tier 1 capital ratio has also improved to 12.89%. That's what we're seeing. And of course, the NPAs, as we've been pointing out, have improved sequentially. Devane was talking about the corporate banking segment. We'll have to see what kind of growth is coming in there, because SBI, unlike other banks, does not disclose its advances and deposits numbers before the results. So we'll watch out for those ones. But generally, there has been this trend where corporate banking has grown very well for banks. And that is for one, primary reason. And that is the bond market is getting more expensive. And therefore, you see corporates being, lining up to go back to banks, for these kind of loans. But Devane, apart from corporate banking, that of course is a standout. We'll watch out for the margins as well. Treasury income does look like it has improved, sequentially from the numbers that I'm seeing. Anything else that stands out for you here?
Keep an eye on the retail book as well, because retail book is likely to remain firm in this particular quarter. Though I think compared to corporate book, this book might be slightly smaller comparatively. But I think retail book is definitely going to be the sure shot winner in this kind of environment where the consumption is growing and growing very well, both discretionary and non-discretionary side.
All right. We have Gurmeet Chadha also back with us. Gurmeet, you were telling us that the internals look good. Asset quality is held up. Anything else, you saw in the numbers that you would highlight for us? Of course, we're still going through some of the finer details, but despite a rise in provisions, profit looks good. The core income is strong. Pre-provisioning operating profits have grown as well, and asset quality is stable.
Oh, absolutely. I think, and I think the market is reflecting it. I think I was a little surprised that it hasn't done too well, especially after some value unlocking also with the SBI mutual fund, IPO. Also, as Devin pointed out, I think the corporate loan book growing is a very healthy sign. I've not seen 17-18% credit growth at a system level with leading bank, doing double digit. I think that's a very healthy sign for the economy as well. And I think corporate loan book is pointing to, a larger capex cycle now coming into play. Very strong set of numbers. And as I said, you don't see net NPA sub 0.4%, gross NPA lower, capital adequacy improving, NI, everything, all operating metrics. These are more like, these numbers are more associated with ICICIs and leading private banks. I think it's a great set, and I think you would see maybe a little bit more re-rating for SBI as per my view.
Okay, more re-rating for SBI. Devane, you think that's likely?
Yeah, I think there is nothing that one can not expect hereafter, because I think currently the price to book is something which is, I think, around 1. And if you minus the SOTP, I think this is certainly, it's a very, very attractive proposition. So certainly we think that it deserves to be back into the operating side of price to book of around 1.5 to 2. And that's where I see the appreciation possibility of 15 to 20% in this stock.
Okay, let me point out for our viewers the net domestic margins for State Bank of India that we can see are now 3% in the first quarter, and that's a 7 basis point improvement sequentially. And the total margins, the whole bank NIMs, that's come in at 2.86% in the first quarter, which is again an expansion over the previous quarter. So unlike what the street was expecting, which was an 8 to 10 basis point dip in margins, the bank has actually been able to improve their NIMs by 5 basis points to 2.86%, which is 5 basis points higher than what we saw in the fourth quarter as well. The overall advances growth is very strong. It is in line with what we're seeing currently for the system-wide loans as well. 18.63% year-on-year growth in the entire advances. Domestic advances growing by a good 18.15% as well. The corporate advances have registered an 18.05% year-on-year growth. And the CASA ratio, that stood at 39.24% for State Bank of India. The slippage ratio, we have those details as well. Again, this is an 18 basis point improvement over the previous year. We'll get the sequential number for you shortly, but the slippage ratio for the first quarter is at 0.57%, whereas the credit cost for the first quarter stood at 0.27%. So these numbers, as we look at the internals, are looking a whole lot better. The CASA ratio has actually declined, a little bit by a few basis points, but 39.36 versus 39.46%. But I think the positive news that the street will take note of is the margins expanding sequentially and year on year. It's a 5 basis point uptick on the margins coming in from State Bank of India. So solid set of numbers on the top line, on the bottom line, on asset quality, on margins. So there's little to complain about, as we see these numbers. Of course, we will be quizzing the management on what's happening on the FCNR front as well. And if they continue to see this, corporate loan book continue to pick up this way, remember, M&A financing also kicks in. And that's something SBI has been talking about as a big area of opportunity. So, overall, it looks like a very solid set of numbers. And that's why you have the street giving SBI a thumbs up.
Well, thank you so much, Ritu, for joining us, and thanks to our guest as well for giving us a quick take as far as what appears to be a very strong set of numbers as far as SBI is concerned. Credit costs too sequentially have stayed quite stable. But with that, it's all the time we have on this edition of Midcap Radar. More on the markets on the other side. Stay tuned.
Hello and welcome to CNBC TV 18 explains the CAS conundrum. Well, India's stock market has just undergone one of its most consequential microstructure changes in years, one that has fundamentally altered how the official closing price is discovered. Now, until last week, the closing price of a stock was based on its volume-weighted average price during the final 30 minutes of continuous trading. Now, under the new closing auction session, or CAS, that changes for stocks which are eligible for futures and options trading. Continuous cash market trading in these stocks now ends at 3:15 p.m. That's a graphic which explains the changes. 3:15 to 3:20, the market transitions into the auction. Orders can then be entered from 3:20 p.m. with the order window closing randomly between 3:28 and 3:30. Those orders are matched at a single equilibrium price and the official close is determined by 3:35 p.m. Meanwhile, the derivatives market remains open till 3:40. It trades continuously. Stocks outside the CAS framework continue to trade normally until 3:30 p.m. So a bunch of changes, and I said this is pretty consequential compared to what we've had. The objective is entirely defensible, a deeper and more transparent closing price mechanism, better execution for passive and benchmark-linked funds, and alignment with the practice followed by most major global markets. But the first few sessions have produced considerable anxiety. The Nifty and Sensex have diverged unusually at the close. Indicative auction prices and order imbalances have not been sufficiently visible on several broker platforms. And on NSE's weekly expiry on Tuesday, and of course now on the BSE weekly expiry that is on Thursday today, we've seen some moves. The Nifty moved roughly 150 odd points between 3:15 and the auction close. On the BSE, we've seen a move on Thursday, that is today, of about 170 odd points or so, causing violent repricing and expiring options. Traders who were accustomed to knowing the underlying market price until 3:30 p.m. suddenly found themselves uncertain about where the index would finally settle. So is this simply the inevitable turbulence that accompanies a major market reform? Is insufficient auction liquidity creating temporary price dislocations? Are broker systems failing to communicate the information the framework was designed to provide? And does interaction between the cash auction and derivative segment require a rethink, a recalibration? To examine all of this, I'm now joined by Anand Narayan. Anand is, of course, a former whole-time member of SEBI, who headed market regulation and was directly involved in the consultations and deliberations that led to the CAS framework being put into place. Before joining the regulator, he spent more than 2 decades in banking and global financial markets. So few people are therefore better placed to explain both the regulatory intent behind CAS and the market consequences that have followed its introduction. Anand, welcome to the program. Thank you very much for coming.
Thanks for having me, Prashant. Great to be here.
So let me start at the beginning, because we can go...
Very good place to start.
Very good place to start. Because we can go dive straight into what's happening in options, this, that, the other. But a lot of people are still asking, and the common refrain, the most I've heard is, it was a well-functioning market, well-functioning closing. What was the need for CAS? And what was the need for this disruption? It is a bit of disruption right now. Go on.
So it's a very fair question to ask. And I can tell you that when the deliberations started in SEBI about 2 years ago, this was exactly the kind of debate that happened within SEBI as well. Now, the reason for examining this in the first place, and I think the examination began about, as I mentioned, 2 years ago, yes, the starting point was we did see representations coming in from many passive funds, the global passive funds, saying that this is a ubiquitous feature in most global markets, and India is the outlier in terms of not having a CAS. And obviously, they were worried about the errors that they saw in their execution on rebalancing days, etc., so the tracking error. So that was one of the starting points to start with. There were other issues as well. By the way, just for reference, we checked the numbers. The passive players in the FPI community are quite large. In fact, if I remember the numbers, they were about 30% of overall FPI equity inflows, total assets under management as well. And of course, they tend to be very stable long-term flows because people who invest in ETFs typically are there for, as a part of their asset allocation, etc. Also, what we realized is that a lot of the active funds as well, because they are benchmarked to these indices, are also very closely tracking things like tracking error. So it was not just passives, it was also the actives who were interested from a global perspective. Related to that, what we noticed is that index providers, they tend to kind of evaluate markets on various market parameters and microstructure parameters. One of the parameters, amongst many, happens to be the presence of cash. And in that, India was not ticking the box. We were seen as a restricted country. So that was impacting, in a small way, the overall way in which index providers saw us and the weightage they gave to us. There was a third and fourth issue as well, even though they were not the primary issue. The third issue was, on regular closings in the VWAP the last 30 minutes, there were days when there were questions or murmurs which would come about in the market saying, is this really a natural kind of a movement? Or is there unnatural lack of volatility or too much volatility, especially on expiry days? And there were always these murmurs that something is going wrong, and that did lead SEBI to do a lot of investigations subsequently on various things, right? And so that was also in our back of our mind to learn from global best practice as to how do you increase the trust in the ecosystem and make it easier for exchanges and the regulators to monitor what is happening around close. So that was a secondary but nevertheless an important feature as well. And fourth feature, look, one of the things that you like in a derivative cash nexus is that there should be as little basis risk as possible for the hedgers, the arbitragers, the real participants in the market. If I'm, for instance, looking to buy a basket of Nifty stocks, and I start by buying in the futures because I know the cash flow is going to come later, and then I want to actually buy the cash and mimic the Nifty or BSE at the end of when the expiry happens, then what I do in the cash market should be as close to the setting in the derivative market as possible. Ideally, they should be equal. So it's not just the passives who are interested in this. I'm saying even those who are real participants in the derivative market, including arbitragers, including speculators, including real money people, would like as little basis between what you do in the cash versus what is the setting in the derivative. Now, with all of this, we were also conscious that if it ain't broke, don't fix it. And there were lots of smart people within SEBI and the ecosystem saying it's going on very well right now, so why on earth do you want to embark on something like this? But we said there is enough prima facie to at least do a study. So we did a study. And this was a comprehensive study done by the folks in SEBI that showed a few things. One, it reiterated that practically every major market has some form of cash or the other. Second, there was very interesting literature survey and academic papers and market participant papers which suggested that across jurisdiction, Korea, Hong Kong, a whole bunch of jurisdictions, it did appear that the volatility around the setting came down with the cash over time. Initially, there were some hiccups, but eventually they came down over time. And the trust in the setting also went up. That was also kind of a finding that we had from that study that we did. The third, on the negative side, was that, yes, we did see countries where the implementation was chaotic. Hong Kong was a prime example. It was a disaster there the first time they did it. They had to, in fact, withdraw the cash and then had to come back after a few years with a revamped kind of a cash ecosystem. So we had to be very careful about what we did. And second, it also told us that you have to be prepared for things, not going quite the way that you planned for. Based on this, in December 24, we came out with the first consultation paper. That was about a year and a half back, in fact, more than a year and a half back. Now, that consultation paper elicited very strong responses. So from a lot of domestic players, from brokers, from mutual fund, especially arbitrage mutual funds, from prop traders, a whole bunch of people said, don't do this. On the flip side, you also had the foreigners who told us you should do this, right? Especially the passives, but not just the passives, right? Now, that meant that we had to have a lot of dialogue because you could not ignore what was a significant part of the market. We can't say that these people don't matter. They are significant participants in the market. At the same time, obviously, there are some valid concerns which exist about the gas. So I personally remember at least 5 or 6 meetings that we had with all stakeholders, FPIs, brokers, custodians, arbitrage funds, and everybody you can think of, where SEBI frankly sat down and listened as much as possible and tried to learn from all the discussions. Now, a lot of good issues did come up during the course of those discussions. For instance, there was one set of issues about if you go into a cash, you actually have a break where you don't have a cash market operating, but you have a derivative market operating at the same time.
You're answering. I have all these questions, but I think you're answering them. So go on. I won't interrupt you.
But this is precisely.
But that's the point. I think let's just get to that point. Yeah.
Correct. So this is precisely the thinking that we had to go through in SEBI. I have to also caution you. I left SEBI in October last year, but we'll come to that.
Yeah.
So this was a big point, that how do I anchor what's happening in the derivative market when I don't see a cash market operating at the same time? So again, we studied what happens globally. And that's the reason I think that SEBI came out in its circular very, very clearly stating a couple of things. One, during the course of the cash, at every instant, there should be an indicative price available to all market participants to see. Which means if you're seeing a particular stock quoting at, let's say, 1% higher, given the volumes of bids and offers, the market bids and the limit offers and everything put together, if it shows 1% higher, that should be visible to people so that a normal trader or an investor can come in and say, you know what, I'm getting a significantly higher price.
Why would that be not visible? I mean...
So you have to make those system changes to make sure that first there's a calculation being done in real time of what the indicative price would be at that point of time.
So would this be similar to what we have in the morning, the pre-open?
In fact, we changed the nature of what happens in the pre-open based on what we learned for the CAS. But let's take the principles.
That simple point of the indicative price being available and being visible to everyone clearly, we have that in the morning.
That's right. But it should be visible throughout all the stocks. And remember, the closing auction is likely to be a lot more activity-based than the opening auctions are. So,
yeah, absolutely.
So you have to have the indicative price, and you also have to get a sense of what the imbalance looks like. What is the nature of the bids and offers? And therefore, what can tilt this equation going forward? This is complete information which does two things. One, it provides information to the derivative market on where things stand as of now, knowing full well this is not the final number. But at least as things stand, where are they? So that it becomes an anchor or at least an indicator for the derivative market. The second part is this information is extremely important to draw in people. The moment you see the prices deviating from where it ought to be or where the market thinks it ought to be, you bring in offers and bids.
Fair enough. Are you saying that's not happening, Anand?
So my understanding, and I'm sure there is information available among stakeholders, I'm given to understand that in certain broking front ends, that is still not available in full as yet. Now, the first thing I would think about if I had been in SEBI right now, and I'm sure SEBI is doing this, is correct that. Make sure that anybody who's actually interested in the markets can see where the indicative prices are during the course of the cash and what the imbalance is like so that I can jump in whenever required. I'm told in some broker front ends, unless you do a nudge, which means I place an order, only then I can see the indicative price. That should not be the case. I should be able to see the indicative price and the imbalance at all points in time. I suspect now, from your media reports, not you, but other media reports, I'm told that there are discussions happening between SEBI and broker community. I'm sure this could be one of the issues, which is make sure the information is available so that normal people can walk in case they see dislocations. Remember, there is a 3% plus minus, of course, a very wide one, but 3% plus minus guardrail anyway. But even within that, if it's even moving by 0.5%, you should have people coming in and doing that. So that was a valid point that you needed to have an anchor, and that was addressed by looking at what happens globally and trying to address it in that particular manner.
And this particular, the fact that you're able to see this, you think that will fix a lot of issues?
So look at it this way. This is, after all, we are trying to achieve an efficient market, and Indian markets are efficient. Where do you see situations where arbitrages exist for a decent amount of time for a decent size? For instance, what happened on Monday, which is the first day of the cash. If your Nifty is setting 200 points higher than where the market thinks it ought to be, of course you should have sellers coming in at 190, 180, 170, all the way down to whatever is the transaction cost to bring it down to...
You're saying that did not happen, the sellers did not come
to me, Prashant, look, the last three, of course, we are seeing a first few days right now, so it's very early.
And I must say, Anand, that fourth day, right? We've done 4 days, and the difference has actually come off quite a bit. So Monday we started with a 200-point difference between 330 and the 315 close. And, the next day it was 160, then it was 55, and today is about 8 points or so. That is the Nifty. And, something similar on the BSE Sensex has been, volumes, of course, the turnover traded is much smaller, but there, generally speaking, it's been pretty steady as well. So I just want to say that. Go on. Yeah.
Look, I would like to see a lot more of volumes going through cash, and I think it will happen over a period of time. I suspect what's been happening is the following, and I'm only guessing here, speculating here. Look, if you have more people putting in bids and offers on a market basis rather than on a limit basis, right? If there are people who are saying, I just want to trade at the close, and I don't really bother how much the market moves from where it was at 315, I just want to be able to trade at the close, which is what passives would typically do to ensure tracking error is zero. And if there are not enough people looking at the indicative price and therefore ensuring the price moves to the right level, that's when you will see these kind of dislocations. In an ideal market, you should have enough players, including existing mutual funds, including PMSs, including prop traders, including anybody who's trading. Moment they notice these dislocations through the indicative price, they should be walking in. So another thing I want to emphasize, you know, I know you wouldn't be saying this, but there were some stray voices in the market saying, oh my God, is there some manipulation happening if it's setting
I want to get to that. I want to get because you started by saying that studies have shown that actually it reduces the ability to manipulate. I had to take a break, Anand, so allow me to do that. Let's take a quick break and we'll come back and continue this discussion on the closing auction session and what it means and whether something needs to be done or is all going to sort of fall into place given time. Well, we are back with Anand in just a bit. Okay, welcome back. We are talking about the cash conundrum, if I can put it that way, but we're trying to explain this entire thing with someone who knows this in and out. Anand Narayan is with us. Anand, thanks for staying on. You said you began by saying that this was done, the demand came from passive funds, large segment, but one of the reasons you also said is because there was this, maybe not the primary reason, but there was a fair bit of, as you put it, I think, funny business going on. I mean, there were kind of murmurs.
Say that.
Some murmurs going on that maybe, the close on expiry days is being, for the lack of a better word, fixed or whatever. I mean, there were those chatter, and I've also heard it, we've heard it for a while, and maybe this addresses that as well. But what has happened, ironically, is that you've got people now saying that this actually is leading to manipulation, fixing, all those things. Right. Before we hit air, I gave you examples of what happened on Tuesday on weekly NSE expiries. I mean, right? Option prices went berserk. Today on the BSE, the same thing has happened. So I mean, I just wanted to address that.
Sure. So look, yes, what we found is that the trust in the setting internationally seems to increase if you have a cash-based closing, price determination as opposed to a normal trading kind of average, etc. Okay. Now, one thing I want to reiterate, I think you will agree, and I think most of your viewers will agree, that as far as making sure that the system is clean, SEBI and the exchanges have been second to none. In fact, we set the benchmark in many, many cases, including around front running, manipulation, all of that stuff. So rest assured, there are checks and balances to ensure that there is no funny business going on. Okay. Having said that, I can tell you from my own practical experience that checking for things like spoofing, manipulation of any kind, trying to mark the close, etc., is far easier in a CAS environment than it is in a VWAP environment. Because the exchange or the regulator only has to look at that particular window. We can see everything there. We can see who's placing the orders, who's modifying the orders, who's withdrawing the orders. All of that is visible at one go at one particular window, right? So rest assured that actually the CAS lays the ground for very, very solid, surveillance to be in place, which the exchanges and SEBI anyway are very, very good at. So if at all somebody plans to do funny business using the CAS, good luck to them. Okay. And for the ecosystem as a whole, this is an ecosystem which is under the spotlight and very easy to check in terms of volume. Now, the issue, therefore, is not really about manipulation. I think that can be taken care of by the exchanges and by SEBI, and they're good at that. The issue is that the volumes remain low. And the volume.
So I have the volumes, for example, for Thursday. NSE is about 1430 crores. BSE in the cash segment was about 127 crores.
Right. So again,
this is better compared to what we've seen earlier. NSE is largely the same, but BSE is picked up. Yeah.
My recollection during my SEBI days, I think the NSE volumes used to be 8,000 to 10,000 crores in the 30-minute VWAP session. I would like it to come closer to that number eventually over a period of time. Of course, it also depends upon the actual interest in the So two things matter. One is you would like to see volumes being large. That's healthy. If at all volumes are thin, you would like it to not show dramatic movements against what it was at 315, right? Idea being that maybe there's no interest in a particular day, therefore there is not much of volumes. But by that token, the price should be very similar to what it was at 315. If I see a 2% move in a price and thin volumes, I'm really worried.
Yeah.
And there my question would be, why aren't people coming in to what looks like an obvious, arbitrage situation?
What you said, yeah.
So to me, therefore, there are 2 or 3 things which need to happen and looking on a going forward basis. One, if there are issues at certain broker front ends,
that needs to be fixed.
That needs to be fixed. Yeah. Second, existing players, including active mutual funds, including PMSs who have the ability, etc., who are large, and prop traders for that matter. And we have very good prop traders who are very, very smart. They should be sitting and watching this CAS like a hawk because it provides them with trading opportunity. That's the essence of efficient markets.
To use your word, you can give a nudge, but they have to. They'll come on, and when they see the opportunity, they'll be there.
And nature abhors a vacuum. Yeah. When you see a price which is 2% off where the fair value is, you should have people rushing in and arbitraging that away, right? So that we need to see happening on an ongoing basis. The third thing which probably needs to happen is, look, there were some participants anyway whose business model was to make sure that the prices converge, including arbitrage funds, including arbitragers, your high frequency kind of traders, etc. Now, this is a slightly different model. So if arbitrage funds were used to doing simultaneous, buying and selling and therefore locking in the arbitrage, this might mean you have to watch the, CAS very closely, see see how the futures prices are doing. But something like a Monday is a great opportunity for an arbitrage fund as well. Of course, it will require a very different business dynamic than what you're used to. Maybe you have to take on a little bit more of risk. I don't know. There are plenty of experts who can work on this. But that business model has to attune itself to this new world. That arbitrage should be going away. So I think a few things have to happen, including education and making sure that everybody is aware of how the screens look like, what can you do. And finally, I think this is also a great way to give the SLBM, the stock lending and borrowing mechanism, a fillip. Because after all, if I see the prices going too high, I should be rushing in to sell.
Yeah.
And in case I don't hold the stock, I should be able to borrow that stock and do the consummate the trade.
One thing we've heard, and I've spoken this with you about this off the air, is that one demand rather is that dealing F&O, CAS is fine, I mean, it's working fine, but dealing F&O with to CAS. I mean, I just heard from someone saying that even the US quarterly sort of settlement which happens, it's not based on the closing auction price, final settled price. So there is precedent in that sense. I mean, how do you respond to that?
So the good news is, knowing SEBI and having been a part of SEBI for 3 years, I'm sure SEBI will sit down and listen to every representation. It is the most open-minded. It is not dogmatic. It is not ideologically inclined towards having one thing or the other. It tries to take as balanced a view as possible. And this is a great example. We saw a lot of deliberations happening within SEBI as well on this issue. So every view will be heard. But having said that, I will give you my personal view on the question that you asked. I don't think it makes sense for the following reasons. Remember, one of the reasons I told you is, ideally, I would like for the genuine participants, including arbitrageurs, including speculators, including people who are doing cash versus derivatives, etc., the basis between what you do in the cash market versus what the setting is in the derivative market should be as low as possible, including zero. In the old VWAP process, we did have a basis, because if you were trying to execute something in cash and against a setting in derivatives, you could run a basis risk. Here, if I'm long the futures and I want to consummate that in the cash market, I can just participate in cash, and the setting there and the setting here will exactly equalize, right? So I want that umbilical cord to remain, because that's the whole genesis of making sure that it's a liquid, vibrant market. If you break it up into pre-CAS, VWAP, and then CAS, and then derivative separate, mutual fund NAV separate, I suspect we'll be creating liquidity pools which don't talk to each other and creating more inefficiencies than less. One last point, Prashant, and I know this is a slightly longer-term view. Look, globally, and I'm not saying India should follow that, but globally, in most markets, what contracts get taken to expiry is a very small percentage compared to India.
Yeah.
In India, and we did the study for the other one, the futures and options derivatives module, we saw that till 3:15 p.m., the open interest in the ecosystem actually is going up. And it is going up all through, which means there are plenty of people waiting until the actual setting comes through, and taking a punt all the way through. Now, and on the weekly options, etc. Now, that's not very healthy, because first of all, you're leading a lot of risk as an individual based on where the setting comes. Second, at a systemic level as well, you're increasing the risk multifold. So in a sense, if one of the takeaways could be that actually, especially for those who are not punting till the last minute, roll it over, or cancel the trade, or get rid of the open interest well before the setting, is not a bad thing for the ecosystem as a whole. And it'll be more aligned to what happens globally as well.
But this was not the aim.
This is definitely not the aim. Look, it's a free country. You can do what you want. But I think one of the things which SEBI, I'm sure, will be working on is trying to see how do we make sure that everybody who needs to participate in the cash does so to ensure a good setting coming through, reliable setting coming through at all times.
Lovely and great conversation, Anand. And thank you so much for explaining all of this, I think, as only you can. And thank you for coming down. I'm sure we'll either do maybe one or two more. You said education is a big part of it, and I think you can help with that. Thank you very much.
Thank you so much, Prashant.
Well, that's it. That's the show. Thank you very much for staying with us. More coming up on the other side.
to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Asian markets are projecting a slightly negative picture. The Kospi is now down 1.5%.
I think it's going to end pretty soon. I don't think they can go much longer. I think we're doing very well.
They're 100 points lower. And you don't have to adjust too much because the 315, 330 price was only about 8 points change.
Overall revenues were slightly in line with expectations, with a big beat coming in on volumes at around 9% versus street expectations of 5 to 7%.
That's the opening bell. So 24,540. So about 1/3% down.
I'm glad to state that we reported one of the robust quarters on BLDC, grew at almost at 45%.
Definitely our margin trajectory should improve.
RBI draft guidelines on revolving credit could be an important negative for selected NBFCs.
We did see representations coming in from many passive funds, the global passive funds, saying that this is a ubiquitous feature in most global markets, and India is the outlier in terms of not having a cap.
So Hiromoto had come out with a healthy set of earnings where it had seen healthy volume growth.
We have been trying to improve the contribution from the non-par segment, and that has been the focus area for some time now.
We are below that 24,600 mark for now. We were lower, but yes, it's somewhere in the middle.
Okay, well, that is the day so far. Markets are down 100 points, 24,543. This is closing bell coming to you from the CNBC TV 18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Nigel and Reema. Guys, hi. Good afternoon. Just a quick word on the Sensex before I toss it to my colleagues. The Sensex is down a little bit more. But that is because it was up a little bit more yesterday in the last 15 minutes of trade. The Nifty is down, about 1/3%. The Sensex is down double that. And that is because you had about 150, 160 odd point move on the Sensex between 315 and 330. I think that is being corrected on the Sensex. So that's the reason why you got a bit more in terms of pressure coming through. Nifty change was only about 8 points yesterday, next to nothing. So you don't have very much to correct in that sense on the Nifty index today. Today, of course, it's like a plain vanilla day, no expiry. Expiries have happened Tuesday NSE and Thursday on BSE. Today, you will have cash, but you won't have all the options craziness, which has been usually associated, going into that cash session and out of it as well. Lots happening. SBI, of course, has been the highlight. The management, you can see Mr. Sethi addressing the media, the basic numbers, etc., coming through. But I think we can cut to it maybe for a minute. Let's just listen in.
We have extended our business rule engine, MSME Dream, to cover SME loans up to 10 crore rupees, enabling faster and more consistent credit decisions without compromising underwriting standards. In agriculture, we have expanded digital document execution across the nation for Kisan credit card and Agri Gold loans, thereby reducing turnaround time and improving customer convenience. Technology is equally transforming the way we manage risk through Project Prism, our predictive stress monitoring platform. We are leveraging internal and external sources to identify early signs of stress in borrower accounts. This strengthens our ability to take timely corrective action. Our objective is to remain proactive in preserving asset quality. Collectively, these initiatives are helping us build a future-ready institution. Coming now to our key numbers, I'm pleased to share that our net profit for the quarter stood 21,121 crore rupees, registering a year-on-year growth of 10.23%. Our operating profit increased by 9.77% to 33,529 crore rupees. Return on assets remained healthy at 1.11%, while return on equity stood at 17.87%, comfortably above our long-term guidance for the last 16 quarters. Our operating efficiency also continued to improve during this quarter. Operating expenses remained well contained, leading to further improvement in our cost-to-income ratio. Our domestic net interest margin improved sequentially, reinforcing our confidence in maintaining our guidance of 3% for the financial year. Our balance sheet continues to expand on the strength of customer confidence. During the quarter, our total business crossed 110 trillion rupees, with deposits exceeding 60 trillion rupees and advances crossing 50 trillion rupees. Our domestic business has grown by more than 11.6 trillion rupees on a year-on-year basis, while our overall balance sheet has crossed 76.6 trillion rupees. Deposit mobilization remained healthy in an intensely competitive environment. Total deposits registered strong growth of 9.73% year-on-year, supported by robust growth in retail term deposits as well as savings bank deposits. Our CASA franchise continues to remain among the strongest in the banking industry, reflecting the enduring trust that customers place in SBI.
You know, we're going to cut back to Mr. Sethi on the Q&A, but let's just wrap up the numbers in its entirety in one shot, right? Because the basic numbers, but the numbers out of the presentation, what is important to note. Ananya has got that. Ananya, take it away.
Well, yes, better than expected quarter for SBI. Now, let us look at the numbers. NII grew 15% year-on-year basis, while operating profit rose around 10% year-on-year and 21% sequentially, supported by stronger core income and a sharp normalization in overhead. Now, PAT also grew around 10% year-on-year, coming in more than 10% ahead of our estimates, so a major positive here. Now, margins were the biggest concern, but after the results, the margins were resilient, with domestic NIM improving 7 basis points quarter-on-quarter to 3%, while the cost-to-income ratio also improved sharply. If you look, now fee income was also healthy, rising 20% year-on-year. Now, one point to notice, although overall non-interest income declined due to weaker treasury and forex income. Now, on the balance sheet front, advances grew nearly 19% year-on-year, led by strong agri SME and corporate growth, while deposits grew around 10%. So, now asset quality, if you look, it remained comfortable with GNPA at 1.47% and NPA at 0.38%. Credit cost is just 0.27%, stable quarter-on-quarter. Now, major highlight, fresh slippages did rise sequentially to about 7,000 crore from 5,000 crore, but was still lower on year-on-year basis, while recoveries and upgrades remain healthy. So overall, a better than expected quarter and strong numbers coming in from SBI.
Indeed, it's a solid set of numbers. You know, as Ananya was telling us, credit growth ahead of peers, the net asset quality below 0.4%, nothing really to complain about. We'll cut back to the press conference as the Q&A begins. For now, let's get in a few trading ideas. Last star to go, Mitesh Thakkar joins in as always. Mitesh?
Yeah. Good afternoon. So I think the market, has slightly tapered off, but since we are still above 24,400, I'll side with the long side, and in case it gets closer to 24,400, even the Nifty can be bought. But for the timing, I have a buy on Aurobindo Pharma. Keep the stop of 1624, look for targets of 1705, and Canada Bank is a buy. Keep the stop below 128, look for targets of 140.
Yeah, all right. Thanks a lot for that. By the way, Hindalco's numbers are up for you in the screen. And, prima facie, I'm just looking at these numbers. There are three big numbers that you need to look at since you already have Novelis. One is the aluminium business. I'm looking at the breakup, the segmental breakup, and I'm not eliminating the, the interlinked segments. So the aluminium upstream business is around 7,390 crore rupees. And the downstream business is around 298 crore rupees. So you put that together, you're at close to around 7,700 crores of aluminium EBITDA itself. Now, our poll was at around 6,950 crores of the entire India business. So the aluminium business seems to have rocked. We'll have to wait by to see whether or not there is some inter-segment profit or loss. But otherwise, for the time being, even if you assume that, still it's looking very, very good. Aluminium business goes down as a big beat. The copper business has come in around 918 crores. Our poll threw up a number of around 800 crores. And what this means is that on a sequential basis, in fact, it's improved. Remember, the copper business will be driven by the higher sulfuric acid prices. They've also been focusing on the VBAP side. So Hindalco's India business, both on the aluminium as well as on the copper business, it's much better than the EBITDA number that most on the street were working with. And that's where the stock has seen a good recovery from the low point of the day. Now, there's just one more number you look at with regard to these numbers. That's the debt number, that should come up. But that will come, I think, in the press release, which is not yet uploaded. Operationally, these numbers are good. The worry is in terms of Novelis' debt, which has perked up 4.5 times net to EBITDA. and clarity with regard to that is awaited. Otherwise, the India business benefits from higher aluminium prices. They don't have capacity expansion that's come on stream yet, so that's not a factor with regard to the aluminium business. But the copper business, still I think around 4-5 quarters ago, it was doing a EBITDA per quarter of around 600 crores. That number has perked up to 918 crores. And if I look at my sheet, that's the highest that we've seen in many, many quarters, if not many, many years, because they're getting the benefit of the byproduct prices, which is sulfuric acid. So thumbs up going in for Hindalco, and the street is applauding that. Let's get in our guest who's joining on the show. I think Sid is joining in. Sid Bambre, Head of Institutional Research. Asif C. Mehta Investment, who joins in. Hi, Sid. Good afternoon. Good to see you in. What's your take with regard to Hindalco? The numbers just flashing for our viewers on the screen. But the stock has seen a bit of a pullback from the recent peak. Novelis's operational performance was good. The problem was on the debt. But India, no worries whatsoever.
Good afternoon, Nigel. Thanks for having me on your show. I think these numbers were anticipated by markets, and that's the reason stock is not showing much of fervor. The rise in base metal prices have ensured that most of the metal companies post decent set of numbers. We'll have to see that what is the bifurcation of value versus volume growth. But nevertheless, metal space looks interesting. We are seeing good fervor among major participants in this segment, though we are not tracking very closely. But then I think this space will keep attracting attention, and I'm not surprised that these companies are posting good set of numbers, at least in this quarter.
Siddharth, any view on Bajaj Finance, Bajaj Finserv, Shriram Finance? The entire gamut of these NBFCs are under pressure on the back of those RBI draft guidelines about stopping or banning revolving credit. Stocks have reacted adversely, 5% overdone. As of now, it's only a draft. Comments are expected by the 28th of August. But what's your analysis?
Well, these companies have seen, NBFCs have seen, phenomenal growth, and what you mentioned is, has led to has played its part in that high growth. And now what market is anticipating that if this drafts come into play, and if it comes into play in same form, then there can be some cut down on the growth. And that's the reason these names are corrected. From BFSI space, Rima, we are seeing more traction happening in mid banks. So rather than, NBFCs at this point of time, which I believe would have a bit challenging environment going ahead, one should focus on some of the mid and small banks which are doing phenomenal both in terms of loan growth as well as deposit growth. So not all, but then these are the names which we are considering and not NBFCs. Till the time this draft is not out, I think this is just a knee-jerk reaction which market is showing. I don't see till the draft comes out there would be a continuous correction. So a day or two, and maybe they'll find their feet.
No, yeah, and if it comes in this shape and form, it's going to be material. But this is draft, and we don't know if it's going to be all of it's going to come through. I mean, it's a complete halt, or they're going to prescribe some, safeguards, etc. But it's a pretty important product. The other thing, of course, is that Bajaj Finance has done quite well. The stock's done quite well going into the results, and the numbers were good, and the stock did well even after that. So I think there is that to consider when you look at this as well. SBI chairman talking about the FCNR deposits. Do we have the number for how much SBI has brought in?
Yeah,
6 billion is SBI. Wow. So that is SBI. We should be mobilizing around. I don't think that is SBI. That is a total, right? 6 billion would be what? About 55,000 crores. Nigel, right?
Yeah, but we were working with around 40 billion, right? Till now.
Sorry. 40. Yeah, that's right.
I think this gas is having an impact.
No, I got a little confused between billions and thousands of crores. But yeah, 40 billion was the number. 6 billion is SBI. And that is absolutely correct. So SBI essentially saying that they should, on their own, get in about $10 billion out of the, I mean, whatever, 40, 50, but it's going to be a meaningful number, and I think it'll be the single largest out there. I mean, as far as Indian banks are concerned, I mean, there's HSBC and others, etc., who are going to be pretty large as well. But I think as far as India is concerned, SBI, no doubt, will be the larger one. Blue Star, beg your pardon, is the next one, which is under pressure. Management commentary in focus there. And Upasana is here with the details. Upasana, take it away.
Well, certainly the company has reported a weak set of numbers, weakness seen across the board. This was mainly because of the company's UCP segment. Now, company held con call today. Now, let us see what are the key important details given by the company. Now, the company has said that it has taken a price hikes of just about 5% against a required 13% price hike due to market share loss of nearly about 30 basis points seen in the month of April. Additional 8% price hike is required to cover the cost inflationary pressures is what the company has indicated. However, the management is of the view that it is unlikely that the company will take such a high price hike as the market will not accept it. Hence, it is focusing on the cost reduction from here on in the upcoming quarters. If I talk about the Q1 market share, it is seen a downtick of nearly about 30 basis points. And with this company's RAC market share stands around 14%. Now, data centers is another important theme highlighted by the company. It is also one of the sectors that the company is eyeing on for the growth driver. Now, data center project is expected to contribute nearly 3,000 crore of order inflow and 1,400 crore in terms of revenue for FY27. Now, company has also said that for the next 9 months, it will certainly focus on the product portfolio rejig and improve its margin, especially in the RAC business. Now, talking about the guidance for the UCP margin, the company has given a guidance of nearly about 6.5% to 7% for the full year. And overall, the company says that it continues to maintain a cautious stance. So certainly, we'll look at the month-on-month trends and also the demand outlook as next month onwards, the festive season will kick in.
All right, thank you very much for that. SBI's guidance is getting flashed on the screen as was released in the press conference. Credit growth guidance for FY27 stands at 13 to 15%. I think what they've done is that they have raised the lower end. What they had shared 3 months back was 13 to 15%. Now they're saying it will be 14 to 15%. So upper end remains unchanged at 15%. More confident about at least getting to 14% for the year. NIM guidance remains unchanged at 3%. This is what they had indicated even prior. In terms of the other numbers, we've got ROA 1%, ROE in excess of 15%, and they're saying there will be an uptick in deposits in Q2 thanks to the strong deposit mobilization because of FCNRB. So that's SBI for you. The stock is coming off a tad bit. We will slip into a break on that note. We'll come back and talk more about the markets. We'll invite our Alpha Manager for the day, Anirudh Naha of PGIM India Asset Management.
Okay, welcome back. We have Anirudh Naha with us, CIO at PGIM India Asset Management, now joining in. I think we're getting more and more details. I don't know if you've addressed this. Credit growth guidance has been raised as well to 14 to 15% on SBI as compared to 13 to 15% earlier. So this is, this is positive. Stock slumped actually quite a bit, but it's done well recently over the last 2 days or so. But there's nothing to fault in the numbers except positioning, etc. around the numbers. I mean, exceedingly hard the thing to do, of course, is going to be there's so much positioning bill going into numbers and, out of numbers, sometimes that gets unwound and in a name like SBI, where pretty much, you've got institutional activity, retail, all kinds of positioning. It's very tough to say who's on which side and that's why if you're trading and trading around results, it becomes very, very tricky. I mean, if you're investing, or maybe taking a positional view, it's always better to do it post results once you've seen the numbers, once you have, the data with you, and perhaps also the management commentary, like we're starting to get now at this point in time. Anirudh, great to have you with us here. Thank you for joining us. Appreciate your time. SBI numbers, what's your sense? If you've looked at the numbers, and what does it mean, by the way, for I think this is another quarter where PSU numbers have all pretty much outpaced what private banks have done. We'll have to compile the numbers, but I mean, prima facie, that seems to be the case. Anirudh, what's your view?
I think banking generally, it has gone through its bit of time correction over a long period, especially on the private sector side. The PSUs undoubtedly, over the last the last 3 quarters, we've been noticing the PSUs have been delivering not only on their asset quality side, but also on their growth side. From a valuation perspective also, frankly, the gap between PSUs and private banks have narrowed, with the PSUs still being on the cheaper side. Our sense is it's a good trade that's continuing. Some of the banks which have delivered and the guidance that is coming through, we continue to remain positive selectively on names. But we being largely focused on the mid-small micro space, we've not built a portfolio around large caps, but we find interesting names in the lending space, in the mid and small cap space.
Anirudh, let me ask about one of your top holdings, and that's Blue Star. We were just chatting with a colleague earlier, post the numbers, and Blue Star seems to have lost some market share, and the stock has, in a way, slumped 4%. What's the thesis behind Blue Star? Are you convinced about the RAC space? What is it that you like from here on?
We, without talking on specific on a company, but the way we look at it, it is probably one of the most underpenetrated spaces in the consumer space. That is one. Secondly, at least from whatever research that is coming through on how weather patterns are moving, things will continue to remain reasonably heated up, not only in India. I think the opportunity also opens up in how weather patterns are behaving in probably in a continent like Europe also. Plus, some of these companies have the optionality which is coming through on the data center side. This was just non-existent probably even a year back. And these can actually turn out to be reasonably large, a large scope playing out there. So all put together, we wouldn't be really worried about a quarter here and there. Yes, this was a quarter where a lot of companies, and not just in the RAC space, it's also playing out in capital goods, in quite a few sectors where raw material prices, freight costs have actually gone through a very dramatic change. I think it'll take probably a quarter or so for things to subside, normalize, and profitability should start coming back for some of, not just the RAC players, but I think even cap goods. You've seen margin compressions happening. I think so that will start normalizing.
Hi, Aniruddha. This is Nigel on this side. I was looking at your holdings, and I think Universal Cables is something that's done phenomenally well. Not a very widely tracked name, but that's the one that I think you'll have an overweight stance out there. One of the largest weighted stocks in your portfolio. And that's really held you all well, because if we look at the cables ones, companies that we normally talk to on the channel, or that are widely covered as well, those stocks are up, I think, 20 to 35% at most. But this one is up close to 100%. I think there are a couple of factors that stand out, right? The high cables voltage, I'm guessing so. A couple of things. Run us through your view on this space as well as on this particular company, if possible, since we have the due disclosures already.
So Nigel, I don't want to put myself in a spot, but I can tell you this is a space which will continue to do very well. Not just from the demand that is playing out in India. I think globally there is enough demand for wires and cables across the world. Data centers, frankly speaking, or HVDC. Even if you look at HVDC or data centers, they require extra high voltage cables, EHV cables. In India, frankly, there are only a couple of guys who have the capacity or the capability. Large part of EHV cable requirement for India, even today, is imported, excepting for a couple of guys who have the capability to deliver. This is a high margin product uh, vis-a-vis the normal cable part of it. Plus, you've got the volume growth coming through, because I think the pickup in data centers in India, it's at a very, very nascent stage. Over the next 5 years, if someone takes a view, very clearly, data center and the whole ecosystem around that is going to do very well. And one play on that is how the requirement for cables. So that's how we went about identifying some of the businesses. And we believe valuations still continue to be very reasonable. And from that perspective, we take a little longer view of how the next 2 to 3 years play out. I think there is reasonable scope in the overall cable and wire space out there.
Anirudh, SBI's numbers look much better than some of their peers. So peers reported margin compression, SBI's reported margin expansion. Now they've gone ahead and raised the credit growth guidance to 14 to 15%. On SBI versus some of the larger private sector banks, how would you debate?
So we've actually been we've had a stance over the last 5-6 years where we've been reasonably underweight the large cap space on the lending side. It has stood out well because, excepting for probably the largest public sector bank that you mentioned, generally the mid and small cap space on the PSU side has done better. That is one. Secondly, I think so. It's an elephant, but when it moves, it moves. We clearly find valuations still, when I look at it vis-a-vis the PSU, the private sector space, the PSU space has a reasonable amount of scope for re-rating in terms of the numbers that they're delivering. So if I have to build a position there, we would actually, lean towards the PSU space vis-a-vis the private space.
Yeah. Got that. We'll take a quick break here. Anirudh, good speaking with you. Thank you very much for joining us. And it's a pleasure. Well, I think we'll take a break with information news that there's about 87 odd point cut on the Nifty, 24,550 is where we're at. Just one name which is spiking and numbers have come out is Electronics Mart. If you can put the stock up, EMIL, it's surging about 8%. I think numbers came through a while back. They were due today, but the move is happening at this point in time. I think EBITDA is doubled, margins have expanded, etc., etc. So 162 or so on EMIL as we speak. So
revenue,
that's the number.
Okay, so revenues for Electronics Mart have gone up 39% to 2,419 crore. EBITDA margins have expanded to 10% versus 6.3%, and net profit has gone up from 22 to 121 crore. So near 5x jump in the company's bottom line, and the stock is surging. So 39% revenue growth, margins have expanded, and profits are up nearly 4.5-5x.
Well, this EMIL number, stock's been a huge underperformer over the years. But looks like it's been a good quarter. They're a retailer, by the way, so largely focused in the Delhi NCR, Gurgaon region, and numbers are looking much better. We'll take a break. We are back with some trading calls with our experts at the other side. Stay tuned.
Welcome back. Well, Hindalco continues to move from strength to strength. Good move out there is what we're seeing on Hindalco because the India business did well. A couple of trading sessions ago, we had Novelis that came out with a set of numbers. Operational numbers look good, but debt number is up. And I think the debt number goes up a little bit in second quarter before coming down in the second half of the year because Oswego unit is up and going. For the time being, Hindalco has moved to the high point of the day. Lloyd's Engineering Works, just take a look at that stock. It's now up close to on 10%. Clearly, the street is looking ahead. They're quite impressed with regard to the numbers as well as the vision that the company has given. So Lloyd Engineering Works is holding strong as well. Let's get in Mitesh Thakkar back on the show. Mitesh, tell us, what are your fresh trades?
On the fresh trades, I have a BTS in Reliance. 1320, 1325 has been a problem area for the stock. Just trying to close about that. So Reliance is a BTS. They keep the stop at 1319, look for a target of 1345, 1350. And the other one which I like is, I've already given a buy on Canara Bank. So Indian Bank is another one from the PSU banking lot. It's come off the highs, but the pattern is quite good. It's closing at a fresh swing high. So keep a stop at 880 for targets of around 900 for tomorrow.
Got that. Thank you very much for that. Moving on now, life insurers are in focus after the July report card is out. Yash has analyzed the numbers, joins in to break down the key trends.
Well, the month of July goes to Axis Max Life Insurance or Max Financial Services. A strong growth in new business premium of 19%, APE growth of 16%, retail APE growing also at about 16%. This strong growth comes on a high base which the company had to work on in the form of July 2026, so of course that is a strong growth coming in for the company. Canara HSBC Life Insurance, it's a strong growth, but the base has been favorable for the company. New business premium growing by 24%, APE growing by 16%, retail APE growing by about 21%. Bajaj Life Insurance is a strong growth for the company coming on a favorable base. New business premium growing by 20%, APE by 15%, retail APE growing by 15%. HDFC Life Insurance, the growth has been weak for the company and that has been the case for the last few months. What is the saving factor here is that weak growth has come on a strong base. So new business premium growing at 16%, APE down 2%, retail APE down 7%. ICICI Prudential Life, weak growth. The base was though favorable for the company. New business premium growing at 21%, APE 29%, but retail APE just seeing a growth of 9%, almost half of where its peers are growing. SBI Life, strong growth on a favorable base. New business premium, that has seen a growth of 3%, APE 9%, retail APE has seen a growth of 14%. Finally, Life Insurance Corporation of India, the company also reported its quarterly results yesterday. Today, the numbers for July are out. New business premium, that has seen a growth of 24%. APE seeing a growth of 14%, retail APE seeing a growth of about 10% for the company.
Thank you very much for that. Samvardhan Motherson Sumi is doing very well today. Brokerages to upbeat post the numbers. Well, Q1 numbers are in line, but what the street is very excited about is the opportunity beyond autos, whether it's aerospace, and now even the company, looking at other emerging spaces like robotics, industrial automation. So we had a chat earlier on the growth strategy. We asked them about our European OEMs who the company caters to under pressure because Chinese companies are now gaining market share. Listen in to their comments about growth and the way forward.
A lot of our customers are also in these areas and they want us to be suppliers with them. So, but these are very new areas. We are very proud that we are associated with our customers in a very small way in these very new areas, like being a supplier to these industries, but it's very small at the moment. And as time goes, then these industries will also, possibly you will see that we will be a big supplier to the makers, or whether it's humanoids or data centers and things like that. We don't know, but we continue to strive to support our customers. So we cater to all the customers. We are in China also. We are in Europe. We cater in Europe mainly to our European customers, and also in China we support them. We are definitely supporting the Chinese OEMs as well. Because of our presence in China and our relationships, if the Chinese OEMs are setting up plants outside China, there is a big chance they would want global players to support them. And that's the play where we will come in. However, when we say that there is a pressure in Europe, there are multiple model lines, and it's a debatable question as to how the market is evolving there.
Okay, let's talk about Godrej Consumer. Came out with numbers earlier in the day. Manglam joins in with his analysis.
Well, these numbers are largely in line with street expectations. They're good numbers, actually. If you look at the overall, growth of the company, it's been 18% on the top line. We have 15% growth in the EBITDA, 11.5% growth in the bottom line as well. The company had guided for all these things: high teens revenue growth, mid-teens EBITDA growth, which is higher than what they had guided for from the start of this year. And they expect the margins to progressively increase from here as well. So that's something that the street, if you pull up both the reported numbers as well as what we were expecting, is pretty much as expected. The important part, however, the exceptional loss at 15.5 crores makes the reported net profit look a lot lower than the expected number. If you adjust for that, it is again pretty much in line. The domestic volume growth, higher end of the street's expected range at 9% versus 8 to 9%. India as well, 12% growth, led by 12% growth in both home care and 11% growth in personal care. Indonesia's pumped back to growth, so that's a positive. And we are seeing consistent performance in Africa as well as LATAM. The important part here, Godrej Consumer now has a speedboat strategy. Some of their businesses which are growing extremely fast and they are growth drivers to the company, they now account for 17% of sales versus 14% same time last year. In fact, even quarter on quarter, there's been an improvement. They've seen strong recovery in soaps business, where they say that they've seen market share improve. And Synthol body wash witnessed their highest ever offtake in the first quarter as well. The stock is selling off a little bit because after the first quarter update, we saw a couple of days of an up move on the counter. But these numbers aren't particularly bad. In fact, they're good, in line with how the street was positioned.
Thank you very much for that. Anand Tandon, market expert, is now joining in. Anand, hi. Afternoon. You want to share your thoughts on what's been happening in the markets and the way the earnings season has panned out?
Well, the earnings have been actually surprisingly good, especially on the consumer side. The expectation that you would get good, strong numbers from the engineering, the manufacturing, etc., has actually come through. But as I said, the consumer side has been a lot more stable, and that is somewhat positive because you had expected this quarter to slightly underperform from expectations. Which would mean that perhaps the expectations for the rest of the year may actually be met rather than have to be toned down, has usually been the case in the past.
Got that. By the way, the cash session has begun, and as we always do, just at least over the last 4 days, this is the 5th day of cash. We just take a quick look at the price at that is 24,557, where the cash market is closed. I mean, for now, 320 is when the cash session will become. So 24,557, and just look at the sort of spot price on the Sensex as well, and then we'll move forward it'll basically give you a sense of where we settle at 330 on both the indices. That's the Sensex, 78,491. It's getting better. I mean, for the last every day, we started on the Nifty with 200-point gap, and yesterday was 8 points. So hopefully, we continue with a good run in that sense. I mean, at least relatively speaking, the change is not that large. It should not be large if there's enough volume. And that's the whole point of it. Anand, good to have you with us here. That's the change. So August 7th, 315, and the Sensex will come up. That same plate will come up today as well. No options expiry or anything, so no craziness of that sort. So it should be a normal cash kind of a day. Futures trading will go on till 340, just to reiterate once again. So it's just that there's no expiry. So the F&O market is not going to be too bothered with what is happening as far as the cash segment is concerned. Actually, not bothered at all. It's only the expiry contracts which change, and that happened on Tuesday and Thursday. But I mean, next weekly contracts expiring next week or the monthly contracts. I mean, there's no change at all in that sense. Anand, what else is top of mind? I mean, we I think crossed the halfway mark with regards to earnings, more than halfway. Should be 60-65% done. Thoughts so far, Anand?
Well, as I said, the surprise was the consumer. But other than that, autos, of course, have been tremendously stable and growing very fast, which is something, again, which is a bit surprising. Maybe it is the fact that new models are getting introduced and therefore, that is spiking the consumer interest. Oil, to my mind, is the real danger because, if you've seen the latest transcript of Saudi Aramco's readout, what they have suggested is that it may take 18 months, assuming the end of the war, for inventory levels globally to come back to what they were pre-inventory, and that the current inventories across the globe are rather low. So you should be bracing yourself for sustained prices at this level, unless something really bad happens, in which case can go further. But basically, you're not likely to see a drop in crude prices anytime soon because of the fact that the inventories need to be built up, and there seems to be a major dislocation in capacity around the world. So that will be the thing to watch out for, besides the weather. Other than that, I think we seem to be doing better than expected. And of course, RBI is helping by making sure that you are not incentivized to put your money safely.
Got that. We have to take a quick break there, Anand. So we'll continue maybe a question or two on that theme that you said. And we'll continue the coverage on markets as well. Last 11 minutes coming up. So it's 3:19, 3:20 is when the cash session kicks off. So take that break. We're right back.
Welcome back. Well, plenty of stocks in the broader markets actually are doing a thing of their own. Just take a look at Varroc Engineering. I recall visiting the management in Pune when the stock, I think around 3 years ago, stock was on 300, 350 rupees or thereabouts. And there was a lot of rough edges out there. Management sounded very optimistic, Mr. Tarang Jain, I recall, saying that things were on the verge of turning around. It seems they put the pieces together because the numbers came. And I think probably the street has read these numbers well because the stock is up close to 9.5% or thereabouts. We'll try to get the management on the show. Also, Sapphire and Devyani. Just take a look at both those two names. They have spiked up and both of them are at the high point of the day. So big move is what you're seeing on these names. Anand, let me get your view on these names. Either Sapphire, Devyani, Restaurant brand Asia for this week. For the week, it's up close to around 40%. Do you like any of these names?
Well, they haven't yet, except for this quarter, perhaps they've been kind of struggling to show same-store sales growth for many of these companies. And that is the key parameter to watch for. So if that were to come back in a sustained way, clearly that would be a business that you are looking at. Also, some restructuring has happened, which kind of helps to bring more clarity in terms of which company owns what brand. Net, the sector has always been interesting, but somehow the valuations were somewhat stretched. Now that the growth has slowed down, the valuations have become a little more meaningful, but then they are still not reflecting the fact that the growth is really low at this stage. So, if you assume that the growth picks up from here, which potentially can, especially if the consumer growth that we are seeing sustains for a while, then I think it could be somewhat interesting to look at.
What's worked actually for both these two names? Because suddenly they're perked up. I'm not sure whether the merger approvals or something have come through. But both these two names suddenly saw a big volume spurt is what we saw. Let's talk about a couple of other names then. Anand, actually, I think we have some news that's coming in. The government may not be in a hurry to sell more stake of its LIC stake. That's the word that's coming in from LIC. They've told CNBC TV18 that another OFS may not come for the next 2 years. Let's listen in to what the insurer told us.
Once the government was convinced, perhaps, on the possibility of a big issue going up, they decided to go with the green shoe. Originally, the issue was only 2.5% base with a 4% green shoe option. But the first day response itself was such that the government had the conviction that it should have the 4% green shoe also exercised. Now this gives enough time for the government for further dilution to 25%. We have now 5+ years available. So that advantage is there. So in my opinion, there need not be an immediate offer coming from the government.
And immediate is not for the next 2 to 3 years?
It may not be 2 to 3 years. It can be maybe 18 to 24 months. There need not be, because now that we have a success of 6.5% going in one shot.
Correct.
Remaining 15 can go in two shots also is possible. So it can take a bit of time for them to come up with the next offer.
Anand, I know you, insurance is a space you like, or should say not dislike. What's the view?
Well, absolutely. As I've said many times in the past, it's a very attractive space. LIC, of course, suffers one problem that, it is such a big giant that that the incremental growth that they are witnessing, even if it is good, will hardly move the needle on their overall book. And that is the reason why, despite the fact that the liquidity wasn't much, or the fact that the government has had to dilute at a lower price than they did earlier, brings out the reality of where the market is. That said, it is trading now, I think, at embedded value of less than of about half of its embedded value, or approximately there 1 year forward, which means that, if you are owning it, it makes no sense to sell it. You should be at least holding on to it. If the government were to do a drip sale in another 24 months, I'm afraid that will put some cap on where the prices can go to structurally.
Yeah, no, you're absolutely right. By the way, just this, you did speak about the oil and gas. You started by talking about that. Did you see this new exploration policy? The incentives the government is providing. Any thoughts on that, if you've looked at it?
Well, I haven't actually, so I can't comment on that. But, you find it is a space that one should be looking at this stage. Serious shortage there.
Yeah. No, actually, with regards to energy security, one was that there was some it's a large program, 84,000 crores. Government is actually putting in money for offshore exploration. And yesterday, I think there was this policy with regards to biogas as a fuel, which has been put together. And there also, you've got a bunch of companies which play in. So far, I don't think it's gotten too much attention at all. Those, of course, are tracking. But otherwise, I don't think this got too much coverage. We'll try and do something around it in the coming early next week with regards to what was done, what was announced yesterday in that sense. Bajaj Finance is still down about 5%. It's a combination of the run-up that it's seen recently and, of course, the news, which is not all that great. But by the way, Anand, any thoughts on the Bajaj Finance story? Basically, the RBI is saying that this revolving credit business, flexi loans, are not a great idea. They've issued draft regulations which need to be finalized, but it's a very large chunk of Bajaj Finance's business, overall business.
Well, yeah, I mean, I think that what RBI is saying kind of makes sense and it will affect the company. But I think the company makes money from a whole different set. I mean, it is not a pure lender in the sense that it also buys out inventory and places them out at a discount from having bought it out from the manufacturer at a discount, it then sells it. So to some extent, part of the margin comes not just from the financing, but the fact that they are actually taking product risk in some of the product lines that they are financing, and therefore, the margins are likely to not be that badly impacted. Size has become very large, of course, for the company. I think the question would be at what stage does it morph into something else in terms of its structure.
Quick word on Hindalco. Numbers look quite good. Stock spiked up. Any view on the metal space?
Well, I think all commodities will continue to be on a roll. I don't see any reason for expecting that the domestic market will, which is already protected, will see any major downside. The only question is that in less protected markets globally, you may see a little more volatility, but even then, by and large, the commodity cycle is still on the upswing.
Got it. Okay, all right. Thanks a lot, Anand, for joining in and giving us all of those details. Well, I think we are about to get, have we got the final rate? Is that the final rate, Prashant?
Yeah, I think we have the final rate, 24,570. So it's a small change. It's a very small change. So we closed, 315 close was 24,557. So which basically means that 13 points, 13-point change on the Nifty, 315 to 330 on your screen. And then the Sensex also we should just quickly put up, 78,499, 78,499. Yeah, so it's basically nothing. I mean, 8-point change on a 78,000 index, right? So nothing at all. So 13 points on the Nifty, 8 points on the Sensex. This is pretty, is settling down. And I think that is the basic point, which I think we need to sort of, take away from over the last 5 days or so. The gaps are reducing as it should, as volumes and participation, etc. pick up. We should be able to put up the volume traded, turnover traded in the cash session on the BSE, on the Sensex yesterday, for example, it was about 129 crores in that window. And on the NSE, it was about 1,400 something crores. So we should be able to get the data for today as well in short order, as we always put out. So those are the last 5 days, the first week as far as this new closing system is concerned for both the Nifty and the Sensex as well, the NSE and the BSE as well. So very much more orderly as compared to what it was when we started this Monday, earlier this week. It's a wrap on this edition of Closing Bell. Thank you very much for staying with us. But Editors Roundtable will pick up on the action on the other side. So stay with us.
The Wall Street ended the week on a strong note, extended the winning streak to its second consecutive week. Both the Nifty and the Sensex gained over 1 percentage point each, while the broader markets kept pace with the benchmark indices. PSU banks, defense, metal stocks led the rally. On this week's edition of Editors Roundtable, we'll break down the new closing auction framework, the CAS framework. We'll track the recovery seen in IT stocks in the past 1 month. We'll analyze the government's latest divestment plans. So hello and welcome to Editors Roundtable. I am Prima Tendulkar. With me are my colleagues Prashant, Nigel and Nimesh. And joining us on the show today is Sandeep Tandon, founder and CIO at Quant Mutual Fund. Guys, this is the week we will remember when CAS was implemented. It created a lot of confusion, chaos. We had to deal with 2 expiry sessions, Nifty and Sensex. But by the end of it, you did get this feeling that things are getting ironed out.
You have to mention that even Prashant is in the show, so it's like a special guest.
Nobody noticed, right? Or actually on the long shot,
No, we're talking about CAS, and then that's why, Prashant was on top of it all through the week.
Yeah.
We're talking about the special auctions.
It's been a full-on CAS week, right?
It's been a full CAS week.
It's something completely new, and it kept us busy and kept us in office longer. The closing bell shows, so lots of new things happened this week. But
let's...
Yeah. I think Sandeep is with us.
Yeah, let's get Sandeep. Sandeep's view of us. Hi, Sandeep. Good to have you on the show, and thanks a lot for joining in. How are you feeling about the markets, Sandeep? There was that feel-good feeling that was actually coming in there. Suddenly, this cash towards the the final 15 minutes of trade became very exciting. Kept us very busy as well. But that aside, trend of the market you believe is up? Are the pieces coming together in terms of the macros, in terms of earnings as well?
Yeah, Nigel. In fact, we have been advocating for last few months now that we are more constructive on India. I think the bearishness which was there in our deep subconscious mind has started subsiding. And what is very important to see now, actually India is the biggest beneficiary of anti-AI theme which is getting built. Okay. And frankly speaking, 2020, if you recollect, that ESG noise was very high, and how European companies or country has suffered, and we play anti-ESG theme. Today, I think we as a house is also playing anti-AI theme, and that is working well. And it will attract a lot of money for India, because ultimately from FI perspective, it's not about absolute return. It's a relative return. If the relative returns are going to decline in some of these high profile market in last few quarters, then I think money will come to India, and that trend has already begun. So I think it's a good time for India, irrespective of global market. My personal assessment is that global markets are still going to be very turmoil. Okay, and I still believe though US is a lifetime high, but if I have to look at purely from a vulnerability perspective, it's very, very vulnerable right now. We have seen a move in USD JPY, a sign towards appreciation, and that may not be a good news for the global equities. Having said that, concern on global market, but still we remain constructive, because if global market corrects a lot, money will shift to India. So we will look for a scenario where these market correct sharply, and we should be beneficiary of that.
Hi, Sandeep. Okay. Hi, Sandeep. You spoke about US markets, but what about the dollar? What's your view there? And in that context, what's your view on commodities now? The metals, so to speak, the metal stocks.
If you really look at purely from a dollar perspective, I have to talk about DXY. Beginning in January, we talked about the biggest risk this year will be on DXY, where the whole world was looking for a depreciation. We expect DXY has more potential to move up. So I think it has not spiked up to that extent what we were initially visualized, but still it is more biased towards on the long side of the trade. That does not give a great comfort. The only comfort is that it has not rallied at all as compared to what was the expectation. So I think the way I have to look at is more from an opportunity perspective. Metal has been a biggest outlier out here also. I think we are looking for a scenario where even metal stock will sort of pause sort of thing. I'm not saying they will collapse from here, but some sort of time consolidation is there, some sort of pause I expect. So I'm not I don't want to own any of these metals name at this point of my portfolio.
Sure.
Sandeep, good afternoon. We're going to talk more markets, but let's talk market microstructure for a minute and a half or so, just to kind of sort of wrap up what happened with this entire CAS business. So let me go across to the wall and explain exactly the last 5 days, because this is week 1. And in just 2 or 3 graphic places, you'll just see what I'm talking about. So this is the Nifty 50, and this is 1 week of CAS. There are 5 days there. we started with a 200-point gap in the first day, that is Monday, 184 to be precise, and we ended with a 13-point gap. So you can see that it has become better. Have volumes picked up in a huge way? Probably not, but the gap, I mean, I think as people get a hang of it and see, I think all of us basically are learning together, and as more and more people understand what's going on, what are the windows, the changing timing, the change in timings, and all of that stuff. I mean, I think it's going to get better. The same thing with the Sensex as well, quickly. And I think we ended with an 8-point change on the Sensex by the end of it, right? So look at the look at the Sensex between 315 and the closing auction discovered price in that sense. So just, I mean, if you look ahead in the sense of, okay, why don't we tackle this, right? So that is cash. And I think from Monday itself, on the first day, the opinion has been that cash is fine. This is global best practice, allows better price discovery, et cetera, for passive funds. And there are a couple of other reasons as well. But the problem has been options and what happens to, and you know, I posted on social media on Monday saying that, well, you know, what happened on Monday, and remember that 200-point gap on the Nifty, what if that had happened on an expiry day, it perhaps would have been a disaster. Monday options prices on the NSE did go a little berserk, and on Thursday on the BSE expiry day, option prices also did go a little berserk. So I mean, just to get this actually happened. This is a real example. This is the 79,300 call option yesterday at 255 was trading at 60 rupees. I mean, going into expiry, I mean, the option basically expired worthless, obviously, but it still there was a buyer for that call at 120 rupees. So, and the only reason, of course, is I mean, you know, some sort of fear psychosis, or I mean, what you want to call it, anticipation that perhaps prices are going to settle higher. The close, by the way, was below the 70. So, you know, this call, by the end of it, this was what, almost 400 points out of the money. So, you know, these kind of things have happened on, and I highlighted with an example on Tuesday as well. And this is I think, this is the basic worry. You know, volumes will pick up on the cash session and there won't be that much of a difference. So this also perhaps will settle down. But this is what we saw on Tuesday and Thursday as well. If you can quickly move forward and just to sort of, you know, look ahead a bunch of things. This is, we had Anand Narayan. So he was, of course, with SEBI in the financial markets for a long time. And these are a few things that he said, basically, that we should watch out for going forward. Brokers should display indicative cash price and buy and sell imbalance continuously. He said that his feedback was that a lot of broker terminals were not showing it, that limited participation. He said get much more liquidity in. You know, why should there be so much arbitrage, you know, so much difference between the final price at 330 and the 315 price? Arbitrages should come in and trade the discrepancy away. And that's a natural, it'll take time, but it should happen. And of course, I mean, this is a more philosophical way to look at things. But Anand's point essentially is that we are one of the few markets where on an expiry day with 15 minutes to close, open interest is still rising, which is not exactly a great thing according to him. But as I said, that it's a free country, and you know, each one to his own. But just I wanted to put this up in terms of, you know, the first week of experience as far as this new closing auction mechanism is concerned. Guys, back to you.
Sandeep, what was your overall read of CAS? Did it cause a lot of disruptions? Were you all looking to square off positions before 315 just to avoid this unnecessary volatility that we've seen? How did you all approach it? And what are your takeaways after 1 week is done?
Frankly speaking, anything new gets implemented, it takes time for market to accept. Okay. And we have seen in the past, we have seen how Badlava, this Pandil came into picture, or demat things happen, you know, or demutualization thing of shares happen. So we have all seen these changes, really taking time. The only thing was that it was a very different, it has its own impact on the liquidity point of view. Ideal situation would have been you could have allowed 7 to 10 days of mock trading so that people could have experimented it, and then it could have went live. Okay, so right now, I think we are also watching very closely. It's a new movement. We don't want to criticize the system. We want to see how the stability will emerge. But right now, there are many challenges. Even as a mutual fund, we think if the gap differential between the 315 and 330 is very large, then it affects the investor also. Somebody, let's say, example, that day on Monday, Nifty was 200 points higher, and somebody has given a redemption at that day. obviously he is going to get redemption at higher price, where in actual manner we are able to sell next day only at significantly lower price. So there are some challenges, and it's also about whether you are what the size you're putting, whether you will get fulfilled or not. So there are some challenges. I think I would like to wait and watch, see how in next 2-3 weeks it evolved, and then it should stabilize. Right now, as an institution, we are not doing much in that, but from a HNI perspective and the hedge fund side, we have seen lot many people are trying to take advantage of this window and try to put selling orders at 1.5%. Some sort of arbitrage opportunity could be there. Let's see how it evolves. The only good part is that the volumes are significantly low, so this sort of activities is also not very encouraged. But it will take some time before it stabilizes.
And of course, I mean, Sandeep was in the earlier avatar. He would have been out there, right? Ran a large sort of prop desk and has done, futures, option, everything. Sandeep, but now on just to come back to what you like, and LIC, right? That large 30,000 crore rupee OFS. I don't know if this is still true, but I think it is true. You are the Quant is the second largest shareholder in LIC post the Government of India. What is your view? Numbers also came through. Numbers look pretty good. I think the chairman gave an assurance that, I mean, of course, assurance from the government itself, which they passed on to the investors, that maybe for the next 2 to 3 years, I mean, this drip OFS is not going to happen. That's why they collected this large sum in one shot. Go on.
So frankly, Prashant, is a good development, because doing one shot 6.5% now, at least from the liquidity point of view, LIC will be now part of the MSCI rebalancing whenever it happens next, maybe in the month of October or November. This should be part of it, because we require the 10% free float sort of thing, which is already there. In terms of free float market cap, it was anyway qualified. So I think the way I am looking at it, any stock become part of MSCI basket, liquidity automatically increases, the institutional participation becomes meaningful, and it become part of Nifty 100 stock gradually, and then maybe coming to Nifty 50 itself, because it qualifies from the market cap perspective. So I think from a LIC shareholder perspective, and even from the market perspective, it's a good news. Very large market cap company, which was slightly illiquid in nature, and a lot of people were very hesitant to participate. I think that stigma has gone. So it's a liquid name, people can participate, and obviously from a valuation perspective, it's very attractively priced from the current level. So I think it's a good development from a LIC shareholder and the market perspective both.
Sure. But Sandeep, what's your broad view on the OFS that the government is doing? Is it going to cap the upside for the PSU stocks in the very near term? Or you look at the other way around, that this is an opportunity to add into some of the good names at lower price?
So I think it depending on the environment condition. If environment is pretty gung-ho, then everybody is saying, yeah, good time to accumulate because I'm getting at low impact cost. And it works other way. Market is slightly weak, and then say, supply is coming. So depending on the how you perceive, and depending also on the relative condition of the market, the way I look at it is that all these things are good development, because it increases the breadth and the depth of the capital market, which is very much required. I don't think government bothered too much about few percentages here and there. So I think it's in a larger interest, it's a good development. And frankly speaking, I said in the beginning for last few years that this decade belongs to value as a thesis, and all PSU are qualified for that. So it all depends how you look at like a defense sector, which used to be ignorant sort of thing. Now suddenly it commands a very large premium, and as compared to previous OMC, which used to be darling of the market, are at the neglected valuation. So I think the way I look at the market is an opportunity at every level, but you have to trade in this market because it's a very, very challenging market. It's not easy to make money in this scenario. So I think PSU, why we like PSU, very, very liquid name. So it's not a challenge on the liquidity perspective. Valuations are very attractive, and we don't have too many challenges on the governance perspective, which you see some of the private companies. So all data points are constructive and good news for the market.
Right. The other highlight this week, Sandeep, was this entire MDR issue, and looks like MDR perhaps is now going to become a reality. Do you own, this Paytm, this Pine Labs?
MobiKwik.
MobiKwik is there. Any thoughts at all?
So frankly speaking, we don't own any of these names, okay? And maybe you can call it a miss also from our perspective, because we never felt comfortable in terms of valuation they came from. So we have actually not participated in any of these companies. So I will not have much
Any
to say.
thoughts on Bajaj Finance, just to stick with the financial space for a bit more? I mean, I think that RBI circular, draft regulation though at this point, flexi loans in sharp scrutiny. I mean, a very profitable product across. It's just that it's very large for Bajaj Finance. Any thoughts, Sandeep?
Frankly speaking, it's a draft regulation. And obviously in India, people tend to overreact without understanding the repercussions. And in last few days, Bajaj Finance has rallied a lot. So it's a natural correction when you see perceived negative news of the market. But Prashant, frankly speaking, we as a house believe NBFC as an index will continues to outperform banking sector, both private as well as PSU. So I think from a longer term perspective and even medium term perspective, we remain very constructive on the NBFC as a space, and it has done very well. So if you even you look at strip the BFSI into from the insurance as well as bank and the NBFC, then NBFC is a clear leader. So I don't think one should be too much worried about it. Maybe another few point correction, it should be again attractive to rebuild your exposure.
Sandeep, you've been known to make these high conviction macro calls very often before it even plays out. The market catches on to it. So I remember from the start of the year, you've been calling out for a top on the US markets, these big tech companies, Kospi. Now looking ahead, what would be your top 3 high conviction investment ideas or themes or trends?
From a macro perspective, I think if I have to look at, let's talk about for next 1 quarter. Okay, macro perspective, 1 quarter is a good timeline to talk about. My biggest worry is that we expect a lot of volatility coming in the currency market, which is not the case. We just saw a trailer last week when US JPY appreciated in a 1 minute's time from 163.80 to 157.80 or so, something like that, which was a very sharp move. And we are forecasting that USD JPY has potential to appreciate further. And that will create some amount of turmoil in the global equities, particularly in the developed market. So you have to watch currencies volatility very closely. I think commodities piece, particularly on the crude front, we were very early to talk about at 120 is that long-term top, sort of medium-term top is in place, and we talked about 70 levels. We have recently touched. I don't think any meaningful trade is now left in the crude from the current year perspective. It will marginally move over, marginally correct down. And if you recollect the beginning, January 2026, I talked about that you will see a precious metal behave like a cryptocurrency, and we have talked about a vertical fall, which played out well. The way I am looking at is that both gold and silver, maybe price-wise damage is largely done. Okay, that does not mean we are calling a bottom, but we are closer to the neglected zone. But time-wise correction is still pending. So that's the one area which I will look at some of the lower levels. When it corrects sharply, any other days should be an opportunity to rebuild your exposure from a longer-term perspective. But within, let's say, short-term or medium-term also, you are not going to make big money. But from an institution point of view, if you get opportunity, you may accumulate at lower levels. So these are a couple of big call, and obviously purely from India perspective, I think India in next 1 quarter on a relative basis will do very well. Okay, and the way I'm looking at data, particularly last few months, we have talked about small cap outperforming mid and mid outperforming large. I'm seeing some signs of reversal where for a short period of time, maybe a month or two, you will see good amount of money will getting again shifted back to the large cap because they are very attractively priced and volumes are pretty large. And if any sort of uncertainty emerges globally and FIs comes back, I think their predominantly focus will be on the large cap area, not necessarily banks, which they have selling for last many quarters.
All right. Sandeep, I want to ask you about precious metals as well as on tech. On precious metals, you've already given us your view. Tell us on tech, the street is still divided. Some believe the worst is in the price, while others believe this is just a temporary bounce and it will return back to the lows that we recently saw. I think you were a little bit selective the last time we spoke, and some of those tech stocks actually have bounced back. How are you all placed right now?
So, frankly speaking, Nigel, we have been very bearish for a long period of time, but in the last 2 months, on multiple forums, we talked about that we are building our IT exposure after many quarters. Okay. So we have been closer to 26,000 mark on the Nifty IT index. We have nibbling around and we have a reasonably good exposure. Some of the funds even has 12 to 18% exposure, and many of the large cap funds we have built very large exposure there. Since we are largely as opportunists, I'm not that bearish from the current level. The way I'm looking at, yes, best of the analysts have given up, best of the strategists has given up, they don't see. But ultimately, we have to understand from an AI perspective, because we ourselves has been a big time a user of technology, and we were very early to talk about predictive analytics, which is like quasi AI using. But somebody has to implement your AI, even these tools. Somebody has to adapt these things for even for large enterprise. So we need to see how some of these tech companies become a AI enabler or they become adopter. So we have to see how well they can implement. So from the current level, I don't think their direction can change. One thing good about India and Indians is all that we are able to adapt a lot of things very quickly. We may miss out the AI in terms of transition point of view. We have missed that opportunity from the product perspective, but we are one of the largest user of AI tools globally today. So I think I am not going to be negative from here. I will look for opportunity to participate rather than, and obviously you understand as a house, we have a philosophy of dynamic side of money management. So we are very agile in booking profits also and looking for a better opportunity sometime.
Sandeep, great conversation, but wish you were here with us in the studio next time then. Thank you very much for joining in. Enjoy your weekend.
Thank you for calling us.
Well, with that, it's curtains down in this edition of Editors Roundtable. Hope you enjoyed. Don't go anywhere. More news and updates will follow.
Good evening. Thanks for joining us on Business 360. I'm Shireen Bhan. The top stories that we're tracking for you this evening. Oil prices near the $85 mark after Iran reviews a draft plan that proposes permanent transit bans for the U.S. and Israeli vessels in the Hormuz Strait. President Trump claims the U.S. has unlimited supply of munitions, slams reports suggesting that he pulled up War Secretary Pete Hegseth over the depletion of missile stockpiles. Iran's chief negotiator accuses Trump of theater diplomacy. The Sensex and Nifty gained 1% in the first week of closing auction. The adjustments on Friday after the closing auction was the lowest this week. India's largest bank, SBI, beats estimates in Q1. Loan growth hits the highest level in nearly 4 years. Asset quality remains stable, even as provisions jump 75% sequentially and slippages rise 33%. Shares of NBFCs decline after the RBI releases draft rules imposing a ban on revolving credit. NBFCs can only offer term loan products under the proposed rules. Merchant discount rate on UPI transactions, if introduced in the future, applies only to merchants and not customers, says the finance minister. Adds a committee headed by the NPCI is yet to decide on imposing the MDR. Interim relief for Dabur. The Delhi High Court stays the food safety regulator's order imposing a ban on products with 100% pure claims on the label. Court says the FSSAI should have given Dabur a hearing before passing the order. Ransom-seeking hackers target dozens of U.S. private equity firms, including Blackstone, Bridgewater, Apollo, KKR, Bain Capital. Google reveals hackers designed at least 72 websites aimed at stealing passwords from employees of private equity firms. A U.S. judge orders Facebook parent Meta to pay $940 million for its failure to warn the public about the dangers posed by its platforms to children. This is the largest penalty on a social media company over child safety yet. Also on the show, CNBC TV 18 decodes the new bill that replaces 135-year-old legislation. As per the new bill, digital bank records can be admissible as evidence subject to conditions. Also, a bank official cannot be compelled to produce records in legal proceedings if the bank is not a party. Well, the top story this evening, there is no fresh breakthrough in the Iran-US talks yet, as Tehran accuses Trump of quote-unquote theater diplomacy. Here are the latest developments. Oil prices near the $85 mark after Iran reviews a draft plan that proposes permanent transit bans for U.S. and Israeli vessels in the Hormuz Strait. Bloomberg reports that the deal includes a proposal on a transit fee structure as well. Now, according to ship tracker Kepler, 33 vessels transited this week compared to 50 a week ago. President Trump says he believes the war with Iran will soon be over, maintaining that Washington still has an unlimited supply of certain munitions. However, he admitted that inventories of others were limited without specifying the weapon category. Iran's top negotiator Ghalibaf hit out at President Trump, accusing the U.S. president of, and I quote, theater diplomacy on loop. Ghalibaf also alleged that Washington keeps switching from military threats to offers of negotiation and has termed it as a failed strategy. Meanwhile, militant group of Houthis claimed responsibility for a missile and drone attack against alleged Saudi-backed military mobilization in Yemen. 18 soldiers were killed. Saudi Arabia also alleged that the Houthis were behind an attack that left 11 civilians injured in the southern region. Here's President Trump on the status of negotiations with Iran.
We had oil down to less than $2 in many places like Iowa. Oil was down to, gasoline was down at numbers that people hadn't seen in years. $1.85, $1.95. So it passed Tuesday. I was in Iowa at a stop, and we had $1.95, another one, $1.85 a gallon. And we'll see those days pretty soon again, based on everything I see, as soon as the war ends. And I think it's going to end pretty soon. I don't think they can go much longer. I think we're doing very well. I just, I'm involved in the negotiation. I think we're doing fine.
Well, that's President Trump. Now, Saudi Arabia, Turkey and Pakistan will reportedly sign a joint defense agreement in Jeddah. The scope of each country's commitment remains unclear. Turkish President Erdogan and Pakistan's Prime Minister Shehbaz Sharif will meet with Saudi Crown Prince Mohammed bin Salman to sign the deal. The deal comes after nearly a year of negotiations. We will get you more details on that. President Zelensky has said that Ukraine has hit more oil facilities deep inside Russia in overnight attacks. The repeated strikes have reportedly caused fuel shortages in Russia. Kyiv has also targeted Russian online retailer Wildberries for the third straight week. This as Moscow continues a barrage of attacks that Ukraine's depleted air defenses are struggling to counter. Let's talk about the day's market action. Now, the Sensex and the Nifty gained 1% each in the first week of the closing auction session. The adjustments on Friday after the closing auction was the lowest this week. Prashant joins us now to explain to us what transpired in the market and what the implications of these new rules will be. End of week one for CAS, Prashant.
So this is the Nifty 50, and this is 1 week of CAS. There are 5 days there. We started with a 200-point gap in the first day, that is Monday, 184 to be precise, and we ended with a 13-point gap. So you can see that it has become better. Have volumes picked up in a huge way? Probably not, but the gap, I mean, I think as people get a hang of it and see, I think all of us basically are learning together, and as more and more people understand what's going on, what are the windows, the changing timing, the change in timings, and all of that stuff. I mean, I think it's going to get better. The same thing with the Sensex as well, quickly. And I think we ended with an 8-point change on the Sensex by the end of it, right? So look at the look at the Sensex between 315 and the closing auction discovered price in that sense. So just, I mean, if you look ahead in the sense of, okay, why don't we tackle this, right? So that is CAS, and I think from Monday itself, on the first day, the opinion has been that CAS is fine. This is global best practice, allows better price discovery, etc., for passive funds. And there are a couple of other reasons as well. But the problem has been options and what happens to, and, you know, I posted on social media on Monday saying that, well, you know, what happened on Monday, and remember that 200-point gap on the Nifty, if that had happened on an expiry day, it perhaps would have been a disaster. Monday options prices on the NSE did go a little berserk. And on Thursday, on the BSE expiry day, option prices also did go a little berserk. So, I mean, just to get this actually happened. This is a real example. This is the 79,300 call option yesterday. At 255, was trading at 60 rupees. I mean, going into expiry, I mean, the option basically expired worthless, obviously, but it still there was a buyer for that call at 120 rupees. So, and the only reason, of course, is, I mean, you know, some sort of fear psychosis, or, I mean, what you want to call it, anticipation that perhaps prices are going to settle higher. The close, by the way, was below the 70. So, you know, this call, by the end of it, this was what, almost 400 points out of the money. So, you know, these kind of things have happened on, and I highlighted with an example on Tuesday as well. And this is, I think, this is the basic worry. You know, volumes will pick up on the CAS session and there won't be that much of a difference. So this also perhaps will settle down. But this is what we saw on Tuesday and Thursday as well.
We saw a lot of deliberations happening within SEBI as well on this issue. So every view will be heard. But having said that, I will give you my personal view on the question that you asked. I don't think it makes sense for the following reasons. Remember, one of the reasons I told you is, ideally, I would like for the genuine participants, including arbitrageurs, including speculators, including people who are doing cash versus derivatives, etc., the basis between what you do in the cash market versus what the setting is in the derivative market should be as low as possible, including zero. In the old VWAP process, we did have a basis, because if you were trying to execute something in cash and against a setting in derivatives, you could run a basis risk. Here, if I'm long the futures and I want to consummate that in the cash market, I can just participate in cash, and the setting there and the setting here will exactly equalize, right? So I want that umbilical cord to remain, because that's the whole genesis of making sure that it's a liquid, vibrant market. If you break it up into pre-CAS, VWAP, and then CAS, and then derivative separate, mutual fund NAV separate, I suspect we'll be creating liquidity pools which don't talk to each other and creating more inefficiencies than less.
Well, 1 week of CAS. Now, back to earnings. State Bank of India reporting a strong set of numbers for the first quarter, beating estimates on all fronts. Net profit up over 10%. Net interest income has grown over 15%. The bank's credit growth has also climbed to a 15-quarter high. Ritu's here with more on the SBI numbers. Strong performance there, Ritu.
Well, SBI has delivered a solid first quarter, beating street estimates on both the top line and the bottom line. Net profits rising 10% year-on-year to more than 21,000 crores, despite having higher provisions. The core net interest income, that also grew 15% to almost 47,000 crore rupees, while the operating profits were also up 10% over the previous year. The other positive was margins. They surprised on the upside, improving 5 basis points to 2.86% against street expectations of a bit of a decline. Loan growth was also broad-based across retail, agriculture, SME, even corporate picking up. The RAM segment, which is retail, agri and MSME, that grew more than 18%, while the total advances rose to almost 18.6% year-on-year, which is the best performance from SBI in at least 15 quarters. Deposit growth was slower at 9.7%, and because of that wide gap, the credit deposit ratio has inched up sequentially to 74.2%. On asset quality, again, good news. SBI continues to report its best numbers in 2 decades. Gross NPAs improving to 1.47% and net NPAs down to 0.38%. But slippages did increase 28% sequentially to about 7359 crore rupees, but they were still 11% lower year-on-year. Now, this appears to be more of a seasonal trend that we've been seeing across the banking sector rather than any specific red flag for SBI. But importantly, recoveries and upgrades more than doubled sequentially for the bank, and that helped offset some of these higher slippages. Now, going ahead, the management is guiding for 14 to 15% credit growth, which is revised up from 13 to 15% earlier, and 10 to 11% deposit growth in the financial year, while expecting the margins to remain around that 3% mark.
Ritu, many thanks. Let's talk about Hindalco now, reporting a strong set of Q1 numbers as well. Standalone net profit has more than doubled in the quarter. Revenue up 26% on an annual basis. Hindalco said its aluminum upstream, aluminum downstream, copper and Novelis all delivered their highest ever quarterly EBITDA during the period. The company attributed its overall performance to favourable macroeconomic tailwinds, security and operational performance. Shares of NBFC stocks slipping in trade. This after the RBI proposed to bar most of these companies from offering revolving credit facilities. The central bank has proposed that NBFCs should offer only term loan products and should not provide revolving credit facilities. Under this, the restriction would not apply to NBFCs that have been specifically authorized by the RBI to issue credit cards. We told you first that it is now official. LIC CEO Doraiswamy says the government may not look at another offer for sale in the company for the next 2 years. Speaking to CNBC TV 18, the LIC chief added that there need not be an immediate offer coming from the government. Take a look.
Once the government was convinced, perhaps, on the possibility of a big issue going up, they decided to go with the green shoe. Originally, the issue was only 2.5% base with a 4% green shoe option. But the first day response itself was such that the government had the conviction that it should have the 4% green shoe also exercised. Now this gives enough time for the government for further dilution to 25%. We have now 5+ years available. So that advantage is there. So in my opinion, there need not be an immediate offer coming from the government.
And immediate is not for the next 2 to 3 years?
It may not be 2 to 3 years. It can be maybe 18 to 24 months.
Well, that's the LIC chief. Now, the Supreme Court has agreed to hear the centre's plea against the Bombay High Court's order striking down a one-time spectrum charge. Notice have been issued to Bharti Airtel and Vodafone Idea. The case arises from the government's 2012 decision to impose a one-time levy on spectrum held beyond 6.2 megahertz for the 2008-2012 period. Finance Minister Nirmala Sitharaman has clarified that the merchant discount rate will be levied on merchants and not on customers. This comes after Congress leader Jairam Ramesh claimed that the consumer will end up paying more for using UPI. Responding to Ramesh in a social media post, the Finance Minister said the purpose of MDR is to strengthen the digital payments ecosystem by enabling banks and fintech companies to invest in infra and innovation. Now, the Lok Sabha recently cleared a new bill that amends 135-year-old legislation on banking records. The new bill, among others, proposes that digital bank records will be admissible as evidence in legal proceedings, subject to conditions. Ritu joins us now to explain the contours of this new bill, what it changes and what the implications are. Ritu.
Well, the Lok Sabha has passed the Bankers' Books Evidence Bill 2026, which replaces a law that had been in place since 1891. Now, what this primarily changes is how bank records are treated as evidence in courts and in investigations. The biggest change is that the law now explicitly recognizes electronic and digital bank records as evidence and not only physical records. So the bill also says certified copies of bank records can continue to be used as far as legal proceedings are concerned, but banks cannot just simply produce any digital record. They'll have to certify that it was created, stored, or processed in the ordinary course of business, that it hasn't been tampered with, and is protected against any unauthorized changes and cyber risks. Now, the bill also protects bank officials from just being routinely summoned to court. They can now only be called if there is a special cause. For instance, if there is doubts about the authenticity of the record. Another key provision is that the bill applies to investigations as well as to court proceedings. So during an investigation, certain powers of the law can be exercised by an officer, but not below the rank of superintendent of police or another officer notified by the government. But importantly, the bill does not create any new power for the police to just freely access your banking records. It mainly changes who can exercise the procedural powers that are available under the Act during the investigation. So in summary, the bill modernizes this 135-year-old law for the digital banking era. It gives digital bank records clear legal recognition as evidence. And according to the industry people we've been spoken to, the bill only puts to paper what is already common practice.
All right, Ritu, many thanks for joining us. We'll head to a break, but up next, the US judge orders Facebook's parent Meta to pay $940 million for its failure to warn the public about the dangers posted by its platform to children. That and more when we return. In interim relief for Dabur, the Delhi High Court has stayed the food safety regulator's order imposing a ban on products with 100% pure claims on the labels. Ashmit joins us now with more details. Ashmit, what has the court said? What does this now mean for Dabur?
Well, for now, it means an interim relief. Dabur will not have to suffer under the FSSAI order, which had essentially barred claims of 100% pure, organic or nature that these brands often put on the packaging of the product. That is no longer something Dabur has to comply with. But mind you, that is an interim relief until the next date of hearing. Now, here's the broad contours of the case. On August 3rd, the FSSAI had passed an order barring these 100% claims, 100% pure, organic or natural. The FSSAI's rationale essentially was that these claims are ambiguous, are unverifiable, and importantly could potentially mislead customers. Now, this was challenged by Dabur before the Delhi High Court. Dabur raised multiple concerns. Number one, they said that the officer who passed such an order did not have the power to do so. Also going on to say that there was no show cause notice that was given to Dabur, there was no hearing that was given to Dabur, that these products are tested, verified, have been in the market for decades, and that any withdrawal order would mean that inventory worth over 150 crore rupees would have to be called back. Now, these concerns weighed on the minds of the Delhi High Court. The High Court said that prima facie such an order should not have been passed without at least giving a hearing to Dabur. So on the merit of that one argument alone, the High Court seeing it fit to grant an interim relief. Dabur, of course, is the recipient of that relief, but importantly, interim in nature. This will be as of till the next date of hearing. The High Court will resume hearing in this case on August 24th.
Many thanks for joining us. A quick check of some of the global headlines. We're tracking at least 7 people have died after a 14-year-old student opened fire in his home and school in Thailand's Bangkok. The student is believed to have shot dead his grandparents at home before opening fire in his school. He killed 5 teachers before taking his own life. This is the second school shooting in Thailand this year. Google's threat intelligence team has flagged a fresh wave of phone-based scams targeting finance companies. Hackers targeted employees on their personal mobile numbers, posing as internal IT help desk staff and talking to them into handing over login credentials. As per Reuters, the ransom group demanded anywhere between $750,000 to $3 million per victim. Google has not named any victim, but Reuters reports that Apollo, Bain Capital, Blackstone, Bridgewater are among the companies that were targeted. A New Mexico court has ordered Meta to pay an additional $567 million for its failure to warn the public about dangers that its platform posed to children. The ruling comes as part of a second phase of a landmark trial the social media giant lost in March. Rachna joins us now with the details. Rachna, significant blow for Meta.
Definitely. A New Mexico court has ordered Meta to pay $567 million to address harms to young people on Facebook and Instagram. Now, the money goes into a youth mental health fund. $420 million is ring-fenced for treatment services, with the rest covering awareness, prevention, screening and referral over 5 years. This is the phase 2 of a 2-part trial. In March, a jury found Meta liable on all counts after a 6-week hearing and awarded $375 million in civil penalties for 75,000 violations of the state's Unfair Practices Act. That takes the total to $942 million. New Mexico had sought $2.2 billion in the first phase. Now, the order goes beyond just money. Meta has been directed to delete accounts belonging to users under 13, along with the personal data collected from them. The state had pushed for curbs on addictive features and tighter age verification there. The court noted that federal privacy law under COPPA limits what it can order, because verifying age would itself require collecting data on children. The judge wrote that New Mexico is in a youth mental health crisis and that Meta's platforms are a significant contributing cause. The case was brought by Attorney General Raul Torres in 2023. He alleged Meta's platforms had become a breeding ground for child predators and that the company misled users about safety. Now, Meta has denied. It denied it then and is now contesting and trying to appeal. It says it remains confident in its record on teen safety and that the claims misrepresent the facts. No appeal has been filed so far, but Andy Stone has confirmed one. Now, this is among the first jury verdicts anywhere on platform child safety. And Meta faces thousands of similar suits across the US, which its own filing says seek damages in the tens of billions. So it could just be the first of many. So we'll have to see how it goes.
All right, Rachna, many thanks for joining us. With that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC TV 18. Stay tuned. We're back in a minute with more.
Pawan, congratulations once again, and thank you so much for joining us here on Rising Bharat. I don't know how many of you understand the enormity of what Pawan and his very young team at Skyroot have been able to pull off. To start with, it's a company that was founded only in 2018, so it's an 8-year-old company, and it has managed to create history. The average age at Skyroot is 28. Ladies and gentlemen, let that sink in. 28 is the average age at Skyroot, and it clearly shows you that when you have a clear vision in place and you have a clear execution roadmap, nothing is impossible, and even space is not far enough. But Pawan, let's talk a little bit about your journey before we talk about Skyroot's journey. I saw a picture that you tweeted of your father and you celebrating your birthday, and you talked about how you were terrible at math, something that we have in common. Of course, you went on to do better at it. I still am terrible at math, but it was your father's belief in you that pushed you to not just sort of get equipped in dealing with math, but really live out the dream that you eventually had. Take me through that, because very often, before we believe in ourselves, you need somebody else to believe in you. In your case, it was your dad.
Yes, absolutely. And thanks, Shireen, for having me. So in fact, after the launch, as you know, I just flew to London for some stuff, and like just coming back to India. And first event is this.
Thank you so much.
So thanks a lot for having me. And so basically I was a very slow student to start off with, and I was not doing very terrible at school, and almost up to my 8th standard I was probably among the last people in school. And even then my dad thought, my son can go to an IIT. He dreamt that my son can get into an IIT, I should make him get into an IIT. And then he joined me a foundation course, in 7th or 8th standard when I was doing terribly at school. And in fact, I had to get into a recommendation to get into a foundation course for IIT. He got me a recommendation, got it there. And then because of that, slowly, and then I changed my school, so many things. And then my teachers encouraged me, my parents encouraged me, the thought they didn't give up on me. And somehow, the interest in math and science has grown and completely U-turned to, from the last in the school, I got into the first in the school, got into an IIT. And then, of course, joined ISRO as a scientist. And now we have launched India's first private rocket to orbit and made India the 3rd country in the world to do so.
Made India the 3rd country in the world to do so. But Pawan, we were talking about this, and I think it's a very unusual thing for somebody, a young engineer like yourself, who'd already managed to get into ISRO, to give up on that job, to give up on that career, and imagine that you would be able to create a company in India when the private sector wasn't even encouraged to be in the space sector in India. What gave you the courage to start up in this sector when the private sector was not even encouraged to do so?
Yeah, fantastic question. So in fact, I always wanted to start a company from childhood. So I had entrepreneurial dreams. I really liked people building companies, creating impact for society. And I thought one day I would start my own company. And in fact, even in college in IIT, I thought I would start my company, not sit for placements. But there was no idea which was a calling that, I should start something. I just followed my passions. I really like rocket space. And ISRO came to campus. I didn't think twice. I just said I want to get into ISRO as a scientist, got into ISRO as a scientist. I was part of the space program. I was part of the team, which built India's largest rocket. I spent good time there. And then as a streak of lightning, one fine day I felt, because this entrepreneurial bug is always there at the back of the mind, and I just got an idea, why can't we build a world-class space company from India? And then that's why I couldn't sleep that night. It was so exciting to me because it was like marriage of two passions, entrepreneurship and rockets. But at that time, it's a very different time when there was no policy, there was no funding environment, there was no talent in the private sector for space. Literally, odds of success seemed almost zero. But that's what I liked. I like taking risks. I felt this opportunity. I felt this is a time to start where you get an early advantage. Eventually, it's going to open up. We'll be the early players. And that's exactly what happened. The government opened up the sector a few years from there, and we became the first beneficiary of it. And today, we are standing the leading company in India, one of the leading in the world.
Absolutely. And of course, also India's first and only space tech unicorn at this point in time. Hopefully, that picture will change. But, from the time that you got your first check in, which was courtesy a Bangalore boy, Mukesh Bansal, who decided to write the first check for Skyroot to turning unicorn. How hard has it been to convince people to bet on you, to believe in the dream that you've always believed in?
So in fact, like speaking about Mukesh Bansal, I was just with him before this.
Great.
The moment I landed, I met him. I had lunch with him. And we were just revisiting the memories of starting Skyroot 8 years ago, where he wrote our first check. In fact, one of my friends was helping me raise capital. He just got an idea that why don't I ping Mukesh. He pinged Mukesh on LinkedIn, immediately responded. He generally doesn't respond to LinkedIn messages. That day he happened to see it, he responded. The weekend I met him along with my co-founder Bharat, and he wrote a first check, 10 crores. He started off the company and gave us runway for 3 years. And literally, that's one of the prime reasons we exist. And that risk capital took us a long way. And then after that, we made decent progress. And the policy came in. Then we had other entrepreneurs backing us. Anil and Mahesh of Greenco, they put in 50 crores of their personal money. And then GIC came in. Then Temasek came in. And all early believers. Even GIC doesn't invest in such an early stage company like Skyroot. Everybody took leap of faith. And now, now I think they're all with us celebrating the success so far. But it's just the beginning. I mean, we're not even. I told our team after the launch that we just warmed up, so the race is just going to start.
Just warmed up. The engines have just started to fire. But I want you to relive for all of us in the room what happened that day on the launch day itself while you were making history. And I was watching it online. I don't know how many of you were watching it. It was scheduled to launch at 11:30, and then it was delayed to start at 12:05. And while that period of waiting was on, I had my heart in my mouth waiting. I don't know what that feeling was like for you, but we could see shots of your control room and everybody looked calm. And you said that a job of a rocket engineer is that you have to be as cool as a cucumber. So what was going on in the control room? What was going on in your head as you went through that period between 11:30 and 12:05? Did you ever, even for a minute, think that you may have to abort?
It's a good question. So in fact, this is the first time ever a private rocket is sitting on the launch pad ready to take off to orbit in the country. And in most of the launches happened globally. They scrubbed on the first day of attempted launch. And whenever they launched, almost all of them failed. So this is the global statistics, And then on the day of launch, I was fully prepared. Our entire team was fully prepared. Everybody's excitements were high. People were thinking we're going to win, we're going to make it to orbit in the first attempt. And I said that let's keep our expectations low. Rocket science is rocket science. Anything can go wrong. And then probably we should pray if we lift off the next day. So we reduce the expectations as much as possible, and we were ready for anything which happens on the launch pad, anything which happens before the launch, any hold comes, scrub happens, we're all prepared for everything, fix the problem, move forward. And luckily it happened to be a very small issue, and like in India, if something doesn't work, what do? We switch it off, switch it on. We just did
is that what happened?
That's exactly
you switched it on and switched it off?
We call it an automatic launch sequence. This is a computer which takes over. And there was an old memory which was floating in this software, which we mismatched with the existing number, so it put a stop. So the moment we restarted, that issue got sorted because the new number was matching with the existing number. So it was just, what we did was we just restarted. It was simple trick we used. And then it was back to all, and we lifted off and we reached orbit.
Yes, you lifted off and reached orbit. And as Pawan is pointing out, that in itself is adding to the historic feat that they've achieved, because as he pointed out, not many do it in their first attempt. So that was the other special aspect of what happened there as far as Skyroot is concerned. But let's talk a little bit about Vikram 1, which is the rocket that you've sent up in space. And the significance of this launch for India, the significance of this launch for Skyroot. What kind of doors and windows does this now open up?
Yeah, so there are, just imagine, the first satellite was launched in 1957. And today we are sitting in 2026. There are only 2 companies which launch regularly to orbit. There are only 2 companies. Of course, the number one is SpaceX, and both are American companies. And then there is no new access to space which is regular. So and in the entire world, and everybody else launches just few numbers a year. All legacy vehicles, etc. So this is the first time a private company from India designed a orbital rocket which can put satellites into orbit, came to the launch pad and lifted off and achieved orbit in the very first attempt, which is super rare in the entire industry. And then we opened up, we launched 2 satellites. In the first attempt. In fact, most people in the first launch, they put dummy satellites. For example, Elon Musk put Tesla car in one of the launches. This is a getting to a real satellite launch is very difficult in the first launch. But we put real satellites, launched to orbit.
Because you were that confident from the get-go.
We thought we'll just take the bet. We said let's take go all in and see what's going to happen.
One was yours, so I can imagine you wanted to take the bet, but one was somebody else's, and they decided to take the bet with you as well.
That's it. I think that's a fantastic customers we had. In fact, I'll tell you, the one of the customers which had this successfully launched their satellite, they lost their previous satellite in a different private company. They launched their satellite, the rocket failed, and they couldn't put their satellite into orbit, and they had so much of pushback from their investors. Why do you want to take a risk on another private rocket? But still, they believed in us, put it in it. Finally, they reached orbit. So I think that's a very unique. It's a very unique thing which happened that day, and just the faith of the people. They just thought that it could happen. There are decent chances of it going well, and it did.
Let's talk a little bit about the space economy now and the kind of addressable market that you're going to go after. You've got plans of putting a rocket in space every month. That is the target, and you're hoping to be able to get to that at some point next year. You're also building your rockets. You've got a large manufacturing facility, so you're building your rockets as well. You're designing them and building them. Take me through the monetization roadmap as well, and what the space economy could potentially do for India over the next 5 to 10 years.
Great, great. In fact, space today is $600 billion market globally. It is set to become $1.8 trillion by 2035. But these are all slightly older numbers because after Musk came out and said he's going to launch 1 million satellites, so now the whole market numbers are changing. In fact, the recent SpaceX IPO proposed a TAM of 28 trillion.
Yeah.
28 trillion, can you imagine? So I think, space market is far bigger than what you can imagine. It's a blue ocean, you can create your own market if you want to. So I think the only thing
others, I mean, what do you make of those numbers? I mean, all the analysts are making what they have. We saw how SpaceX listed. We've also seen the correction as far as the stock is concerned. But what do you make of those numbers?
I think they're small.
They're small.
I think it can go bigger, it's just like how much more you can do, how much more you imagine. Because I've been watching the sector every year. There is a reboot every year. Every year there are new opportunities, new things which you cannot imagine the previous year. So I think, of course, they're very ambitious, but probably, it could be even bigger. It could be even bigger. It just doesn't match our imagination today.
But what is going to drive the kind of explosion in demand that you're anticipating?
So one is communications. Billions of people will get access to high-speed data. For example, I was flying back from London to Bangalore. I did not get internet in Air India flight. I mean, it's like 2026, we should get high-speed internet in flight, which are there in many airlines across the globe. So there's so much this is just one example, but there's so many pockets of Earth, so many people not getting connected with high-speed internet. Just imagine billions of people getting connected always with high-speed internet that transforms life. That itself is a multi-trillion-dollar market. Just communication from space. And direct to mobile is another thing, is another big application where directly satellite gives signal to the phone, and there's again continuously no portion or no place where it's unconnected. And the third thing is data centers in space.
Yeah.
And I strongly believe that the lowest cost of compute will be in space because you have 8 times more energy for the same area of solar panel. In space, you get more energy and you get 24/7 electricity. You have no atmosphere to filter your energy. You can exactly put the panels right to the sun. So many advantages.
Yeah. When are we going to see that happen? I mean, Musk has already announced his plans, and another Bangalore boy, Pixel, Aves, and Sarvam, both Bangalore-based companies, have decided to partner to put data centers in space. When do you believe that is going to be a reality?
I think in 2-3 years, the initial prototypes will go and it'll start having good maturity of the tech, and in 5 years it should be quite common.
5 years it should be quite common. And is that something that you would want to look at?
Yeah, definitely.
At some point.
At some point, yeah.
So, how do we get to that one rocket launch a month, which is the cadence that you're working with? What are you doing to build internally to be able to achieve that target?
See, we have taken a lot of risks, Shireen. One is we invested in the infrastructure even before the first launch. And as we speak, we're building parts of the 3rd rocket, 4th rocket. The 2nd one is already, almost getting done. So I think this is something very unique globally where you're industrialize the product even before the first launch, and that's what we have done. So we took the risks, and now it's paying off. And now, the first launch was successful, and we want to repeat it more often. And we're already in production. In fact, the latest factory was inaugurated by the Honorable Prime Minister himself. And in fact, it's also great to hear him after the launch. He's the first one to call us and congratulate on the successful flight. So I think this is more like a national milestone. And there's no stopping from here.
No stopping from here. The 3rd rocket, the timeline for that, and it's going to be much larger than Vikram 1 as well. So you're moving up that trajectory also.
Yeah, that's right. So the next launch we're targeting this year, and we're going to build bigger vehicles from next year onwards, and also down the line large reusable vehicles as well. So it's a very interesting pipeline, So we want to become literally meet our dream of opening space for all.
Reusable. You use that word. When is that going to be a reality? Are you fast tracking that plan?
Yeah, of course. I mean, it'll be a few years. We'll probably, we are making decent progress. We'll share more details soon.
we'll share more details soon. But, for those people who are watching and for young scientists and young engineers who, like you, have an entrepreneurial kida, and everybody in Bangalore seems to have an entrepreneurial kida, if they want to start a space company today, what should they be prepared for?
So I think prepared for the super long-term, super hard journey. It's a 20-year journey. So it has to. First thing is start a company. First thing most people to get stuck at the idea. Go make the first step 50% done, and second is go after the biggest idea of your passion. Space is vast. There's so many ideas you can look at. For example, data center is one, communication satellite is other, data from space, Earth observation, so many things you can pick. You choose what is the biggest thing in that particular sector which excites you. Go directly bang on with the most important and the most biggest thing, and then persevere, make it happen. That's it. I mean, it's, as I mentioned, nothing. I mean, sky is no limit for space.
Sky is no limit for space. Clearly, you've proven that. But I want to come back to the point about 28-year-olds building Skyroot. When we were chatting earlier and you said that when you first started sending out ads, getting people to want to join Skyroot, people thought that this was a joke, that this was a prank that you were playing on people, but that you've now managed to get engineers who've relocated from locations outside like the US to come to India and work at Skyroot. What has it taken to build this team of young, talented, passionate engineers?
So I think rockets and space is super fascinating. People, young engineers really want to be there. We're just creating that platform, creating that opportunity. And then we have now, I think even before the launch, we have for every one position, we have 1,000 plus applications happening, so we choose one from 1,000, probably is going to go an order of magnitude more now going forward. So it's it's a very rare opportunity for anybody to come in, experience this, and you see 1,000 people celebrating yesterday. They're all at the spotlight when the launch happened, and this is what who gets this opportunity to build and launch rockets to space, orbit, and then create history. It's very, very rare opportunity. So I urge more and more engineers to take up space, and we're all open. So I think please apply to Skyroot. And then let's create history together.
Yeah, so there you go. He's an open invitation. You can send in your CVs to Pavan at Skyroot. They're looking to hire bright Indian talent. Pavan, the dream is already fulfilled in many ways. You've started up, which was your childhood dream. You've sent a rocket to space, which was also a childhood dream. What is the dream that you now have?
So I think we have to literally make space open for everybody. So how many of you gone to space? That's explained. So it's an unfulfilled dream. So we want to see all the hands up one day. I think space should become as accessible as anything else. It's humans are exploratory species, and our life should go beyond Earth as well. We think that today we're geocentric is what we think. We think Earth is everything, but out there resources are vast and infinite in space, and it's just a matter of time. Once we crack the tech on a regular basis, and we'll see people across the world, maybe for tourism or across the world, living across the universe. So I think that's transition is going to happen hopefully in this lifetime, and Skyroot to some extent, if we are able to contribute, that will be a great satisfaction to us.
So you're sticking to your Uber for space vision, your Uber for space idea that got you to start this company?
Yeah, absolutely. So I think we want to watch more. We want to open space for more and more people. And make it accessible.
The economics of it, to make it accessible to each and every person who's sitting in this room, how will the economics work?
See, the dream is to maybe a foreign holiday, equivalent to a foreign holiday, a trip to space. That would be interesting. It will be great.
So start saving if you want to go to space. Finally, have you caught up on your sleep? Because I know it's been a lot of sleepless nights ahead of the launch. Yeah, and has the big party happened? The celebration happened?
No, in fact, as I flew outside and then I just returned today. So because I was continuously traveling, couldn't catch up on my sleep. Probably tonight I'll have a good catch up with the sleep, and we'll have a celebration hopefully in the coming days. We'll have a big celebration celebration at Skyroot, where I think the people who made it happen, it's a time to celebrate them and ensure that this history gets repeated and that enthusiasm and the drive exists for decades.
Is there any risk that you won't take?
No, I think all in, always.
All in, always. Ladies and gentlemen, a big round of applause for Pavan Chandana, going all in to create history, not just for his company, but for India. Thank you very much. Congratulations once again, and we wish you all the very best of luck as you put all of your plans into motion. Thanks very much, Pavan, for joining us here today.
Hello and welcome to News Center. I am Ashmit Kumar. Here are the top headlines that we're tracking this evening. Oil prices near the $85 mark after Iran reviews a draft plan that proposes permanent transit bans for U.S. and Israeli vessels in the Hormuz Strait. President Trump claims the U.S. has unlimited supply of certain munitions, slams reports suggesting that he had pulled up the war secretary over depletion of missile stockpiles. Iran's chief negotiator accuses Trump of theater diplomacy. Sensex and Nifty gained 1% in the first week of the closing auction session. The adjustments on Friday after the closing auction was the lowest this week. India's largest bank, SBI, beats the estimates in Q1. Loan growth hits the highest level in nearly 4 years. Asset quality remains stable even as provisions jump 75% sequentially and slippages rise 33%. Shares of non-banking finance companies decline after RBI releases draft rules imposing a ban on revolving credit. NBFCs can only offer term loan products under the proposed rules. Merchant discount rate on UPI transactions, if introduced in the future, applies only to merchants and not customers, says the Finance Minister Nirmala Sitharaman. Also adds a committee headed by NPCI is yet to decide on imposing MDR. Interim relief for Dabur, Delhi High Court stays the food safety regulator's order imposing a ban on products with 100% pure claims on the labels. The court says FSSAI should have given Dabur a hearing before passing the order. Ransom-seeking hackers target dozens of U.S. private equity firms, including Blackstone, Bridgewater, Apollo, KKR, Bain Capital, among others. Google reveals hackers designed at least 72 websites aimed at stealing passwords from employees of private equity firms. Google also says that some companies paid the ransoms but stopped short of naming them. A U.S. judge orders Facebook's parent Meta to pay $940 million for its failure to warn the public about the dangers posed by its platforms to children. This is the largest penalty on a social media company over child safety yet. Well, here's the top story. The government scrutiny of Meta continues, with discussions between the two sides now entering a third day. At the heart of these meetings is a clear message from the government. Global technology platforms operating in India must comply with the law of the land. On day one, senior Meta officials were summoned by the government over a range of issues, including WhatsApp's username policy and alleged instances of child sexual abuse material, or CSAM, on Instagram. Now, sources told us that the platform apologized to the government over these issues. The Meta delegation was led by the Chief Global Affairs Officer, Joel Kaplan, and included senior global and regional executives. Government officials questioned the company over its understanding of Indian IT laws, the steps it has taken to comply with those laws, and importantly, the technology being deployed to identify and combat harmful content. The discussions continued on Thursday with IT Minister Ashwini Vaishnav meeting Meta officials again. Sources told us that day two discussions focused more closely on technical issues, including examination of relevant logs and the safeguards deployed by the platform. And the engagement is not ending there. Meetings with Meta are expected to continue over the next 3 to 4 days. Sources have told us that Joel Kaplan was expected to leave after Thursday's meeting, but Meta's technical team will remain in India to assist the government. The government's broader position is that platforms operating in India cannot simply function according to US law. They must meet Indian legal requirements and have responsibility towards Indian society, just like other institutions operating in the country. Well, joining us now to take this discussion ahead is with us Pawan Duggal, cyber law expert. Mr. Duggal, coming to you now. There's been a great deal of scrutiny being applied by the government on Meta. The questions that many have asked, though, is that if Meta is indeed found to be violating Indian law, that's what the government's claim is. If you're in India, follow Indian law. If there is a violation, why not take action? That's the question many are posing.
I think the question is pretty valid. Have you ever seen government going into talks with an offender under the existing law? I've never seen such a scenario. So what's so special about Meta?
that, look, Meta has already lost its statutory exemption from legal liability. It began with the downing or blocking of the Prime Minister's video for 5.5 hours, first on legal grounds, then on technical glitch, finally landing into an apology. But I think then the subsequent disclosures of skeletons that have come out of the cupboard of CSAM content being constantly not just produced, disseminated, distributed, but also actively promoted by Meta in India clearly shows that various contraventions and offenses under the Information Technology Act 2000, under the POXO Act, and under the Bharatiya Nyaya Sanhita have already been committed. That being so, where is a logical basis for engaging into any discussions? I'm amazed to look at this approach. Rather than the government going ahead and taking the law to its logical conclusions, we are effectively making a mockery of the existing Indian cyber law. Look, at no point of time when an Indian or another country's representative or company violates Indian law, the Indian government does not go into parleys of talks and negotiations. For what? You have violated the law. You are amenable to Indian law. You don't recognize us. That's your problem. We proceeded under you. And since the statutory exemption from legal liability has already been taken away, snatched away from them by operation of law, I see no reason why these talks need to be happening. In fact, the onus is now on the government. The government should quickly take action, not only against Meta.
Government should take action. Let me then bring you to the next question. What is that action that is needed? We've heard from, again, sources, officials who were present in the meeting, who've basically sought to drive home the message to Meta that, look, if you're funneling certain content to certain customers, and if you're being paid for it, then you're no longer just an innocent platform. Then you become an active participant and therefore can no longer claim to be an intermediary, can no longer claim to have safe harbor protection. Is that the action that's needed?
That's actually the correct interpretation of law. And they have lost their statutory exemption from legal liability thanks, again, to operation of law rather than anything else. So I'm of the firm opinion that the legal action going forward will be criminal prosecution of the top management in India for offenses that have taken place under the IT Act, under POXO Act, and under the Bharatiya Nyaya Sanhita. Further, fines need to be imposed upon them and civil liability of paying damages, unlimited damages under the then now Section 43A. Otherwise, damages up to 5 crore rupees per one contravention under Section 43 of the IT Act need to be invoked. Now, this is a very strange situation. Yesterday, we saw a New Mexico state court imposing $567 million fine. Today, we have a $950-odd million fine coming from a US court, all because of their failure to put in place reasonable security practices for safeguarding children. And now with so much of CSAM content, which is actually being promoted by them, they are no longer just intermediaries. Further, they are extensively now using artificial intelligence. They are...
We have you on Apache line, Mr. Duggal, but let me on that instance get another question through to you. You mentioned, of course, how there's been a US court decision which slapped a penalty aggregating to about $1 billion as far as Meta is concerned. Again, children not being protected on the platform is the premise of that US court decision. What I want to ask is that, is there similar room for action here? Are there powers available under the IT Act that allow for levy of such penalty? And if yes, is that likely to be taken?
Well, first and foremost, under the IT Act, this kind of a content publication itself will tantamount to child pornography, which is a serious non-bailable offense under Section 67B of the IT Act, punishable with life imprisonment and fine. In addition, the government has the power to fine the intermediary for their failure to comply with law. But if you're looking at millions of dollars of fine, that is not currently happening because the existing law does not yet provide for it. Yes, the Digital Personal Data Protection Act, as and when it comes into force on 13th of May 2027, will be prospective. But under that particular law, fine up to 250 crore rupees per one contravention could be awarded. As of now, since the law of torts is very poorly developed in the country, there's no basis on the basis of which fines, exemplary fines can be done. But yes, once they are stripped of their statutory exemption from legal liability, the Pandora's box can be opened up. A new tsunami of litigations, lawsuits can actually follow to give a deterrent message not just to them, but to every stakeholder in the that if you operate in Indian law, in the Indian market, you'll have to comply with Indian law.
Right, Mr. Duggal. Right, Mr. Duggal, appreciate your perspective that it's apologies. We need to move beyond that and begin to take action under the IT Act. Mr. Duggal, thank you so much for joining us for your perspective. But let's move forward. State Bank of India has reported a strong set of numbers in the first quarter, beating the estimates on all fronts. Net profit rose by 10%, while net interest income has grown by over 15%. The bank's credit growth has also climbed to a 15-quarter high. Ritu Singh spoke to SBI Chairman C.S. Sethi and began by asking whether the stellar performance by the bank can be sustained throughout the year.
The sustainability and consistency of performance is something what we always look for. And the numbers what you see now are a conscious effort in that direction. And whatever numbers you mentioned in terms of outliers, I think they're not outliers at all. The overheads uptick sequentially will always be there. And on the year on year, I think the overheads are contained. And what are the standing out numbers are in terms of our a proactive adjustment in our cost of resources. I think we focused on containing the cost. It's almost 7 basis point reduction. That really helped us in terms of ensuring that in a very difficult market conditions, margins are protected. And we also have a fair idea in terms of what is going to be our FCNRB trajectory in the Q2. So we have proactively reduced our bulk deposit, which also contributed to the cost of resources coming down. So with the availability of liquidity and the capital what we have, we are very confident that these numbers will be maintained.
All right, so let's talk about the advances. They've grown very healthily, but almost double the pace of deposits. Is that something that concerns you, the CD ratio inching up to about 74%? Are you comfortable at those levels, or would you look to bring that down?
Ritu, I think we also mentioned that our ability to fund this credit growth, apart from the deposits, also comes from the excess liquidity we have in the form of excess SLR. As we speak, we have almost 4 lakh crore excess SLR, which gives an ability to look at beyond the high-cost deposits. We believe that any bulk deposits, the system, wholesale deposits, what banks resort to, is a treasury activity, which means that the treasury has an option either to access the bulk or go to the market and borrow because we have adequate securities to offer. So combining, the liquidity which is available, excess liquidity which is available in the system, within our system, as well as around 10-11% growth rate in deposits, what we are seeing with the FCNRB flows, what we have, I'm sure, I think comfortably we can provide the funding capacity.
Let me pick up on that 10 to 11% deposit growth, sir. I mean, this $10 billion FCNR raise target that you have, will that then continue to lower your reliance on bulk deposits? And could the number look even better, if the FCNR flows are better?
FCNR, I think there's only so much you can reduce on the bulk because some of the bulk deposits are also relationship deposits, right? So long-term relationship also we give a better rate for them in the form of bulk deposits. But broadly speaking, yes, I agree with you that a dominant portion of this FCNRB deposit, not only for us, for the major banks which are raising FCNRB, would be reducing the competition for the bulk deposits. So obviously that would be overall costs will be reduced. But if the credit growth continues to be robust, some of the banks probably would still have to access the bulk deposit market.
A related question then, sir, because your margin guidance for the year, one, you've surprised us in the quarter with an improvement, expansion in margins. Now you're targeting a 3% NIM for the full year. But this large FCNR raise that you're factoring in, could that impact your margins from here, or is that already baked into your guidance?
It is based into our guidance. We have given a 12-month, the full year guidance at 3% NIM. I think we are still standing by that.
All right, sir. Sir, even your credit growth guidance, you've raised it. It was earlier, I think, 13, 14%. Now you're talking about 14 to 15%. What is the visibility that you have on the pipeline? Will a lot of this come from the corporate book, which is seeing some strong growth, or where exactly are you seeing more credit demand?
No, we are seeing credit demand across the sectors, whether it is MSME, retail, personal, even agriculture. Agriculture could be maybe mainly because driven by the agricultural gold loan. But corporate side also we are seeing good demand coming from many sectors, both on the conventional side as well as the renewables and highways, data centers. So it's a broad-based demand what we are seeing. And we have a pipeline almost more than 3 lakh crore as we speak on the corporate side. So that gives a good visibility in terms of growth rate. But I also linked, Ritu, if you remember, that our growth rate guidance on the credit side is essentially linked to the GDP growth rate. If nominal GDP is 12%, the SBI consistently has been growing 2 to 3% more than that. So the guidance is based on that.
Take that point, sir. Sir, asset quality, again, I think it's the best we've seen from SBI in a long time. That increase in slippages, though, sequentially to about 7,046 crores. Is it correct to assume that's largely seasonal from the agri book as we've been seeing across banks? Because, you know, the other part to this is your SMA book has risen. It was 3350 in the previous quarter. Now it's about 4174. Is there any concern there as well? Could that slip into NPA, and therefore what your guidance for the full year could be on asset quality?
Asset quality guidance, I think we've been giving on the credit cost side only, not on the gross and net NPAs. I think credit costs, we still stick to a broader guidance of 50 basis points, which is unlikely to reach that stage. Whatever uptick, what we have seen is more of a seasonal nature. Even out of the 7,000 crore slippages, we have, as we speak, pulled back almost 1,400 crores. So there's no matter for concern on that. And if you see, generally the Q1 will have an elevated slippages for 2 reasons. One is their gross slippages. As we move into the next quarter, it will become net slippages. And also we have enough time to pull them back, and that is the reason what we see. And some of the agricultural slippages also will add to the seasonality. But I think broadly, there are no concerns on the asset quality. It is definitely aided by the overall benign asset quality life cycle, what we are seeing, but also the improvement in underwriting and the risk management, which is resulting in this.
So there's nothing to be concerned about the SMA book increasing. You don't see any slippages from there into your NPAs?
No, nothing specific on that.
All right, sir. Just a final question. If to fund this kind of a growth that you're talking about, 14-15% credit growth, capital is sufficient, yes, but would you be looking at any kind of capital raise? Of course, you have that NSE IPO coming up. That'll help with some monetization. But apart from that, any kind of capital raise plan for the year?
No, I don't think we need any more capital at this juncture. Both by way of the divestment what you talked about, and also the divestment what we have done in mutual fund. I think that is providing adequate capital for us for growth.
Right, now moving ahead, India is stepping up its renewable energy push with the PM Surya Ghar Muft Bijli Yojana now crossing the 50 lakh household mark. The government is aiming to double that number by March of 2027, while also looking to ramping up wind energy capacity by replacing aging turbines. My colleague Abhimanyu Sharma caught up with the MNRE Secretary Santosh Kumar Sarangi. Listen in.
States like Maharashtra, Gujarat, Kerala, Uttar Pradesh have been doing extremely well in the PM Surya Ghar scheme until now. In the recent past, we have seen states like Andhra Pradesh, Odisha, Madhya Pradesh having picked up the pace of installation in their respective states. Going forward, we expect states like West Bengal, Tamil Nadu, Karnataka, Chhattisgarh also to ramp up installation and try and avail maximum facilities under the scheme.
Sir, speaking about other sources of renewable energy, the government is also foraying into geothermal energy, and wind energy is also being looked at. Sir, any new targets being looked at for wind energy in terms of replacement of turbines which already exist in several facilities? Because we understand that's what the minister also had indicated a few months back, because land acquisition continues to be a big challenge, and beyond desert areas, beyond lesser populated areas, land acquisition will continue to be a costly proposition. Any targets you're looking at with respect to replacement of those wind turbines?
There are no specific targets as such, but you are right that wind installations which had happened some 20 years back and which have completed their designed economic life need to be replaced with more efficient wind turbines. And to that extent, such areas in Maharashtra and Tamil Nadu have been identified. And currently, there is some replacement which is going on in Maharashtra, and in the recent past, MNRE officials and Tamil Nadu government officials along with wind power developers have had a meeting at Chennai, and we expect such repowering to happen at a much better pace in Tamil Nadu in the next couple of months.
Sir, other sources of energy like small hydel projects which already have been approved, and also other sources like tidal energy, what has been the kind of development in those areas? What are the kind of targets as well as challenges which you are looking to resolve?
In the small hydropower, there were issues relating to availability of land, ROW issues, right-of-way issues. There were issues of forest clearance. In the recent ones, we are trying to ensure that all these clearances are given upfront, and after that the schemes are approved. So that would de-risk the developer to a substantial extent, and that would also ensure expedited project completion. So a similar model is also being tried out in the floating solar, where all the clearances would be available upfront, and then the tendering for the project would be done. So the idea is to de-risk the developer to the optimum and ensure that the projects are completed in time.
Well, with that, it's a wrap on this edition of News Center. More news and updates will continue right here.
Welcome to a very special Indianomics. India's UPI payments, which is currently totally free or uncharged, is likely to become a charged service. The government has moved an amendment to the Payments and Settlements Act 2007, which, if passed, will allow RBI and or NPCI to make rules on how UPI payments may be charged and who may be charged. Right now, there are only guesses. The guess is person-to-person transaction, that me paying you will not be charged at all because no merchants are involved. Payment to merchants will be charged, but only above a threshold, and everyone is talking about a threshold of 2,000 rupees. There is also an expectation that merchants with turnover less than 1.5 or 2 crore rupees will not be charged. The move is seen as positive for banks, payment platforms like, say, Paytm, and fintech companies like Pine Labs, who will earn some money for a service which is now going unpaid. The negative could be that UPI adoption may slow down when it becomes a charged service. To understand more, I am joined by Amarish Rao of Pine Labs, Ramesh Lakshminarayan of HDFC Bank, and Mahesh Ramamurthy of Yes Bank. Gentlemen, good morning and thank you very much for your time. Ramesh, if I may start with you, are you privy to any conversation at all? Did NPCI phone you informally, about who should be charged and how much? This 2,000 rupees as the minimum, is there any sanctity to this number?
Good morning, Lata, and good to be back on the show. No formal calls. I just want to be very, very categorical about it. These are all right now conjectures and guesses. I think the industry has been asking for some help around this, and I'm sure the government and the NPC are looking in the positive way on this one. And I think it's very important to understand the ecosystem and then kind of frame the rules. And I think that they're going it in a very, very calibrated way, and that's a good sign.
No, I agree with you that the regulators have been in favor and have been kind of thrown back by the government's resistance so far. In fact, what did the governor say yesterday at the press conference when we asked him? He said somebody is already paying. It happens to be the taxpayer. Now the user should pay at some point in time. So it is very clear where the emotions of the regulator are. Amrish, are you privy to any such conversation? I mean, if NPCI or RBI has an informal conversation, I would assume you will also be included in it. Any moves at all?
But I'd be lying if I say that I'm completely out of it. So I have to say that for a long period of time, and just being a participant in this journey, we have been very keen to bring some sort of, monetization model. I just want to put some facts out there. Over the last 10 years, as consumers have gone through sea change when it comes to using UPI, almost 150,000 crores or 1.5 lakh crores has been invested in growing UPI transactions. And these investments have largely come out of fintechs and banks. Ramesh and Mahesh will agree with me today, but banks in India are today spending almost 10,000 crores every year to run their infrastructure related to UPI. Fintechs have been investing into it at a minimum about 5,000 crores a year to grow UPI transaction across the country. As we are all speaking on this panel, 1 lakh people are today on the street trying to grow UPI transactions in the country. Now, the way we are looking at it from an industry standpoint is that 1.5 lakh crores which have been invested over the last 10 years, let's keep it aside. But if we have to get growth back and significant growth back on the UPI transaction side, I think more investments have to come in here. I don't think so this is about profit or profiteering. I think it is much more about growth. And there are enough data points that we can bring growth back in if we have investments coming into this sector.
Okay, fair point. That's very strongly argued. Mahesh, I'm looking for numbers. The analysts have already built. They've already said how much Pine Labs will make if it is 2,000 crores, if it is 2,000 rupees. But have you all done any math internally? Above what level will your costs be borne? Like if it is 2,000 rupees minimum chargeable, 5,000 rupees minimum chargeable, any math at all that you need just to break even?
No, I think we know our costs, but at the end of the day, what is going to be important is
It is about how the distribution of these is going to take place, because one is to charge an MDR helps facilitate, in terms of better understanding of management of the risk, better management of the scale and the security associated with the scale that we are operating on. But I think at this moment, I don't think those make much sense because we know our costs. What is going to be important that we really need to work towards is how is the distribution, if at all, if it's charged, how is that going to be done? And hence, what is it that banks like us, banks like HDFC and others, or fintech players, what is that we're going to get out of it? And what does it make sense of it? I think that's going to be very important. So until then, I don't think we should conjecture because it's still some way out.
I agree.
But we should be hopeful that at the end of the day, a national capability that has been built and scaled is actually leads to better innovation and better stability and security. I think that's going to be the main important thing for us.
I like the two words you meant, stability and security. See, until now we were only wanting to spread electronic payment, but now suddenly things like Mythos are scaring us about cybersecurity. Ramesh, would you say that that is what has caused an acceptance of payment, because now the costs go up for simply cybersecurity?
Absolutely, Lata. Cybersecurity is going to be one of the key aspects because, like Mahesh mentioned, the costs of running the UPI has to be, accredited to the banks. I think it's very important. But and security is at the center stage of that. I mean, look, it's a very, very critical ecosystem. All of us have to protect it with all might. I mean, that's how I would like to put it. So clearly one aspect is around security, which came out. The other obviously is the resilience. I mean, see, earlier somebody would go to an ATM, let's say withdraw 5,000 rupees and he would do 100 transactions. But the core banking is taking only one transaction hit, right?
Yeah.
Today, look at it, that 5,000 rupees probably is resulting in 100 hits to the core banking. So the transaction per second on core banking has gone up. The hardware costs are very, very today. It's kind of linked to the supply chain vagaries today because of the AI, economy. So all of these aspects, security, resilience, they all have to come together. And then, I think the bank should at least recover the costs. That's the most critical aspect that I would like to bring out.
Fair point. And definitely on security. Imagine, Mythos-like attack. Where are we? So, we have to build our defenses. Amrish, now, before I move into the more macro question as to what are the possible innovations, which is what we want to hear from you, there is a Jefferies report which has already decided how much profit you will make. Assuming it is 2,000 rupees as the minimum threshold, they say your EBIT will go up by 9% and your profit by 23% by FY28. Any sanctity to this?
That's not how we think about it. And I'll be very transparent about it. The way I look at my business is we think that we are in a very, very early stage of a massive transformation where cash is being converted into electronic payments. As you get into electronic payments, for every 1 lakh crore of new spends happening on electronic payments, 0.5% gets added to the GDP. And this is not me making this up. There are economists and there are reports associated with all of this. I've been in this industry for more than 20 years. One thing I can tell you is right now is not the time for us to look at, are we going to be making X crores or are we going to recover, a certain amount of money? I think the importance piece is we've got to increase the pie. Brazil, China is today almost at about 90% acceptance when it comes to digital payments. India is today at 35%. I'll give you some statistic. The growth in UPI over the last 3 financial years has been at 60%, 40%, and now just below 30%. So there is clearly deceleration when it comes to UPI growth in the country. And really what we want to do is we want to continue to accelerate this because 35% of digital payment acceptance is not a good number for us. And we really need to increase that number. I want to add one last point to what Ramesh was saying out there. Let's not kid ourselves. Payments will become important when it comes to geopolitics. Yeah. When you look at UPI and our own sovereign payment systems, they have to be accepted not just in the country, but they also need to be accepted globally. Today, we can say we have a partnership with France and Singapore, But when I'm walking on the streets of France, I don't get to see UPI acceptance happening on the walking on the streets of France. Now, if that has to happen, we have to invest into it. When you look at China and China Union Pay, they have actually invested into acceptance of their payment, product in those markets. Now, who's going to do that? Where is the investment going to come from? So I don't think so. This 100 crores, 150 crores is significant because most of that will get plowed back to ensure that there is growth in this sector.
But Ramesh, let me get one round of what innovation do you think are low-hanging fruits if you all are paid for it? Anything that comes to the mind that can immediately be innovated if you all get some money?
There's a couple of things here. I think innovation has been happening. If you follow the GFF for last 3-4 years, every year there's been innovation that's come through UPI, whether it is the entire capital markets being driven by UPI now. Delegate UPI payments was a great innovation. Wallets was a very interesting, the UPI Lite was a very interesting innovation. I think we have to focus on getting them, the usage of on them to come through. I think that should be our focus. And that's why the investments are needed back here because frankly, look at something like a delegate payment. It's such a beautiful thing. I mean, I would definitely like to delegate something to my daughter and she can pay on her own without even having a bank account. It's a great innovation. But, we have to kind of drive this, make usage more, widespread, get merchants have to participate. I think MDR is also largely focused on the merchant. Look at the credit card ecosystem. So much of innovation happens today, Lata. Joint promotions, co-promotions. So I think there's a lot of opportunity to bring innovation back while even squeezing the existing innovation. I think it's a mix of both. And we're in a good spot. I think if we get it right in the next few months, I think this will set it right. Like Amrish and Mahesh pointed out, that 35% to 90% it should be our single-minded focus as we go.
Yeah, that 91% is actually a government going in and asking every taxi driver and Nariyalwala to take the payment. And many of them did after COVID. So, we should perhaps see that improve on its own with some government education. Amrish, we have to go into a break, but quickly, if you can think of one or two big innovations that can easily happen.
Two very quick ones. One, if you see B2B payments has not been addressed as yet. B2B payments is a very big sector. Huge amounts of money is flowing on that one. I think UPI can solve for B2B payment. That's one. Second is on agentic payments and AI-based agentic payments. Around the world, people are using stable coins. I think mandate-based UPI can play in the agentic payments world also.
Oh, absolutely.
And the SME sector. And the SME sector.
Yeah, go ahead, please.
No, I think the one area that Amrish said and struck me was also the SME sector, because the SME sector can be really catered in the B2B space. I think there's a huge opportunity there. Because that's where the innovation can really kick in, and that's a big area that India is focused on. And that's the growth market that we're all focused on.
Lata, just to point that out, there is an invoice-based payment today from Tally, and then you do the entire discounting. Somehow, that ecosystem hasn't taken off.
Absolutely.
I think what to do.
Absolutely. Actually, I'm forced to take a break. Welcome back to a very special Indianomics where we are discussing how will the world evolve if UPI is charged. I've been speaking with Amrish Rao of Pine Labs, Mahesh Ramamurthy of Yes Bank and Ramesh Lakshminarayanan of HDFC Bank. Gentlemen, thank you very much for your patience and for staying on. Ramesh, the charges that are being spoken about, and let us put it in perspective. Credit cards, which is a totally free market, there are no RBI controls on it. The merchant charges are between 2 and 3%. For debit cards, the charges are, I think, 1%. And there are some low category where there is an absolute amount. And for debit, now for UPI, what do you think is the resistance threshold? People are talking about 30 basis or 50 basis points, that is 0.5%. Will that be a major resistance from retailers and say other units?
Yeah, but I think we have to start somewhere. I think if you just start straight away to 100, I think it will kind of, it's something that's not good to my mind. I think start with small. I don't know what that number would be, but whatever that number, it should get the merchants to also feel comfortable saying, hey, look, this is in the interest of growing the business. Banks will suddenly get interested. All the fintech players will come into the play. We can innovate far better, like we discussed. And once you prove that, I think in a graded way, then we can see where the number goes. But at least start with a smaller number would be my at least thought process out here, so that you at least start somewhere. Today we are absolutely at zero.
Fair point. Amrish, the worry is that we would play into the hands of the multinationals. I mean, who has got the biggest platform today? Google Pay and Phone Pay. So if we start paying them, like let us assume it is 30 basis, and 10 basis goes to the banks on either side, and 10 basis to either Pine Labs or Google Pay or someone, we are probably, it's a foreign exchange drain. And also, our payments will be locked by big tech. Is that a worry?
I have to look at it slightly differently. First of all, what I would say is that the way any model of MDR comes about, it always favors the bank, because bank makes a very large investment in running the backend infrastructure operate, and a lion's share will always go to the bank, and that's a fair thing to do. Now, when it comes to these fintechs, and in our case where we've had fintechs which have ownership either through a VC structure or through direct ownership by global companies, I think that's exactly what we need to solve. We need more participants to come in out there. The way to look at this is not that we are going to make the incumbents bigger. We are actually going to bring in competition. We will have more players coming into this sector, and hence we will have market share which will become very well spread out. So in my head, today where there are, let's say, 3 or 4 participants which are actually growing the UPI acceptance, once MDR comes in, we'll have 10 of them. And once you have those 10, I think there'll be a sharing of the pool. So I'm not too worried on this topic.
Okay. Fair point. I mean, Mahesh, your point, as your take also on this question, do you think that if it is charged, I'll tell you the backstory to this. I believe there was a Reserve Bank of India deputy governor who was speaking to bankers on this issue of, you guys did not innovate and create a Google Pay or an Amazon Pay kind of platform, and now Google has taken away the game. He chided the bankers, and the bankers who were chided told me that, Google can have money to spend. We don't have money to bleed like that when it is not chargeable. So do you think that competition comes for PhonePe, Google Pay, Paytm, etc., if it is chargeable?
I think the opportunity, like Amrish was saying and Ramesh was also articulating too, is as you start to get some amount, whether it's a fraction, but given the volumes, it will start driving a good innovation. And the innovation, when it comes in, you will start to have a lot of our own fintechs, a lot of them getting more into payments, as well as trying to innovate in that. Now, whether the innovation happens in the front end with the support of the bank, how you can channelize the innovation, like, for example, even simple things like, for example, the front end for a phone pay or a Google Pay has far too many opportunities for them to cross leverage. Banks can use it for even acquisition, for much better. and you can have certain, say, credits, micro credits coming in far more better. So I think the opportunity lies as you start to expand the front end and the acceptance. And that is where the innovation will come in. And that innovation will itself drive more stickiness, and hence for the bank, it becomes an opportunity to drive more volumes. It all depends upon what is the cost payback that we get on it. And I'm sure that is holding back today. That will actually get freed up for better.
Oh.
And that will help actually accelerate more in the front end as well as the back end as combination.
Okay, I'm being told I'm out of time. Ramesh, therefore, a two-part question and hopefully quick answers. One, if MDR is imposed on UPI payments, do cards get a leg up? At the moment, we have been replacing card payments with UPI. That is one question. The other question is exactly what I asked Mahesh and Amrish. Do you think we will see a competitor to Google Pay, Phone Pay and Paytm once the chargeability comes?
No, I think on cards, Lata, look at RuPay. Hasn't it done well over last 2-3 years? Yes. Why are we thinking only on MasterCard, Visa card? I think this is very, very critical. I think the same, infrastructure rides on RuPay rides on the same infrastructure. There's much more to do out here. In fact, you will see RuPay as a serious competition to the multinationals, actually, the way we spoke about it.
Yeah.
So that's, to my mind, I think card system will also evolve along with UPI. So it's a great incentive for us to get back some money out here and push the credit card usage on RuPay as well. That's one point. The second, obviously, like I mentioned, the UPI ecosystem is far more complex, Lata. There are parts to it. It's not that the multinationals have just taken over. Many banks today have their own apps. I mean, HDFC has Pays app. Some of the other banks have their own apps. They would actually be very happy to push those apps. These are all homegrown inbuilt apps like fintech. So nothing, on the contrary, I think if we get some money back, we will be far more innovative in bringing on apps back to the table, like the discussion that happened. So my point here is that if banks can get something back, they can spend more, because banks' technology, unfortunately, is more widespread, right? It's not just about looking at the payment app, but something comes back, we will put far more effort on building these apps as well.
Absolutely. I think the biggest disservice done to RuPay was to have forced it to keep it free. Probably if it was charged, maybe it would have been an even more serious competitor. But to be fair, as you said, for that brief period when MasterCard was not able to spread because of those localization or other issues, RuPay stepped in so beautifully. I mean, we didn't even know the absence because we had another card to fall back on, and therefore, charging for UPI also will perhaps create more alternatives. Amrish, last word.
Look, I think what I'm going to say is that if through this policy move, if we can assure two simple things. One, if the rates are not to that level where the merchant passes those to the consumer, I think everybody will be happy in the ecosystem. And in my head, that number would be somewhere around 25 basis points, where merchant will not be so keen to pass this on to the consumer. So consumer will remain completely free of any new charges out there. That's one. And in the meantime, if we can create a monetization model so that banks and fintechs recover for the investments that they have made, let's say, which we are, as I said, it's almost about 15,000 crores on a yearly basis, I think we will create growth in the UPI ecosystem in India.
Okay. Unfortunately, out of time, but I think this is the start of a very important conversation. And I'll be inviting you and other fintech bank experts to see how this journey proceeds. It's absolutely vital for the development of not just the financial economic development of India, but the overall country's progress itself. Thank you very much, gentlemen, for a very fruitful start to this conversation. That's it on Indianomics.
Thank you.
Thanks for watching.
Good evening. Thanks for joining us on Business 360. I'm Shireen Bhan. The top stories that we're tracking for you this evening. Oil prices near the $85 mark after Iran reviews a draft plan that proposes permanent transit bans for the U.S. and Israeli vessels in the Hormuz Strait. President Trump claims the U.S. has unlimited supply of munitions, slams reports suggesting that he pulled up War Secretary Pete Hegseth over the depletion of missile stockpiles. Iran's chief negotiator accuses Trump of theater diplomacy. The Sensex and Nifty gained 1% in the first week of closing auction. The adjustments on Friday after the closing auction was the lowest this week. India's largest bank, SBI, beats estimates in Q1. Loan growth hits the highest level in nearly 4 years. Asset quality remains stable, even as provisions jump 75% sequentially and slippages rise 33%. Shares of NBFCs decline after the RBI releases draft rules imposing a ban on revolving credit. NBFCs can only offer term loan products under the proposed rules. Merchant discount rate on UPI transactions, if introduced in the future, applies only to merchants and not customers, says the finance minister. Adds a committee headed by the NPCI is yet to decide on imposing the MDR. Interim relief for Dabur. The Delhi High Court stays the food safety regulator's order imposing a ban on products with 100% pure claims on the label. Court says the FSSAI should have given Dabur a hearing before passing the order. Ransom-seeking hackers target dozens of U.S. private equity firms, including Blackstone, Bridgewater, Apollo, KKR, Bain Capital. Google reveals hackers designed at least 72 websites aimed at stealing passwords from employees of private equity firms. A U.S. judge orders Facebook parent Meta to pay $940 million for its failure to warn the public about the dangers posed by its platforms to children. This is the largest penalty on a social media company over child safety yet. Also on the show, CNBC TV 18 decodes the new bill that replaces 135-year-old legislation. As per the new bill, digital bank records can be admissible as evidence subject to conditions. Also, a bank official cannot be compelled to produce records in legal proceedings if the bank is not a party. Well, the top story this evening, there is no fresh breakthrough in the Iran-US talks yet as Tehran accuses Trump of quote-unquote theater diplomacy. Here are the latest developments. Oil prices near the $85 mark after Iran reviews a draft plan that proposes permanent transit bans for U.S. and Israeli vessels in the Hormuz Strait. Bloomberg reports that the deal includes a proposal on a transit fee structure as well. Now, according to ship tracker Kepler, 33 vessels transited this week compared to 50 a week ago. President Trump says he believes the war with Iran will soon be over, maintaining that Washington still has an unlimited supply of certain munitions. However, he admitted that inventories of others were limited without specifying the weapon category. Iran's top negotiator Ghalibaf hit out at President Trump, accusing the U.S. president of, and I quote, theater diplomacy on loop. Ghalibaf also alleged that Washington keeps switching from military threats to offers of negotiation and has termed it as a failed strategy. Meanwhile, militant group of Houthis claimed responsibility for a missile and drone attack against alleged Saudi-backed military mobilization in Yemen. 18 soldiers were killed. Saudi Arabia also alleged that the Houthis were behind an attack that left 11 civilians injured in the southern region. Here's President Trump on the status of negotiations with Iran.
We had oil down to less than $2 in many places like Iowa. Oil was down to, gasoline was down at numbers that people hadn't seen in years. $1.85, $1.95. So it passed Tuesday. I was in Iowa at a stop, and we had $1.95, another one, $1.85 a gallon. And we'll see those days pretty soon again, based on everything I see, as soon as the war ends. And I think it's going to end pretty soon. I don't think they can go much longer. I think we're doing very well. I just, I'm involved in the negotiation. I think we're doing fine.
Well, that's President Trump. Now, Saudi Arabia, Turkey and Pakistan will reportedly sign a joint defense agreement in Jeddah. The scope of each country's commitment remains unclear. Turkish President Erdogan and Pakistan's Prime Minister Shehbaz Sharif will meet with Saudi Crown Prince Mohammed bin Salman to sign the deal. The deal comes after nearly a year of negotiations. We will get you more details on that. President Zelensky has said that Ukraine has hit more oil facilities deep inside Russia in overnight attacks. The repeated strikes have reportedly caused fuel shortages in Russia. Kyiv has also targeted Russian online retailer Wildberries for the third straight week. This as Moscow continues a barrage of attacks that Ukraine's depleted air defenses are struggling to counter. Let's talk about the day's market action now. The Sensex and the Nifty gained 1% each in the first week of the closing auction session. The adjustments on Friday after the closing auction was the lowest this week. Prashant joins us now to explain to us what transpired in the market and what the implications of these new rules will be. End of week one for CAS, Prashant.
So this is the Nifty 50 and this is 1 week of CAS. There are 5 days there. We started with a 200-point gap in the first day, that is Monday. 184 to be precise, and we ended with a 13-point gap. So you can see that it has become better. Have volumes picked up in a huge way? Probably not, but the gap, I mean, I think as people get a hang of it and see, I think all of us basically are learning together, and as more and more people understand what's going on, what are the windows, the changing timing, the change in timings and all of that stuff, I mean, I think it's going to get better. The same thing with the Sensex as well quickly. And I think we ended with an 8-point change on the Sensex by the end of it, right? So look at the look at the Sensex between 315 and the closing auction discovered price in that sense. So just, I mean, if you look ahead in the sense of, okay, why don't we tackle this, right? So that is CAS, and I think from Monday itself, on the first day, the opinion has been that CAS is fine. This is global best practice, allows better price discovery, etc., for passive funds. And there are a couple of other reasons as well. But the problem has been options and what happens to, and you know, I posted on social media on Monday saying that, well, you know, what happened on Monday, and remember that 200-point gap on the Nifty, what if that had happened on an expiry day, it perhaps would have been a disaster. Monday options prices on the NSE did go a little berserk. And on Thursday, on the BSE expiry day, option prices also did go a little berserk. So, I mean, just to get this actually happened. This is a real example. This is the 79,300 call option yesterday. At 255, was trading at 60 rupees. I mean, going into expiry, I mean, the option basically expired worthless, obviously, but it still there was a buyer for that call at 120 rupees. So, and the only reason, of course, is, I mean, you know, some sort of fear psychosis or, I mean, what you want to call it, anticipation that perhaps prices are going to settle higher. The close, by the way, was below the 70. So, you know, this call, by the end of it, this was what, almost 400 points out of the money. So, you know, these kind of things have happened on, and I highlighted with an example on Tuesday as well. And this is, I think, this is the basic worry, you know. Volumes will pick up on the CAS session and there won't be that much of a difference. So this also perhaps will settle down. But this is what we saw on Tuesday and Thursday as well.
We saw a lot of deliberations happening within SEBI as well on this issue. So every view will be heard. But having said that, I will give you my personal view on the question that you asked. I don't think it makes sense for the following reasons. Remember, one of the reasons I told you is, ideally, I would like for the genuine participants, including arbitrageurs, including speculators, including people who are doing cash versus derivatives, etc., the basis between what you do in the cash market versus what the setting is in the derivative market should be as low as possible, including zero. In the old VWAP process, we did have a basis, because if you were trying to execute something in cash and against a setting in derivatives, you could run a basis risk. Here, if I'm long the futures and I want to consummate that in the cash market, I can just participate in cash, and the setting there and the setting here will exactly equalize, right? So I want that umbilical cord to remain, because that's the whole genesis of making sure that it's a liquid, vibrant market. If you break it up into pre-CAS, VWAP, and then CAS, and then derivative separate, mutual fund NAV separate, I suspect we'll be creating liquidity pools which don't talk to each other and creating more inefficiencies than less.
Well, 1 week of CAS. Now, back to earnings. State Bank of India reporting a strong set of numbers for the first quarter, beating estimates on all fronts. Net profit up over 10%. Net interest income has grown over 15%. The bank's credit growth has also climbed to a 15-quarter high. Ritu's here with more on the SBI numbers. Strong performance there, Ritu.
Well, SBI has delivered a solid first quarter, beating street estimates on both the top line and the bottom line. Net profits rising 10% year-on-year to more than 21,000 crores, despite having higher provisions. The core net interest income, that also grew 15% to almost 47,000 crore rupees, while the operating profits were also up 10% over the previous year. The other positive was margins. They surprised on the upside, improving 5 basis points to 2.86% against street expectations of a bit of a decline. Loan growth was also broad-based across retail, agriculture, SME, even corporate picking up. The RAM segment, which is retail, agri and MSME, that grew more than 18%, while the total advances rose to almost 18.6% year-on-year, which is the best performance from SBI in at least 15 quarters. Deposit growth was slower at 9.7%, and because of that wide gap, the credit deposit ratio has inched up sequentially to 74.2%. On asset quality, again, good news. SBI continues to report its best numbers in 2 decades. Gross NPAs improving to 1.47% and net NPAs down to 0.38%. But slippages did increase 28% sequentially to about 7359 crore rupees, but they were still 11% lower year on year. Now, this appears to be more of a seasonal trend that we've been seeing across the banking sector rather than any specific red flag for SBI. But importantly, recoveries and upgrades more than doubled sequentially for the bank, and that helped offset some of these higher slippages. Now, going ahead, the management is guiding for 14 to 15% credit growth, which is revised up from 13 to 15% earlier, and 10 to 11% deposit growth in the financial year, while expecting the margins to remain around that 3% mark.
Ritu, many thanks. Let's talk about Hindalco now, reporting a strong set of Q1 numbers as well. Standalone net profit has more than doubled in the quarter. Revenue up 26% on an annual basis. Hindalco said its aluminum upstream, aluminum downstream, copper and Novelis all delivered their highest ever quarterly EBITDA during the period. The company attributed its overall performance to favourable macroeconomic tailwinds, security and operational performance. Shares of NBFC stocks slipping in trade. This after the RBI proposed to bar most of these companies from offering revolving credit facilities. The central bank has proposed that NBFCs should offer only term loan products and should not provide revolving credit facilities. Under this, the restriction would not apply to NBFCs that have been specifically authorized by the RBI to issue credit cards. We told you first that it is now official. LIC CEO Doraiswamy says the government may not look at another offer for sale in the company for the next 2 years. Speaking to CNBC TV 18, the LIC chief added that there need not be an immediate offer coming from the government. Take a look.
Once the government was convinced, perhaps, on the possibility of a big issue going up, they decided to go with the green shoe. Originally, the issue was only 2.5% base with a 4% green shoe option. But the first day response itself was such that the government had the conviction that it should have the 4% green shoe also exercised. Now this gives enough time for the government for further dilution to 25%. We have now 5+ years available. So that advantage is there. So in my opinion, there need not be an immediate offer coming from the government.
And immediate is not for the next 2 to 3 years?
It may not be 2 to 3 years. It can be maybe 18 to 24 months.
Well, that's the LIC chief. Now, the Supreme Court has agreed to hear the centre's plea against the Bombay High Court's order striking down a one-time spectrum charge. Notice have been issued to Bharti Airtel and Vodafone Idea. The case arises from the government's 2012 decision to impose a one-time levy on spectrum held beyond 6.2 megahertz for the 2008-2012 period. Finance Minister Nirmala Sitharaman has clarified that the merchant discount rate will be levied on merchants and not on customers. This comes after Congress leader Jairam Ramesh claimed that the consumer will end up paying more for using UPI. Responding to Ramesh in a social media post, the Finance Minister said the purpose of MDR is to strengthen the digital payments ecosystem by enabling banks and fintech companies to invest in infra and innovation. Now, the Lok Sabha recently cleared a new bill that amends 135-year-old legislation on banking records. The new bill, among others, proposes that digital bank records will be admissible as evidence in legal proceedings, subject to conditions. Ritu joins us now to explain the contours of this new bill, what it changes and what the implications are. Ritu.
Well, the Lok Sabha has passed the Bankers' Books Evidence Bill 2026, which replaces a law that had been in place since 1891. Now, what this primarily changes is how bank records are treated as evidence in courts and in investigations. The biggest change is that the law now explicitly recognizes electronic and digital bank records as evidence and not only physical records. So the bill also says certified copies of bank records can continue to be used as far as legal proceedings are concerned, but banks cannot just simply produce any digital record. They'll have to certify that it was created, stored, or processed in the ordinary course of business, that it hasn't been tampered with, and is protected against any unauthorized changes and cyber risks. Now, the bill also protects bank officials from just being routinely summoned to court. They can now only be called if there is a special cause. For instance, if there is doubts about the authenticity of the record. Another key provision is that the bill applies to investigations as well as to court proceedings. So during an investigation, certain powers of the law can be exercised by an officer, but not below the rank of superintendent of police or another officer notified by the government. But importantly, the bill does not create any new power for the police to just freely access your banking records. It mainly changes who can exercise the procedural powers that are available under the Act during the investigation. So in summary, the bill modernizes this 135-year-old law for the digital banking era. It gives digital bank records clear legal recognition as evidence. And according to the industry people we've been spoken to, the bill only puts to paper what is already common practice.
All right, Ritu, many thanks for joining us. We'll head into a break, but up next, the US judge orders Facebook's parent Meta to pay $940 million for its failure to warn the public about the dangers posted by its platform to children. That and more when we return. In interim relief for Dabur, the Delhi High Court has stayed the food safety regulator's order imposing a ban on products with 100% pure claims on the labels. Ashmit joins us now with more details. Ashmit, what has the court said? What does this now mean for Dabur?
Well, for now, it means an interim relief. Dabur will not have to suffer under the FSSAI order, which had essentially barred claims of 100% pure, organic or nature that these brands often put on the packaging of the product. That is no longer something Dabur has to comply with. But mind you, that is an interim relief until the next date of hearing. Now, here's the broad contours of the case. On August 3rd, the FSSAI had passed an order barring these 100% claims, 100% pure, organic or natural. The FSSAI's rationale essentially was that these claims are ambiguous, are unverifiable, and importantly could potentially mislead customers. Now, this was challenged by Dabur before the Delhi High Court. Dabur raised multiple concerns. Number one, they said that the officer who passed such an order did not have the power to do so. Also going on to say that there was no show cause notice that was given to Dabur, there was no hearing that was given to Dabur, that these products are tested, verified, have been in the market for decades, and that any withdrawal order would mean that inventory worth over 150 crore rupees would have to be called back. Now, these concerns weighed on the minds of the Delhi High Court. The High Court said that prima facie such an order should not have been passed without at least giving a hearing to Dabur. So on the merit of that one argument alone, the High Court seeing it fit to grant an interim relief. Dabur, of course, is the recipient of that relief, but importantly, interim in nature. This will be as of till the next date of hearing. The High Court will resume hearing in this case on August 24th.
Many thanks for joining us. A quick check of some of the global headlines. We're tracking at least 7 people have died after a 14-year-old student opened fire in his home and school in Thailand's Bangkok. The student is believed to have shot dead his grandparents at home before opening fire in his school. He killed 5 teachers before taking his own life. This is the second school shooting in Thailand this year. Google's threat intelligence team has flagged a fresh wave of phone-based scams targeting finance companies. Hackers targeted employees on their personal mobile numbers, posing as internal IT help desk staff and talking to them into handing over login credentials. As per Reuters, the ransom group demanded anywhere between $750,000 to $3 million per victim. Google has not named any victim, but Reuters reports that Apollo, Bain Capital, Blackstone, Bridgewater are among the companies that were targeted. A New Mexico court has ordered Meta to pay an additional $567 million for its failure to warn the public about dangers that its platform posed to children. The ruling comes as part of a second phase of a landmark trial the social media giant lost in March. Rachna joins us now with the details. Rachna, significant blow for Meta.
Definitely. A New Mexico court has ordered Meta to pay $567 million to address harms to young people on Facebook and Instagram. Now, the money goes into a youth mental health fund. $420 million is ring-fenced for treatment services, with the rest covering awareness, prevention, screening and referral over 5 years. This is the phase 2 of a 2-part trial. In March, a jury found Meta liable on all counts after a 6-week hearing and awarded $375 million in civil penalties for 75,000 violations of the state's Unfair Practices Act. That takes the total to $942 million. New Mexico had sought $2.2 billion in the first phase. Now, the order goes beyond just money. Meta has been directed to delete accounts belonging to users under 13, along with the personal data collected from them. The state had pushed for curbs on addictive features and tighter age verification there. The court noted that federal privacy law under COPPA limits what it can order, because verifying age would itself require collecting data on children. The judge wrote that New Mexico is in a youth mental health crisis and that Meta's platforms are a significant contributing cause. The case was brought by Attorney General Raul Torres in 2023. He alleged Meta's platforms had become a breeding ground for child predators and that the company misled users about safety. Now, Meta has denied. It denied it then and is now contesting and trying to appeal. It says it remains confident in its record on teen safety and that the claims misrepresent the facts. No appeal has been filed so far, but Andy Stone has confirmed one. Now, this is among the first jury verdicts anywhere on platform child safety. And Meta faces thousands of similar suits across the US, which its own filing says seek damages in the tens of billions. So it could just be the first of many. So we'll have to see how it goes.
All right, Rachna, many thanks for joining us. With that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC TV 18. Stay tuned. We're back in a minute with more.
Hello and welcome to Startup Street. I'm Shruti Mishra and with me is Arundhati Ramanan. These are the top headlines from the startup space. Piper Serica has hit the first close of its 800 crore Bharat Tech Fund at 300 crore rupees just 45 days after launch. The deep tech focused fund will back Indian startups across AI, semiconductors, defense, space tech, robotics and advanced electronics.
D2C athleisure brand Bliss Club has raised 160 crore rupees in a funding round to expand its offline retail presence, strengthen product development and fuel its next phase of growth.
Wakefit reported a 17% jump in first quarter revenue to 405 crore rupees, while net profit rose 19% year-on-year to 23 crore rupees. The home and mattress brand said mattresses continued to be its largest revenue driver.
A U.S. judge orders Facebook's parent Meta to pay $940 million for its failure to warn the public about the dangers posed by its platforms to children. This is the largest penalty on a social media company over child safety just yet.
Nvidia has committed $500 million to Australian AI infrastructure startup Firmus. The deal nearly doubles Firmus's valuation to about $15.5 billion in just 4 months ahead of its planned IPO. Those were the headlines we've been tracking for you this evening on What's Brewing. Bliss Club has raised 160 crore rupees in a new funding round led by Singularity AMC with existing investors, Elevation Capital and 8 Roads Ventures doubling down. Founder Meenu Margaret and her partner Meesho's Vidit Atre are also investing significant personal capital in the round. The women's first brand has grown revenue at over 60% year-on-year for the past 2 years, expanded to more than 40 stores and has now entered menswear. Joining me now is Meenu Margaret, the founder of Bliss Club. Meenu, welcome to Startup Street. Like I mentioned earlier, you and Vidit have also put significant personal capital into this round led by Singularity AMC. Elevation and 8 Roads are doubling down. Is this a statement of conviction about where you believe Bliss Club can grow from here? And where will you deploy the fresh capital?
Hi, thank you for having me. Yeah, this is definitely a very, very special round for us, all at Bliss Club, and for me personally as well. I think, been building for the last 6 years and have built so much conviction on this category, which we're building into, which is just highly functional clothes that are supremely comfortable, building few products, building hero products, buying it deep, and getting the right value for the consumer. So yes, I think, very, very excited to have Singularity as our lead investor who's coming into this round. We've, been speaking to Singularity for a long time. But yeah, also very special with our existing investors backing us up. Both our seed and Series A investors have put in money and backed us up in this round. But all the more special because we as, I would say in some way, the promoter family is also going in. I think somewhere we thought that, we have so much conviction in this category, so much conviction in what we're building. And if we were to put in all our bets into something, it should be Bliss Club. So yeah, very, very special for us.
And you have grown revenue at over 60% year-on-year for the past 2 years. So let's put some numbers around the business. Where does revenue stand today? What's your current ARR and how are gross margins and profitability trending?
I think it's been a truly great couple of years for us. I think, like you said, we've grown more than 65% year-on-year. We closed FY26 at close to 200 crores. And I think the incredible job done is growing top line while improving profitability for us. So we're close to break even now. Have kind of operated both top line and bottom line growth together. And I think that's been, an incredible journey for us while taking some large bets in women's and men's, as you said, that we've launched earlier this year.
Absolutely. And, Meenu, Bliss Club started as a digital-first women's activewear brand, but now has more than 40 stores. So what's driving the offline push and how do how do store economics compare with D2C and how large do you expect the retail network to become over the next couple of years?
I think, fundamentally what differentiates us really is the fabric. And that's something that is a true moat for the business that we've built out over the last 6 years. So we work directly with our mills. We have our fabric engineers. We control the quality, the cost, the feel, everything about the fabric. And I think going offline means that you can truly feel the fabric, truly get an understanding of the fit. And I think core differentiator for Bliss Club with Fabric is just the fact that we build hero products. We, even as of today, have 30 products, and in that, 15, 20 products that does 80% of the business. So the idea is to build few products, build it very differentially, and go deep while solving problems for the consumer. So we do think that offline is a channel which helps us really communicate the differentiation both in terms of fabric and fit very, very strongly. We've seen some incredible year-on-year growth in offline, upwards of 30% for mature same-store growth, same-store sales growth year-on-year. And so we're really, really excited about what offline means for us. And that's what we're also going to be doubling down over the next few years.
Okay, you're looking at doubling down your offline network, but your original proposition, was activewear designed specifically for Indian women, Indian body types, climate and price points. But global brands, Meenu, such as Nike, Adidas and Lululemon are expanding in India, while domestic players are also chasing the opportunity. While you just said that, fabric is your biggest moat, do you believe, product innovation, pricing, community or distribution will play a larger role in sort of differentiating when these brands, in terms of competing with them?
Yeah, no, I think as of yesterday, Skims is entering India as well. And honestly, very excited for the category to build out in front of us. But I think the true differentiation that Bliss Club comes with the fact that we are a bunch of people obsessing about solving for India. Be it Indian climates, be it Indian body types, be it Indian, pear-shaped bodies. This is exactly what we're building for. And I don't think any global player is going so deep to build into it. Just yesterday, we had our denims launch. We're calling it Zenims. These are jeans and denims built for the Indian humidity and the Indian pear-shaped bodies of women. I don't think anyone is going to go so deep and really solve for our country as deeply. And I think that's where the opportunity really lies for us. And product and product differentiation in terms of innovation on fabrics and fits remains singularly the thing that we will focus on and build very deeply into as well.
All right. So you said you've just launched denims and this year you entered menswear. What kind of demand are you seeing there and how large can menswear become for Bliss Club? And any other category you plan to enter into anytime soon?
I think the common thread between everything that we're building out is the fact that we think the world is moving towards an active lifestyle. The fact that, movement is no longer just restricted to the gym, but people are getting really conscious about movement and really bringing movement to their daily lives, be it in terms of, climbing steps, walking to your workplace, dropping your kids to the school bus, but really inculcating movement in everyday life. And hence, the categories that we build out is really figuring out how do we build for all stages and parts of her day. And anytime that she's moving, we want to build the most functional and comfortable clothes for her and now him. But really the idea being that while we build for men, while we build for movement, we will go and build across all categories of movement that they're looking out for. So that's broadly the product thesis. And so everything that we've launched, be it in terms of men's earlier this year, be it in terms of denims, that's what we're really going after.
Okay, Meenu, you and Vidit are both building consumer internet businesses at very different scales and in very different categories. How much shop talk happens at home and what's the one lesson from this journey building Meesho that has most influenced the way you're building Bliss Club?
I'd be very honest, I think a lot of shop talk, I think most of our conversations really does revolve around this, but it really doesn't feel like work. It just feels like us discussing something that we're really, really passionate about. And I think even our investment into Bliss Club is really a sign of just how we feel. And we both derive so much joy from our work and from the missions that both of us individually have in terms of the work that we're doing, obviously building for very different demographic users. But a lot of learnings, of course. I think if I were to look back and think about the one thing that I really learned from Meesho is just what it takes, the journey and just the thick skin you have to build, the grit you have to just keep going. And, there's so much noise around you, but you just got to keep your head down and keep. And yeah, I think that's been for me one of the most exciting parts of seeing with it.
Okay. All right. One final question before I let you go. Going global, are you eyeing international markets anytime soon?
No, I think at some point of time, for sure. I think we'd be so proud to build the kind of innovation we're building for India and take it global. For a long time, as a kid and as a lot of Indian consumers, we've waited for global brands to come to India. We hope that at some point of time, there are a bunch of Americans waiting for an Indian brand to go global, and hopefully that's Bliss Club.
Okay, all right. We hope that too. Meenu, many thanks for joining us on Startup Street. Wish you the very best. Thank you so much.
Thank you so much. Thanks for having me.
As digital payments become a commodity, fintechs are looking beyond transactions to drive their next phase of growth. Mintok, which builds payments technology for banks, has acquired Dubai-based ICICI Loyalty in a deal that expands its presence across the Middle East, Africa and Eastern Europe. The company says the acquisition will help banks move beyond payments to offer loyalty, rewards and a personalized customer engagement through a single platform. So what does this mean for Mintok's global ambitions and the evolving fintech landscape? Let's ask Raman Kanduja, the co-founder and CEO of Mintok. Raman, thank you so much for taking time out and being here with us on Startup Street. You know, you have built payments OS for banks, right? Why was loyalty sort of what you felt like was the missing piece, and why acquire instead of sort of build internally?
Great question. And firstly, thank you for having me on your show again. See, we've always believed that the future of payments is not about processing transactions. It's what happens after the transaction is done in terms of engaging the merchant or the customer and monetizing that engagement. And that's the belief we started when we built Mintok. Over the last few years, we've created a platform that helps banks strengthen their SME relationships by converting their payment acceptance into a business growth platform. The playbook has evolved quite nicely for us. Today, we power the merchant platform for 3 of the largest banking players in India, which is HDFC Bank, Axis Bank, SBI Payments. And we are starting to see some interesting green shoots in Africa, Middle East as we expand. Now, as we were thinking about our next phase of growth, we wanted to diversify. And diversification for us meant 2 dimensions. One was geographic dimension, where we wanted to strengthen our presence outside India. And second we were looking at adjacencies within payment, but relying on the core thesis that the value still has to be in software and value-added services rather than transaction processing. And that's where we looked at multiple options, and IC finally zeroed in on ICC. They do loyalty processing. Why loyalty? Very similar to how we complement payment processing to add value in terms of engagement and monetization. They do that similarly on the other side of the payment transaction, which is consumers. So they solve for loyalty for consumers. They also complement processing. They also work with banks. To your last question on why.
Mr. Raman, we seem to have lost that connection there with you, but I think we just got you back. You were answering the question on why this was important. If you could tell us quickly.
So the thesis is the same. They are also complementing processing. We are also complementing processing. They also work with banks. We also work with banks. We both believe that banks are uniquely positioned to win in the digital era, given they've already built trust and distribution. What they're lacking is nimble tech, which is what we are providing. You also asked me, like, why acquire and why not build? See, building in today's day and age is very easy, and it's getting easier. It's getting the distribution, getting those bank relationships, that's a tougher part, and which is where ICC has built a fantastic franchise in the Middle East.
Absolutely, and we're running out of time, so if I could quickly ask you the next question. How much was this deal valued at, and how did you fund it? Was it internally funded, or did you raise funds to fund the acquisition?
So both parties, for some reasons, agreed to not to disclose the contours of the deal. But let me just say that both parties came out smiling. It's a significant deal. I'll just give you some numbers for ICC. They finished their last year with $16 million of revenue and $4 million of profit. You can assess in terms of the multiples that are prevailing around. It was a significant deal. This was largely funded out of our own balance sheet. We took a small debt, small leverage, but as I said, we've been profitable for the last 5 years, and we used our cash reserves to fund this deal.
Absolutely. So you've answered the questions on the deal contours, and both parties came out smiling. Now, the acquisition, as you were pointing out, significantly expands your presence across the Middle East, Africa, and Eastern Europe, right? Which markets are the biggest growth opportunity for you over the next 3 years?
So as I was saying, they built a solid franchise in the Middle East, but we still see some very significant headroom in the Middle East and Africa, and those will be the focus markets. We will also be venturing into Southeast Asia markets. These are markets that are looking to emulate India, but in various stages of maturity. So these are like big strategic opportunities that we are currently going to focus on.
All right, so that's what you're going to focus on. And this acquisition will take your annual revenue past $30 million with over 30% profitability, right? Does this sort of change Minto's roadmap towards IPO or larger global expansion?
I would say we are getting ready for it, but now is not the time. It is still some time away.
Still some time away, and now is not the time, is what you're saying. How soon? When is that time away for you to probably consider it?
We've just acquired. We need to strengthen this acquisition, work on stabilizing this over the next 2 years. After that, we'll start thinking.
And speaking about the acquisition, what are the priorities over the next 12 months to ensure that this merger delivers the synergies that you're targeting for both your banking clients and your shareholders?
So the good thing is we are very complementary businesses working on two sides of the same transaction, customer and merchant, both doing well. It just allows us now an opportunity to take a consolidated offering to banks to be able to, as I said, the future is not about processing, but more about what the software riding on top of processing can do. Now we saw, as we sit on both sides of the transaction, every payment transaction generates data, which are signals, which is what we leverage to orchestrate engagement, loyalty, monetization, and which is what we are looking to deliver for our banks going forward. Payments processing is commoditized, but it's a necessary commodity. It's like the railroads. They are required, but railroads don't provide customer experience. And that's what we are doing, sitting on top as a software layer over those processing railroads to help banks drive their monetization and engagement for merchants and customers.
Absolutely. All right, Raman, thank you so much for joining us on the show again, and we wish you all the best on your journey.
Thank you so much for having me once again. Thank you.
Well, with that, it's time for us to head into a short break. But coming up, Bangalore-based ice cream Polar Bear crosses 200 stores, remains bootstrapped. We check in with the firm to find out more. Stay tuned.
Welcome back. You're still with us on Startup Street. Bangalore-based ice cream chain Polar Bear is charting a rare path in India's consumer startup ecosystem. Despite crossing the 200-store milestone, the company remains entirely bootstrapped and has ruled out private equity funding or an IPO for now. Founder Kishore Kumar Rai speaks to Meghna Sen about the company's expansion plans, store economics, and why it's choosing profitability over external capital. Take a look.
India's organized ice cream market is becoming increasingly competitive, with both legacy brands and new age players chasing the same consumer. Amid that, one Bangalore headquartered company has quietly expanded to 200 outlets across 6 states without raising a single rupee of external capital. Building a consumer brand is one thing, but scaling it while protecting profitability is another. Today, we are at a Polar Bear ice cream outlet to understand the business model driving that growth.
Hi, Meghna. How are you?
Hi, I'm good. How are you doing?
Very good. We started in 2008, we started our first store in ITPL 2008. We were in the business already. We started our business journey in 2002. We were already mainstream manufacturers. So we didn't have reasonable money. And the moment we started this business, it became profitable from the beginning. So we didn't have to look for external funding. And this business is always cash positive.
Let's move to the store economics. So say if you want to open a Polar Bear outlet tomorrow, so what's the typical investment required to open an outlet? What's your average revenue run rate, say annually? And once the store becomes operational, how long does it take to get break even?
Okay, I'll answer one by one. To set up a store, it takes about, with the current investment, it takes about 50 to 60 lakhs, depending on the size. A store size varies between 600 to, ideal size is 600 to 800. Sometimes we have to go for based on the availability, we go up to 1000 square feet, 1200 square feet, adjust with 500. But investment varies between 50 to 60 lakhs. Any outlet, it starts becoming cash positive from the day one. It breaks even from the day one. If it does. Some outlets, very few outlets, gradually it picks up. We say our recovery period to recover the investment that we have done, that 50 to 60 lakhs, it varies between 18 to 24 months.
Right.
Our average sale per store is always varies between 1.8 to 2. There are many outlets, almost 30-40% of the outlet, it does much beyond that. And almost 40 to 80%, it recovers in 18 to 24 months. Very few outlet, it takes longer period, probably 3 years or 3.5 years to recover this thing, based on the locality and all that.
What is the store count that you're targeting, say by the end of FY27, and what kind of capital would you require for that expansion?
We run a hybrid model, it is a combination of company owned and franchise model. For a franchisee outlet, we don't need money. In fact, we get the money back by the way of franchise fee, this thing. If it is only for the company outlet, we need the investment of 50 to this thing. Now, say for example, if we are opening about 100 outlets this year, we are planning to open about 70 stores this year. Out of that 50%, if it is going to be a company outlet, 35 divided into 50 lakhs, which is about 17-18 crores. That anyway we generate within our business.
One metric that is closely tracked is same-store sales growth. So how has that been for you?
We have been doing extremely good. Last 5 years, average of 20% year on year, we have been growing on the same store.
Okay.
That's a good sign. I feel there is still scope for further consolidation through innovation, through better customer service. I think we can continue to grow with the same pace for next 5 years.
Can you walk us through your business model? Like how are you growing in terms of revenue, and as you're scaling your business, where does profitability stand? Also, what are your EBITDA margin target going ahead?
See, at a brand level, we have been growing anywhere between 40 to 60% historically in last 5 years, post-COVID, I would say. This year at a brand level, we should touch a top line brand level turnover of about 400 crores. That is what we are estimating to achieve.
At a company level, EBITDA level, always we achieve about 15% EBITDA.
It is Friday and it's time to take stock of all the deals from the startup space. This week saw a total of 27 deals worth $339 million. According to Venture Intelligence, some of the notable deals include electric scooter maker River raising $102 million from 361, Aniket Capital, Yamaha Motor Ventures and others. Sarvam AI also raised $74 million from Gaja Capital, Indigo Ventures and others, while InsurTech startup InRisk Labs secured $29 million in a Series A round from Bessemer and Northpoint Capital.
And that's not all. Women's activewear brand Bliss Club raised $16 million from 8 Roads Ventures, Elevation Capital, Singularity AMC and others, while wealth tech startup Stable Money raised $14 million from Fundamentum, Peak 15 Partners, RTP Global and Z47. According to Venture Intelligence, 2026 so far has seen 566 deals worth more than $5 billion.
Well, with that, it's a wrap from me, Shruti and Arundhati. On this edition of Startup Street, more news and updates continue on CNBC TV 18.
Hello and welcome. You're watching Global Lens with me, Archana Solanki. Let's start bulletin with some top stories. Former Pakistani Prime Minister Imran Khan remains one of the country's most prominent political figures, even from prison. This is what his supporters claim. August 5th marked 3 years since his imprisonment. Thousands of supporters from his Pakistan Tehreek-e-Insaf party held demonstrations nationwide demanding his release, and more than 100 people were arrested. 73-year-old Khan led Pakistan from 2018 to April 2022 when he was ousted in a no-confidence vote. He claimed it was a military-backed conspiracy involving the US, but both US and Pakistani military deny this allegation. Imran Khan was first detained in May 2023 and later imprisoned in August on corruption and state secrets charges. Since then, Khan and his wife Bushra Bibi have been convicted in multiple cases. Authorities cracked down on PTI, arresting top leaders and barring the party from the 2024 elections. Imran Khan is now serving 14 years for corruption, while his wife is serving 7 in the same case. In December, both received an additional 17 years in a case involving state gifts. Now, PTI has called the charges politically motivated, but Prime Minister Shehbaz Sharif's government has rejected these allegations. Amnesty International is urging Pakistan to uphold Khan's rights, citing prolonged solitary confinement and restricted medical access. Speaking to CNN from London, Imran Khan's sons, Qasim and Suleiman, say that they haven't been allowed to see their father in 7 months and fear for his health. His sons also claim that each time they speak to the media, Pakistani authorities make it harder for them to see him, either by delaying their visas or through other administrative issues. However, when CNN reached out to Pakistan's government, it denied any communications blackout. Now, Islamabad has said that Khan has repeated and substantial access to family, lawyers and doctors and is housed in a 7-cell compound built for up to 35 inmates. Now, Pakistan has tightened the screws on foreign media. It has imposed new restrictions under which foreign journalists and Pakistani reporters working for international outlets will need the government's permission to report from most parts of the country. The journalists won't need clearance for Islamabad, Karachi and Lahore. The move comes after, they will of course now need this clearance, and the move comes after deadly protests in Pakistan-occupied Kashmir, where international media covered the violence despite communication restrictions. Now, Pakistan even restricted access to Al Jazeera's website following its reports. Now, from one neighbor to another, Bangladesh's former cricket captain and Awami League leader Shakib Al Hasan's house came under attack on Wednesday, just hours after former Prime Minister Sheikh Hasina held a virtual press conference in New Delhi on the second anniversary of her ouster. Now, reports suggest a group of people threw bricks and stones before attempting to set his property ablaze. A voice note sent by Hassan was briefly played at the event. He joined the event later but did not speak. Meanwhile, Bangladesh expressed outrage after Hasina's virtual event. Dhaka accused India of allowing, and I quote, an absconding convicted mass murderer to use its territory to launch venomous vitriol. End of quote. Now, India's Ministry of External Affairs had earlier said the event did not have any involvement from the Indian government. Listen in.
The interaction that you are referring to is being organized by a private media entity. The government has no involvement whatsoever in it. Neither does it endorse any views that may be expressed at the forum.
US President Donald Trump has denied reports that the US is running low on some munitions. In a social media post, the US president maintained that large amounts of munitions are being manufactured and shipped to the US as needed. Trump warned, and I quote, leakers of such statements are being hunted down, end of quote. Addressing an event in Las Vegas, Trump said he would rather make a deal with Iran than kill people. US Vice President J.D. Vance told Fox News that negotiations will be messy and will take some time. Tehran has signaled progress towards reaching an understanding on the Strait of Hormuz with Oman. Reuters reported the countries are closer to finalizing a joint statement. The statement reportedly maintains that third parties should not interfere and suggests that the proposed deal would give Iran control over ships entering the Gulf through the strait. Here's the US president on the ongoing talks with Iran.
I'd rather make a deal because I don't want to kill people. I do not want to kill people. But at some point we're gonna. We were set for the biggest attack of any attack, and we've hit them very hard for the last few months. But we were all set for the biggest attack since World War II. And they called me and they said, please don't do it, let's talk. And then they said, we never said that. You know what? The fake news knows they did say that, but we are talking. Let's see what happens. But they respect us. They respect us.
Ukraine has struck 2 Russian oil refineries hundreds of kilometers from the border in an overnight attack. Russia's defense ministry said it downed 605 Ukrainian drones. This as Russia hit a train station and commercial ship in Ukraine. Both sides have stepped up long-range attacks in recent months, leading to a rise in civilian deaths. A severe heat wave is sweeping across parts of Asia and Europe, with record temperatures triggering health alerts, emergency measures and straining power infrastructure. Italy has placed all 27 major cities under its highest heat alert as temperatures continue to soar. Now, Hungary has also introduced energy-saving measures, switching off lights at several iconic landmarks, including parts of Budapest. In South Korea, Seoul is expected to see temperatures touch 39 degrees Celsius as the country braces for the peak of the heat wave. The extreme heat has been linked to more than 20 deaths, with authorities warning of growing health risks. Officials are also deploying drones equipped with thermal cameras and loudspeakers to warn elderly farmers to take breaks, stay hydrated, and avoid working during peak heat. Meanwhile, drought conditions have pushed water levels in the Danube River to record lows. In Romania, authorities are working to protect the country's only operating nuclear power plant using rock-filled barges to divert water for reactor cooling after one reactor was taken offline for maintenance, raising concerns over power supplies. Scientists continue to warn that climate change is making extreme heat waves more frequent, longer lasting and more intense. Now, El Nino is hurting crops across the world, but for Indonesia's salt farmers, it has been a boon. The prolonged dry spell has boosted salt production by speeding up evaporation, offering farmers the prospect of a bigger harvest. Here's a report.
For us, El Nino is a blessing and a grace. It is something we should be grateful for.
The drier, hotter conditions caused by the El Nino phenomenon usually mean bad news for farming, but not for salt farmers in Indonesia's West Java province, who wish it would return every year. As most of Indonesia's salt production is still done traditionally, farmers heavily rely on heat to evaporate seawater in shallow coastal ponds. They then scrape the crystallized salt from the pond floors and collect it in piles. Even brief rainfall can interrupt the process, which is why the El Nino-driven dry season has been highly beneficial for salt farming. An official at the Cirebon Regency Food Security and Fisheries Agency said salt production had surged compared with the same period last year.
In the same month last year, it was slightly lower at 30 to 25 metric tons. Yes, it is already hitting 600 tons, so the drought is likely to continue in August to October. But hopefully it will prolong to September to November, and then the possibility of a more abundant harvest will be higher.
During the El Nino period in 2023, national salt production reached 2.5 million tons, a far cry from last year's output of 1 million tons, which was hit by a shorter than usual dry season and wetter La Nina conditions. The Indonesian Weather Agency has warned that the El Nino will persist into early 2027. The news comes to the detriment of the country's crop farmers, who have been advised to adjust their planting schedules and farming activities. But despite having to endure El Nino's baking heat in the fields, salt farmer Darminto looks forward to the chance of making a better living.
My hope is that the drought will last longer, so that I can get more money, store enough salt, and meet my daily needs. If the salt season is short, what else can I do? I'm just a laborer.
81 years ago today, in a matter of seconds, an entire city was wiped out. The atomic bombing of Hiroshima not only changed the course of World War II, it changed the course of human history. So today in history, on August 6, 1945, the US B-29 bomber Enola Gay dropped the uranium bomb, codenamed Little Boy, over Hiroshima. It detonated about 600 meters above the city, killing an estimated 70,000 to 80,000 people instantly. By the end of the year, the death toll had risen to around 140,000 as thousands succumbed to burns, injuries, and radiation exposure. 3 days later, a second atomic bomb destroyed Nagasaki. Within a week, Japan surrendered, bringing the Second World War to an end. Today, thousands gathered at the Hiroshima Peace Memorial Park to ensure that memory is never lost. Around 50,000 people from 123 countries and regions, including atomic bomb survivors, observed a moment of silence as the peace bell rang across the city. Prime Minister of Japan, Sanae Takeshi, reaffirmed Japan's commitment to its 3 non-nuclear principles and pledged to work towards a world without nuclear weapons and lasting peace. Hiroshima Mayor Kazumi Matsui also called on world leaders to eliminate nuclear weapons.
The devastation wrought by the atomic bombings of Hiroshima and Nagasaki, and the indescribable suffering endured by so many people, must never be repeated. Japan firmly upholds the 3 non-nuclear principles, and as the only nation to have suffered atomic bombings in war, it bears the responsibility of tirelessly pursuing the realization of a world without nuclear weapons.
All right, on that note, we'll take a short break. News and updates continue right here. Welcome back to Global Lens. The next story is going to sound like the plot of a crime drama, but it might be a real and growing concern in Russia. Marry a soldier, wait for him to die in combat and collect the payout. A CNN report reveals that Russian soldiers have become the target of alleged marriage scandals. Local media has termed the disturbing wartime trend the Black Widow scam. Here's what is behind it. Now, Russian military compensation rules say the family of next of kin of a soldier killed in combat is entitled to a lump sum payment. It starts at about 5 million rubles, which translates to nearly 60 lakh rupees. According to the CNN report, in some cases, additional regional benefits are given over and above the compensation. As of a consequence of the rules, Russian lawmakers have alleged some women seem to be exploiting the scheme. They're allegedly entering into marriages with soldiers shortly after the deployment or when they are severely injured. If the soldier dies in combat, the surviving spouse becomes the legal beneficiary. The trend has sparked public debate. Just last year, a nurse working in a Russian military hospital was fired after being accused of collecting the benefits after marrying 5 soldiers in her care, just before they succumbed to their injuries. Now, this means they were practically on their deathbed. One lawmaker pointed out that such crimes are now reaching serious proportions. Calls for a crackdown have grown louder following the economic impact of the Russia-Ukraine war. Now, when Russia's invasion began in 2022, the Kremlin encouraged defense personnel to get married to bolster family support. According to NATO estimates, nearly 5 lakh Russian soldiers have been killed since the war began 4 years ago. All right, in a major test of the Democratic Party's direction, progressive candidate Abdul El-Sayed has won the Democratic Senate primary in Michigan, defeating moderate Congresswoman Hallie Stevens. Now, El-Sayed was backed by Senators Bernie Sanders and Elizabeth Warren. Hours after the result, U.S. President Donald Trump called El-Sayed a hateful communist, saying the Democratic Party was moving further to the left. So what does this result mean for the Democrats and Republicans ahead of the midterm elections? Here's a report.
My hope is that our democracy will never be the same.
After an election night cliffhanger, Abdul El-Sayed was eventually declared the winner of the Democratic Party's U.S. Senate nomination contest in Michigan, an important U.S. swing state that President Donald Trump carried in 2024. So who is this progressive newcomer who beat out a more moderate candidate? El-Sayed is a doctor whose campaign focused on health care, the economy, and an end to unconditional military aid to Israel. He'll be facing off against Republican Mike Rogers in November's midterm elections, a former congressman backed by President Trump.
I know not everybody's going to agree with me on everything. That's not how this works. But I do know that they agree with me on the need to beat Mike Rogers and the need to hold Donald Trump accountable and the need to stop fighting stupid wars we should never be fighting.
According to the state party chairman, the contest to replace retiring Democratic Senator Gary Peters had the highest turnout in the history of Michigan's Democratic primaries. So what's the impact of El-Sayed's victory? Reuters video journalist Eric Cox has more.
Analysts say this result signals that a progressive working-class message is striking a real chord with voters. Many voters tell me they're looking for change in the Democratic Party, putting health care for all and taking on corporate influences as front and center initiatives. The war in Gaza and U.S. policy toward Israel also became defining issues in this race.
My name is not the reason you can't afford your groceries. You know what it is? Their BS policies.
Now the focus shifts to November's midterms. Michigan is a must-win battleground state, and the Democratic Party must stand together if they have any hope of holding on to this critical Senate seat.
Even if Democrats manage to hold that Senate seat in another competitive Democratic-held seat in Georgia, they would need to flip at least 4 Republican-held seats to gain control of that legislative chamber. But some see that within reach, as Donald Trump's approval rating lingers near all-time lows. And Reuters polling show U.S. voters now rank Democrats slightly above Republicans on managing the economy.
All right, let's talk about another interesting story that's in the headlines. So the question is, why are lettuce, avocados and jalapenos suddenly making headlines? Now, there's one common link, and it's Mexico. Now, a salmonella outbreak potentially linked to imported jalapeno peppers from Mexico has sickened more than 345 people across 27 U.S. states. At least 36 hospitalizations have been reported. No deaths have been recorded. The FDA has traced the outbreak to jalapenos grown in Sinaloa, Mexico. Separately, health officials are also investigating an illness outbreak linked to lettuce served at Taco Bell restaurants. Investigators have traced the lettuce to operations run by Taylor Farms in central Mexico. The investigation now spans 15 U.S. states with more than 6,000 cases, nearly 300 hospitalizations and 2 deaths reported. Meanwhile, avocados been in focus after U.S. recently suspended export inspections in a Mexican state, citing an unspecified threat to American interests. Now, these inspections are mandatory before avocados can enter the U.S., meaning the suspension could delay exports. The move has raised concerns over supply disruptions and potential price increases. Now, U.S. President Donald Trump held frequent conversations with Fed Chair Kevin Warsh after he took office in May. According to a Wall Street Journal report, the report says the two discussed a range of issues, including the economic impact of the West Asia war and the rise of artificial intelligence. People familiar with the conversation said they did not discuss interest rates, avoiding a direct breach of the Fed's independence. The Warsh is also said to have expressed a generally positive view of the U.S. economy. The relationship stands in sharp contrast to Trump's frequent public clashes with former Fed Chair Jerome Powell, whom he repeatedly criticized and threatened to remove over his interest rate decisions. Now, Google parent Alphabet has announced a major leadership reshuffle in its AI business, with Google DeepMind CEO Demis Hassabis taking on the new role of Alphabet's chief scientist while continuing as chairman of DeepMind. Now, the reorganization also includes the exit of several senior Gemini AI leaders, including veteran engineer Jeff Dean, as Google looks to strengthen its AI strategy amid intense competition from OpenAI and Anthropic. Now, the shakeup comes as Google has yet to release its next-generation flagship Gemini model, adding to questions over its AI momentum. Now, Hassabis had spoken to CNBC in December 2025 about the intense competition in the tech space. Listen in.
It's a ferocious competitive environment at the moment. I mean, many people who are telling me, you know, being in tech for 20, 30 years say it's the most intense environment they've ever seen, perhaps, you know, ever in the technology industry. And you know, all the, I guess, most capable players, whether it's individual, you know, tech titans or big tech companies or the best startups, they're all involved in this space now, because I think everyone has understood what we've known for 20 plus years now, that this is really the most important technology. So that's sort of to be expected, but it's tough, but it's also exciting. You know, I love competition, fortunately. In fact, many ways I live for competition.
All right, let's talk about earnings now. SoftBank's first quarter profits beat market expectations on the back of the gains from its stakes in Intel and ByteDance. Its profit of $2.2 billion beat estimates, even though it's 18% lower than the previous year. SoftBank booked a gain of around $8.5 billion on the shares it owns in Intel. Meanwhile, its stake in TikTok owner ByteDance rose by $2.2 billion, offsetting declines in PayPal. Now, Meta has launched Muse Code, an AI-powered coding tool designed to help developers write and debug software. The tool is powered by Meta's latest AI model, Muse Spark 1.2, and can generate code, verify results, and handle complex coding projects using multiple AI sub-agents simultaneously. Now, Muse Code also maintains a log of its own actions, allowing it to resume tasks after interruptions. In the world of sports now, FIFA's governing body throws its weight behind embattled President Infantino. FIFA says a letterhead had been sent to member associations sincerely apologizing for the errors. Matthew Thomas has more. Matthew.
After 7 hours of crisis talks in Rabat, FIFA's top brass has reconfirmed its support for President Gianni Infantino. The meeting came days after FIFA's decision to scrap its controversial World Cup investment plan following widespread backlash. In an official statement issued after the meeting, FIFA said its management board had unanimously backed Infantino's leadership. Members of the FIFA Management Board include the head of finance, legal head, and other heads of FIFA's operations. It must be noted that this board does not include any member nations. Secretary General Matthias Grafstrom, who earlier described the past week as a sad and reproachable series of events, was also present at this meeting. FIFA also apologized to member nations in a separate letter. The letter, which has now been leaked, has been signed by Grafstrom and Infantino. FIFA said it did not intend for its member association and the council to feel excluded from the process. The governing body acknowledged that mistakes were made in the process of the proposed establishment of FFE. It also said that errors were made after it was leaked to the media. FIFA promised to review the process and a report will be presented at the next FIFA Council meeting. The letter then states that FIFA's top management is fully confident that the outcome of today's meeting will help restore confidence in the organization. This after a whole host of European football associations have withdrawn their support for Infantino's re-election. In its official statement, FIFA has now drawn a line under the episode. The investment proposal has now been formally withdrawn, and the organization has threatened that it will no longer tolerate any attacks on its integrity. It added it will take all necessary measures to protect its reputation. But pressure on Infantino has not disappeared. UEFA is unmoved by this written apology. It says it will continue to push for his removal, with its tactics including further scrutiny of the proposal. Longtime FIFA insider and Portugal legend Luis Figo has also called for Infantino's resignation. But for now, FIFA President Gianni Infantino remains in control of football's governing body.
All right, thank you, Matthew, for that. Let's take a quick look at some trending stories now. Denmark's 19-year-old princess Isabella has joined the military, entering the country's new 11-month conscription program. The princess has chosen to serve without taking a military salary, joining other young Danes in national service. Isabella is the second child of King Frederick to serve in the military after her elder brother, Crown Prince Christian.
I'd like to inform you that the teleprompter has ceased to function. Unlike a certain world leader, I do not view this as a conspiracy.
Right, that was Canadian Prime Minister Mark Carney taking a light-hearted dig at US President Donald Trump after his teleprompter stopped working during a news conference in Toronto. Carney joked about Trump's own teleprompter glitch at the UN last year when the US president called for an investigation after both his teleprompters and an escalator malfunctioned. The remark comes as Carney and Trump remain at odds over trade, with Trump imposing tariffs on Canadian goods and repeatedly reviving his call for Canada to become the 51st US state. 97-year-old Betty Bromwich has broken her own world record, becoming the oldest female wing walker. Bromwich took to the skies for her 6th wing walk just a year after suffering a stroke. She first tried wing walking at 87 and set her first world record at 93. This time, she took on the challenge to raise money for the stroke unit at Cheltenham General Hospital, which treated her. And before we go, let's take a look at a big moment from space. Indian origin NASA astronaut Anil Menon has completed his first ever spacewalk outside the International Space Station. Menon spent more than 6 hours outside the ISS alongside NASA astronaut and Expedition 75 Commander Jessica Meir. The duo carried out critical work on the space station, from upgrading its power system to replacing a communications antenna. And with that, it's a wrap on another edition of The Global Lens. Goodbye and many thanks for watching. We'll be back again tomorrow.
Pawan, congratulations once again, and thank you so much for joining